Welcome back, everyone, to The Deep Dive. Today, we're going to be diving into deferred tax.
Ooh, yeah.
Which is basically recognizing that some transactions today, they have tax consequences down the line.
In the future.
In the future. And I think everyone can relate that taxes can feel like a maze, but we're going to pull out, hopefully, the most essential insights from all the research that you gave us so we can make it clear and even interesting.
Absolutely. The foundation for deferred tax accounting really lies in IAS 12.
Okay.
And at its heart, it's all about temporary differences. So that's the difference between an assets or liabilities carrying amount in the financial statement. So what it's stated at in the books versus its tax base, which is the amount attributed to that asset for tax purposes.
Makes sense. And just to give everyone context, you gave us a ton of material to go through. We had, the actual accounting standards themselves.
Of course.
Regulatory information, and then some more practical guides. So that's what we're going to be pulling from. And yeah, so the whole point of this deep dive is to help you solidify your understanding of the fundamentals of deferred tax, but also explore some of the more complex areas and highlight where you really, need to pay close attention. So why don't we start by, unpacking how we actually calculate deferred tax?
Okay, well, IAS 12 requires a mechanistic approach for calculating deferred tax.
Mechanistic.
So it's a step-by-step process.
Yeah.
The first element is the accounting base. That's the carrying amount of an asset or liability.
Right, so that's just what's in the financial statements.
Exactly.
Okay, so that's easy enough.
Yeah.
But then it's not just about the number on the balance sheet, right?
Right.
We need to consider how that asset is expected to be recovered or how a liability is expected to be settled. So, are we going to use it? Or are we going to sell it? And sometimes the rules even tell us to split the carrying value. If we think we're going to be recovering an asset, partly through using it and partly through selling it. What's so interesting about this is, we have to look ahead. We have to look into the future.
Yeah.
It's almost like we're fortune tellers.
Yeah, exactly. You need to consider the economic reality of how these assets and liabilities are going to affect the business.
Yeah.
Following on from the accounting base, then we need to determine the tax base. This is the amount attributed to an asset or liability for tax purposes.
Okay.
This can be different from the accounting base.
Okay.
So, for example, if you had a loan receivable, the repayment of that loan wouldn't have any tax consequences. So its tax base would be equal to its carrying amount.
Okay, so that makes sense. So then we have our accounting base, we have our tax base.
Yeah.
So then how do we know what tax rate to apply to figure out how much deferred tax is?
That comes down to the principle of substantive enactment for determining what tax rate to use. So this isn't always as simple as a law being formally enacted.
Right.
The IASB has clarified that substantive enactment occurs when the remaining stages in the legislative process are unlikely to affect the outcome. So, for example, in some jurisdictions, substantive enactment might be when the head of state signs a bill into law. But in others, a government announcing new tax rates could be substantively enacted, if all that remains is administrative or ceremonial steps.
So it's as good as done.
Exactly.
If the government announces a tax rate change with a press release with all the details and it's just a rubber stamp from, whoever, then we use that rate, even though it hasn't technically been formally enacted yet.
Exactly. It's as good as law for accounting purposes.
Yeah. Okay. So now we know how to calculate it. But when do we actually have to record it in our financial statements?
Well, generally speaking, IAS 12 says that we should recognize a deferred tax liability for all taxable temporary differences. So this is a temporary difference that will result in us paying more income tax in the future when the asset is recovered or the liability is settled. It's like a future tax bill waiting to happen.
Okay, all sounds pretty definitive.
Yeah.
But I know there are times where we don't recognize it, right?
That's right.
So what are those?
So there are a few exceptions to that. One being the initial recognition of goodwill in a business combination.
Okay.
So the reasoning behind this is tied to how goodwill itself is accounted for. Changes in goodwill aren't tax deductible. So recognizing a deferred tax liability on its initial recognition wouldn't reflect a future tax consequence tied to the company's operations.
Okay, so that makes sense. Then what's the other one?
The other big one is the initial recognition of an asset or liability in a transaction that's not a business combination.
Yeah.
But crucially, only if that transaction affects neither accounting profit nor taxable profit at the time it occurs. And it doesn't create equal taxable and deductible temporary differences. So the principle here, which is highlighted in the standard, is to stop the financial statements from becoming less transparent. by recognizing a deferred tax liability or asset that immediately offsets the initial carrying amount. You'd just be creating a phantom adjustment that has no real impact on the business's performance immediately.
Yeah, so it's like artificial.
Exactly.
Yeah, okay, that makes sense. And then I also remember something about first-time adopters of IFRS.
Yes, so even with that exemption, if you're a company adopting IFRS for the first time, at the date of transition to IFRS, you must recognize deferred tax assets and liabilities.
Oh,
For all temporary differences relating to leases and decommissioning, restoration, and similar liabilities.
okay.
So it kind of overrides that initial recognition exemption in this specific area. It recognizes that these items, leases, and decommissioning liabilities can have a really big financial impact over time.
Okay, interesting. So a specific rule for those folks. Okay, so we've talked about when we recognize a liability, but what about for deductible temporary differences? So the ones that will eventually lead to us paying less tax in the future. Do we recognize an asset for all of those?
Generally, yes, a deferred tax asset is recognized for deductible temporary differences if, and it's a big if it's probable that future taxable profit will be available against which we can use those differences.
Yeah.
So think of it as a future tax deduction to offset against future profits. However, there's a specific rule when it comes to deductible temporary differences related to investments in subsidiaries, branches, and associates. A deferred tax asset is generally recognized.
Right.
But there's an exception if the parent or the investor can control the timing of the reversal of the temporary difference, and it's probable that the difference won't reverse in the foreseeable future.
Okay.
So if you control when that tax benefit arises, and it's a long way off, immediate recognition might not be appropriate.
Makes sense. Okay. So we've covered when we recognize it. So now how do we actually measure it? How do we put a number on it?
Okay, so the measurement is based on the tax rates expected to apply when the asset is realized or the liability is settled. But it's not necessarily today's tax rate.
Right.
We have to look ahead.
Right.
We need to use the tax rate that's been enacted or substantively enacted by the end of the reporting period. It's about anticipating the tax environment when these temporary differences are going to actually play out.
So if a tax rate increase has been substantively enacted, but it isn't in effect yet, we still use that higher rate.
Exactly.
Okay.
And if you've got different tax rates that apply to different levels of taxable income, like in a progressive tax system, you need to use the average rates that you expect to apply in those periods where the temporary differences are going to reverse.
Okay.
So you're just trying to reflect the most likely tax impact based on what you know today.
Right. What about if an asset has been revalued in the financial statements? So like property, plant, and equipment. Does that affect how we measure deferred tax?
Yes, it can. So for non-depreciable assets revalued upwards under IAS 16, the standard specifically says that deferred tax should be based on the tax consequences of recovering the carrying amount through sale,
Okay.
regardless of how you're measuring it in the financial statements. So even if you're using a valuation based on the asset's use in the business, the tax impact is considered from a sale perspective.
Okay.
For deferred tax purposes. It's one example of how tax rules and accounting rules can view things a little bit differently.
Right. And then what about investment property measured at fair value?
So for investment property measured at fair value under IAS 40, there's a rebuttable presumption that the property will be recovered entirely through sale. So you'd measure the deferred tax based on the tax consequences of selling the property. However, this presumption can be rebutted for depreciable buildings if your business model is about consuming the economic benefits over time rather than through sale, for example, renting it out. But interestingly, for land classified as investment property, that presumption of recovery through sale is non-rebuttable
Okay.
because land's non-depreciable, and it's pretty much always going to be recovered through a sale at some point.
Makes sense. Okay, so let's look at some specific scenarios.
Sure.
So for example, like business combinations. How does deferred tax play into that?
So in a business combination, any deferred tax liability or asset that is recognized as part of the acquisition directly impacts the calculation of goodwill
Okay.
or any bargain purchase gain
Okay.
that you record. So you're factoring those future tax impacts into the overall valuation of the business you've just acquired, recognizing those future tax impacts as part of that acquisition.
Yeah. What about those like share-based payments, like equity-settled share-based payments?
Ooh, that's a tricky one.
They always seem to have their own special rules.
They do. So the guidance, and this is illustrated in your sources in example 13, is that you recognize a deferred tax credit based on the intrinsic value of the share options that are expected to be exercised.
Right.
But what's interesting here is that this tax credit isn't always recognized entirely in profit or loss.
Okay.
So a portion of it, specifically the amount relating to the excess of the expected tax deduction over the cumulative accounting expense that's been recognized up to that point, is recognized directly in equity.
Okay.
So it
Yeah.
reflects the fact that it's an equity transaction.
Right, right. So it makes sense. What about like when we have consolidated financial statements? So when you have a group of companies.
So in consolidated accounts, IAS 12 says we have to recognize deferred tax on all unrealized intragroup profits.
Oh.
So if one company in a group sells inventory to another company in the group, and that inventory hasn't been sold on to an external party by the year end,
Yeah.
the profit on that internal sale is eliminated when you prepare the consolidated financial statements.
Right.
But then you need to account for deferred tax on the difference between the carrying amount of that inventory after eliminating the intragroup profit and its tax base in the hands of the purchasing company. This stops the group from recognizing a tax benefit on a profit that hasn't actually been realized outside the group.
Right, right. So you're not realizing or recognizing, I should say, the tax benefit too early.
Exactly.
Yeah. Okay. So what about goodwill impairment? Does deferred tax come into play there at all?
It can do in a specific way. So when you're performing an impairment test on a cash generating unit, or CGU, that includes goodwill. The recoverable amount is often determined on a post-tax basis. So a deferred tax liability that was recognized as part of the original business combination that created the goodwill might be included in the net assets of that CGU for this impairment test.
Okay.
However, it's important to note that other deferred tax assets and liabilities that arose from that business combination, other than those directly related to the fair value less cost to sell calculation, are excluded. So it's quite a focused inclusion there.
Okay. So it's a very specific instance of where deferred tax is included.
Yes.
Now, I also noticed like some recent changes related to leases and decommissioning liabilities.
Yeah, so there have been amendments that kind of narrow the scope of that initial recognition exemption we talked about.
Okay.
So it no longer applies to transactions that, on initial recognition, give rise to equal taxable and deductible temporary differences.
Okay.
This change was specifically aimed at transactions like leases under IFRS 16 and decommissioning obligations, making sure that the deferred tax implications of these transactions are considered right from the get-go.
Right.
It brings a bit more consistency to the accounting for those economically significant items.
Yeah. And then there's the whole international tax reform thing.
Yes.
Pillar 2 rules.
Pillar 2, that's a big topic at the moment.
Yeah.
So the amendments to IAS 12 provide a temporary exception, specifically for Pillar 2 income taxes.
Okay.
So entities aren't currently required to recognize or disclose information about deferred tax assets and liabilities arising from Pillar 2 rules.
Okay.
However, you do still need to disclose the current tax expense or income related to Pillar 2. And for periods where Pillar 2 legislation has been enacted or substantively enacted but hasn't yet come into effect, you need to disclose known or reasonably estimable information to help users understand the entity's exposure to those new rules. If you can't get that information, you just disclose that fact and update on the progress of your assessment. So this is all about recognizing that these reforms are really complex and they're still developing.
Yeah, it's kind of like a temporary pause on the deferred tax side.
Exactly, yeah.
Okay, so now let's talk about how we present all this stuff in the financial statements.
Okay, so IAS 12 is really prescriptive about how we present deferred tax.
Okay.
So firstly, the major components of the total tax expense or income for the period need to be disclosed separately. So that includes current tax expense, adjustments for prior periods, deferred tax expense arising from temporary differences, the effects of changes in tax rates and laws, and any tax benefits from previously unrecognized tax losses or tax credits.
Okay.
So a lot of detail there, giving users a lot of insight into what's affecting the tax position.
Right. And then for the deferred tax balances on the balance sheet, what are the rules there?
So for the deferred tax balance, you need to disclose the amount of deferred tax assets and liabilities that have been recognized for each type of temporary difference, as well as the amounts relating to any unused tax losses and unused tax credits. And this is for each period presented in the financial statements. If the deferred tax income or expense isn't readily apparent from the changes in these balances, you also need to specifically disclose that.
Okay, and then what about if a company has some discontinued operations?
Right.
Are there any specific disclosures there related to deferred tax?
Yeah, for discontinued operations, IAS 12 says you have to disclose the tax expense relating to both the gain or loss on the disposal of the discontinued operation and the profit or loss from the ordinary activities of that discontinued operation for the current period. And you need to show comparative figures for prior periods as well,
Okay.
so users can see the tax impact that specifically relates to that discontinued part of the business.
Right. And so when are companies actually allowed to offset deferred tax assets and liabilities?
Offsetting is permitted, but only if two conditions are met. Firstly, the entity needs to have a legally enforceable right to offset current tax assets against current tax liability.
Right.
And secondly, the deferred tax assets and liabilities must relate to income taxes levied by the same taxation authority. And they need to relate to either the same taxable entity or different taxable entities that intend to settle their current tax balances on a net basis or realize the asset and settle the liability simultaneously.
So not just the same tax authority, but also how they're going to settle those obligations.
Exactly.
Yeah. And then there was one last disclosure I remember about the potential tax consequences of dividend payments.
That's right. So you need to disclose the nature of the potential income tax consequences from paying dividends. This should include a description of the tax systems involved and the factors that will affect the amount of any potential tax impact. If you can't reasonably calculate the total potential impact, you should just say that
Okay.
and disclose any amounts that you can readily determine.
Okay. And finally, if the realization of a deferred tax asset depends on the company making profits in the future, are there any extra disclosures required?
Yes. In that situation, you must disclose the amount of the deferred tax asset that's been recognized and the nature of the evidence that supports that recognition,
Okay.
so that the users of the financial statements can assess how likely it is that that asset will actually be realized.
Okay, so wow, this deep dive has really given us a good structured overview of deferred tax accounting under IAS 12. We've gone through the basics, some of the more complex areas, and the presentation and disclosure requirements.
Yeah, and really understanding those temporary differences and how assets will be recovered is so important to getting that deferred tax calculation right. And like we said, remembering those specific scenarios like business combinations, share-based payments, and intergroup profits is key.
Yeah, and the accounting standards, they don't just sit still, right?
Yeah,
We've seen how they evolve with those recent amendments and temporary exceptions to leases and, international tax reforms.
absolutely. While this deep dive has given you a good understanding, remember that the specifics of how deferred tax is applied can really depend on the facts and circumstances of each business. So further analysis might be needed, depending on your specific situation.
So here's a final thought for everyone listening. How does this entire concept of deferred tax reflect the time value of money and the idea that expenses should be matched with the revenue they generate? Even when those things happen in different accounting periods and even across different tax jurisdictions, it's like the crossroads of financial reporting and tax law.
It is, yeah.
Well, thanks for joining us for this deep dive,
My pleasure.
and we'll catch you next time.
See you then.
Welcome to the deep dive. Today we're tackling related party disclosures. Now that might not sound, like the most thrilling topic, but stick with us because understanding these disclosures is absolutely key to truly grasping what's going on beneath the surface of a company's financial reports.
That's right. Think of it as getting a look at the connections a company has with its inner circle, its parent company, its subsidiaries, the folks at the top, and even their close families. These connections can lead to deals and arrangements that wouldn't necessarily happen with unrelated businesses.
Exactly, and that's where these disclosures come in. For this deep dive, we've pulled together a really interesting set of sources tailored just for you. We're looking at accounting rules from different parts of the world, IAS 24, which is an international accounting standard, then the Australian Accounting Standards Board's version, AASB 124, and New Zealand's take with NZIAS 24.
Yeah, and plus we've got some sharp analysis from the CFA Institute, especially focusing on how related party transactions play out in Asia and even some regulatory viewpoints. So we're getting a really, well-rounded picture.
Our goal today is basically to make sense of all this without getting lost in accounting jargon. We want you to understand why these disclosures matter, what kind of potential problems they can highlight, and what safeguards are supposed to be in place to protect investors.
Okay, let's unpack this. First things first. What exactly are we talking about when we say related parties and related party transactions?
A good starting point.
Well, according to IAS 24, that international accounting rule we mentioned, a related party is essentially a person or entity that is connected to the company that's preparing its financial statements. Now, this connection can take Several forms.
Can you give us some examples of who could be considered a related party? Like who falls into that bucket?
Sure. The most obvious examples are a parent company and its subsidiaries. But it also includes what are called fellow subsidiaries. These are companies that share the same parent. Then you have associates and joint ventures.
Okay.
Think of companies where your main company has a strong say in decisions. That's what's meant by significant influence. Or where it jointly makes decisions with another company. That's joint control. And crucially, it also includes key management personnel. These are the people who have the authority and responsibility for, running the company.
Right, the top brass.
And it doesn't start there.
So it's not just the CEOs and top executives then?
That's right. It extends to close members of their families as well. IAS 24 clarifies that this generally includes children, spouses, or domestic partners and dependents. The key idea here is the potential for influence.
Okay.
Could this family member influence or be influenced by the key manager in their dealings with the company? It really comes down to looking at the level of potential sway in each situation.
Okay, so it's not just about legal structures or job titles, but also these personal connections and the possibility of one person's actions being influenced by another. That makes sense. Now, what about the transactions themselves? What counts as a related party transaction?
Right. A related party transaction is any transfer of resources, services, or obligations between these related parties. And this is a really important point. It doesn't matter if money actually changes hands or not.
Really? Even if nothing's paid?
Yeah. Even something like a free service provided to a related party is considered a related party transaction.
That makes sense. So it's much broader than just buying and selling goods.
Absolutely. The accounting standards, like IAS 24 and the CFA Institute report, give us a good list of examples. This can include buying or selling goods or property, providing or receiving services like accounting or consulting, leases, loans, guarantees where one party backs the debt of another.
Guarantees, okay.
And even things like transferring research and development or licensing agreements. Pretty broad.
Wow, that covers a lot. Even something like a parent company guaranteeing a loan for its subsidiary would be a related party transaction.
Exactly. And as the Australian standard AASB 1-124 points out, even if there are no actual transactions, just the existence of a related party relationship can affect a company's profit and loss and its overall financial situation.
How can that be if no money is being exchanged? That seems counterintuitive.
Well, think about it like this. A subsidiary might decide to end a perfectly good business relationship with another company simply because its parent company bought a competitor of that other company. No transaction occurred between the subsidiary and its parent regarding this, but the parent's action directly impacted the subsidiary's business.
Ah, I see. So it's indirect influence.
Precisely. Or a parent company could tell its subsidiary not to pursue a promising research project because it clashes with the parent's own plans. Again, the relationship influences decisions, even without a direct transaction between them.
Okay, that really highlights that it's not just about the specific transactions, but the broader influence these relationships can have on a company's operations. So with all this in mind, why are these related party disclosures actually necessary? Why should an investor, like, someone listening, care about them?
Here's where it gets really interesting. The core reason these disclosures are so important is that related parties might enter into transactions that completely unrelated parties simply wouldn't consider. Or they might agree to terms that are very different from what you'd see in an open market deal.
Like preferential treatment.
Exactly. For example, as IAS 24 mentions, a company might sell goods to its parent company at just the cost to produce them, something it would almost certainly never do for a regular independent customer.
Right. It's not a level playing field when you're dealing with related parties, is it?
No, not at all. This creates a significant potential for conflicts of interest when insiders are dealing with each other, as the CFA Institute report really emphasizes. While related party transactions can have legitimate business reasons, things like internal reorganizations or sharing services efficiently, they can also be used, particularly in regions where a few people or families control many businesses, like in parts of Asia, as a way for those dominant shareholders to essentially move wealth away from the smaller minority investors.
That sounds pretty concerning. Can you give us a clear picture of how that might happen? Like, what are the actual mechanisms?
Sure. The CFA Institute report shares some really telling cautionary tales. Imagine a publicly listed company buying an asset from a private company that's owned by the same controlling shareholder, but at a price that's far higher than what that asset is actually worth.
Yep.
Yeah. That's a direct transfer of value from the public company and its shareholders to the private company and the controlling shareholder. It's like the company is overpaying itself using shareholder money, directly impacting shareholder value by potentially diluting earnings per share and, reducing the value of the company's assets.
So it's a direct hit to the investors.
Right. Or consider a company providing loans or guarantees to a struggling related company. If that related company can't repay, the healthy company and its investors are the ones who suffer the loss. At its worst, these transactions can even be used to hide outright fraud.
Wow. The CFA Institute report also touched on the Asian financial crisis of 1997. How did related party transactions contribute to that whole mess?
Yes, that crisis really highlighted the dangers. Many businesses in Asia were controlled by families who often pursued rapid expansion using a lot of borrowed money, and these borrowings and investments often flowed within their own network of related companies.
Kind of keeping it all in the family, financially speaking.
Sort of, yeah. But when the value of their currencies dropped sharply, these heavily indebted companies couldn't repay their loans. Because so many of these companies were interconnected through lending and guarantees within the related party network, the failure of one could quickly spread to others, a real domino effect.
A systemic risk, then.
Absolutely.
Mm.
Minority shareholders often saw the companies they invested in engaging in questionable cash transfers, taking on each other's debts and buying assets from each other at inflated prices in a desperate attempt to stay afloat, leaving little for the outside investors. This really demonstrated how interconnectedness through related party dealings can create systemic risk, where the failure of one entity can quickly cascade.
The report even mentioned some specific historical examples, didn't it? Like the Sinar Mas Group and the Rebar Group. Those sounded pretty bad.
Yes, those are really clear examples of how problematic related party transactions can lead to major corporate collapses. In Indonesia, one of the listed banks within the Sinar Mas Group failed under the weight of huge loans it had made to its own subsidiaries. And in Taiwan, the Rebar Group saw two of its listed companies go bankrupt after the main shareholder allegedly moved billions of dollars through related entities. These aren't just theoretical risks. They've had very real and damaging consequences for investors.
So the disclosures are really about bringing these potential risks and conflicts of interest into the open, risks that you wouldn't necessarily see just by looking at the company's dealings with independent parties.
Okay.
Now, if a company does have these related party relationships and transactions, what specific information do they actually need to disclose? What are the rules around that?
According to IAS 24, the main idea is that companies have to disclose the nature of their related party relationships and give enough information about their transactions and outstanding balances, including any commitments they've made, so that anyone looking at the financial statements can understand how these relationships might be affecting the company's financial position and performance.
Okay, so it's not just a simple yes or no question of whether they have related parties. They need to provide details. What kind of details are we talking about? Like, how granular does it get?
At a minimum, they need to disclose the total amount of the transactions, any balances owed between the related parties at the end of the reporting period, and the terms and conditions associated with those balances.
Terms and conditions, too.
Yes. So, for example, if a company has made a loan to a related party, the disclosure should probably mention the interest rate, when it's due to be repaid, and whether any assets have been pledged as security. The important stuff.
What about those key management personnel we talked about earlier? Is their pay part of these disclosures? That seems like sensitive info.
Absolutely. IAS 24 specifically requires companies to disclose the compensation paid to those in key management roles, both the total amount and how it breaks down into different categories.
Categories like what?
This includes things like their base salaries, bonuses, retirement benefits, any long-term incentives, payments they receive if their employment ends, severance packages, and even things like stock options or shares they might have been granted. This kind of transparency is really important for investors to judge whether the executives are being paid fairly, in relation to the company's performance and the interests of the shareholders.
Right. We also saw that the Australian accounting standard, AASB 124, initially had a specific exemption for not-for-profit public sector entities. What was the thinking behind that? It seems odd.
Yeah, initially AASB 124 did have an exemption for these types of organizations. It was largely due to practical concerns about the sheer volume and complexity of transactions that can occur within government and between different government-controlled entities. It could be a huge burden.
I can imagine.
However, it's important to know that this blanket exemption is no longer in place for the general-purpose financial statements of these entities. There was a growing recognition that providing relevant information about related party dealings, especially concerning the compensation of key management personnel, is a crucial aspect of public sector accountability.
Okay, so that changed. What about government-related entities more broadly? IAS 24 seems to have some specific things to consider for them, right?
That's right, because government-related entities often have a huge number of relationships with other government entities, ministries, departments, other state-owned companies. IAS 24 acknowledges this and provides a partial break, a sort of relief, from the full disclosure rules in paragraph 18.
A break? How so?
Well, if a company is controlled, jointly controlled, or significantly influenced by a government, it doesn't have to disclose every single transaction it has with other entities that are also under the control of the same government.
That sounds like it could potentially hide a lot of information, though. What are the conditions for that exemption? Are there guardrails?
There are still important disclosure requirements, even if they use this exemption. They absolutely must disclose the name of the government that controls, jointly controls, or significantly influences them, and they have to describe the nature of that relationship.
Okay, that's something.
Crucially, they also have to provide enough information about their transactions and any outstanding balances with other government-related entities so that users can still understand the overall impact on their financial statements. This includes disclosing the details and amounts of any individual transaction that is significant on its own.
Right, the big ones.
And also giving a general idea, either in words or numbers, of the total extent of other transactions that might not be significant individually, but are important when you add them all up. Collectively significant, they call it.
So even with this break, the really big and important stuff still needs to be visible. They can't just sweep everything under the rug.
Exactly. And as both IAS 24 and guidance from organizations like Audit Scotland emphasize, the concept of materiality is always key in deciding how much detail needs to be disclosed. Small, unimportant transactions don't need pages of explanation, but anything that could reasonably influence the decisions of people using the financial statements needs to be clearly presented.
Makes sense. Materiality is always a factor.
And one more point on disclosure. It's worth remembering that if a company claims that a related party transaction was conducted on arm's-length terms, meaning it was priced as if it were with an independent party, they can only say that if they actually have evidence to back that up. They can't just make the claim without proof.
Right, they need to substantiate it. Okay, so we've got a handle on what related parties and transactions are, why we need to know about them, and what information has to be disclosed. Now, let's talk about how investors are actually protected from potentially dodgy related party deals. What safeguards are in place?
Okay, yeah. There are several layers of protection designed to address this, as the CFA Institute report outlines pretty well. The first, and most fundamental, is simply the existence of accounting standards like IAS 24 that mandate these disclosures. At the very least, this shines a light on these transactions. Transparency is the first step.
But just knowing about them isn't enough to stop abuse, is it? Like, seeing it doesn't prevent it.
You're absolutely right. That's where the second layer comes in. The rules set by stock exchanges for companies that are listed on them. These listing rules often have specific thresholds for related party transactions.
Thresholds, based on size.
Exactly, based on financial size relative to the company. And if a transaction exceeds these thresholds, the company might be required to get approval from its shareholders. Importantly, related parties themselves are often not allowed to vote on these approvals.
Ah, so the conflicted parties can't vote in their own favor.
Precisely. For example, the CFA Institute report mentions that in Hong Kong and China, if a related party transaction exceeds certain financial benchmarks, it triggers the need for a shareholder vote, with the related parties having to abstain.
So the smaller shareholders, the minority investors, get a say on the really big deals that could potentially benefit the insiders.
In theory, yes. That's the idea. The third layer of protection is the crucial role played by independent directors and the audit committee. These individuals are supposed to review related party transactions to make sure they are fair to all shareholders, not just the controlling ones.
The independent oversight?
Yes. In many places, including across Asia, regulations require listed companies to have a minimum number of directors who are independent and an audit committee made up of mostly or entirely independent members.
And what about inside the companies themselves? Are there any internal checks and balances they're supposed to have?
Absolutely. The fourth layer involves the company's own internal corporate governance systems. This can include things like keeping a record or a register of all related party transactions. Sometimes these registers are even open for shareholders to inspect, which is interesting.
Didn't know that.
And having specific committees within the company, maybe separate from the audit committee, that are responsible for reviewing these kinds of deals before they happen.
And if all these safeguards fail, the disclosures, the listing rules, the independent directors, the internal controls, do investors have any way to seek justice? Any recourse?
Yes, the fifth layer is the possibility of shareholders taking legal action. If minority shareholders believe that the company's directors have acted improperly, including through unfair related party transactions, they can sometimes go to court to seek remedies, like damages.
Like a lawsuit.
It's exactly. However, as the CFA Institute report points out, actually succeeding with these kinds of lawsuits can be difficult. There are legal complexities, it costs a lot of money, it takes a lot of time, all of which can sometimes discourage shareholders from actually pursuing them, even if they feel wronged.
Right. It sounds like there are quite a few protections in place on paper, but the CFA Institute report also points out some challenges in making them truly effective in practice. What are some of the main obstacles?
Yeah, there are definite challenges. One big one is simply identifying all the related parties, especially in complex business structures that might involve numerous private companies, maybe offshore entities. It can get murky.
Hard to follow the trail sometimes.
Very. Auditors often have to rely heavily on the company's management to disclose these relationships. And if there's a deliberate attempt to hide a questionable transaction, well, that disclosure might not happen.
So reliance on management honesty is a weak point.
It can be. Another issue is the possibility of rubber stamp independent directors. These are individuals who might be technically independent according to the rules, but in reality are too closely tied to or influenced by the controlling shareholders, maybe due to past connections, friendships, or other loyalties. They might not push back hard enough.
Just nodding things through. The report also mentioned that in some Asian markets, just looking at the regular financial reports, like the annual or semi-annual ones, might not be enough to catch these issues early on. Why is that?
That's a really important practical point. Unlike in some other regions like the U.S., where companies report quarterly financial statements pretty comprehensively, including related party disclosures, in some Asian markets, the regular interim reports, the ones between the big annual reports, can be quite brief, sometimes just summarize figures.
Less detail.
Much less detail. So investors often need to be more proactive and look at other filings with the regulatory authorities and announcements made by the listed companies on the stock exchange websites to get more timely information about significant related party deals as they happen, rather than waiting months for the next full report.
So more legwork required for investors in those markets. Okay. What are some of the things that are being done or recommended to improve transparency and regulation in this area, particularly in Asia, where the CFA report focused?
Well, the CFA Institute makes several recommendations for improvement. These include setting clearer and more specific rules, maybe bright line tests for what level or percentage of related party transactions requires disclosure and shareholder approval, making it less ambiguous.
More objective thresholds.
Yes. Also, requiring independent financial advisors to provide valuations for significant related party deals to ensure they're fair from a financial perspective. Get a third-party opinion on the price.
That seems sensible.
And working to increase both the number and the genuine independence of company directors. Maybe stricter definitions of independence or longer cooling off periods. There's also a push for companies to be more transparent about their related party relationships overall, perhaps even voluntarily disclosing the identities and ownership structures of their key related parties and their subsidiaries, even if not strictly required, just better maps of the corporate group.
Interesting. We also touched briefly on the situation in Bangladesh with the mention of the SEC, ICB, and DSE. What's happening there specifically?
Yeah, the analysis we looked at, focusing on how IAS 24 is applied in Bangladesh, showed that, particularly among insurance companies, many aren't doing a great job of following the standard. Compliance was patchy.
Really?
It could be a mix of reasons, maybe lack of expertise, maybe weak enforcement. Regulatory bodies like the Securities and Exchange Commission, SEC, the Institute of Chartered Accountants of Bangladesh, ICAB, and the Dhaka Stock Exchange, DSE, clearly have a crucial role to play in making sure companies comply. But the research suggests that there's a need for stronger enforcement of the existing rules and possibly more specific guidelines tailored to the local context for a related party disclosure to really raise the bar for financial reporting quality there.
So the rules might be there, but the follow-through needs work.
Seems like it, yeah.
And finally, we saw that the Reserve Bank of India's guidelines for non-banking financial companies, the NBFCs in India, also reflect a growing focus on these disclosures, right?
Yes, absolutely. The RBI has been increasingly emphasizing the need for these financial institutions, which are really important in India's economy, to provide more comprehensive disclosures of their related party transactions in their financial statements. It's about bringing them more in line with the accounting standards and the regulations that already apply to listed companies. This really indicates a wider global trend towards greater scrutiny and transparency in this area. It's not just an Asian issue.
Right, a tightening up everywhere. Okay, wow, we covered a lot today. To sum up then, related party disclosures are really about understanding the network of connections a company has and how those connections could be influencing its financial dealings, for good or ill.
Exactly. They're vital for identifying potential conflicts of interest and helping to ensure that controlling shareholders aren't unfairly benefiting at the expense of other investors, the minority shareholders.
And while we have regulations and accounting standards like IAS 24 aimed at providing transparency and protecting investors, the risk of abuse is still definitely there, particularly in certain types of ownership structures like family-controlled groups and perhaps more prevalent or harder to spot in some regions.
Absolutely. And as we've discussed, these disclosures aren't just some technical accounting requirement you tick off a list. They can provide really important clues about a company's financial health, its governance quality, and maybe even the trustworthiness of its management.
Yeah, those historical examples of corporate failures linked to dodgy related party transactions, Sinar Mas, Rebar Group, they really serve as a stark reminder of just how critical these disclosures can be, don't they?
They really do. Big warning signs.
So considering all this complexity and the potential for hidden influence, here's something for you, our listener, to think about. For an individual investor who might not be an expert in accounting, how can they really use related party disclosures effectively to make informed decisions about where to put their money? It's not always straightforward.
That's the key question, isn't it?
And maybe what additional steps could regulators realistically take to make this information more valuable and, crucially, easier to understand and digest for the average investor? Because just dumping data isn't always helpful. It definitely makes sense, though, to take a closer look at those company financial statements and regulatory filings with a more critical eye, specifically looking for these related party sections.
Absolutely. Dig a little deeper. And on that note, we wrap up this deep dive. Thanks for joining us. Okay, so this time you've given us quite a bit to dig into when it comes to how companies report their financials.
Absolutely.
Especially when we're talking about groups of companies.
Right.
We've got IAS 27, which is all about a company's separate financial statements. Then we have IFRS 10, which dives into the whole world of consolidated financial statements.
Yep.
And then just to make things even more interesting, we've got this case study ebook called Pass FFR Case Studies.
Oh, yeah, that's a good one.
Which looks like it's got tons of real-world examples.
It does. It does.
And then to top it all off, we've got this discussion paper that really gets into some of the trickier parts of separate financial statements.
Yeah, some of the finer points, for sure.
So basically, we're going deep into how and when companies have to combine their financials and all the little details that go along with that.
Exactly. And the goal here is to really distill the key takeaways from all of these sources without, overwhelming anyone.
Yeah, because there's a lot here.
Yeah.
So I think one of the things that I'm finding most interesting is this idea that a company can actually have control over another company even if they don't own most of the shares.
Oh, yeah, that's a big one.
Like, how does that even work?
It's more common than you might think.
And then the other thing that kind of blew my mind is how the exact same transaction can be accounted for in totally different ways.
Oh, yeah.
Depending on whether you're looking at the consolidated statements for the whole group or the individual company's own statements.
Right, because the perspective changes.
Yeah, so what are the implications of that for actually understanding a company's financial picture?
Yeah, that's a really important point.
So, okay, let's start with the basics.
Okay.
What exactly are consolidated financial statements?
Okay, so consolidated financial statements are basically like a snapshot of the financial performance and position of a whole group of companies. It's like taking a parent company and all of its subsidiaries and treating them like one big economic unit. It's kind of like, if you were looking at the finances of a whole family instead of each individual person in the family.
Yeah, like the whole household budget versus my personal spending.
Exactly, exactly.
Okay, so we keep hearing about this parent company and its subsidiaries.
Right.
So what exactly defines those?
So according to both IFRS 10 and IAS 27,
Yeah.
a parent company is basically any entity that controls one or more other entities.
Okay.
And those other entities are its subsidiaries.
Gotcha.
Now, what's really interesting is that these subsidiaries can be in totally different businesses.
Really?
Yeah, like you could have a parent company that's like a manufacturing company,
Mm-hmm.
but one of its subsidiaries could be a retail company that sells the products that the parent makes.
Okay.
But they're all brought together in the consolidated financial statements.
Interesting. So even though they might have totally different operations,
Right.
they're all considered as one for financial reporting purposes.
Exactly.
Okay, so then what about this term that keeps popping up, non-controlling interest?
Yes, non-controlling interest. So that basically refers to the part of a subsidiary's ownership that isn't owned by the parent company.
Okay.
So let's say a parent company owns 80% of a subsidiary.
Mm-hmm.
Well, that other 20%, that's the non-controlling interest.
Okay.
And it has to be shown separately in the consolidated statements
Why is that?
because it represents the ownership stake of other people who aren't part of the parent company.
Right, like other investors or something?
Exactly. Other investors or maybe even like the original founders of that subsidiary who
Yeah.
held on to some shares.
That makes sense.
Yeah.
So we're kind of taking all these separate pieces
Yeah.
and smushing them together into one.
Mm-hmm.
But how do we decide which companies need to be consolidated in the first place?
That's a great question. And that's where the control model comes in.
Okay.
It's this really important concept in IFRS 10
Okay.
that helps us determine if an investor has to consolidate an investee.
So it's not just about ownership then?
Not necessarily,
Oh.
no.
Okay.
There are actually 3 key elements that all need to be present for consolidation to be required.
Okay, hit me with those 3 elements.
All right, so first, the investor has to have power over the investee.
Okay.
Second, the investor has to be exposed to or have rights to variable returns from their involvement with the investee.
Okay, so they have to have some skin in the game, basically.
Exactly. They need to benefit or be hurt by how the investee performs.
Got it. What's the third one?
And third, the investor has to be able to use their power to actually affect the amount of those returns.
Okay, so it's not just about having power in theory.
Right.
It's about being able to actually use that power.
Exactly. It's about having influence over the things that really drive the investee's performance.
Okay, so let's dig into that first element a little more.
Okay.
This whole power over the investee thing.
Yeah.
What exactly does that mean?
So power in this context means having the ability to direct the relevant activities of the investee.
Yeah, relevant activities.
Right. So according to IFRS 10, those are the activities that significantly affect the investee's returns.
Okay, so we're not talking about like every single decision the company makes?
No. It's more about the big decisions.
Right.
The ones that really drive the investee's profits or losses.
Got it.
It's like having the ability to decide what the key players in that company do.
Okay, so it's about having control over the things that really matter.
Exactly.
Okay, and IFRS 10 gives us a really interesting example of this whole concept
It does.
with this investment fund.
Yeah, the investment fund example.
Could you walk us through that?
Yeah, absolutely. So imagine you have this investment fund that's financed partly by debt from one investor
Mm-hmm.
and partly by equity from several other investors.
Okay.
Now, one of those equity investors also happens to be the asset manager for the fund.
Okay, so they're wearing 2 hats.
Exactly. They're both an investor, and they're managing the fund's investments.
Got it.
And let's say they hold like 30% of the equity.
Okay.
Now, the question is, who actually controls this fund?
Right, because we've got the debt investor, we've got the equity investors, and then we've got this one investor who's also the asset manager.
Exactly. So to figure that out, we have to look at what the relevant activity is.
And in this case, what would that be?
In this case, it's managing the investment portfolio.
Okay, makes sense.
Because that's the activity that exposes the fund to market risk and ultimately determines its returns.
Right, like if they pick bad investments, the fund's going to lose money.
Exactly.
So who has the power to direct that activity?
Well, it could be the asset manager because they're the ones with the expertise,
Uh-huh.
but it could also be the debt investor if certain conditions are met.
Like what kind of conditions?
Well, like if the value of the investments drops significantly,
Okay.
the debt investor might have the right to step in and take over.
So even though they don't directly manage the investments,
Right.
they could still have control in certain situations.
Exactly.
Wow, this is way more complicated than just looking at who owns the most shares.
It's really about understanding the power dynamics within the investee.
Yeah. And like you said, sometimes a seemingly small stake can actually give an investor a lot of influence.
Absolutely.
Okay, so IFRS 10 also talks about these things called structured entities.
Right.
Can you explain what those are?
So structured entities are basically entities that are set up with very specific legal and financial structures.
Okay.
Often they're designed to achieve a particular purpose, like isolating certain assets or liabilities.
Got it.
Now, you might think that because of their very structured nature, they don't really have any relevant activities, like they just kind of operate on autopilot. But IFRS 10 points out that that's rarely the case.
Oh, really?
Yeah, in reality, very few structured entities truly have no relevant activities at all.
So there are almost always decisions being made that affect their returns.
Almost always, yeah.
Okay. So even if a structured entity seems like it's just running on its own,
Right.
someone still probably has control over it?
Most likely, yes. And if there genuinely are no relevant activities,
Okay.
then no single investor would have control.
And what would happen in that situation?
Well, then consolidation wouldn't be required.
Even if that investor was the one who created the entity.
Even then, yeah.
Wow. Okay, so we've talked about how control isn't just about ownership.
Right.
But you also mentioned earlier that control can exist even without majority ownership.
Exactly.
Like even if you own less than 50% of the shares.
Yeah.
So how does that work?
That's where this concept of de facto control comes into play.
Okay, de facto control sounds kind of ominous.
It kind of is. It basically means that you have the practical ability to direct the relevant activities of an investee, even if you don't hold a majority of the voting rights.
Okay, so it's like having control in practice,
Ex
even if you don't have control on paper.
Precisely. And IFRS 10 gives us some really great examples to illustrate this.
Okay, I'm all ears.
Okay, so example 5 talks about this scenario where investor A owns 40% of the voting rights in a company. Now, there are 12 other investors, each holding only 5%.
Okay, so investor A is the biggest shareholder, but they still don't have a majority.
Right. But here's the catch.
What's that?
There's a shareholder agreement in place that gives investor A the right to appoint, remove, and set the compensation for the entire management team.
Oh, wow, so they control who's running the company.
Exactly. And since a management team is responsible for directing the relevant activities, investor A is considered to have control.
Even though they don't own most of the shares.
Even though, yeah, it's all about that power to direct the key decisions.
That's pretty wild.
It is, isn't it? And what's even more interesting is that it doesn't matter if they actually exercise that right or not.
Really?
Yeah, just having the potential to do so is enough to establish control.
Okay, so that contractual power over management can be more important than the actual number of shares you own.
Absolutely.
Okay, so what's another example of de facto control?
Okay, so example 8 paints a slightly different picture. In this scenario, you have an investor who holds 35% of the voting rights.
Okay.
There are 3 other shareholders who have 5% each,
Okay.
and the remaining 50% is spread out among a whole bunch of small shareholders.
So it's a pretty fragmented ownership structure.
Very much so.
Okay.
And importantly, there are no agreements among these smaller shareholders to act together.
Right, so they're all acting independently.
Exactly.
Yeah. Okay.
Now, decisions about the relevant activities require a majority vote, and historically, around 75% of the voting rights have been cast at shareholder meetings.
Okay.
So in this case, even though our investor has a sizable chunk of the shares, they don't actually have the practical ability to direct the relevant activities.
Why not?
Because those other shareholders are actively participating and voting independently.
Oh, I see. So even though the investors' votes might have lined up with a majority in the past,
Right.
there's no guarantee that that will always be the case.
Exactly. And that lack of predictability means they don't have de facto control.
Okay, so it's not just about the potential for control.
Yeah.
It's about the real-world dynamics of how the shareholders actually behave.
Precisely.
Gotcha.
So the key takeaway here is that de facto control is all about that practical ability to direct relevant activities, and that can come from things like contractual rights or the way other shareholders are dispersed.
Okay, that makes sense.
Yeah.
Now, you also mentioned this thing called potential voting rights earlier.
Yes, potential voting rights.
When do those come into play when we're trying to figure out who controls a company?
So potential voting rights are things like options to acquire shares.
Okay.
Or convertible instruments.
Got it.
Basically, anything that could give an investor more voting power in the future.
Okay.
Now, these potential voting rights are only considered in the control assessment if they are substantive.
Okay, substantive. What does that mean?
It means that the investor has the current practical ability to exercise those rights
Okay.
when decisions about the relevant activities are being made.
So it's not just about having the right in theory.
Right.
It's about being able to actually use it.
Exactly.
Right.
Like if an investor has an option to buy a bunch of shares, but the exercise price is so high that it's basically impossible for them to do so,
Yeah.
then those potential voting rights wouldn't really matter.
Right, because they can't realistically exercise them.
Exactly.
Okay, this whole control thing is definitely more complex than I initially thought.
Oh, it can be very nuanced.
So we've talked about when a company might need to consolidate another company.
Right.
But are there any situations where they don't have to do that?
Yeah, actually, IAS 27 outlines a few specific exceptions where a parent company isn't required to present consolidated financial statements.
Okay, so under what circumstances could a company get a pass on consolidating?
Well, one exception is if the parent company's debt or equity instruments aren't publicly traded.
Okay.
Another is if the parent hasn't filed its financial reports with a regulatory body to issue securities publicly.
Got it.
And another exception is if the ultimate parent company,
Or any intermediate parent company
Mm-hmm.
does produce consolidated statements,
Okay.
and those statements are publicly available.
So basically, if a smaller private company is part of a bigger group,
Right.
and that bigger group is already consolidating everything,
Exactly.
then the smaller company might not have to do it themselves.
Yeah, that's the general idea.
Okay, that makes sense from a practical standpoint.
It does.
So let's shift gears a little bit now
Okay.
and talk about what happens after we've figured out which companies need to be consolidated.
Right.
How do we deal with the fact that different companies within a group might have different financial year ends?
Oh, that's a good question.
And how do we actually account for transactions between these companies?
Right, so both IFRS 10 and IAS 27 are pretty clear on this.
Okay.
Ideally, the financial statements of the parent and all its subsidiaries should be prepared using the same reporting date.
So everyone's on the same page.
Exactly.
Okay.
But if a subsidiary has a different financial year-end,
Then adjustments need to be made to their statements to align them with the parent's reporting date.
so we're basically making it look like everyone's reporting at the same time.
Exactly.
But what if it's just not practical to do that?
Well, the standards do recognize that there might be situations where it's really difficult to make those adjustments.
Okay.
But only if the parent company has made every reasonable effort to do so.
So they can't just be lazy about it.
No. They have to demonstrate that they really tried their best.
Got it.
And even then, there are some limits.
Like what?
So the difference between the parents' and the subsidiaries' reporting dates can't be more than 3 months.
Okay.
And that difference has to be consistent from one reporting period to the next.
So they can't keep changing it.
Right.
So basically, if they can't align the dates completely, they can use the subsidiary's most recent statements,
Yes.
but they have to adjust them for any big transactions or events that happen between the two reporting dates.
Precisely.
Okay. Consistency in making adjustments for any significant changes seem to be the key here.
Absolutely.
So what about when we look at the profit or loss of the whole consolidated group?
Right.
How do we split that up between the parent company's owners and the non-controlling interests?
So the profit or loss, as well as each component of other comprehensive income.
And what's other comprehensive income again?
That's basically income and expenses that aren't recognized in profit or loss.
Okay, got
So
it.
all of that has to be attributed to both the owners of the parent company and to the non-controlling interests.
Okay,
And here's an important point from IFRS 10.
that's that.
That allocation to non-controlling interests is made even if it results in them having a deficit balance.
Wait, so even if the subsidiary is losing money and the non-controlling interest share of the equity goes negative,
Yeah.
it's still recognized in the consolidated statements.
Exactly.
Huh. That's interesting.
It is, isn't it?
Okay, so then what happens if the parent company's ownership percentage in a subsidiary changes,
Okay.
but they still keep control?
Like if they buy more shares.
Exactly.
So those types of changes where control doesn't change hands are treated as equity transactions with the owners of the parent company.
Okay.
Basically, the difference between how much the non-controlling interests are adjusted and the fair value of the consideration paid or received,
Okay.
that difference is recognized directly in equity.
So it doesn't affect the reported profit or loss?
No, it's seen as a transaction between the owners.
Okay, I'm following you.
Good.
So we've covered a lot of ground here,
We have.
but consolidated financial statements aren't just about the numbers themselves, right?
No, they're not.
There's also a whole lot of disclosures that are required.
Absolutely.
So what's the purpose of all these disclosures?
Well, IFRS 12, which specifically deals with disclosures about interests in other entities,
Okay.
it says that the main goal is to help users of the financial statements understand the nature of the risks associated with a company's interests in other entities.
Okay, so it's about transparency
Exactly.
and helping investors and other stakeholders make informed decisions.
Precisely.
What kind of specific disclosures are we talking about here?
Well, for consolidated structured entities,
Yeah.
there are some extra requirements.
Like what?
Well, investors have to disclose the terms of any agreements that could require them
Okay.
or their subsidiaries
Hmm.
to provide financial support to the consolidated structured entity.
Okay, so if there's any chance they might have to bail out the entity, they have to tell people about it.
And they also have to describe any events or circumstances that could expose them to potential losses.
Okay, so it's all about being upfront about the risks.
Absolutely.
What about disclosures for unconsolidated structured entities?
So, for those companies have to disclose how they determined that they sponsored the entity,
Okay.
how much income they've received from it, and the carrying amount of any assets they've transferred to it.
Got it. And what if they've provided support to an unconsolidated structured entity,
Right.
even though they weren't contractually obligated to do so?
They have to disclose that too.
Okay, so transparency is really the name of the game here.
It really is, especially when it comes to these more complex structures.
All right, so we've talked a lot about consolidated statements,
We have.
but let's switch gears now and talk about separate financial statements.
Okay.
IAS 27 covers these. And we also have this discussion paper that brings up some really interesting points.
Yeah, it does.
So what's the point of having separate financial statements if we already have the consolidated statements that show the big picture?
That's a great question, and the discussion paper really dives into that.
Okay.
So separate financial statements are prepared by a parent company or an investor and an associate or a venturer in a jointly controlled entity.
All right.
And they're presented in addition to their consolidated statements. Now, in these separate statements, the investments are accounted for based on the investor's direct equity interest,
Okay.
rather than reflecting the investee's underlying results and assets.
So it's a different perspective.
Exactly. It's looking at the investment from the investor's individual standpoint.
Okay.
And the discussion paper highlights that these separate statements are often legally required.
Really?
Yeah. And they're super useful for a lot of different people.
Like who?
Well, like individual equity investors, debt providers, regulators, tax authorities.
Okay, so a pretty wide range of stakeholders.
Yeah, basically anyone who's making decisions about that specific legal entity.
Got it.
They need that separate view to understand the entity's own financial health.
So while the consolidated statements give us that overall picture of the group,
Right.
the separate statements provide crucial information about the individual company,
Exactly.
like its ability to pay dividends or repay its debts, its compliance with local regulations, and its standalone financial position.
All of that.
Okay, so how are investments in subsidiaries, joint ventures, and associates actually accounted for in these separate statements?
So IAS 27 gives companies a choice here.
Okay.
They can either account for those investments at cost, or they can use IFRS 9.
And what does IFRS 9 cover?
IFRS 9 deals with financial instruments,
Okay.
so it's a more complex approach.
Gotcha.
But the discussion paper points out a bit of a snag with the cost method.
What's that?
IAS 27 doesn't really give us specific guidance on how to deal with things like transaction costs.
Okay, transaction costs.
Right, those are the costs incurred when acquiring the investment.
Right, like legal fees or brokerage commission.
Exactly.
Oh.
And it also doesn't give clear guidance on how to handle contingent consideration.
And contingent consideration is?
That's basically an extra payment that might be made,
Okay.
depending on certain future events.
Okay, so like an earn-out provision.
Exactly.
Okay.
So the paper suggests that these transaction costs should really be included as part of the initial cost of the investment.
That makes sense.
Yeah, and it also suggests that contingent consideration should be factored in when determining the initial value of the investment and any subsequent adjustments.
Okay, so it's about making sure the cost of acquiring the investment is fully reflected.
Precisely.
But it sounds like there's some room for interpretation there.
There is, yeah, and that can lead to inconsistencies in how companies actually apply the standard.
Right, because different companies might make different judgments.
Exactly.
Okay, so what about business combinations that happen between companies that are all under the same ultimate control?
Yes, common control transactions.
Right. IFRS 3, which deals with business combinations. It doesn't apply to those.
No, it doesn't.
So how are they accounted for in separate financial statements?
So this is another area where the discussion paper highlights a need for more clarity
Okay.
and where different approaches are seen in practice.
So what are some of the ways these transactions are handled?
Well, one approach is to use the carrying amounts of the assets and liabilities as they were recorded in the consolidated financial statements.
So basically carrying over the consolidated number.
So essentially, yeah.
Yeah.
Another approach is to carry forward the pre-combination carrying amounts
Okay.
from the separate financial statements of both entities.
So sticking with the individual company's numbers.
Right.
Okay.
Now, it's important to understand that these intragroup restructurings,
Mm-hmm.
they don't actually change the overall financials of the consolidated group.
Right, because it's all within the same family, so to speak.
Exactly.
Oh.
But they can have a big impact on the separate financials of the individual companies.
That makes sense.
Yeah. And the paper also talks about how the users of consolidated and separate statements might have different information needs in these situations.
Can you give an example?
Sure, like if a lender is considering giving a loan to a specific company within a group,
Okay.
they're going to be really interested in that company's post-merger liquidity and solvency.
Mm-hmm.
And that's information they'd get from the separate financial statements.
Right, because the consolidated statements wouldn't show that level of detail.
Exactly.
Okay, so it sounds like there's still some debate
There is.
and a lack of very specific rules
Yeah,
when it comes to accounting for separate financial statements,
it's an evolving area.
especially for transactions that happen within the same group.
Definitely.
Okay, so let's talk about the past SFR case studies ebook.
All right.
How does that resource help us understand all this stuff we've been talking about?
So the ebook is great because it takes all these theoretical concepts and shows us how they actually play out in real-world situations.
Okay, so it's like a bridge between theory and practice.
Exactly.
Does it have specific cases on consolidated and separate statements?
It does, yeah. So there's a dedicated case study that focuses specifically on IFRS 10
Oh, cool.
and walks you through how to apply the control model step by step.
That sounds really helpful.
It is, yeah. And while there isn't a standalone case study just on IAS 27, the principles of accounting for investments in separate statements are woven into a lot of the other cases.
Okay, so it's still covered, just not in a dedicated case.
Right.
What other topics does the ebook cover?
Well, it's got cases on investments in subsidiaries, related party disclosures, which is covered by IAS 24,
Okay,
and even IFRS 3, which deals with business combinations.
got it.
So it really gives you a broad view of how these standards are applied in different contexts.
And does the ebook actually show us the numbers and the calculations and everything?
It does, yeah. It goes into quite a bit of detail.
So it's not just high-level concepts.
No. You get to see the nitty-gritty of how the accounting works.
Awesome. So it sounds like a really practical way to get a deeper understanding.
It is, for sure.
Well, we've definitely gone deep into the world of consolidated and separate financial statements today.
We have.
It's been quite a journey.
It has.
So let's recap some of the key takeaways for everyone listening.
Okay.
First, consolidation is all about presenting a group of companies that are under common control, as if they were one single entity.
Right. It's about that economic reality.
And it's important to remember that control isn't always just about who owns the most shares.
Yeah, exactly.
There are a lot of other factors that can come into play.
Yep, like those contractual arrangements we talked about.
Right, and the way other shareholders are dispersed,
Mm-hmm.
and even potential voting rights.
All of that.
And we've also seen how the rules for determining control can be pretty complex.
I can.
Especially when you're dealing with things like structured entities.
Right.
Or less than majority ownership.
Definitely.
So it often requires careful judgment to figure out who's really in charge.
Absolutely.
And then we talked about how the accounting for transactions within a group
Yeah.
can look very different depending on whether you're looking at the consolidated statements
Right.
or the separate statements of the individual companies.
And that's a key point because it means that the same transaction could be presented in different ways.
Yeah,
Depending on the perspective you're taking.
exactly. And those different perspectives are meant to serve the needs of different users of the financial statements.
Precisely.
Okay, so I have a question for everyone listening.
Okay, shoot.
Given all this complexity
Mm-hmm.
and the fact that there's so much judgment involved in figuring out who controls who
Yeah.
and how transactions are accounted for,
Right.
what are the implications for how we actually interpret a company's financial health and performance?
That's a really great question.
It really makes you think about how those different views of the same transaction
Yeah.
can paint very different pictures,
They can.
and how important it is to understand the context.
Absolutely.
So for
Yeah.
anyone who wants, okay, so have you ever looked at, like, a company's financials, their balance sheet and all that, and kind of scratched your head wondering, is that debt or is that, like, part of what they own? Like, is it something they owe or is it ownership?
Yeah, I get that. It can be tricky, right?
Hmm,
The line between what's a liability or what they got to pay back and what represents actual ownership. Sometimes it's not so crystal clear.
it's true. It's almost more like a spectrum than like a hard line in the sand sometimes.
Exactly. And honestly, getting that distinction right, it's crucial because it really tells you a lot about the company, about their obligations, and who actually benefits if the company does really well or, tanks.
For sure. So in this deep dive, that's exactly what we're going to be digging into. We're going to break down the difference between what's considered a financial liability and what's considered an equity instrument, according to the accounting rules.
Right. We're going to go through like the core accounting principles, the backbone of how these classifications are made. We'll touch on some of the exceptions because, as you can imagine, there are always exceptions, right?
Always.
And we'll even get into some of the potential changes that might be coming down the pipeline in terms of these rules. It's a pretty dynamic area.
Yeah, for sure. So we've got a lot to cover. We're looking at IAS 32, that's the International Accounting Standard 32, and of course, INDS, the Indian Accounting Standards.
Right. Plus, we've got guidance from the IFRA, the IFRS Interpretations Committee, and this really interesting analysis from EFRAG, the European Financial Reporting Advisory Group, that kind of gives us a sneak peek into what the future might hold for these standards.
Okay, great. A lot of acronyms there,
Yeah.
but we'll break it all down. So first things first, what is the fundamental core principle that determines if something belongs on the liability side of the balance sheet or the equity side?
Okay, at its heart, it really comes down to whether there's a contractual obligation. IAS 32 lays it out pretty clearly. A financial liability comes from a contractual obligation that a company, the issuer, has to deliver either cash or another financial asset to the holder of that instrument.
Okay.
So it's like a legally binding promise from the company to hand over something valuable.
Okay, so it's about a binding obligation from the company side. How does that compare to equity then? What defines an equity instrument?
Well, an equity instrument, you can think of it as what's left over. It's like the residual interest in a company's assets.
Okay,
So once you've taken care of all your liabilities, all those things you owe, what's remaining, that's your equity.
I see.
IASB's conceptual framework, along with IAS 32, really emphasizes this idea of residual interest. And the key difference from liabilities is that there's no contractual obligation.
Right.
The company doesn't have to make distributions like dividends, for example, to those who hold equity. It's more about sharing in the company's potential upside, in its future profits, and the underlying value of the business.
Makes sense. So it's the difference between I'm obligated to give you this back versus you have a stake in this, and if it does well, you do well.
You got it.
Can you maybe give us a real-world example of how this principle plays out, like in a real situation?
Sure. So let's imagine a forward contract. In this case, a company agrees to buy back its own shares on a specific date in the future at a price that's already been determined.
Okay.
Now, even though this involves the company's own shares, IAS 32 says this is actually a financial liability
Why is that?
because they've entered into a contract, a legal agreement, that obligates them to pay cash on that future date to get those shares back.
I see.
It's the cash obligation that makes it a liability.
Interesting. So even though it's their own ownership involved, that promise to pay out cash turns it into something they owe. What about situations where a company uses its own shares to pay for something?
That's a really good question. And that brings us to another interesting area in IAS 32. If a company uses its own equity instruments as currency, let's call it, in a contract, and the number of shares they'll give or receive isn't fixed, it depends on some other variable,
Okay.
like maybe the price of gold or another company's stock, then it's typically not treated as equity. It's more likely to be seen as a financial asset or liability.
So the fact that the number of shares is up in the air, that's what makes it different.
Yeah, the variability is key. If it's not a fixed number of shares for a fixed amount, it usually points towards a liability or asset classification.
Gotcha. So this fixed for fixed idea seems pretty central. You exchange a fixed number of your shares for a fixed amount, then it can be equity. But if either side of that equation is variable, it's often a liability. Now, I remember reading something about discussions and possible changes around this fixed for fixed concept. What was that all about?
You're right, there has been some debate around that. So the fixed for fixed rule in IAS 32 as it stands basically means that for a derivative instrument, one that's linked to a company's own equity, be classified as equity, it has to result in a very specific exchange, a fixed number of the company's own shares for a fixed amount of cash or another asset.
Got it. And the IFRS Interpretations Committee, they were looking at potentially broadening that definition a little bit, weren't they?
They were. They explored the idea of saying that even if the fixed exercise price of a conversion option was in any currency, it could still be classified as equity. Their thinking was that for the holder of that option, the economic outcome was still basically the same, a fixed value for a fixed number of shares.
Okay, yeah.
But the IASB ultimately decided not to go ahead with that change, back in 2005, actually.
So even if you fix the exercise price at a specific number, if that price is in a different currency than the actual amount the company gets in its own currency, that will fluctuate with exchange rates, right? So it wouldn't be truly fixed for fixed when you look at it from the company's perspective.
That's exactly right.
So it stays as a derivative liability.
Yeah.
It's pretty amazing how much detail goes into these accounting standards.
It can get very nuanced. And this complexity extends to things like rights issues. These are instruments, like rights, options, warrants that give current shareholders the chance to buy more shares, often at a discount.
Right. And those are pretty common ways for companies to raise more capital, aren't they? It gives existing investors a chance to hold on to their percentage of ownership.
Exactly. So with these rights issues, even though they grant the holder the right to buy a fixed number of shares for a fixed amount in, say, a foreign currency, there was this question: should they be viewed as derivative liabilities?
I see. Because of the potential fluctuation in the amount when translated into the company's main reporting currency.
Exactly. In the end, the board decided against any approaches that would automatically classify contracts settled in a company's own shares as equity if their value changed based on something other than the share price itself. They also decided not to limit the definition of equity instruments to just outstanding ordinary shares because, there can be other forms of equity.
Right, right. So it seems like they're really trying to maintain a clear definition of what counts as true equity versus something that creates an obligation for the company, even if that obligation is tied to its own shares.
That's a really good way to put it. Now, shifting gears a little, let's talk about when an instrument has characteristics of both liabilities and equity. These are what we call compound financial instruments.
Yes, like the classic convertible bond. It starts off looking like debt, but has this potential to convert into equity.
Perfect example. And IRS 32 recognizes this. They acknowledge that you can have instruments that have a liability component, the obligation to pay back the principal and the interest, and an equity component, which is the holder's right to convert that debt into shares.
So how do you account for something like that? It can't just be all debt or all equity.
It can't. The accounting rules say you have to separate these components. So first, you measure the liability component.
Yep.
You basically figure out what the fair value would be for a similar debt instrument that doesn't have that conversion option.
Okay, so you find the value of the pure debt part of it. What happens to the rest of the money the company received when they issued that convertible bond?
That difference between what they got for the bond and the fair value of the liability component gets allocated to equity.
I see.
So that remaining amount basically represents the value of that conversion option, what investors are willing to pay for the potential to become shareholders later on.
It's like breaking the instrument down into its core economic parts and accounting for each one separately.
Exactly. Now, let's look at instruments where the holder has certain rights, specifically the right to sell their investment back to the company. We call these puttable instruments.
Okay, so even if it looks like a share, if the holder has a way to force the company to buy it back, it's usually treated as debt in the accounting world, right?
Generally, yes. IAS 32 says that if a financial instrument gives the holder the right to put it back to the issuer, to basically demand cash or another asset for it, then it's a liability because, again, the company has that potential obligation to pay up.
Okay. So are there any exceptions to that rule?
There is one very specific exception. It's for instruments where the company's obligation is to hand over a portion of its net assets, but only when the company is being liquidated.
Only when the company is being liquidated. That seems like a pretty specific situation.
Very specific. And for it to even qualify for this exception and be classified as equity, there are a bunch of conditions that have to be met.
What are they?
Okay, first off, it's got to be subordinate to all other kinds of financial instruments the company has.
Okay.
Second, all of those instruments within that specific class have to have identical terms, no special treatment for anyone. Third, there can't be any other contractual obligation for the company to pay out cash or exchange assets under conditions that could be unfavorable to them, aside from this liquidation obligation.
So basically, liquidation is the trigger,
Yeah.
and that's the only trigger.
And finally, it has to settle only when the company is actually being wound up.
So if an instrument starts off as a liability, but then later meets all those conditions for the liquidation exception, can they reclassify it?
They can. IAS 32 has a process for that. If a financial liability checks all those boxes for the liquidation exception, it can be reclassified as equity from that point on.
So they really are trying to account for the underlying economic reality, even in very niche scenarios like a company shutting down.
They are. Now, let's look forward a bit. We've got this IFRS working paper, right? And it kind of analyzes potential changes to these classification rules. What's the general direction those changes seem to be heading in?
Yeah, what's the big picture?
Well, it's important to remember this paper is just an early analysis of some proposals that the IASB is floating. Doesn't mean IFRAG agrees with them or that this is how things will definitely shake out.
Right, more like a glimpse into the future of these standards.
Exactly. So what the IASB is thinking about is really focusing on two main things when deciding if something should be a liability. The timing of the obligation,
Right.
meaning, is the company definitely obligated to transfer economic resources, and if so, at what point? Is it at a specific time or only when the company liquidates?
Right.
And the second thing is the amount of the settlement.
Okay.
So how much the company has to pay out to settle this obligation. Is that amount fixed, or does it depend on the company's own financial health, its resources?
Timing and amount. Those are pretty fundamental concepts.
They are, and they could have a big impact on how instruments are classified.
Yeah, so how might these new ideas affect the way things are currently classified under IAS 32? Would a lot of things change?
The IASB's initial thought is that actually most of the classifications under IAS 32 probably won't change. But they do think some things currently classified as equity might end up being reclassified as liabilities.
Because of this new amount feature.
Right, especially if the amount the company has to pay out isn't connected to their own resources.
I can see how that could be a big deal for companies. Their liabilities could suddenly go up.
Right, and the ERIGE paper mentions that some stakeholders are worried about that, particularly when it comes to certain types of instruments, things like perpetual bonds, the kind where there's no fixed maturity date, especially those with cumulative deferral features for interest payments.
So basically, the interest keeps adding up, but they don't necessarily have to pay it right away.
Right, and then there's also non-redeemable fixed-rate cumulative preference shares.
Okay.
And even those rights issues we talked about earlier, the ones denominated in foreign currencies.
So some things that used to have more equity-like features might get pushed over into the liability category with these potential changes.
That's the concern. And there's even some uncertainty about how to estimate how much would actually be reclassified. The ERAC paper says there's potentially a lot of money at stake, particularly when it comes to those perpetual bonds.
Sounds like these changes could have a ripple effect. Now, what about shares in cooperative entities?
Right. This is especially important in Europe. Cooperative banks there have a huge chunk of their capital in the form of members' shares, hundreds of billions of euros.
Wow, that's a lot.
And this amount feature that the IASB is looking at could end up classifying some of those members' shares as liabilities instead of equity.
Oh, I see. But the EVROG paper also mentioned that the IASB is leaning towards keeping the current guidance from IREC 2, which deals specifically with those instruments.
They are. And that's a big deal because if those cooperative shares were suddenly reclassified as liabilities, it would completely change how those banks look on paper. They might appear to have little or no equity capital at all.
Yeah, that would definitely raise some eyebrows.
It would, and it might not accurately reflect their true financial health. So keeping the current treatment seems like the safer bet.
It makes sense. Now, thinking about credit ratings, how do rating agencies view these instruments, the ones that have both debt and equity features?
That's a crucial question. Rating agencies often give something called equity credit to those kinds of instruments. It basically means they see them as contributing to the company's capital strength, but maybe not as much as pure equity.
Okay.
It depends on the specific features, like whether they're subordinate to other debt, how well they can absorb losses if things go south, things like that.
Right.
And the E4XL analysis suggests that the rating agency's own criteria for assigning this equity credit are probably not going to change just because IFRS accounting standards change.
So even if something gets reclassified as a liability under IFRS, a rating agency might still see it as providing some of that equity cushion.
Right. So there might be a disconnect between how it's classified in the financial statements and how a credit rating agency views it. But IFRAG also found that users of financial statements generally felt that the IASB's proposed changes wouldn't make the information less relevant.
That's good.
And the extra disclosures that are being considered were generally seen as helpful for investors.
Transparency is always a good thing. And I guess for more experienced investors, they're not just looking at the label of debt or equity anyway.
Sure.
They're digging deeper, looking at the specific terms and features of the instrument, right?
Exactly. Now, let's touch on treasury shares really quickly. These are a company's own shares that they've bought back from the market.
Okay.
These are treated as a direct reduction of equity on the balance sheet. And importantly, no gains or losses are reported when the company buys or sells treasury shares.
Right, because those transactions with their own equity are basically seen as dealing with their owners, not as profit-making activities.
Exactly. And like we talked about with convertible bonds, when you first recognize a compound financial instrument, the liability part gets measured at fair value first, and then what's left over is allocated to equity.
Now, IFRAG brought up this idea of economic substance. Are these potential accounting changes going to make financial statements better reflect the true economic reality of transactions?
It's a good question. And some preparers of financial statements who were surveyed by IFRAG said they weren't sure if the IASB's proposed principles would actually do a better job of reflecting economic substance than the current rules in IAS 32.
Okay.
It's a good reminder that even though accounting standards are supposed to show economic reality, there can be different interpretations of what that reality actually is.
For sure. Let's try to make this a bit more concrete with an example. The case study we looked at talked about participation certificates. What were the main things to consider when trying to decide if those were debt or equity?
The main question was whether those certificates created a contractual obligation for the issuer. It goes back to that core principle in IAS 32.
Right.
They looked at a few key things to figure that out, whether the issuer could terminate the certificates, how the payments to holders were determined, and whether they had a set maturity date.
So how do those things help determine if there's a contractual obligation?
Well, if the issuer can just decide to end the certificates, it might mean there's not as strong of an obligation. But if there's a fixed maturity date where the principal has to be paid back, that's a classic sign of debt.
Yeah, that makes sense.
And how the payments are calculated is really important. If the payments are fixed or easily determined and the issuer doesn't have complete discretion over them, it leans more towards debt.
So it's like weighing all these different factors to see what the overall picture is.
Right.
Okay. One last thing. Offsetting. What is that and how does it work?
So offsetting is basically when a company can net a financial asset and a financial liability on their balance sheet, so they show just the net amount. But IAS 32 has strict rules about when they can do this.
Makes sense. You can't just decide to net things out whenever you want.
No. First, there has to be a legally enforceable right to set off the amounts. And that right has to hold up even if one or both parties default or become insolvent.
So you need a rock-solid legal basis for it.
You do. And the company has to intend to either settle on a net basis or realize the asset and settle the liability simultaneously.
It's all about reflecting the company's true economic position.
Right.
So big picture, classifying financial instruments really comes down to that central question, is there a contractual obligation? But it's definitely not as simple as just slapping a label on something and calling it a day. There's this whole framework of rules and guidelines that tries to get at the economic reality of these instruments.
And that's the key takeaway. The next time you're looking at a company's balance sheet and see those words equity and liabilities, remember it's about more than just labels.
Exactly. It's about understanding what those labels represent, the underlying obligations and ownership structures of the company.
Now here's a final thought for you. Think about how reclassifying something from equity to debt might change people's perception of a company's risk.
Okay.
Could it affect their credit rating? And if so, could it make it more expensive for them to borrow money? How might these accounting decisions impact investors and the overall financial markets?
Some great points to consider. If you want to go even deeper into this stuff, definitely check out the sources we've mentioned today. There's a lot more to explore.
And maybe even take a look at the actual accounting standards themselves.
Yeah, you'll get a real appreciation for the intricacies of this whole world.
Absolutely.
Thanks so much for joining us for this deep dive.
My pleasure. It's been a great discussion. We all watch company profits, don't we? Up, down. That's the big news, right? But to really understand what's going on, especially if you're thinking about shares, your piece of the action, you could say we need to look a little closer. And that's where earnings per share, or EPS, comes in. It sounds pretty basic, profit divided by shares. But the details of actually calculating and showing that number, well, it can get a bit more involved than you might think at first glance.
You're absolutely right, and that's precisely what we're going to delve into today. All those ins and outs of EPS, how it's calculated, how it's presented, all according to International Accounting Standard 33, or IAS 33. Think of it as, well, the global rule book for EPS.
Exactly. So if you've ever seen EPS in a financial report and thought, hold on, what's actually going on here? This is for you. We're going to break it all down, make it clear.
It's like getting a backstage pass to those EPS figures. We'll see what they really mean, why they're presented the way they are.
Perfect. And for this deep dive, we've got a quite a stack of resources to work with. We're looking at the official IAS 33 standard itself, the basis for conclusions, which explains the reasoning behind the rules, the why, you could say. We've got exposure drafts that show us how these rules have evolved over time, and of course, practical application guides, and even some really useful examples. So yeah, if you've ever looked at that EPS figure and thought, there's got to be more to this story, well, you're in the right place. Our mission today, you could say, is to equip you with a really solid understanding of the fundamentals, and also to highlight some of those, shall we say, fiddly bits of calculating EPS under IAS 33. Okay, so first things first, basic EPS. Where do we even begin?
Right. So at its heart, basic EPS is, well, pretty straightforward. It's a company's profit or loss, but the part that belongs to its ordinary shareholders. And we divide that by the average number of those ordinary shares that were out there during the reporting period. So in essence, it's like a per-share snapshot of how profitable the company is.
Okay, that makes sense. But that top number, the profit or loss, it's not always just that final number on the income statement, is it? What about if there are other shares or equity instruments involved, like, say, preference shares? How do they fit into the picture when we're figuring out that profit figure for EPS?
Yeah, that's a really important point. With IAS 33, we have to adjust that net profit or loss to factor in any returns that go to those other equity instruments. And preference shares are a prime example. So if those preference shares are classified as equity, meaning they're treated as part of the ownership structure of the company, we need to deduct the after-tax preference dividends from the net profit. Logically, this makes sense because those dividends are essentially a chunk of the profit that's not going to be available to the ordinary shareholders, the ones we're focusing on for EPS.
Right. Okay, that makes sense. So what happens then if those equity classified preference shares get repurchased by the company, before they're due? Or if there are incentives to encourage the holders to convert them into ordinary shares sooner rather than later?
Yeah, those situations can also lead to adjustments in the numerator. So let's say the company pays more than the carrying amount to repurchase those preference shares early. Now, that extra amount, it isn't actually reflected in the profit or loss, but it is a return to those preference shareholders. So it reduces the profit that's available to ordinary shareholders for EPS purposes. Similarly, if the company offers, let's say, a sweetener for early conversion, maybe better terms or some extra compensation, that inducement, well, it's also treated as a return to those preference shareholders. So it needs to be subtracted as well.
Interesting. It's like we're trying to zero in on that profit that really belongs to us as ordinary shareholders in that numerator. Now, there was something in the material about participating equity instruments. Can you explain what those are and how they come into play?
Right. Participating equity instruments and even different classes of ordinary shares that have, let's say, different dividend rights. They add another layer to this whole calculation. The standard says we need to allocate the profit or loss based on how those instruments actually share in the earnings. So it's not always a simple split based on the number of shares. For example, if you have one class of shares that only gets a dividend if the profit goes above a certain level, well, the profit that we're going to use for EPS has to reflect that specific agreement. We look at how the profit would be distributed if all of it were paid out as dividends.
Okay, so reflecting the real economics, you could say, of who gets which slice of the profit pie. And last question on the numerator, what about those big consolidated financial statements we often see? How do non-controlling interests, or NCI, factor into the equation there?
Yes. So with consolidated financial statements, the net profit or loss includes results from both the parent company and its subsidiaries. But for EPS, what we're really interested in is the profit that belongs to the ordinary shareholders of the parent company, right? So if there are any agreements where the parent has to cover losses incurred by non-controlling interests in a subsidiary, Those obligations, they also have to be considered in our numerator calculation. Again, it's about isolating the profit that truly belongs to the parent company's ordinary shareholders.
Okay, I see. The numerator not always as straightforward as it seems. Now let's move on to the denominator, that weighted average number of outstanding ordinary shares. I'm guessing that weighted average bit is pretty crucial here.
It really is. The reason we use a weighted average is to take into account the fact that the number of shares that are out there can change throughout the year. The company might issue new shares, it might buy back some of its own shares. The time weighting factor, it basically reflects how much of the year a particular number of shares was actually in the hands of investors. So for instance, if a company issues a bunch of new shares halfway through the year, well, those new shares are only included in the denominator for that second half of the year.
So if we had, let's say, shares outstanding for 90 days out of a 365-day year, they'd get a weighting of 90 divided by 365.
Exactly. IAS 33 says we should weight them based on the number of days they're outstanding as a proportion of the total days in the period. Now, of course, in practice, the standard acknowledges that you can use reasonable approximations, like based on weeks or parts of months, as long as it doesn't make a material difference. You don't need to count every single day.
Okay, good to know. Real-world practicality. What about treasury shares, then? Those shares a company has bought back and is now holding. Do they still count in the denominator?
Nope. Treasury shares are excluded. They're the company's own shares that it's reacquired, right? And because the cash that was used to buy back those shares, well, it's no longer available for operations, those shares aren't considered outstanding. So they're not included in the denominator, however long the company holds them. It makes sense when you think about EPS as earnings per share held by investors.
Makes total sense. Now, can we look at an example just to really cement this idea of basic EPS? I think you mentioned one from that EPS handbook earlier.
Absolutely. Example 3.1 in that handbook lays out a really simple scenario. We've got company P, and they have a profit attributable to ordinary shareholders of $4.6 million. Their capital structure is pretty straightforward. 3 million ordinary shares outstanding for the entire year. So to get basic EPS, all we do is divide that 4.6 million profit by those 3 million shares, giving us an EPS of 1.53. Nice and clear.
Yeah, nice and clear. Okay, so that's the basic EPS sorted. But as we know, things aren't always that simple. What happens when there's a possibility of more shares being issued down the line? That's where diluted EPS enters the picture, right? It's like, what if we have to divide that profit pie into even more slices?
Exactly. Diluted EPS takes into account the potential for those earnings per share to be, well, diluted, if you like. That could happen if certain financial instruments or contracts were converted into ordinary shares or exercised. These are what we call potential ordinary shares.
Potential ordinary shares. So we're talking things like stock options that employees might have, or those convertible bonds that can be swapped for equity.
Precisely. Options, warrants, convertible debt, convertible preference shares, those are all common examples of potential ordinary shares. They're not ordinary shares yet, but they could become ordinary shares in the future. And if that happens, it would bump up the total number of shares outstanding, potentially spreading those earnings over a larger base and thus reducing the EPS for each existing shareholder.
So diluted EPS is like the cautious approach, the what-if scenario, showing us what EPS would look like if all those potential shares actually materialize.
You got it. It's all about providing a more complete picture of the company's profitability on a per-share basis.
Yeah.
We're taking into account all those potential ordinary shares that could water down those earnings, so to speak. The way we calculate it is we start with the same number of shares we use for basic EPS and the denominator, and then we add in the weighted average number of ordinary shares that would be issued if all those dilutive potential ordinary shares were converted or exercised. And typically, we assume this happens at the start of the period or on the date they were issued if they came into play during the year.
Okay, so that term dilutive, that's important here. Are all potential ordinary shares considered dilutive? Do we just assume that every single option will be exercised and every bond converted?
No, not at all. We only include potential ordinary shares in the diluted EPS calculation if they would actually decrease the EPS or increase the loss per share if the company's making a loss. This would need to be from continuing operations. Now, if including them would actually increase the EPS, well, then they're considered antidilutive, but we just leave them out of the diluted EPS calculation. We're only interested in scenarios that would, potentially drag down that EPS number.
Okay, makes sense. Focusing on the potential downside. You also mentioned a control number in this context. What's that all about?
Right. The control number is basically the benchmark we use to figure out if those potential shares are dilutive or anti-dilutive. Usually the control number is the profit from continuing operations,
Hmm.
the profit from the core ongoing business, you could say, and we use that as our measuring stick. So if a potential ordinary share has the effect of reducing EPS from those continuing operations, then it's dilutive. And even if that same potential share might look anti-dilutive, if we consider the overall profit or loss per share, including any discontinued operations, if it's dilutive to the continuing operations, it's still treated as dilutive for the overall diluted EPS calculation. Continuing operations sort of takes priority in the whole dilution assessment.
Interesting. So it's all about the core business, essentially.
Okay.
Now let's get into the specifics of some of these different types of potential ordinary shares. Options and warrants are pretty common. How do we figure out their impact on EPS? I think there's a treasury share method involved.
Absolutely. The treasury share method is the way IAS 33 tells us to go about calculating the impact of options and warrants. There are a few steps to it. First, we work out how much money the company would get if all those options were exercised. This includes the price the option holders would pay for the shares at the exercise price, and sometimes even the fair value of any future services that employees might still need to provide to actually earn those options. Then, we basically imagine the company taking that cash and using it to buy back its own ordinary shares on the open market at the average market price during the period. The difference between the number of new shares we assumed were issued when the options were exercised and the number the company could buy back with the proceeds, that's what we call the bonus element. And it's that net increase in shares, the bonus element, that we add to the denominator for diluted EPS. So it's not just a simple case of adding the total number of shares the options represent. We need to factor in that potential incoming cash and the company's ability to, in a way, offset some of the dilution by repurchasing its own shares.
Okay, so it's like a measure of the net increase in shares, not just the gross number from those options. What about convertible instruments, like those bonds or preference shares that can be converted? How do they impact diluted EPS?
For convertible instruments, we need to consider the effect on both the numerator and the denominator. So if those instruments are dilutive, meaning that converting them would push the EPS down, we adjust the numerator. We do that by adding back any interest expense, net of tax, that the company would recognize on that convertible debt, or any preference dividends they paid out on those convertible preference shares. The thinking here is that if those instruments had already been converted into ordinary shares, well, those interest payments or dividends wouldn't have happened. Then, on the denominator side, we simply add in the number of ordinary shares that would be issued if those instruments were converted. So you've got the numerator going up because we're reversing an expense or dividend, and the denominator going up because we'd have more shares outstanding.
Got it. What about shares that might be issued in the future, but only if certain conditions are met? Like, say, the company has to hit a certain profit target, or the share price has to reach a certain level. Those are contingently issuable shares, right?
That's right. How we handle contingently issuable shares in diluted EPS all depends on whether those conditions have actually been met by the end of the reporting period. If all the boxes are ticked, then those shares are included in the diluted EPS denominator. But if the conditions haven't been met, well, then we only include the number of shares that would be issuable if the market price at the reporting date stayed the same until the end of that contingency period. It's a bit of a what-if scenario based on the current situation.
Interesting point about using the reporting date price. What if the share price takes a nosedive after the reporting date, but before the financial statements are actually released? Does that change how we calculated diluted EPS?
Nope. Even if the share price drops below that trigger level after the reporting date but before the statements are finalized, we stick with the share price at the reporting date for calculating diluted EPS. The goal is to present a consistent snapshot of the situation as it was at the end of the reporting period.
Okay, consistency is key. Now, what if a company has a bunch of different types of potential ordinary shares out there? Like employee stock options, convertible bonds, and warrants. How do we figure out which ones to include in the diluted EPS calculation?
Right, so when a company has more than one type of potential ordinary share, we have to rank them. We start with the most dilutive and work our way down to the least dilutive. We calculate the impact of each type on the EPS from continuing operations, one by one, and cumulatively. So if adding a particular type makes the EPS go down even further, we keep it in, and we keep going until including the next type of potential shares doesn't make the EPS any lower. So it's a step-by-step process, always focusing on whether we're getting a more and more diluted EPS figure as we add each category.
So it's about like maximizing the potential dilution, you could say. Okay, so we've talked about the calculations themselves, both basic and diluted. But EPS isn't just about the numbers, is it? It's also about how it's presented in the financial statements. What are the key things to know there?
You're absolutely right. Presentation and disclosure are really important to make EPS actually useful for investors. And IAS 33 is very specific on this. Both basic and diluted EPS need to be shown right there in the statement of comprehensive income and with equal prominence. No hiding one away in the footnotes or anything. And if the company chooses to present a profit or loss figure specifically from continuing operations, well, then they also have to show both the basic and diluted EPS figures for just that part of the business.
So, equal prominence and a focus on continuing operations. What about if they have discontinued operations? Maybe they sold off a whole division or something.
Ah, good point. For discontinued operations, the standard says we need to show those basic and diluted EPS amounts. Either we include them directly in the statement of comprehensive income itself or in the notes to the financial statements. This way, investors can see the per-share impact of both the ongoing business and any bits that have been discontinued.
That extra level of detail is definitely helpful for analysis. Now, what about if the company's share structure changes? Say they do a stock split and double the number of shares, or a bonus issue where existing shareholders get extra shares for free. Does that affect the way they report EPS for past periods?
Yes, those sorts of changes, because they change the number of shares out there without actually changing the company's underlying assets or profitability.
Yeah.
They required a bit of a rewind. We have to restate those previously reported EPS figures. So if there's a capitalization issue, a bonus issue, a share split, or even a reverse share split where they combine shares, the company has to go back and recalculate and restate the basic and diluted EPS for all the prior periods that are shown in their financial statements. And they have to do it as if that change had happened right at the start of the very first period they're showing. The same principle applies if there are corrections for past errors or changes in accounting policies that are applied retrospectively. It's all about ensuring that we're comparing like across different periods.
Makes sense. So if a company splits its stock 2-for-1, it's like someone came along and cut every slice of pizza in half. To compare today's pizza slice to what we had before, we need to go back and imagine all those past slices were also cut in half.
Precisely. It's about making those comparisons meaningful. Now, what if these share changes happen after the company's financial year ends, but before the financial statements are actually signed off and published?
Right, that's a good question. What happens then?
Well, in those cases, the per-share calculations for both the current year and any past years shown in the statements they need to be based on the new number of shares. And, importantly, the company has to clearly disclose the fact that those EPS figures have been adjusted to reflect these changes that happened after the year end, but before the statements got the final stamp of approval. Transparency is key.
Okay, transparency is key. Now, I remember reading something about a parent company's separate EPS. Is that something that's commonly reported?
There is an option for a parent company to disclose its separate EPS in some very specific circumstances. But IAS 33 actually prohibits them from showing that separate EPS figure in the consolidated financial statements. And that applies both to the main part of those statements and to the notes. The concern, as they explain in the basis for conclusions, was that having two different EPS numbers, one for just the parent company and one for the whole consolidated group, could be a bit confusing for users of those statements. It could even be misleading. So they decided to really focus on that consolidated performance for the entire economic entity.
Makes sense. Focusing on the big picture for the group. One last question on presentation. What about the year-to-date diluted EPS? Say a company reports its results every quarter or half year. Is that just an average of the diluted EPS numbers from each of those shorter periods?
Actually, it's not a simple average. Calculating the year-to-date diluted EPS is a little more nuanced than that. You can't just take a weighted average of the diluted EPS figures that were worked out for each interim period. And the reason for that is that whether those potential ordinary shares are dilutive or anti-dilutive, well, that's assessed based on the results for the whole year. We use that control number, remember. The profit from continuing operations, that belongs to the parent company for the whole year. A potential share might be dilutive when you look at the full year, but it might have been anti-dilutive in one specific quarter, or vice versa. So the year-to-date number needs to reflect the dilutive impact as assessed over that whole year-to-date period. It's not just the sum of its parts when it comes to diluted EPS.
Right. It's really important to keep that in mind. That nuance really highlights that EPS isn't always a straightforward thing, especially when potential dilution is involved. Okay, so we've covered basic EPS, diluted EPS, and how it's presented. But there are, of course, a few more specific scenarios and complexities that IAS 33 addresses. What about rights issues, for example, where existing shareholders get the right to buy new shares? How do they affect these calculations?
Right, so rights issues are where those existing shareholders are given the chance to buy more shares, often at a price that's lower than the current market price. And this is where the concept of a bonus element comes in. Because they're getting those shares at a discount, you could say. It's like the shareholders are getting a little something extra. To account for this, when we're working out both basic and diluted EPS for all those periods before the rights issue, we have to adjust the number of ordinary shares that were outstanding. And we do that using a factor that's based on what's called the theoretical ex-rights value per share. This way, the EPS figures before and after the rights issue can be properly compared. It's not just about the new shares being issued. We also have to go back and tweak those old share numbers to take that embedded bonus into account.
Okay, so we're sort of retrospectively adjusting those past figures to keep things consistent. We also talked about participating equity instruments a bit earlier. How are those treated specifically in diluted EPS?
So, with participating equity instruments, if they can be converted into ordinary shares, then for diluted EPS, we assume they are converted, as long as that would make the EPS lower. And if they can't be converted into a specific class of ordinary share, well then when we're figuring out diluted EPS, we allocate that undistributed profit or loss for the period to all the potential ordinary shares in those participating instruments, assuming they're all outstanding. And that allocation is based on their respective rights to participate in the earnings. It's another one of those what-if scenarios. We're looking at how those earnings would be shared if all those potential instruments were active and participating.
Okay, so again, it's all about that dilutive effect. Only include them if it lowers the EPS. What about potential ordinary shares of subsidiaries, joint ventures, or associates? You know, those companies that our main company has investment in but doesn't fully own. How do they get considered when we're working out the consolidated diluted EPS?
Right. So with consolidated diluted EPS, we have to consider any potential ordinary shares that have been issued by subsidiaries, joint ventures, or associates. But only if those potential shares could potentially lead to a dilution of the parent company's earnings per share. We make the assumption that those potential shares in the investee company are converted into their underlying ordinary shares. And then we adjust the numerator of the parent company's EPS, the profit that belongs to the parent's ordinary shareholders, to reflect any changes in the parent's profit or loss that would come about from that assumed conversion. This might include, for example, changes in the dividend income the parent receives from the investee, or changes in the share of the investee's earnings that's recognized under the equity method. But importantly, the denominator of the parent's EPS, the number of the parent's own ordinary shares that's not affected by this assumed conversion of the subsidiary. It only impacts the parent's share of the profit.
Right, so it's the parent slice of the pie that's affected, not the number of slices, so to speak. Okay, here's another interesting one. What about those contracts that could be settled in either the company's shares or in cash? How do we handle those in diluted EPS?
Okay, so for contracts like that, where the company has the option to settle in ordinary shares or cash, IAS 33 has a specific assumption for diluted EPS. We presume it'll be settled in ordinary shares, which means we have to factor in the potential dilution from those shares being issued. It's worth pointing out that this is one area where IFRS and US GAAP differ. Under US GAAP, that presumption can be, well, overturned, but only if the company's past practices or a stated policy give us a good reason to believe it'll actually be settled in cash. So with IFRS, we generally lean towards assuming those shares will be issued for dilution purposes, unless there's a strong argument for thinking otherwise.
Right, okay. And finally, what about mandatorily convertible instruments? So those are the ones that have to be converted into shares at some point in the future. How do they get treated when it comes to basic EPS?
The treatment of mandatorily convertible instruments in basic EPS has been a bit of a discussion point, with various proposed amendments over the years. Proposals in a 2008 exposure draft suggested that we should only include them in basic EPS if they also meet the criteria for participating instruments, meaning they participate in the company's profit or loss, just like ordinary shares, based on a predetermined formula. The goal was to ensure that basic EPS only reflects instruments that give the holder a current right to share in the profits, similar to how ordinary shareholders do.
Right, that makes sense. Aligning with the whole definition of basic EPS. Now, last but not least, let's talk about reverse acquisitions. This is where a private company takes over a public company. even though technically, legally, the public company might be the one doing the acquiring on paper. Are there any special things we need to consider for EPS in these situations?
Yes, reverse acquisitions are a unique animal, you could say, with some specific considerations for EPS. So, in the consolidated financial statements of the legal acquirer, which, in a reverse acquisition, is actually the company that was economically acquired, the way they present the equity structure reflects the legal acquirer. But in terms of the actual financial results, aside from that equity structure, those consolidated statements are treated as a continuation of the legal acquiree's financials, which can make things a bit tricky when it comes to EPS, especially for periods before the acquisition happened. The standard says that for those comparative periods, the basic and diluted EPS are calculated using the weighted average number of ordinary shares of the legal acquiree that were out there during that period, and then multiplying that by the exchange ratio set out in the acquisition agreement. It's kind of a blended approach, trying to reflect both the combined history and the current capital structure. It's definitely a more specialized scenario.
Definitely specialized, but good to be aware of. Okay, so we're nearing the end of our deep dive here. Let's just step back and think about why EPS is such a big deal and what some of the ongoing challenges are when it comes to actually applying IAS 33 in the real world.
EPS is definitely a fundamental metric for investors.
Yeah.
It's one of the key ways they gauge a company's profitability. How much profit are they making for each share of stock? And it feeds into other important calculations like the price-earnings ratio. But as we've seen, actually calculating it, especially diluted EPS well, it can get pretty complex when you have lots of different potential shares in the mix.
Absolutely. And thinking back to the basis for conclusions, there were definitely some concerns about potential confusion if companies were allowed to present both their parent-only EPS and the consolidated EPS side by side. So the decision to mainly focus on consolidated EPS seems to be an attempt to prevent that kind of potentially misleading presentation.
Exactly. And there's been a lot of work over the years to make accounting standards more consistent globally. EPS is one area where the IASB and the FASB in the U.S. have collaborated, trying to, iron out some of the differences in how it's calculated and presented. The fact that companies and accounting folks still have questions about how to apply IAS 33, especially when things get really complicated, just highlights the fact that it's not always a simple cut and dried issue. And that's why the IASB has continued to provide more guidance and clarifications.
And I imagine to make ETS a really useful tool for comparing different companies, it's crucial that they all apply these accounting policies consistently, right?
Absolutely. Without that consistency, it becomes really difficult to compare EPS figures across companies, which makes it much harder for investors to make informed decisions.
Okay, so let's wrap up with some key takeaways for our listeners after this deep dive into the world of EPS under IAS 33.
All right. So the main things to remember are that basic EPS gives us that initial per-share profit figure, dividing the profit that belongs to the ordinary shareholders by the weighted average number of shares outstanding. And remember that profit attributable part, that can involve some adjustments for things like preference dividends and how different equity instruments participate in the earnings. And the denominator, well, it's not just a head count of shares. That weighted average is vital to account for any changes in the number of shares over that reporting period.
And then we have diluted EPS, which is all about looking ahead and considering those potential future shares. But we only include the ones that would actually bring the EPS number down, those with a dilutive effect. That treasury share method, which helps us figure out the impact of options and warrants, and those specific adjustments we have to make for convertible instruments, those are some key things to remember.
And finally, remember that how EPS is presented in the financial statements is just as important as how it's calculated. Equal prominence for both basic and diluted EPS, those specific rules for continuing and discontinued operations, and the fact that if a company's share structure goes through some major changes, they often have to restate their EPS for previous periods to make sure those comparisons over time are fair and accurate.
Right. And thinking about all those complexities we've talked about today and calculating diluted EPS, it really begs the question, when you're looking at a company's results, how much emphasis should you as an investor really put on that single EPS metric when you're trying to assess their future prospects? And given that there are some judgment calls involved, like figuring out how to handle those contingently issuable shares or determining the average market price for treasury stock, how might those judgments impact how comparable EPS figures actually are across different companies? It's something to bear in mind when you're digging into those reports.
Definitely. And for anyone who wants to become a real EPS guru and explore all those details, we'd highly recommend checking out the full IAS 33 standard, along with the basis for conclusions and any implementation guidance that's been published. There's a whole world of information out there if you want to take your EPS knowledge to the next level.
Well, that brings us to the end of our deep dive into EPS. Until next time, happy exploring.
Welcome back, everyone, to the Deep Dive. Today, we are going to take a deep dive into something that I think could be really tough to wrap your head around. We're talking about IAS 36, Impairment of Assets.
Yeah.
And this standard, it really is kind of like a window into how companies make sure the value of their assets are really what their books say they are.
Right.
Everything from, machinery to patents to even things like goodwill.
Exactly. And I think the easiest way to think about impairment is like this. It's basically a reality check for a company's balance sheet.
Okay, I like that.
So when you have an asset,
Yeah.
and that asset's future earning potential or its market value drops below what's recorded on the books as its value, that's when you have to apply the rules of IAS 36.
Got it.
And this doesn't just apply to like tangible assets like a building. It also applies to intangible assets like brand names, intellectual property, and even that figure we hear so much about, goodwill.
Goodwill, right.
Yeah.
So to get a good grasp on all of this, we went and got all the best sources. We pulled excerpts straight from IAS 36. Practical guides on how companies are actually using this stuff, academic research on how transparent companies are being, and even some interesting perspectives on how things could be better when it comes to goodwill impairment. So no matter how familiar you are with this stuff, we want you to leave today with like a solid understanding of the core ideas, the real-world problems companies face, and the key information they need to be sharing.
Absolutely.
So let's get down to it.
Let's jump right in.
What's the core of all this?
Well, the core is comparing an asset's recoverable amount
Okay.
to its carrying amount. Now, carrying amount, that's just the asset's value on the balance sheet after depreciation, amortization, and any previous impairment losses.
Right, so basically the book value.
Exactly.
But recoverable amount, that sounds more complex.
It is a bit more involved. Yeah, basically you have to figure out which is higher. The fair value, less costs of disposal, or the value in use.
Okay, so like two different ways of looking at it.
Right. Fair value, less costs of disposal.
Yeah.
Imagine you wanted to sell that asset today. What price could you get minus all the costs of selling it?
Okay, so like if we're talking about some piece of specialized equipment, we'd be looking at things like auctioneer fees, maybe costs to prep the equipment, shipping costs, all that.
Exactly.
But we're not talking about a fire sale.
Right.
Unless that's the only option.
Right. We're talking about a normal sale under normal conditions.
Got it. And then what about value in use?
Well, value in use is all about the future. It's the total cash flows that asset is expected to generate for the company from using it until they get rid of it.
Okay, so that's where forecasting and estimating come in.
Exactly.
How do you even start to calculate that?
Well, first you estimate all the future cash flows.
Okay.
Inflows and outflows. So that's revenue, costs to operate the asset, and any cash flow you get when you finally dispose of it.
Right. Everything.
Yeah. Then you have to bring those projected cash flows back to their present value. So basically you're saying, what is the value today of all the future cash we expect this asset to generate? But to do that, you need a discount rate.
Okay.
And that discount rate, it has to take into account both the time value of money, the idea that money today is worth more than money tomorrow,
Right.
and the risk that the asset might not actually achieve those projected cash flows.
So you're factoring in the risk that things might not go as planned.
Exactly.
Okay. So an impairment loss only happens when the carrying amount,
Yes.
the book value, is higher than the recoverable amount.
Yes. When the carrying amount is higher than the higher of those two, either fair value, less costs of disposal, or value in use.
Okay, got it. But what if you can't really evaluate an asset on its own? What if it's part of something bigger?
That is a great question, and this is something that I think trips people up a lot.
Yeah, sounds like it is.
Sometimes an asset doesn't generate cash flows all by itself. Like, think about a piece of software that's used for an entire online sales platform. You can't separate the software from the whole e-commerce operation.
Makes sense.
So in those cases, IAS 36 says you have to look at what's called a cash generating unit, or CGU.
CGU, okay. So how do you define what a CGU is?
Well, a CGU is the smallest group of assets that generate cash flows that are largely independent
Okay.
from other assets or groups of assets. It all comes down to largely independent.
So a single restaurant in a big chain might be a CGU because its money coming in and going out is pretty much self-contained.
Exactly.
But a central warehouse that supplies all the restaurants That wouldn't be a CGU on its own.
Exactly.
Interesting. So then what about corporate assets? Things like a company headquarters, shared research facilities, a brand name.
Yeah, these things contribute to the cash flows of multiple CGUs, but they don't really generate cash flows on their own.
Right, so you wouldn't test the headquarters building for impairment in isolation.
Right. So the standard says that if you can allocate a portion of the carrying amount of those corporate assets to individual CGUs, then you include that allocated amount when you test the CGUs for impairment.
Okay, so you could allocate the cost of a central IT system based on how much each CGU uses it.
Exactly. But if you can't find a reasonable way to allocate it, like, say, the value of a global brand name, then you do it a bit differently.
Okay.
You first test the individual CGUs on their own,
Hmm.
and if there are any impairment losses, you recognize them.
Yeah.
And then you test the entire group of CGUs that benefit from that corporate asset, and this time you include the carrying amount of the corporate asset itself.
Okay, so test individually and then test the bigger picture.
Right. It makes sure those shared resources get considered in the impairment assessment.
Okay. So now, goodwill. That one always seems to cause a lot of confusion.
It does, yeah. Goodwill is unique under IAS 36.
Okay.
Goodwill arises when a company acquires another company for more than the fair value of its identifiable net assets.
Right.
And unlike other intangible assets, goodwill is not amortized. That means it doesn't get systematically written down over time.
Okay.
It has to be tested for impairment at least once every year.
At least once a year.
Yeah.
And this all ties back into CGUs, right?
Yes, it does. When goodwill is recorded from an acquisition, it's allocated to the CGUs that are expected to benefit from that acquisition.
Okay.
And this is done at the lowest level that goodwill is monitored for internal management purposes. But it can't be larger than an operating segment.
So this allocation and how you define the CGU, it seems like there's a lot of judgment involved there.
You're absolutely right. There's a lot of judgment involved, and it can have a big impact on whether impairment is recognized.
Right. I see. And when you're testing a CGU that includes goodwill, is there a specific order you follow?
Yes, there is. If a CGU has goodwill, any other assets in that CGU have to be tested for impairment first.
Got it.
And any losses on those other assets, those are recognized before you even think about the goodwill. It's like you're making sure those underlying assets are valued correctly before you look at the goodwill.
Makes sense.
And another thing to remember about goodwill impairment, any loss on goodwill can never be reversed.
Never.
Yeah.
Never. Even if things get better later on, that goodwill impairment stays there.
Okay, that's important to remember. Different from other assets.
That's right.
What about intangible assets other than goodwill?
Well, there are some that are treated similarly to goodwill,
Okay.
like intangible assets with indefinite useful lives. Think of strong brand names or perpetual licenses.
Right, things that could last forever.
Exactly. And also intangible assets that aren't being used yet.
Okay.
These are tested for impairment at least annually,
Mm-hmm.
and also whenever there's an indication that they might be impaired.
Okay, so similar to goodwill.
Right. But for all the other assets that fall under IAS 36, they're only tested for impairment when there's a trigger.
Okay, so when there's a sign that their value might have dropped, so what kind of things would trigger an impairment test? What are the red flags?
There are internal and external triggers. Internally, it could be that an asset is becoming obsolete or it's been damaged.
Makes sense.
Or maybe the way the company uses the asset has changed, or they plan to sell it sooner than expected.
Okay.
Or maybe internal reports show that the asset isn't performing as well as they thought it would.
Right, all internal signs.
Yeah. External triggers could be a drop in the asset's market value.
Okay.
Or maybe there are bad changes in the technology, the market, the economy, or even the legal environment where the asset is used.
So like if a competitor makes a big technological breakthrough, that could trigger an impairment test for a company's existing technology.
Exactly.
Interesting. And then an increase in interest rates could also be a trigger.
Yes, because that can affect the discount rate used in the value in use calculation.
Right, because a higher discount rate means the present value of future cash flows is lower.
Exactly. And different industries have different risks. Like in technology, things become obsolete so fast that impairment reviews happen often.
Makes sense. So let's get back to value and use for a minute. What are the rules around cash flow projections?
Well, they have to be reasonable and supportable
Okay.
and reflect management's best estimate of future economic conditions with more weight given to external evidence.
So they can't just make up whatever numbers they want.
Right. They usually base these projections on the most recent budgets and forecasts,
Uh-huh.
and they generally don't go beyond 5 years unless there's a good reason for a longer forecast.
5 years seems like a reasonable time frame considering how uncertain things can be.
Right. It's about being realistic.
What about after those 5 years? What happens then?
After that initial 5 years, companies have to extrapolate the cash flows using a steady or declining growth rate.
Okay.
But that rate can't be higher than the long-term average growth rate for the industry or the overall economic growth rate for the country unless they can justify a higher rate.
So again, trying to avoid overly optimistic assumptions.
Exactly.
And what about the cash flows themselves? What should be included and what shouldn't?
Okay, so you can't include cash flows from future restructurings that the company hasn't committed to yet,
Okay.
or from future improvements to the asset. You're basically valuing the asset as it is right now, based on current plans.
Got it.
But you do have to include any cash outflows needed to maintain the asset's current level of performance, like maintenance or necessary upgrades.
Right. To keep things running.
Yes. And if the asset produces something that's used internally by another part of the business, the transfer prices in your calculation should reflect what you could get if you sold it externally.
So you're trying to be realistic about the value of those internal transfers.
Exactly.
What about working capital and inventory?
Well, working capital depends on the situation and how the CGU is defined. You're focusing on operating cash flows, so any changes in working capital that affect those flows should be considered. Inventory is usually dealt with separately under IAS 2, but if a company includes inventory in a CGU for practical reasons, then they have to include the future cash flows from selling that inventory and maybe adjust for gross margins if those are significant.
So it all comes down to being consistent and capturing all the relevant cash flow.
Precisely.
Okay, so now let's talk about the discount rate. You mentioned earlier how important it is.
It is, yeah. It has to be pre-tax, and it has to reflect the market's view of the time value of money and the risks specific to the asset or CGU.
Right, so basically the return that investors would expect for an investment with a similar risk profile.
Exactly.
How do you figure out what that rate is?
Well, you can look at recent market transactions for similar assets, or you can use the weighted average cost of capital, or WACC, of a comparable publicly traded company.
Okay.
But you have to adjust the WACC to reflect any specific risks of the asset or CGU being tested.
Makes sense.
And if you start with a post-tax rate, like you often do with WACC, you have to adjust it to pre-tax.
Okay, that adjustment sounds tricky.
It can be. The standard gives some guidance on how to do it, but it often involves an iterative calculation.
So definitely an area where companies might make mistakes or where analysts should pay close attention.
Absolutely. Okay, so now let's talk about fair value less costs of disposal.
Yep.
It's the price you'd get in a normal sale between knowledgeable, willing parties.
Right.
The best evidence is a recent transaction for the same asset.
Uh-huh.
But if there isn't one, and there's no active market for the asset, then you use the best available information,
Okay.
like recent transactions for similar assets or other valuation techniques.
But again, not a fire sale unless that's the only option.
Right. And you also have to consider the highest and best use of the asset.
What does that mean?
It means you have to think about how a market participant would maximize the asset's value, even if the company isn't using it that way right now.
Okay, so even if a company uses an asset in a certain way, they have to consider if there's a more valuable alternative use. Got it. So what happens when you find an impairment loss? How is that recognized in the financials?
Well, for an individual asset, you just reduce the carrying amount to the recoverable amount.
Okay.
And the difference, that's your impairment loss, which is recognized in profit or loss.
Straight to the P&L.
Yeah, unless the asset was previously revalued upwards, then the loss is treated like a reversal of that revaluation increase.
Interesting.
After the loss is recognized, the new lower carrying amount becomes the asset's new cost basis.
Okay. What about when a CGU is impaired?
That's more complicated. The loss is allocated in a specific order.
Okay.
First, it reduces the carrying amount of any goodwill in that CGU down to 0.
So goodwill acts like a buffer.
It does, yeah. If the loss is bigger than the goodwill, then the remaining loss is allocated to the other assets in the CGU based on their carrying amounts.
Proportionally.
Exactly. But no asset can be written down below the highest of its own fair value, less costs of disposal, its own value in use, or zero.
Right, so you don't go below its own recoverable value.
Exactly. And any loss on goodwill goes straight to profit or loss and can never be reversed.
Okay, we covered that earlier. So what about reversals for other types of assets?
You can reverse impairment losses on assets other than goodwill.
You can.
Yes, but only if the recoverable amount increases later because of a change in the estimates used.
Okay.
The reversal goes through profit or loss unless the asset is carried at a revalued amount.
And then it goes through other comprehensive income.
Exactly. But the carrying amount can't go above what it would have been if there had never been an impairment loss.
Right, so you can't inflate the value beyond its original trajectory.
Precisely. Now, disclosures are also really important for anyone looking at financial statements.
Yeah, what kind of information should we be looking for?
The disclosures under IAS 36 are meant to be very transparent.
Okay.
They should tell you about the judgments and estimates that management made.
So we can understand how they got to those numbers.
Right. For any asset or CGU where they estimated the recoverable amount, they have to disclose the key assumptions they used, especially those assumptions that have the biggest impact on the recoverable amount.
So if their value in use calculation depends heavily on a certain revenue growth rate, they have to tell us what that rate is.
Exactly. And if the recoverable amount is based on fair value less costs of disposal using present value techniques, they have to disclose every key assumption, the valuation technique, and the discount rates used.
So we can see how they did the valuation and if it makes sense.
Right. And if a small change in a key assumption could change whether there's an impairment or not, they have to disclose that too.
Okay, so like a sensitivity analysis.
Yes. It shows how much uncertainty there is around the impairment assessment.
Got it.
They also have to disclose specific things if some goodwill hasn't been allocated or if they're using a recoverable amount calculation from a previous period.
Okay, so quite a bit of information.
There is, but it's all designed to help people understand the asset values.
Makes sense.
Yeah.
So let's talk about the bigger picture. What are some of the challenges companies face when applying IAS 36?
Well, there's a lot of judgment involved, especially when making long-term forecasts and when there are no observable market prices for assets.
Right, it's not always clear-cut.
No, it's not. And people who use financial statements, regulators, and enforcement bodies, they often have concerns about how rigorous and objective these impairment assessments are,
Okay.
and whether the assumptions are supported by evidence and how transparent the disclosures are.
So there's a lot of room for interpretation.
There is, and things like the discount rate, the cash flow assumptions, and even how you define the CGUs, those can all affect whether you find an impairment or not.
So it's important for companies to apply the standard consistently and avoid generic disclosures that don't mean anything.
Exactly. And there's actually research that shows that the quality of impairment loss recognition can be different in different countries.
Interesting.
Maybe because of differences in regulations and enforcement.
Yeah, that makes sense. So it's been a real deep dive into IAS 36 and impairment.
It has.
Let's sum up the key takeaways for our listeners.
Okay, so basically IAS 36 is about making sure that asset values on the balance sheet don't exceed their recoverable amount.
Yeah.
And that means looking at both fair value less costs of disposal and value in use and using the higher of the two.
Got it.
This whole process involves a lot of estimations and judgment, especially when forecasting cash flows and choosing a discount rate.
Right.
And there are specific rules for different types of assets, like goodwill, which has to be tested every year, and where impairment losses are never reversed.
Okay.
And the disclosures are crucial for understanding the assumptions and uncertainties involved.
So for anyone analyzing financials, understanding IAS 36 is really important.
It is, yeah.
It's not just about the reported numbers, it's about understanding how they got there.
Mm.
So here's something to think about. Given how subjective these impairment assessments can be, how can we assess the reliability and usefulness of the disclosures we see in company reports? And how might things like changes in interest rates or technological disruptions affect how often and how big impairment losses are in different industries?
Yeah, it's definitely something to think about.
Well, thank you for joining us for this deep dive. Hopefully we've made impairment a little bit easier to understand. Stay tuned for future episodes where we'll continue exploring the world of finance and accounting. You know, when you're looking at a company's financials and you hit terms like provisions and contingent liabilities, it feels like a different language sometimes, doesn't it? You might be feeling a bit lost trying to figure out what they really mean for the company's health.
Yeah, that's a really common feeling, actually. I mean, the goal is clarity in reporting, but when you factor in future uncertainty, which happens, well, all the time in business, the picture can definitely get less straightforward.
Exactly. And that's what we're diving into today. Our aim is to really get to grips with IAS 37. That's International Accounting Standard 37, the one dealing with provisions, contingent liabilities, and contingent assets. Think of it as our map for navigating those uncertain obligations and maybe future benefits.
Precisely. And for this exploration, you've given us a fantastic set of materials. We've got the IASB's own research summary, an exposure draft looking at possible changes to both IAS 37 and IAS 19, some really insightful feedback from the European Financial Reporting Advisory Group, EFRAG.
Right, EFRAG. Plus a clear summary of IAS 37 itself. Extracts from loads of different accounting standards, IFRS, IPSAS, HKAS, NZIAS, and even some audit-related bits for that practical angle.
Yeah, a really good spread. So our mission, like you said, is to pull out the most vital insights for everyone listening. We're going to break down those core concepts, provisions, contingent liabilities, contingent assets, and also shine a light on some of the ongoing debates and potential changes in how these things are handled.
Okay, sounds good. Let's unpack this then, starting right at the foundation. What fundamentally is a provision?
Okay, so under IAS 37, a provision is defined as a liability, but one where there's uncertainty, either about the timing of when it needs settling or the exact amount that will be required. It's interesting because, that inherent uncertainty means you could argue that, in a broad sense, all provisions have a sort of contingent feel to them.
Oh, that's a good point. Uncertainty is baked right in. So if a provision is a type of liability, let's just get even more fundamental for a second and clarify what makes something a liability in the first place.
Absolutely, good call. The conceptual framework defines a liability as a present obligation of the entity.
Present obligation. Two
It
terms.
stands for an economic resource, and this obligation has to arise as a result of past events. So those two elements, present obligation and past event, they're absolutely crucial.
Okay, so a present obligation, that's a result of something that's already happened to a past event. How does that then translate into something we actually need to account for financially?
That's where the concept of an obligating event becomes really important. An obligating event is that specific past event that creates either a legal or a constructive obligation. And the key thing is, it leaves the entity with no realistic alternative but to settle it.
Legal or constructive, what's the practical difference there? Can you break that down?
Sure, a legal obligation is usually pretty clear-cut. It stems from things like a signed contract, specific legislation, or just the operation of law. Fairly defined. A constructive obligation is, well, a bit more subtle. It arises from the entity's actions. Maybe through a consistent pattern of past practice, like always fixing things out of warranty, or through publicly stated policies, or even a very specific current statement they've made. Basically, they've created a reasonable expectation in others that they'll accept certain responsibilities.
I see. So legal is formal, written down maybe. Constructive is more about the commitments implied by how a company behaves, the expectations it sets.
Okay.
Now, where do contingent liabilities fit into this picture? The name sounds so close to provision.
Yeah, and this is a really critical distinction to grasp. A contingent liability is one of two things. Either it's a possible obligation that arises from past events, but its actual existence will only be confirmed if some uncertain future event happens or doesn't happen, and that event isn't fully within the company's control.
Okay, so a maybe obligation dependent on the future. What's the other type?
The other type is a present obligation, so it meets that first part of the liability definition, but it fails the recognition criteria for a provision. This could be because it's not considered probable that settling it will require an outflow of economic benefits.
So less than a 50% chance of paying out.
Exactly. More likely than not isn't met. Or it could be because the amount of the obligation simply cannot be measured reliably enough at that point in time.
Okay, so a contingent liability is kind of a step further removed from being booked. It's either only possible or it's present, but not quite certain enough in terms of outflow or measurement. What about the flip side, contingent assets? That sounds like potential good news.
It is, potentially. A contingent asset is a possible asset that has arisen from past events, but again, its existence will only be confirmed by uncertain future events not wholly within the entity's control. Think maybe a pending legal claim where you're the plaintiff. Now, here's a really important point of difference, and you picked up on the good news aspect. IAS 37 is very strict about recognizing contingent assets. They are not recognized on the balance sheet unless the inflow of economic benefits is virtually certain.
Virtually certain. Wow, that sounds like an extremely high bar compared to probable for provisions.
It is. It's a much, much higher threshold.
Why the big difference? Why treat potential liabilities and potential assets so differently?
That asymmetry, that difference in treatment, is actually seen by many stakeholders, users of financial statements, as a real strength of IAS 37. There's a general accounting principle of prudence or maybe conservatism at play, a sort of bias towards caution, especially when recognizing potential gains compared to potential losses.
Ah, right.
Users often feel that for something to be reliably called an asset, there needs to be a very, very high degree of certainty about actually getting those economic benefits.
That makes sense. Sort of a don't count your chickens before they hatch approach for assets, but be prepared for potential costs. Okay, so we've got our definitions. Provisions are recognized uncertain liabilities. Contingent liabilities are possible or uncertain present ones that aren't recognized. And contingent assets are possible assets only recognized when virtually certain. Now, let's talk triggers. When do we actually recognize a provision? What are the specific criteria?
Right. There are three key recognition criteria, and all of them have to be met. First, as we've discussed, there must be a present obligation, legal or constructive, resulting from a past event. That's the foundation.
Okay, present obligation from a past event. Check. What's second?
Second, it must be probable that an outflow of resources embodying economic benefits will be required to settle that obligation.
Probable outflow.
And third,
And third, the amount of the obligation must be capable of being reliably estimated. You need all three.
let's dig into that probable outflow one a bit more. What does probable actually mean in the world of IAS 37? Is it like 90% likely? No, actually, within IAS 37, probable is defined simply as more likely than not. So strictly speaking, a probability greater than 50%.
Just over 50%. Okay.
Yeah. And this is a really interesting point of divergence between IFRS and, say, US GAAP, as some of the sources you give us point out. US GAAP often has a higher hurdle, especially for things like litigation provisions. They might use language like the prospects of success are judged to be slight before recognizing a liability.
Ah, so under IFRS, with that more likely than not threshold, a company might actually book a provision for, say, an ongoing lawsuit earlier than they would under U.S. rules.
Exactly. That lower threshold could potentially lead to earlier recognition. It's something companies operating under both systems have to manage carefully. There have even been some, discussions mentioned in the materials about whether this could theoretically impact attorney-client privilege in certain contexts, though that's a complex legal area.
Wow, okay. That's a really significant practical difference. So assuming we've met all three criteria, present obligation, probable outflow, reliable estimate, how do we actually figure out the amount? How do we measure the provision?
Good question. The standard says the amount recognized should be the best estimate of the expenditure needed to settle the present obligation at the end of the reporting period. Think of it as the amount the company would rationally pay to settle it right then, or maybe pay someone else to take it over.
The best estimate. But given all the uncertainty we've talked about, how do you actually arrive at that number in practice? It sounds subjective.
It definitely involves judgment, but the standard gives some guidance. It really depends on the nature of the obligation. If the provision covers a large population of similar items, think warranty claims on thousands of products, the standard suggests using an expected value approach.
Expected value. How does that work?
Basically, you consider all the possible outcomes for that population of items, you estimate the cost associated with each outcome, and then you weight each cost by its probability of occurring. You sum those weighted costs up to get the expected value.
Right. Can you give us a quick, maybe numerical example of that, just to make it concrete?
Let's use that warranty example. Imagine a company sells, say, 10,000 gadgets. Based on history, they figure 75% will have 0 issues, cost €0. 20% might have minor faults, costing maybe $1 million in total if they all occurred. And 5% could have major faults, potentially costing $4 million in total if they all happened.
Yeah.
The expected value calculation would be 75% plus 20% €, plus 5% $4 million. So that's 0 plus 200,000 plus 200,000 euro, which gives you an expected value and thus the provision of 400,000.
Got it. Weighting the possibilities. That makes a lot of sense for things like warranties where you have lots of data. But what about a single big obligation? Like a major environmental cleanup or one massive lawsuit, you can't really use probabilities across a large population there.
That's right. For a single obligation, the guidance suggests that the most likely outcome might be the best estimate. However, and this is important, the entity still needs to consider the range of other possible outcomes.
How so?
Well, if those other possible outcomes are significantly different from the most likely one, maybe there's a small chance of a much higher cost or a small chance of a much lower one, then the best estimate might need to be adjusted away from the single most likely amount. For instance, if the most likely repair cost is €1,000, but there's a non-trivial chance it could blow out to 5,000 due to complications, the best estimate provision should probably be higher than €1,000 to reflect that risk.
Okay, so even for single items, you look beyond just the most probable number. What about the timing? Does it matter when we expect to actually pay out these costs?
Absolutely. The time value of money is crucial here, where the effect is material, meaning where discounting would make a significant difference to the amount provisions must be discounted to their present value.
I discount.
Because, simply put, a euro you have to pay out 5 years from now is worth less than a euro you have to pay out today. You could invest that euro today and earn a return on it. So discounting reflects that time value.
Makes sense. What kind of discount rate do we use?
The standard specifies using a pre-tax rate or rates that reflect current market assessments of the time value of money and, importantly, any risks specific to that particular liability. However, a key point is that the discount rate should not reflect risks that have already been factored into the estimates of the future cash flows themselves. You don't want to double count the risk.
Okay, pre-tax rate reflects time value and liability-specific risks, but no double counting. Can you give us a quick illustration of discounting?
Sure. Let's say a company knows it will have to pay $1 million, but not for 5 years. If the appropriate pre-tax discount rate reflecting the risks and time value is, say, 15% per year, well, discounting $1 million back 5 years at 15% gives you a present value of roughly $497,177. That lower amount is what gets recognized as the provision today.
Right, so the further out the payment, the bigger the discounting effect, the lower the provision today. What about other uncertainties, like potential changes in technology affecting cleanup costs or new regulations coming down the line? How do they fit into the best estimate?
IAS 37 says risks and uncertainties should surround the estimation process. They should be considered when arriving at the best estimate. Our risk adjustment might actually increase the amount recognized as a provision to build in a cushion for uncertainty.
But isn't there a danger of companies just padding their provisions then, being overly cautious?
Yes, and the standard explicitly warns against that. It cautions against creating excessive provisions or deliberately overstating liabilities, sometimes called creating hidden reserves or cookie jars. The aim is a realistic best estimate, not just prudence run wild. Future events like new technology or laws should only be reflected if there's sufficient objective evidence they will occur. You can't just speculate about some miracle cleanup technology appearing if there's no basis for it.
Okay, so it's a real balancing act. Factor in realistic risks and future events with evidence, but don't create overly pessimistic or optimistic numbers. Now, we talked earlier about contingent liabilities, the ones that don't get recognized on the balance sheet. Are they just ignored then?
Oh no, definitely not ignored. Even though they aren't recognized, contingent liabilities must be disclosed in the notes to the financial statements unless the possibility of an outflow of economic benefits is considered remote.
Remote. How unlikely is remote?
Generally, remote is interpreted in practice as having a probability of less than about 5%. So if there's more than a very slight chance of an outflow, you need to disclose it.
And what information needs to be disclosed about these contingent liabilities?
Typically, the required disclosures include a brief description of the nature of the contingent liability, an estimate of its potential financial effect, if it's practical to make one, an indication of the uncertainties about the amount or the timing of any possible outflow, and also, importantly, information about any possibility of being reimbursed by a third party if the outflow does occur.
So users still get visibility, even if it's not on the balance sheet. What about those contingent assets we discussed? If they don't meet that super high, virtually certain bar for recognition, do we disclose them too?
Yes, there's disclosure for them as well, but again, the threshold is different. If an inflow of economic benefits from a contingent asset is considered probable, so, more likely than not, that same 50% test we use for provision recognition, then the entity should disclose the nature of the contingent asset and, if practical, give an estimate of its potential financial effect.
Oh, so disclosure kicks in at probable for contingent assets, but recognition only happens at virtually certain. Still that asymmetry.
Exactly. Disclosure gives users a heads up about potential future inflows, but you don't book it as an asset until it's almost a done deal.
Let's shift gears slightly now and talk about a specific situation that often triggers provisions: onerous contracts.
What exactly makes a contract onerous under IAS 37?
An onerous contract is defined quite simply as a contract where the unavoidable costs of meeting the obligations under that contract are higher than the economic benefits expected to be received from it. Basically, it's a contract you're locked into that you know is going to lose you money overall.
Okay, a guaranteed loss maker. How do you figure out those unavoidable costs?
The unavoidable costs are measured as the lower of two amounts: either the cost of actually fulfilling the contract completely, or any compensation or penalties that would arise from failing to fulfill it, basically the cost of getting out of it.
So you look at the cost of carrying on versus the cost of canceling,
Yeah.
and the unavoidable cost is whichever is cheaper or less costly.
Precisely. You're looking for the least net cost of exiting the situation. Now, there was an important clarification added relatively recently, back in May 2020, about what costs you include in the cost of fulfilling the contract.
Oh, right. What did that clarify?
It made clear that the cost of fulfilling includes not just the direct incremental costs, like the materials and direct labor specifically for that contract, but also an allocation of other costs that relate directly to fulfilling contracts. Think things like the depreciation charge for a piece of equipment that's being used specifically to fulfill that contract, or maybe allocated overheads directly related to contract activities.
Ah, so it broadened the scope of costs to consider, potentially making more contracts look onerous than before.
Potentially, yes.
Look.
It closed off an interpretation where some might have only included purely incremental costs. Now it's clearer that directly related allocated costs count too.
Okay, that's a significant point. Now, before we actually recognize a provision for an onerous contract, is there anything else we need to do first? Any other accounting steps?
Yes, very important point. Before recognizing a specific provision for an onerous contract, the entity must first recognize any impairment loss that has occurred on any assets that are dedicated to that contract.
Impairment loss first. Why?
Because you need to make sure those dedicated assets aren't already overstated on your balance sheet. If the assets used to fulfill the contract are worth less than their carrying amount, you write them down first. Only then do you assess the remaining contract costs against benefits to see if an additional onerous contract provision is needed for the unavoidable loss.
Got it. Write down the related assets first, then book the contract loss. Can you give us a quick, simple example of calculating that unavoidable loss?
Okay, imagine a company has a contract to build something. They estimate the total remaining costs to finish the job are 300,000 euros. But the total revenue they'll get from the customer is only 240,000 euro. So just carrying on leads to a 60,000 euro loss. 300K costs 240K revenue.
Right, clear loss if they fulfill it.
But let's say the contract allows them to cancel, but they'd have to pay a penalty of 40,000 euro. In this scenario, the unavoidable cost is the lower of fulfilling it, loss of 60K, and canceling it, cost of 40K.
So the unavoidable cost is 40,000 euro.
Exactly. So they would recognize an onerous contract provision for 40,000 euro, representing the least costly way out of that loss-making contract.
Okay, that really clarifies the lower of principle. Now let's move on to another common trigger for provisions: restructurings. Companies reorganize, close divisions, etc. When do the costs associated with these restructurings lead to a provision?
A provision for restructuring costs can only be recognized when the entity has a constructive obligation to restructure. Just management deciding internally isn't enough.
What creates that constructive obligation then?
It arises when two conditions are usually met. First, the entity needs to have a detailed, formal plan for the restructuring, identifying things like the business involved, locations affected, approximate number of employees to be compensated, the expected expenditures, and when the plan will be implemented.
Okay, a detailed plan. What's the second condition?
Second, the entity must have raised a valid expectation in those affected that it will carry out the restructuring. This usually happens either by starting to implement the plan or by announcing its main features to those affected, like employees or customers, in a sufficiently specific way.
So it's plan plus action or communication. Just talking about it in the boardroom doesn't cut it. What kind of costs can actually be included in that restructuring provision?
The provision should only include the direct expenditures that are necessarily entailed by the restructuring itself, and, crucially, costs that are not associated with the ongoing activities of the entity.
Can you give examples of what's in and what's out?
Sure. Costs like employee termination benefits for those being made redundant as part of the plan would typically be included, maybe costs of dismantling plant or closing facilities. What would not usually be included are costs like retraining or relocating staff who are staying with the company, marketing costs to, say, launch a new brand image after the restructuring, or investments in new systems or distribution networks. Those relate to the future conduct of the business, not the act of restructuring itself.
Right. It's about the direct costs of the restructuring, not the cost of running the reshaped business afterwards. Makes sense. Okay, one more specific area, reimbursements. Sometimes, if a company has to pay out for a provision, like a warranty claim or an environmental cleanup, they might expect to get some or all of that money back from a third party, maybe an insurer or a supplier. How do we account for that potential recovery?
A reimbursement is recognized, but only when it is virtually certain that the reimbursement will be received if the entity settles the original obligation.
Virtually certain again. Same high bar as contingent assets.
Exactly the same high bar. And it's recognized as a separate asset, not netted directly against the provision itself on the balance sheet. Although in the income statement, the expense related to the provision can be presented net of the amount recognized for the reimbursement.
And can the reimbursement asset be bigger than the provision?
No. The amount recognized for the reimbursement cannot exceed the amount of the related provision. You can't recognize an asset for getting back more than you expect to pay out.
Okay, so separate asset, only when virtually certain and capped at the provision amount. Got it. Let's just quickly run through some of those specific examples you mentioned earlier, just to see how these principles apply in different scenarios.
Absolutely, helps make it real. So warranty obligations, classic provision, often uses expected value, triggered by the past sale. Contaminated land cleanup could be a legal obligation if laws mandate it, or constructive if the company has a public policy or track record of cleaning up spills even without a law.
Offshore oil field decommissioning.
Usually a legal obligation arising when the platform is installed or the field is developed based on license agreements, measured at present value often because it's far in the future.
A generous refunds policy.
That can create a constructive obligation if it goes beyond legal requirements and is a well-established practice that customers rely on.
Closing a division.
Provision only when there's that detailed plan and it's been announced or implementation has started, creating the constructive obligation for termination costs, etc.
A new law requiring smoke filters on factories by next year.
No obligation yet. The obligating event is actually operating the factory without the filters after the deadline or the act of installing them. The law itself doesn't create the present obligation until non-compliance occurs or the cost is incurred.
Court cases.
This is a common one. No provision initially. A provision is recognized only when, based on legal advice and evidence, it becomes probable, more likely than not, that the company will lose and have to pay out, and the amount can be reliably estimated. Before that, it might be disclosed as a contingent liability.
And onerous leases.
If a company is stuck in a lease for property it no longer uses and can't sublet, it needs to recognize a provision for the unavoidable lease payments, usually discounted to present value, representing the lower of continuing to pay the rent or paying any penalty to break the lease.
Great overview.
Yeah.
Those examples really show the breadth of situations IAS 37 covers.
Yeah.
Now, you mentioned IAS 37 isn't set in stone. There have been discussions, research, amendments. What are some of the key areas of, let's say, ongoing debate or recent change?
Well, the IASB has certainly kept IAS 37 under review. There's ongoing research looking into potential better alignment with the definitions in the conceptual framework, particularly around the definition of a liability itself and when an obligation arises.
Okay.
There were significant past proposals, for instance, to require all provisions to be measured using an expected value approach. But as we touched on, that got quite a bit of pushback from stakeholders, especially for single, large, uncertain events where assigning probabilities feels very subjective and maybe not reliable.
Right. It's a single event problem. What else?
Another area is the discount rate. IAS 37 is relatively light on specific guidance about including or not including non-performance risk. That's the risk the company itself might default on the obligation in the discount rate. Practice varies, and it's an area of some debate.
Non-performance risk. Interesting complexity.
Yeah. And the recognition of reimbursement rights that virtually certain threshold. Some argue it's too high and doesn't reflect the economic reality if recovery is highly likely, but not quite virtually certain. There was even a proposal in a past exposure draft, interestingly, to potentially eliminate the term contingent asset altogether, but that didn't proceed.
Wow. Eliminating contingent asset, that would have been a big shift.
It would have. And of course, as we discussed, the relatively recent amendments clarifying the costs to include when assessing if a contract is onerous, that was a direct response to diversity in practice and requests for clarification.
So it definitely sounds like a standard that's actively monitored and refined based on practical application and evolving accounting thought. Okay, wrapping up then. Why is understanding all this
The definitions, the criteria, the measurements, the debates. Why is it so important for people actually using financial statements? Investors, analysts, lenders.
It's absolutely crucial. Provisions and contingent liabilities represent significant uncertainties that can materially impact a company's future financial performance, its cash flows, and its overall stability. Understanding how these are accounted for helps users assess the potential risks embedded in the balance sheet and income statement.
And you mentioned variations in practice.
Exactly, because there's judgment involved in estimating probabilities, cash flows, choosing discount rates, deciding which costs to include for onerous contracts. Differences in application can lead to substantial variations in the reported amounts between otherwise similar companies. This can really hinder comparability.
So understanding the rules helps users make better comparisons and potentially spot where management might be being more conservative or perhaps more aggressive in their judgments.
Precisely. Having a solid grasp of IAS 7 equips users to ask better questions, to understand the disclosures more deeply, and ultimately to make more informed economic decisions about the company. It helps them look beyond just the bottom line numbers.
Okay, so to kind of bring our deep dive to a close here, IAS 37 gives us this really essential framework for dealing with uncertainty and liabilities and potential assets. It demands a structured approach when to recognize, how to measure, what to disclose, trying to strike that balance between providing relevant, reliable information and acknowledging the inherent uncertainties involved.
That sums it up perfectly. And as we've definitely seen, applying these principles often requires significant judgment. The standard isn't just a simple checklist, it requires thought. And it's a living standard, evolving as the IASB gets feedback and tries to improve clarity and consistency.
And ultimately, it really comes down to management carefully, considering the specific facts and circumstances, using all the available evidence when they apply these rules. Right?
Absolutely. Evidence and judgment are key.
So here's maybe a final thought for our listeners to ponder. Considering the level of judgment that is involved, particularly in estimating provisions and assessing contingencies, what role do you think transparency and really thorough disclosure in the notes actually play in bolstering the overall reliability of what companies report in this area? It's definitely something worth thinking about next time you're looking through a set of accounts and those detailed notes.
A very important question to consider.
Well, that's all the time we have for this deep dive into IAS 37. We genuinely hope this has helped demystify some of these complex but really important accounting concepts. Thanks for joining us. Welcome back to the deep dive. Today we're going deep on intangible assets and how these kind of, I guess you could say, non-physical assets are dealt with under IFRS, so that's International Financial Reporting Standards, specifically IAS 38.
Yeah.
You've given us some really in-depth sources here, lots to unpack, but I think our mission today is to really pull out what are the key issues and debates around how these assets, which are becoming more and more important to how companies actually generate value,
Right.
are treated from an accounting perspective?
Yeah, I think that's exactly right. And, I think your sources do a really good job of exploring kind of that core pension that exists, right? How do you measure something? How do you recognize something you can't actually touch? And then, kind of what are the implications of that? And so we'll be looking at how these accounting rules actually then impact what you see on a company's financial statements. And then also looking at the way companies are talking about these assets and some of the challenges and differences that you see in practice. But I think, for anyone trying to understand businesses today and what actually drives value, this is a pretty essential topic.
Yeah, absolutely. And just to jump straight into it, I think one of the things that struck me going through the material is that you've got this kind of fundamental difference, right, where how intangible assets are accounted for is different depending on whether a company acquires them or generates them internally.
Yeah.
And it feels like that would make it so difficult to actually get a clear picture when you're comparing different companies.
It absolutely does. This is a kind of a key criticism or area of concern that investors often raise, is that the accounting makes it really difficult to have a like-for-like comparison between, let's say, a company that's gone out and purchased a brand versus a company that's built up a brand organically over time.
Right.
And so you have the situation where, one company might have a very significant asset recognized on its balance sheet,
Yeah.
and another company, even though they may have an equally valuable brand, it's not going to be reflected in their financial statements in the same way.
At all.
Yeah.
Yeah.
And so, this is one of the reasons why analysts and investors often look beyond, just the reported numbers in the financial statements to try and get a better understanding. And then on top of that, we have to remember that IAS 38, generally requires there to be an active market
Right.
in order to use fair value.
Yeah.
And an active market for these unique assets, things like brands or patents, often just doesn't exist.
Right. Right. And it seems like to even start to unpack all of this, we need to be very precise in the language that we use. Because one of the sources highlights the need for a consistent terminology when we're talking about intangible assets.
Yeah.
So what does that mean? And why is that so important for investors to understand?
Yeah. So, we're dealing with concepts that are by nature pretty complex, right?
Yep.
If we don't have a shared understanding of what we actually mean when we say things like intellectual property or know-how, or even, distinguishing between the different stages of creating an intangible asset, like the difference between research and development, then it becomes almost impossible to have a meaningful discussion about how we account for these things.
Right.
So this lack of precision can really create a lot of confusion and can make it harder for investors to interpret what they're seeing in the financial statements.
Okay, so we've talked about kind of the practical challenges of actually trying to, recognize these assets and put them on the balance sheet.
Yeah.
The sources also bring in the perspective of academics who've been studying this. So I'm kind of curious to get your take on what are some of the big takeaways from the academic research that investors should be aware of?
Yeah, so broadly speaking, the academic literature kind of falls into two camps on this. You have, some academics who strongly believe that current financial statements just don't do a good enough job of capturing the real value of these internally generated intangible assets.
Right.
They would argue that, this is because the accounting rules haven't kept pace with the way value is actually created in today's economy.
Right.
So, they're pushing for changes in the way that we recognize, in the way that we measure, in the way that we disclose these assets in the financial statements.
But then there's this other argument, right, that the income statement, in a way, already provides the information. Can you talk a little bit about that?
Yeah. So the counter-argument essentially goes that, look, even though these internally generated intangible assets may not be showing up as assets on the balance sheet, the cost to develop them, like research and development expenses or marketing expenses, are being reflected in the income statement. So the argument is that, in a way, investors are already seeing the financial impact of those activities. So, I think it's important to note that even though they're arguing that the information's there, even the folks that hold this view generally agree that there needs to be much better disclosure.
Right.
So regardless of whether it's recognized as an asset or not, there's a pretty strong consensus that companies just need to be doing a better job of providing more information about these intangible assets.
Okay. So that brings us to what the IASB is considering, right? So that's the International Accounting Standards Board, the folks who are behind IFRS. It sounds like they're at the very early stages of trying to figure out what a project on intangible assets might actually focus on.
Yeah. They are very much in the fact-finding mission stage right now, trying to really define what are the core problems.
Okay.
And they're asking some pretty fundamental questions about the scope of any potential changes. So, for example, should they be focusing very narrowly on just how intangible assets and the related expenses show up in the financial statements themselves?
Right.
Or should they be taking a much broader view, maybe even looking at intangible items that currently don't meet the definition of an asset under IFRS?
That seems like a huge difference in terms of what investors would see and have to consider.
Okay.
So they might be looking at, beyond just the balance sheet or the income statement.
Yeah. Exactly. And then they're also asking what kind of information should they be looking at? So should it be limited to, just the details about the intangible assets that are already recognized, such as their useful lives or how they're amortized?
Right.
Or should they be going broader and looking at, other information that companies might be tracking internally, things like customer numbers or net promoter scores, which is a measure of, customer satisfaction.
Okay.
And then, crucially, they're looking at which types of intangible items should be the focus. So is it the intangible assets that are already recognized, the ones that aren't recognized, or even things like, a skilled workforce, which currently isn't recognized as an asset under IAS 38.
Right.
So there's a lot of different directions this could go.
It really does feel like they're trying to wrap their arms around the whole problem.
Yeah. They're trying to figure out, what are all the angles here?
Yeah.
And importantly, they've made it very clear that they're not looking for solutions at this point. What they need right now is input from stakeholders, whether that's investors, preparers, academics, really anybody who's got a vested interest. First, is their initial list of potential topics comprehensive? Are there things that are missing from that list? And then, which of these problems are the most pressing? Where do they really need to be focusing their attention?
Okay.
And I think a key concern that they've raised is, are the current requirements in IAS 38 really adequate for dealing with kind of new ways that companies are accessing and using intangible items? So, one example might be cloud computing arrangements. How do these rules really apply to those sorts of transactions?
Yeah.
And are they really reflecting the underlying economics of those transactions?
So one of the sources you provided presents, I guess you could say, an alternative way of thinking about intangible assets. And I really liked how they approached it. It's not just about kind of slapping more intangible assets onto the balance sheet. And this source really emphasizes the fundamental link between the balance sheet and the income statement through the double entry accounting system. So can you talk a bit about that and how this source approaches this challenge?
Yeah, absolutely. So I think the source really highlights something that I think is often missed in these discussions, which is that recognizing an asset on the balance sheet directly impacts how we measure value creation in the income statement.
Okay.
And that's because of this double entry bookkeeping system.
Right.
So every time you make an entry on the balance sheet, you're also making a corresponding entry somewhere else. And it's either going to be in the income statement or the statement of cash flows.
Right.
So if you decide to recognize an asset, you're going to be impacting how you measure profitability. And I think a central idea here is this concept of uncertainty, right? We've talked a little bit about uncertainty already.
And this is definitely a recurring theme when we're talking about these types of assets.
Yeah, and I think the source suggests that how we deal with this uncertainty is really what should be driving how we think about the accounting. So they highlight, two specific features that they think are really important for deciding whether something should be recognized as an asset on the balance sheet. First is this expenditure requirement.
Okay.
So the company has to have spent money on this item. And the second is separability. So they have to be able to, clearly identify that expenditure separately from other transactions.
Okay.
And they propose that actually these spending-related features are more important than whether the asset is physically tangible or not.
So it's not so much about what it is, but how it was acquired or created.
Yeah, exactly. And I think it's kind of a different way of thinking about it. It's less about the nature of the asset itself and more about, how did it come into being?
Right.
Was there an identifiable expenditure? And the source also argues that, really the main purpose of accounting should be to inform on the performance of the business model.
Right.
And they kind of draw this comparison to how IAS 16, which deals with property, plant, and equipment, defines tangible assets by, essentially what they do. And they kind of contrast that with IAS 38, which they argue doesn't really have that same kind of clear, ostensible purpose.
Okay. So your sources dig into the kind of, why is it so difficult to put internally generated intangible assets on the balance sheet?
Yeah.
And they highlight some specific problems, and it seems like the uncertainty around future revenues is a big one for investors to understand.
It is. I mean, this is one of the core issues, right? So, let's take the example of a pharmaceutical company developing a new drug. So, they spend a lot of money over a number of years researching, developing this drug. And then, it fails in clinical trials.
Yeah.
So what happens? Well, they might have an asset on the balance sheet that's not actually going to generate any future economic benefits.
Right.
And that creates all sorts of problems in terms of, how do you amortize that asset? How do you determine its useful life?
Yeah. It seems like it would be a very subjective exercise.
It can be. And it can lead to, the reported earnings, not really reflecting what's going on in the business, because you might end up having to write down that asset later on and take a big impairment charge. So it creates a lot of volatility and uncertainty.
Okay.
Now, the other side of that coin is that if you were to expense all of those costs immediately, well, then you have a different problem, which is that you're recognizing the expense before you've recognized any of the potential revenue. Yeah.
And so, that's not a great matching either.
Right.
So it's a really tricky situation.
And then there's this other point that you touched on a bit earlier, but it seems like the spending requirement, what about valuable intangibles that might not actually involve clear, identifiable spending?
Yeah, this is a great point. So, think about things like the relationships and networks that a company builds.
Mm-hmm.
So,
people might refer to as social capital,
Right.
or even, the combined knowledge and skills of its employees.
Right.
These things can be incredibly valuable to a company. But it's very difficult to tie them back to specific expenditures. How do you measure the cost of building a relationship?
Right.
It's not always that simple. And so this makes it very difficult to recognize those things on the balance sheet under the current rules, which often focus very much on, the cash that goes out the door, the investment that's made, and then, the return that's generated on that investment.
Okay. And then there's also this challenge of separability for investors, right? Like being able to actually separate out the investment component of expenditures.
Yeah, and I think advertising is a great example of this. So, when a company runs an advertising campaign, some portion of that is really aimed at generating immediate sales, right? You see
Yeah.
the ad, you go out and buy the product.
Yeah.
But then, another portion of that is really about building long-term brand recognition. It's about creating that kind of emotional connection with the consumer.
Right.
And so trying to separate those two and saying, well, this much of our advertising spend was really creating a brand asset, that's really difficult and it's very subjective.
Yeah.
And that lack of separability, it makes it very difficult to use, the cost of creating that asset as a reliable way to measure it.
Right. And then finally, the sources touch on this idea of control and how that can affect whether an internally generated intangible can even be recognized as an asset.
Yeah, so control is a key part of the definition of an asset under IFRS.
Okay.
And so for some of these internally generated benefits, let's say, for example, the skills that an employee gains from training,
Okay.
or a talented employee who, isn't tied down by an employment contract, the company might not actually have sufficient control
Right.
over those benefits because, that employee could walk out the door the next day and take those skills with them.
Right.
And so if you don't have that control, then it doesn't meet the definition of an asset.
Okay. So given all these difficulties in recognizing these internally generated intangible assets on the balance sheet, it seems like, providing more information, what we call enhanced disclosure, might be a more practical path forward for investors to at least get a better sense of what these assets are and how important they are.
Yeah, and this is an argument that you see in several of the sources. So the idea is that, look, even if we can't reliably put a specific number on, some of these intangibles on the balance sheet, giving investors more detail in the notes to the financial statements or in management's discussion and analysis can still be really helpful in understanding what's actually driving value in the business.
And there's been research, right, suggesting that this kind of additional information can be helpful for investors.
There has. So there's been some academic research, particularly in specific industries, showing that when companies disclose more about their intangible assets, it does have what's called value relevance. So that's just a fancy way of saying that the information is actually reflected in the company's stock price.
Okay.
So it's actually useful to investors. And then there have also been some suggestions for more standardized disclosures at an industry level. So the thinking there is that, look, certain types of intangibles are very common
Right.
within a particular industry. So, if you're looking at software companies, the key intangibles are going to be things like software, patents, their developer team, their brand. And so having a more consistent way of reporting on those within that industry could be very useful for investors when they're trying to compare different companies.
Yeah, that makes sense. To kind of, I guess, make some of these ideas a bit more concrete, the sources provide a few examples and case studies. And I thought the one about the IFRS Foundation's bound volume, which is kind of interesting because it's, a book of their accounting standards. Is that something we should think of as a tangible book or an intangible asset?
Yeah, and I think this is kind of a perfect example of where the lines can get blurry.
Yeah.
So, it's a physical book. You can hold it in your hands, but clearly the real value of that is in, as one of the sources puts it, the knowledge embodied in it.
Right.
And so, I think it really highlights the challenge of, categorizing an asset when the intangible aspect is clearly the most important part.
And then there's this comparison of how Airbus and Boeing account for their development costs. And what does that show us?
Yeah, so this is interesting because this highlights kind of the different ways companies deal with costs that have both physical and non-physical elements. So developing a new airplane. So, Airbus reportedly tries to separate the tangible and intangible costs and capitalize those that meet the criteria under IAS 38.
Okay.
So, the software development cost, for example, might be capitalized, whereas, the cost of the raw materials to build the plane would be expensed. Whereas Boeing uses something called program accounting, where they recognize all of the costs associated with the program
Okay.
and then spread those costs out over each aircraft that they produce. So it's kind of more of a total cost allocation approach.
Got it. And then there's a really good example, I thought, with a hypothetical company that one of the sources looks at in detail. So what does this show us about the kind of current reporting practices for intangible assets?
Yeah, so this case study is really helpful because it gives you a kind of a snapshot of a company's balance sheet and income statement,
Right.
along with, some key performance indicators that aren't financial. And so you can kind of start to see the different types of information that are being provided. And I think what really stands out is the mix of intangible assets that are recognized and those that aren't.
Okay.
So they've got brands and patents that they've acquired from other companies, and those are recognized on the balance sheet.
Yeah.
They've also got development and research costs that they've capitalized. Now, we have to remember, under IFRS, typically research costs are expensed.
Got it.
So the fact that they're capitalizing some of those is notable. And then they've also got some very significant internally generated intangible items, so their own brands,
Okay.
customer lists, and patents, and none of those are recognized on the balance sheet. So even within the framework of IFRS, there's a fair amount of, I guess you could say, flexibility for companies to decide how they want to account for some of these things, which could make it very challenging for investors to really compare them apples to apples.
It absolutely can.
Mhm.
And, this case study goes on to kind of compare this company's stock market valuation to others in their industry.
Right.
And it kind of hints at the fact that, look, the market might actually be taking into account these unrecorded intangible assets,
Right.
when they're valuing this company. So even though they're not showing up in the financial statements, there's a recognition that, they exist, they have value,
Right.
and the market's kind of factoring that in. And then the other interesting thing about this case study is the inclusion of these non-financial metrics. So things like, metrics related to innovation or employee skills or customer focus. And so I think it really highlights this point that,
Right.
Some people have made, which is that, you need to look beyond just the financial statements.
To really get a complete picture of value creation.
Okay, so let's dive into the specifics of IAS 38 itself now.
Mm-hmm.
So what's the kind of fundamental definition of an intangible asset that investors should be aware of?
Yeah, so IAS 38 defines an intangible asset as an identifiable non-monetary asset without physical substance.
Okay.
Now, there's a lot to unpack in that definition, but, essentially what they're saying is it's something that, you can separate and distinguish from other assets. It doesn't have a fixed monetary value, so, it's not cash or receivable,
Okay.
and it doesn't have a physical form. And importantly, the entity has to control the asset.
Right.
And they have to be able to demonstrate that they have the right to obtain the future economic benefits that are expected to flow from that asset.
So it's not just about identifying something that's non-physical. There has to be some level of control and future benefit.
Yeah, absolutely.
Okay.
Yeah.
And so what are some of the key hurdles that companies have to overcome to actually recognize one of these intangible assets on the balance sheet?
Yeah. So IAS 38 lays out two key recognition criteria. The first is that it must be probable
Okay.
that those future economic benefits that we talked about are actually going to flow to the entity.
So some level of certainty.
Yeah, exactly. And the second is that the cost of the asset can be measured reliably.
Okay.
So, if you can't measure it, you can't recognize it.
Got it. Now, for the intangible assets that are generated internally,
Yeah.
IAS 38 makes this distinction between the research phase and the development phase, which seems important.
It is. And this is actually where a lot of the complexity and the debate really comes in. So research costs are always expensed as they're incurred.
Okay.
So, if a company is doing basic research, trying to come up with new ideas,
Right.
those costs are going to hit the income statement immediately.
Okay.
However, development costs can be capitalized. So they can be recorded as an asset on the balance sheet, but there's a big but.
Okay. What's the but?
Only if the company can demonstrate that specific criteria are met.
And what are some of those criteria that are important for investors to be aware of?
Yeah. So some of the key criteria include demonstrating that the asset is technically feasible. So, it's actually possible to complete the asset so it can be used or sold.
Okay.
The company has to intend to complete the asset and use or sell it.
Okay.
They have to have the resources to complete the development.
Right.
It has to be probable that it's going to generate future economic benefits.
Okay.
And they have to be able to reliably measure the expenditure.
So it's a pretty high bar.
It is a pretty high bar. And there are some types of internally generated intangible assets that are explicitly prohibited from being recognized.
Okay. And this is important for investors to keep in mind.
It is. And so IAS 38 specifically says, no, you cannot recognize internally generated goodwill, brands, mastheads, publishing titles, customer lists, and similar items.
Right.
So this really highlights, this bias towards expensing a lot of the intangibles that a company creates itself.
Okay. So let's say an intangible asset meets all the criteria, gets recognized on the balance sheet.
Yeah.
How is it initially measured?
Yeah, so generally it's initially measured at cost.
Hmm.
And the cost, includes all the necessary expenditures to get that asset ready for its intended use.
Okay.
So, that could be the purchase price if you acquire it externally, or it could be the development costs
Right.
if you've created it internally. Now, if it's part of a business combination,
Okay.
then the cost is actually its fair value at the acquisition date.
Okay. So once the intangible asset's been recognized, what are the different ways that its value can be shown over time?
Yeah, so after initial recognition, you have two main options. You've got the cost model, which is the simplest and most common, where you basically show the asset at its original cost,
Right.
less any accumulated amortization and impairment losses.
Yep.
And then you have the revaluation model, which, as the name suggests,
Yeah.
allows you to revalue the asset to fair value. But this is much less common for intangible assets because, as we've talked about, it requires you to be able to determine fair value by reference to an active market. And, for many intangible assets, that's just not possible.
Okay. Now, this concept of amortization is important for intangible assets that have a finite useful life. So how does that work?
Yeah, so amortization is basically the process of spreading the cost of that intangible asset over its estimated useful life.
Right.
So it's kind of like depreciation, but for intangible assets.
Okay.
And so this amortization expense is recognized typically in the profit and loss, although sometimes it can be included in the cost of other assets. So, for example, if the intangible asset is used in the production of inventory,
Right.
you might include the amortization in the cost of that inventory. Now, intangible assets that are considered to have an indefinite useful life, well, those are not amortized.
Okay.
But they do have to be tested for impairment at least annually. So that's basically just checking to see if the value of the asset has declined
Okay.
below its carrying amount on the balance sheet.
Okay. The sources also touch on how IAS 38 applies in some specific situations, such as cloud computing arrangements. So how should investors think about those?
Yeah. I mean, cloud computing is ubiquitous these days.
Right.
It's everywhere. And so the accounting can be a little bit tricky.
Okay.
But the key thing is whether the customer, so the company that's using the cloud computing service, recognizes an intangible asset.
Okay.
And this hinges on whether they essentially have a software lease. So what does that mean? That means they have the right to use substantially all of the economic benefits of the software throughout the contract term.
Okay.
If they do, then they would recognize an intangible asset. However, if it's not a software lease or they don't otherwise obtain control of the software at the commencement of the contract, well, then it's just treated as a service.
Okay.
And they just recognize the expenses as they use the service.
Okay. And then another area that's kind of relevant for investors in certain industries is extractive activities. So things like mining, oil, and gas. How are those exploration and evaluation costs accounted for?
Yeah, so this is a bit of a special case, and IFRS actually has a separate standard, IFRS, that specifically deals with exploration and evaluation expenditures. And it actually acknowledges that, there are different views on whether these costs even meet the definition of an asset in the first place. So IFRS 6, says, look, we're going to assume that these expenditures could give rise to an asset.
Okay.
But recognizing them as such is only appropriate if it provides useful information to the primary users of the financial statements, which would be investors. So, generally, IFRS 38 would require research costs to be expensed. Right. But IFRS 6 does allow you to capitalize exploration and evaluation expenditures in certain specific circumstances.
Okay. And then finally, the academic research seems to have some conflicting findings on whether it's more useful for investors if companies capitalize or expense R&D costs.
Yeah, and I think this is a really interesting area. I think the academic research really doesn't give you a clear-cut answer.
Okay.
So, there are studies that suggest that, capitalizing R&D can actually lead to companies providing more voluntary disclosures.
Okay.
And it can also make stock prices more informative to investors. So, in other words, the market is actually able to
Yeah.
incorporate that information into the stock price. However, there are other studies that find that expensing R&D immediately might actually be as good or even better at explaining market values.
Okay.
And then there are even some studies that have found that, capitalizing R&D under IAS 38 might actually make analysts' forecasts less accurate. So, it's a really interesting area. I think it just highlights the fact that, there's still a lot of debate about the best approach.
Yeah, it seems like more research is needed.
Yeah.
And what about the overall usefulness of the intangible assets that are actually recognized in financial statements for investors?
Yeah. So there's been some research looking at this, and it suggests that, strategically important intangible assets that are recognized as part of a business combination, so when one company buys another company, those intangible assets can actually provide more information to investors than just the goodwill that's also recorded. So, if you break out the value of the brands, the patents, the customer relationships, that can be more useful than just having this big lump sum goodwill number.
Right.
However, intangible assets that are not strategically important or that are easily replaced, those might not be as informative.
Okay.
And then, there's a bigger question, I think, which is, are financial statements in general becoming less relevant?
Right. Expert speaker.
Welcome to the deep dive, where we take the information you've shared and, extract the key knowledge. We're aiming to give you a shortcut to being well-informed and maybe even find some surprising angles. Today, you've given us a really interesting mix, some practical stuff, some academic bits, financial statements, accounting research papers. We're plunging into the details of investment property accounting under International Financial Reporting Standards, focusing particularly on IFRS.
Exactly. Yeah. It's a good set of materials. We've got IS-40 itself, sort of the rule book, an illustrative set of IFRS financials showing it in practice, and then some quite insightful academic papers looking at the implications and the choices involved.
Okay.
So our goal really is to navigate this with you, get a handle on the core principles for investment properties, and understand some of the debates around how they're treated.
Right. Okay, let's unpack this then. At the very basic level, what is an investment property according to IS-40? What's the key thing?
Well, the standard is pretty specific. It defines it as land or building or, part of a building or both that's held to earn rental income or for capital appreciation, or sometimes both. The really crucial bit here is the intention. It's not property used for, say, producing goods or services or for admin purposes or stuff held for sale in the normal course of business.
Okay.
Think more like an apartment building a company owns just to rent out, or maybe undeveloped land they're holding on to, hoping its value goes up.
So it really boils down to why you're holding it. Okay.
Yeah.
When a company first gets one of these properties, how does it go into the books initially? What's the starting point?
Okay, so initial recognition is at cost, but cost here isn't just the purchase price.
Right.
It includes all those direct costs needed to get the property ready for use, things like legal fees, broker commissions, property transfer taxes, that sort of thing. And interestingly, sometimes if a company borrows specifically to finance, say, building an investment property, those borrowing costs can actually be included in the initial cost too, under certain rules, of course.
That makes sense. All those upfront bits are part of getting it ready to earn money. Now, one of the sources mentioned a specific case. What if the investment property is held under a lease? How does that work?
Yeah, that connects to lease accounting IFRS 16, which is a big deal now. If you hold a property interest under a lease and it meets the definition of investment property, then you account for it like a finance lease. So basically, you recognize an asset, your right to use the property, and a liability for the lease payments.
Right.
And that asset is initially measured at the lower of its fair value and the present value of the minimum lease payments.
Okay, so a bit more complex than just buying it outright. Are there any types of property that IAS 40 specifically says aren't investment properties? Any exclusions?
Yep.
A couple of key ones. Biological assets, like forests, agriculture, like covered by IAS 41, the agriculture standard. And also things like mineral rights, oil, natural gas reserves. Those non-regenerative resources are outside IAS 40 scope too.
Good to know those boundaries. What about if a company gets an investment property not with cash, but by swapping another asset, like trading one building for another? How do you figure out the cost then?
Right, non-monetary exchanges. That brings up valuation again.
Okay.
Generally, the cost of the property you receive is measured at its fair value. Or, if it's easier to measure, the fair value of the asset you gave up.
Okay.
Unless there's an exception.
All right.
If the deal lacks what's called commercial substance, basically, if it's just swapping very similar assets and doesn't really change the economics for anyone.
Ah, like two identical rental units next door.
Exactly. Or if you just can't reliably measure the fair value of either asset. In those cases, the cost of the new asset is based on the carrying amount, the book value of the asset you gave up.
Right. Okay. So that's the initial setup. What happens after that? How are these properties measured going forward? This feels like a big area where companies have a choice.
It absolutely is. For subsequent measurement, IAS 40 gives a choice: the fair value model or the cost model.
Okay.
Under the fair value model, changes in the property's fair value period to period go straight into profit or loss. Just like that.
Wow. Okay.
Whereas under the cost model, it's more traditional: cost minus accumulated depreciation and any impairment losses. Similar to how a company might treat its own office building under IAS 16.
And that academic paper you shared, it sounded like one of these was way more popular when IAS 40 first landed in the EU back in 2005.
Oh, absolutely striking. That paper noted that in 2005, when IAS 40 became mandatory in the EU, every single company they looked at in Sweden and England chose the fair value model.
Every single one.
Yeah. It really shows how relevant people thought up-to-date market values were for these kinds of assets, right from the get-go.
It really does. Suggests a strong feeling that, for investment property, current market value tells investors more than just historical cost. Why do you think the standard setters even offered the fair value option?
Well, the board's fundamental belief was that fair value info is just highly relevant for users of financial statements when looking at investment property. I mean, these assets are held for changes in market value or for rental income tied to market rates, right? So showing those value changes in profit or loss gives, useful insight into how the investment is performing.
But the cost model is still there as an option, isn't it? Are there times when a company has to use it or might choose to?
Yes, the cost model is still an option, but there's a catch linked to reliability. The standard has this reliability exception.
Okay.
If a company genuinely cannot reliably determine the fair value of its investment property on an ongoing basis, then it must use the cost model.
Ah, okay.
But, and this is important, the board decided you can't then switch back to fair value later, even if you suddenly can measure it reliably. Once you're on the cost model, because of that reliability issue, you generally stay there.
Huh. That's interesting. Stuck with cost. So if a company is using the fair value model, how do they actually figure out that fair value? It seems like it could involve a lot of guesswork, especially for unique buildings.
You've hit a really key point there, and the research you gave us definitely highlights that subjectivity. According to IAS 40, the best evidence is current prices in an active market for similar properties. But, real estate markets aren't always buzzing with activity, and every property is a bit different. It's not like checking a stock price.
Exactly. You might not find an identical office block sold next door last week. So if you don't have those perfect market prices, what else does the standard suggest?
Right. So it outlines a sort of hierarchy. You can look at adjusting current prices for properties that are comparable but maybe different in location or condition.
Okay.
Or adjusting recent prices of similar properties but from less active markets. Then very commonly, using discounted cash flow projections, DCF. Yeah, that involves forecasting future cash flows, like rent, and then discounting them back to today's value using a discount rate that reflects risk and time.
Discounted cash flow. That sounds like it really leans on assumptions about the future. That academic paper raised questions about whether you can always get a truly fair value with that much subjectivity.
Precisely. The research really emphasizes that fair value appraisals, especially using DCF, are inherently subjective. There's just significant uncertainty.
Yeah.
Estimating future rents, vacancies, picking the right discount rate. It all needs judgment, and small changes can really swing the final number. So yeah, the researchers did question if you can ever be 100% sure you've got an objectively fair value.
And the example financial statements you gave us mention how things like rising inflation and interest rates mess with these fair value numbers, too.
Oh, absolutely. Very relevant right now. Rising inflation and interest rates hit several key parts of the valuation. Well, they can change expectations about future rent increases. They definitely affect the discount rates you use. Higher rates usually mean higher discount rates, pushing values down.
Right.
And they can even be indicators that a property might be impaired, needing a value check. So companies might need to rethink their assumptions and probably disclose more about how sensitive their valuations are.
That academic paper also looked at what methods companies actually use in practice. What did it find?
Interestingly, it suggested the DCF model is actually the most common method used by listed property companies now.
Really? More than comparing sales?
Yeah. The sales comparison approach looking at similar sales is still used, but often more as a way to estimate inputs for the DCF model, like figuring out the property's likely final selling price, the terminal value, at the end of the forecast period.
So even though the standard kind of prefers market prices, this more model-heavy approach seems dominant. The paper also mentions someone called Nordlund and his thoughts on cash flow projections.
Yes. Nordlund flagged some real challenges with relying heavily on DCF. He pointed out that these models often struggle to really capture economic cycles properly, which obviously affects things like vacancies and rents. He also stressed how hard it is to forecast accurately way out into the future and said sensitivity analysis is crucial.
Sensitivity analysis.
Yeah, like looking at best case, worst case, and likely scenarios for your assumptions, just to understand the potential range of values.
Makes sense given how unpredictable things can be. What about transparency? Do companies have to reveal much about how they calculate these fair values?
Oh yes, definitely. The standard requires significant disclosure. You need to say which valuation techniques you used, what the key inputs were, especially the unobservable ones, the level 3 inputs,
Okay.
and talk about the extent of judgment involved. The illustrative financials also highlighted, showing whether you used external appraisers or did it in-house, details about the income approach, and those unobservable inputs and how they might relate to each other.
Right. Okay, shifting gears a bit. Transfers. Moving properties into or out of the investment property category. When can you do that, and what happens accounting-wise?
Okay, transfers between investment property, owner-occupied, and inventory. They're only allowed when there's a clear change in use.
A change in use? Like what?
So an example would be transferring from investment property to inventory. That happens when a company starts developing the property specifically to sell it in the ordinary course of business, like converting a rental block into condos for sale.
Okay, so it's the intention changing that drives it. What if a company just decides to sell an investment property as is, no development work? Does it become inventory then?
No, that's a really important difference. If you just plan to sell it in its current state, it stays classified as investment property right up until you sell it.
Oh.
It doesn't become inventory. However, if it meets the criteria for held for sale under a different standard, IFRS 5, then those rules apply. That usually means measuring it at the lower of its carrying amount and fair value less costs to sell.
Okay. And what happens to the property's value on the books when these transfers happen, especially if it was on the fair value model before?
Good question. If you transfer from investment property at fair value to either owner-occupied property or inventory, the fair value at the date you change its use becomes its new deemed cost.
Deemed cost.
Yeah. So basically, that fair value becomes the starting point for depreciation under IAS 16 or for cost under IAS 2.
Yeah.
You don't recognize any gain or loss right at the transfer point.
Okay.
But if you transfer from inventory to investment property, that you will measure at fair value. Any difference between its fair value on the transfer date and its previous inventory cost is recognized immediately in profit or loss.
Right, that makes sense. You capture the market value uplift as it enters the fair value regime. Now, the outline also mentioned distinguishing between buying an investment property and a business combination. Why does that matter?
It's a really critical distinction because the accounting for a business combination under IFRS 3 is way more complex than just buying a single asset. A business combination means you're buying a whole integrated set of activities and assets that counts as a business. It has inputs, processes, and can create outputs.
Okay. And how does that relate to buying, say, an office building? When is it a business combo versus just buying the building?
Well, the guidance suggests that just buying an investment property, even if it has tenants already and you're doing basic admin like collecting rent, That's usually just an asset purchase.
Right.
But if the deal includes other significant assets that aren't normally part of the property itself, or if you're buying a whole separate company that manages properties, that's much more likely to be a business combination.
Mm-hmm.
Other clues might be if the buyer wants more than just the property portfolio, or if things like goodwill are part of the deal.
So it's about whether you're just buying bricks and mortar or buying an actual operating entity that includes property.
Okay, let's touch on leases again. How does IFRS 16, the leases standard, interact with investment property accounting? It's pretty direct. If a lessee holds a lease and the underlying asset meets the definition of investment property, so held for rent or capital appreciation,
Yeah.
then that lease is classified as investment property. Initially, the right of use asset from the lease gets measured based on the lease liability, adjusted for initial payments, direct costs, restoration estimates, etc.
Okay.
And crucially, these right-of-use assets that are investment properties are then subsequently measured using the fair value model, just like owned investment properties.
And didn't the notes on IAS 40 mention some past difficulties with operating leases being treated as investment property?
Yes, there was a historical issue. Under older rules, some leases, like long-term land leases, were often classified as operating leases, and that classification seemed to stop the lessee treating their interest as investment property and using fair value.
Right.
So amendments were made to IAS 40 specifically to allow lessees holding such interests to classify them as investment property, provided they met the definition.
Okay, makes sense. Finally, one big goal of adopting IFRS in Europe was better comparability, harmonization. How has IAS 40 done on that front for investment property?
Well, the academic research you gave us suggests it probably has led to more harmonization, at least for listed property companies in places like Sweden, and likely more broadly.
Mm-hmm.
I mean, that huge swing to the fair value model certainly points that way.
Yeah.
But you have to remember, the standard still allows choices: fair value versus cost, internal versus external valuation.
True.
Those choices, plus the inherent subjectivity in fair value itself and maybe different national accounting traditions lingering,
Yeah.
it means you can still get some variability.
Yeah.
It might stop complete harmonization.
So a common framework, but still some room for differences in practice. And that fair value hierarchy level 1, 2, 3 inputs, that also affects comparability and how reliable the numbers are, right?
Absolutely.
Yeah.
The hierarchy helps assess the quality of the valuation inputs. Level 1 is best quoted prices, active market, identical asset. Level 2 is observable inputs for similar assets. Level 3 is unobservable inputs, the company's own assumptions.
Mm-hmm.
And for lots of investment properties, especially unique ones, the valuation often leans heavily on DCF models using those level 3 inputs forecasts of rent, vacancies, discount rates.
Right.
And as Illustrated Financials noted, these inputs are often interrelated, like higher vacancy assumptions might lead to higher yield assumptions. It just adds layers of complexity and judgment to those fair value numbers.
Well, we have definitely navigated some of the trickier parts of investment property accounting under IFRS and IAS 40 in this deep dive. It's clear that, while the basic rules are there, applying them involves a lot of judgment, thinking about market conditions, the specific property, what the company intends.
Indeed.
Yeah.
Those choices, cost versus fair value, how you get the fair value, even deciding if buying a property is an asset deal or a business combination. These are all big areas with ongoing discussion in financial reporting.
So for you, our listener, thinking about this subjectivity, especially in fair value, it does make you wonder how much weight investors should put just on those valuation numbers, doesn't it? What other information might give a fuller picture of a company's property investments? It feels like a constant balancing act, wanting that current market value, but knowing it can be volatile and depends on assumptions. Definitely food for thought when looking at financial statements. Thanks for joining us on this deep dive. Welcome to the deep dive. Today, we're tackling a subject that might sound a bit niche, but it touches on industries that are absolutely fundamental: agriculture. You sent over a fascinating set of materials, from the actual IAS 41 accounting standard itself to some really insightful real-world case studies and different perspectives from the industry.
Yeah, quite a stack.
Our mission today is to cut through the complexity and understand how the financial world tries to capture the unique economic realities of living, growing things and, the food and materials they produce.
That's right. We've got a really comprehensive collection here. We have the IAS 41 standard, including the thinking behind it from Hong Kong and the IASB. Then there's a great fact sheet that boils down the key elements.
Helpful summary.
Definitely. We also have an issues paper from the Asian Ocean and Standard Setters Group that's a collection of accounting standard setting bodies in our region, which offers some interesting viewpoints. Plus, We get a look at how a Peruvian small business navigated adopting IAS 41, an academic paper giving us a broader sector view, and a crucial reminder about being careful with information in this area.
Exactly. So the core question we're diving into for you is this. How does the accounting world actually deal with things that are alive and constantly changing: your forests, your livestock, the crops in the field?
Hmm.
And importantly, what does this tell us about the financial health of agricultural companies and even their impact on the environment? Okay, let's unpack this by starting with the very foundation. What exactly counts as agricultural activity according to IAS 41?
Well, the standard is quite specific. Agricultural activity is defined as the management of the biological transformation of a biological asset for sale into agricultural produce or into another biological asset.
Okay.
Think of it as actively guiding natural processes for, well, economic gain.
Biological transformation. That sounds almost like something out of a science textbook. Can you break that down in simpler terms, maybe in the context of farming?
Absolutely. At its heart, it refers to the natural processes of growth, degeneration, which could be things like, disease or spoilage production, and procreation.
Right.
And all these result in an increase or decrease in the value or quantity of a biological asset. So, for example, with a dairy cow, that's it growing to maturity, perhaps getting sick, producing milk, and having calves.
Okay.
For a wheat farmer, it's the seeds germinating, the plants growing, and ultimately producing the grain at harvest. Simple as that, really.
Okay, so it's more than just letting nature run its course.
Yeah.
There needs to be some level of human intervention, some active management involved.
Precisely. The standard really emphasizes this management aspect. This is what distinguishes agricultural activity from, say, just harvesting wild berries or cutting down trees in a completely unmanaged forest.
Ah, okay.
It involves actively influencing the conditions, things like controlling the nutrients in the soil, managing breeding programs for animals, or, protecting crops from pests and diseases. And the goal of this management is always to produce either agricultural produce, like that milk, wool, or harvested timber, or more biological assets, such as raising young chickens to become egg-laying hens.
So to make this really concrete for you, can you give some clear examples of what falls under this definition of agricultural activity?
Sure. The standard itself and our sources provide several good illustrations. We're talking about raising livestock of all kinds: cattle, sheep, pigs, poultry, even fish farming through aquaculture.
Aquaculture too.
Yeah.
Sure.
Forestry, meaning the management of timber plantations, and the cultivation of orchards and vineyards. Basically any scenario where you're managing plants over multiple seasons to yield fruit, grapes.
Right. A really diverse range of living things. Now let's consider the boundaries. What specifically does not fall under the scope of IAS 41? I can imagine there might be some areas where it's not immediately clear.
You're right. There are related areas covered by other accounting standards. The most significant exclusion is the land itself, even if it's being used directly for agricultural activity.
Even the farmland.
Yeah, the land is accounted for under IAS 16, which deals with property, plant, and equipment, or under IAS 40 if it's considered investment property. So you wouldn't account for a field where crops are grown in the same way you account for the growing crops themselves.
That distinction makes sense. What else is outside the scope of IAS 41?
Another key exclusion is bearer plants. These are plants that are used repeatedly to bear produce over multiple periods. Think of fruit trees, grapevines, or rubber trees.
Ah, the long-term producers.
Exactly. These are now accounted for under IAS 16 as well. However, and this is a really important distinction for you, while the plant itself is under IAS 16, the produce from those bearer plants, like the apples, grapes, or rubber latex, does fall under IAS 41 at the point it's harvested. So the apple tree is IAS 16, but the apples you pick from it are IAS 41 right up until they are harvested.
Okay, that's a crucial difference to keep in mind. What other areas are excluded?
Government grants that are specifically related to those bearer plants are covered by IAS 20, which deals with accounting for all types of government grants.
Got it.
Any intangible assets that might be linked to agricultural activities, such as, say, water rights or production quotas, fall under IAS 38.
Intangibles, right.
And if a company is leasing land for agricultural purposes, the accounting for the right to use that land would be under HKFRS 16. That's the Hong Kong Financial Reporting Standard 16, which deals with leases. So it's a bit of a mix, depending on the specific type of asset or activity.
It sounds like you need to know your accounting standards pretty well to navigate all of that. Now, what happens once the crop is harvested or the animal product is collected? Does IAS 41 still apply then?
This is a critical point.
Yeah.
IAS 41's reach stops, well, right at the point of harvest.
Okay.
Once the agricultural produce is detached from the biological asset, so the wheat is cut, the milk is collected, or when the biological asset's natural life processes cease to provide that produce, that's considered harvest. Any further processing of that agricultural produce after harvest, like turning those grapes into wine or that milk into cheese, falls under IAS 2, which is all about inventories, or other relevant accounting standards depending on the nature of the processing.
Ah, inventories.
Yeah. Even if that processing is a natural and expected next step in the agricultural business, it's outside the scope of IAS 41.
Interesting. So the grape farmer accounts for the grapes under IAS 41, but the winery then switches to IAS 2 for the wine they produce from those same grapes. Okay, now let's get to what our sources really emphasize as central to IAS 41, fair value. What's the core idea behind using fair value in this context?
Well, the fundamental principle of IAS 41 is that biological assets and agricultural produce at the point of harvest are measured at fair value less costs to sell.
Okay.
The underlying idea here is to try and reflect the current market value of these assets as accurately as possible.
Fair value. That can sometimes be a bit of a slippery concept, can't it? How exactly is it defined here, and what are these costs to sell that are deducted?
Yeah, it can be tricky. Fair value is essentially the price that would be received if you were to sell an asset in a normal, orderly transaction between knowledgeable, willing buyers and sellers
Right.
at the specific date you're measuring it. Costs to sell are the extra costs directly associated with getting rid of the asset. This could include things like commissions for brokers or agents, fees charged by regulatory bodies or commodity exchanges, and any taxes or duties on the transfer.
So not financing costs or income tax?
No, exactly. What it doesn't include are financing costs or income taxes. So if you're selling, say, a truckload of timber, the fair value would be the market price you'd get minus any brokerage fees you'd have to pay to make the sale.
So when a farmer harvests their corn, they need to figure out what that corn is currently worth on the market and then take away any costs they would directly incur to sell it.
That's the core principle. And importantly for understanding the financial reporting, when a biological asset is first recognized, say a new lamb is born, or when agricultural produce is initially recognized at harvest, any profit or loss that arises from measuring it at fair value, less those costs to sell, is usually included in the company's profit or loss for that accounting period.
Right away.
Yeah. The same applies to changes in the fair value of a biological asset over time as it grows and matures. So if that new lamb's fair value is estimated at $50, that gain is immediately reflected in the financial results.
So it's about trying to capture the economic changes as they happen with these living assets. Now, our sources do suggest that measuring fair value isn't always a simple task. When can a company argue that fair value cannot be reliably measured?
Well, the standard operates on the assumption that fair value can be measured reliably for biological assets. However,
It's just a but.
there's a but. This assumption can only be challenged on the initial recognition of a biological asset, and it's only in very specific and rare circumstances.
Like when?
This would be when quoted market prices aren't available, and other methods of estimating fair value are deemed clearly unreliable. It's intended to be a very high hurdle to clear. The standard really pushes for fair value to be used whenever possible.
And if, in those limited cases, fair value can't be reliably measured when the asset is first recognized, what accounting treatment is used then?
In those exceptional situations, the standard allows the biological asset to be measured at its historical cost, minus any accumulated depreciation and any accumulated impairment losses.
Okay, cost model then.
But it's crucial to understand that this is meant to be a temporary fallback. Once the fair value of that asset becomes reliably measurable, the company must switch to measuring it at fair value, less costs to sell. The goal is always to get to fair value as soon as it's feasible.
So the intention is definitely to move towards fair value as the primary measurement. Now, earlier we touched on bearer biological assets like fruit trees and how they've moved under IAS 16. This seems like quite a significant change. Can you explain the reasoning behind this shift and what it means in practice?
Yeah, this was a subject of considerable discussion and debate, as our sources, particularly the paper from the AOSSG, highlight.
Right.
Bearer plants, like those fruit trees or grapevines, are now accounted for more like traditional property, plant, and equipment under IAS 16.
Okay.
This is because their primary purpose isn't to be consumed or sold themselves, but rather to repeatedly bear agricultural produce over multiple accounting periods. Think of an apple tree. The value to the farmer isn't in selling the tree itself in most cases, but in the apples it produces year after year.
So the accounting focus shifts from the biological changes in the plant itself to its capacity to generate a stream of produce over its useful life. Makes sense.
Exactly. The cost model used in IAS 16, which includes depreciation to reflect the wear and tear or obsolescence of the asset over time, is seen as more relevant for these types of assets.
But the fruit is still IAS 41.
Yes. As we discussed earlier, it's vital to remember that the produce they yield, the apples, the grapes, etc., still falls squarely within the scope of IAS 41 and is measured at fair value at the point of harvest.
Oh.
So the tree depreciates under IAS 16, but the fruit is valued at its current market price under IAS 41 when it's picked.
Okay, got it. The AOSSG paper mentioned some specific concerns from financial analysts regarding the use of fair value for bearer assets before this change. What were they worried about?
Well, the analysts surveyed by the AOSSG expressed concerns that using fair value accounting for the bearer assets themselves could potentially distort a company's reported earnings.
How so?
They felt that the valuations of these long-lived plants could rely too heavily on subjective assumptions about future yields, market prices, discount rates, all those variables.
Right, lots of estimates.
Yeah, making it difficult to get a clear and reliable picture of the company's financial performance. Some even suggested that information about the fair value of bearer assets might be more useful as supplementary information disclosed in the notes to the financial statements, rather than being a direct part of the main financial figures.
It sounds like there's a real tension there between the theoretical ideal of fair value reflecting current market conditions and the practical challenges of applying it reliably and consistently to certain types of biological assets.
Absolutely. And this brings us to some of the general difficulties in applying fair value measurement to biological assets more broadly. One of the most significant challenges is that for many types of biological assets, especially those that take a long time to mature,
Like timber.
exactly like timber in a forest or certain types of livestock, there aren't always active and liquid markets where you can easily observe prices.
So if there isn't a readily available market price, how do companies go about determining the fair value of these assets? What do they do then?
Well, in the absence of active markets, the standard provides a kind of hierarchy of approaches. Companies can use market-determined prices for similar assets, making adjustments for any significant differences in characteristics like age, quality, or location.
Okay, compare to similar things.
Right. Another common technique is to calculate the present value of the expected future net cash flows from the asset.
Discounted cash flows, DCF?
Yep, DCF. This involves forecasting all the cash inflows and outflows related to the asset over its expected life, and then discounting those future cash flows back to their present-day value using a current market-based discount rate.
Right.
Think of a discount rate like an interest rate in reverse. It helps us understand the present value of money we expect to receive in the future. The key is that it needs to reflect the risks involved in receiving those future cash flows.
Discount rates. That sounds like it could introduce another layer of complexity and potential for different interpretations, doesn't it?
It certainly can. The standard used to specifically mention using a pre-tax discount rate, but that guidance was actually removed in later updates. Now, the important thing is consistency. If you're discounting after-tax cash flows, you should use an after-tax discount rate, and if you're using pre-tax cash flows, use a pre-tax rate.
Makes sense.
And when using these discounted cash flow models, companies also need to factor in the risks associated with those expected cash flows. This risk can be reflected in either the cash flow projections themselves or in the discount rate that's applied, or even, a combination of both.
The basis for conclusions document also mentions something called additional biological transformation. What exactly does that refer to?
Yes. This refers to further biological changes that are expected to occur in the asset beyond its current condition at the measurement date.
Like future growth.
Yes, exactly. The amendments to IAS 41 clarified that when companies are using discounted cash flow models to estimate fair value, they should take into account the increases in cash flows that are reasonably expected to arise from this future biological transformation, such as the continued growth of a tree or the further weight gain of livestock.
Okay.
However, they also need to make sure they're realistically considering the risks associated with achieving that future growth and those increased cash flows. The idea is to get a fair value that truly reflects the asset's full economic potential.
It's interesting how the standard tries to capture not just the present value, but also the future potential inherent in these living assets. Now, our sources also mention that in certain situations, the historical cost of a biological asset can be used as an approximation of its fair value. When is that considered acceptable?
Yeah, cost can be a reasonable proxy for fair value in two main scenarios. The first is when there has been very little biological transformation since the initial costs were incurred. For example, very young seedlings that have just been planted, or livestock that has only recently been acquired.
Right, not much change yet.
Exactly. In these early stages, the market value might not have diverged significantly from the initial cost yet. The second situation is when the impact of the biological transformation on the price is not expected to be significant.
That's jazz.
This might be the case during the very early stages of growth in a long-cycle plantation, like a pine forest that takes decades to mature. In those initial years, the growth might not yet have a material impact on the market value.
That makes sense. In the very early stages, the cost might be the best, or at least a reasonable, indicator of value. What about when biological assets are physically attached to the land, like trees in a forest or grapevines in a vineyard? How do you determine their fair value separately from the land itself? That sounds tricky.
It can indeed be a tricky area because often there isn't a separate active market for the biological asset independent of the land it's on. In these situations, the standard allows for a valuation technique where you determine the fair value of the combined asset, the land, plus the biological assets, and then you deduct the fair value of the land itself and any improvements that have been made to the land.
Ah, the subtraction method.
Pretty much. The example of wine growing is often used here where this difference method can be applied. So you might value an entire vineyard property and then subtract the estimated value of just the bare land to arrive at an implied fair value for the grapevines.
So you value the whole package and then back out the value of the non-biological component.
That's the general approach. However, our sources also point out a potential limitation of this method. It can become problematic if the value of the land alone is higher than the assessed fair value of the combined property.
Oh.
Yeah, in such cases, subtracting the land value could result in a negative implied value for the biological assets, which doesn't really make economic sense.
Right, you can't really have a negative value for a living asset. So it seems like while the concept of fair value is central, its practical application in the agricultural sector can be quite complex and requires a good deal of judgment. This must have significant implications for how agricultural companies present their financial results and how investors analyze them.
Absolutely. As the academic paper we looked at emphasizes, the accurate application of IAS 41 is really vital for market participants to properly assess the natural capital risks associated with agricultural companies.
Natural capital risks.
Things like deforestation, soil degradation, and loss of biodiversity. These can have a very real impact on the long-term value and sustainability of a company's biological assets. If reporting isn't accurate, it can really distort the perceived financial performance and the environmental footprint of these businesses. So for you as someone interested in sustainable investing, understanding how these natural assets are valued is crucial.
So if a company isn't properly accounting for, say, the impact of unsustainable logging practices on the future value of their timber forests, investors might be getting a misleadingly positive picture of their financial health.
Exactly. The standard actually requires companies to reassess the fair value of their biological assets when there are significant changes in these natural capital risks.
Oh, interesting.
For example, if a major disease outbreak affects a livestock herd, or if a wildfire sweeps through a timber plantation, the fair value of the remaining biological assets would need to be adjusted to reflect the loss and any expected changes in future productivity.
Our sources included some real-world examples of how these accounting principles can play out, both in terms of increased transparency and in situations where things went wrong.
Let's talk about the case of Stora Enso. What did they do that was noteworthy?
Ah, yes, Stora Enso. They're a large forestry and packaging company, and they made a deliberate move towards greater transparency in how they report on their forestry assets.
They actually reorganized their reporting structure to more clearly separate the performance of their forest holdings. They also started to categorize the changes in the fair value of these biological assets into what they considered operational changes.
Like growth and harvest.
Yeah, related to the natural growth and harvesting cycles, and non-operational changes, which might be due to market price fluctuations or changes in valuation assumptions.
Ah, separating the drivers.
Exactly. This provided investors with a much more detailed understanding of how their forestry assets were being valued and the different factors that were driving those changes in value.
That sounds like a positive step towards giving investors a clearer picture of the underlying performance of their forestry business. On the other hand, we have the cautionary tales of Zonico and Noble Group. What happened in those situations that highlights the importance of proper accounting for biological assets?
Oh, these cases really underscore the potential risks and consequences of misreporting in this area. Zonico, a Chinese scallop producer, experienced massive and repeated die-offs of their scallop stocks.
Wow.
Huge losses. The investigations that followed raised very serious questions about potential accounting fraud and whether they had been accurately reporting the value of their biological assets under IAS 41.
Suspicions of fraud.
Yeah, there were suspicions that they might have been using vague explanations like climate change to mask underlying financial issues. Ultimately, their auditors couldn't get comfortable with their financial results after these die-offs, leading to canceled asset sales and regulatory sanctions. These examples are really eye-opening and show just how critical it is to get this accounting right.
It sounds like there were significant doubts about the reliability of their reported asset values in the face of these unexplained losses. What about Noble Group?
Noble Group, which was a major commodity trader with significant palm oil assets, faced substantial write-downs in the value of those assets.
Write-downs. Why?
Well, questions were raised about whether their earlier valuations had adequately taken into account factors like the increasing costs associated with deforestation and forest clearance, both from a regulatory and reputational standpoint.
So environmental costs weren't fully factored in?
The suggestion was that they might have been overvaluing their assets by not fully considering these environmental and social risks. So in both cases, whether it was the disappearing scallops or the potential underestimation of environmental liabilities, the misapplication or lack of transparency in accounting for biological assets had significant negative consequences, including investigations and major financial impacts. Absolutely. These examples highlight the critical importance of having reliable fair value accounting and the potential for misleading information when it's not done properly.
Yeah.
The level at which an asset's fair value is determined, whether it's based on readily observable market prices, which are categorized as level 1, prices for similar assets in less active markets, level 2, or based on a company's own estimates and unobservable inputs, level 3.
Level 3 is the tricky one.
Yeah, that level has a big impact on transparency. Many biological assets tend to fall into level 3, which, as our source noted, can be seen as more of a mark-to-management approach and inherently less transparent than valuations based on active market transactions.
Mark-to-management.
It makes you think about how much trust investors need to place in these valuations in the agricultural sector.
This all really underscores the important role of auditors and regulators in ensuring that IAS 41 is being applied consistently and accurately in the agricultural sector. Now, let's shift gears slightly and talk about government grants. How are these accounted for when they relate to biological assets under IAS 41?
Okay, government grants. The accounting treatment depends on how the related biological asset is being measured.
Fair value versus cost again.
Right. If the biological asset is measured at fair value, less cost to sell, then an unconditional government grant that's related to that asset is recognized as income in profit or loss when the grant becomes receivable.
As income, okay.
You don't deduct the grant from the fair value of the biological asset itself, because that would go against the principle of reporting at fair value.
What if the government grant comes with conditions attached, like a requirement that the entity doesn't engage in certain types of agricultural activity?
Good question. In the case of conditional grants, including those that might restrict certain activities, the grant is recognized as income only when those conditions have been met.
Makes sense. Meet the conditions first.
Yep. And if the government grant relates to a biological asset that is being measured at cost, because fair value cannot be reliably determined, then the general accounting rules for government grants under IAS 20 apply.
And what does IAS 20 say?
Well, IAS 20 does allow for the grant to be deducted from the carrying amount of the asset in some circumstances. So the accounting depends on whether you're using fair value or cost for the biological asset itself.
Okay, so a clear distinction based on the measurement basis. Now, what kind of information are companies required to disclose to investors about their biological assets and agricultural activities under IAS 41? Transparency is key, right?
Absolutely. The standard has quite specific disclosure requirements that aim to provide transparency to the users of financial statements. Companies must disclose the total gain or loss that they've recognized during the accounting period.
the bottom line change?
From both the initial recognition of their biological assets and agricultural produce at harvest, and from any changes in the fair value of their biological assets during that period.
And are they encouraged to provide even more detail than just the total gain or loss?
Yes, particularly in situations where the production cycle for their biological assets is longer than 1 year, the standard encourages companies to separately disclose the effects of physical changes.
Like growth, death.
Yeah, things like growth, harvest, or degeneration, and the effects of price changes on the fair value of their biological assets.
Ah, physical versus price.
Exactly. Breaking it down like this can give investors a much better understanding of the underlying drivers behind the changes in value. Companies also need to disclose any significant items of income or expense that arose from events like disease outbreaks or natural disasters that impacted their biological assets.
And for those limited situations where biological assets are measured at cost, are there any specific additional disclosures required? You mentioned that earlier.
Absolutely. In those cases, companies have to provide a detailed description of the biological assets being measured at cost, along with an explanation of why fair value is considered not to be reliably measurable.
Justify the cost method.
Precisely. If it's possible, they also need to disclose the range of estimates within which the fair value is highly likely to fall. Additionally, they need to disclose the depreciation methods they're using, the useful lives or depreciation rates applied to the assets.
Standard depreciation stuff.
Right. And if, at a later date, the fair value becomes reliably measurable, they have to explain the reasons for that change and disclose the financial effect of switching to fair value.
Yeah.
So even when cost is used, there's a push for as much transparency as possible.
So it's all about giving investors the clearest possible picture, even when fair value can't be directly applied. Now let's zoom out again and look at the global adoption of IAS 41. How widely is it used, and are there any notable differences in how it's applied around the world?
Well, many countries have adopted International Financial Reporting Standards, IFRS, which includes IAS 41, so it's pretty widespread theoretically.
But
As the Peruvian case study we looked at highlights, the actual level of compliance and the emphasis placed on it can vary, particularly for small and medium-sized enterprises.
SMEs.
Ah, the SME challenge.
Yeah. In Peru, for example, it's quite common for SMEs to continue to rely on tax regulations, which often use historical cost accounting, for preparing their main financial statements, even though IFRS for SMEs is the officially recognized standard.
So local tax rules often win out. It seems so sometimes. This shows that even when a standard exists, practical adoption can be influenced by local regulations and the perceived costs and benefits of implementing it fully.
That's a really important point, that the existence of a standard doesn't always equate to uniform application on the ground.
Exactly. However, that Peruvian case study also provided an interesting counterpoint because the forestry SME that did adopt IAS 41 and fair value accounting found that it actually helped them to attract external financing.
Oh, really? How?
Well, the fair value accounting gave potential lenders a clearer and more up-to-date view of the value of their timber assets. Made them look more credible, I suppose.
Interesting. Any other examples of variation?
Australia provides another example. They have a two-tiered financial reporting system. Tier 2 entities, which are generally smaller companies without public accountability, have reduced disclosure requirements related to IAS 41 compared to the larger publicly listed Tier 1 entities.
So less burden on smaller companies.
Right. So while the fundamental principles of IAS 41 might be widely accepted in countries that use IFRS, the specifics of how it's applied and what information needs to be disclosed can differ depending on the local regulatory environment and the size and nature of the company.
So it's a global standard, but its application has local nuances. Well, this has been a really insightful deep dive into the intricacies of accounting for agriculture under IAS 41. We've seen that it's a complex area with a core principle of using fair value to account for living and changing assets.
Yes, and we've really unpacked the key insights for you. The focus on fair value is intended to provide a more current and relevant view of the financial realities of working with biological assets. However, we've also discussed the significant practical challenges that arise in reliably measuring fair value, especially when active markets don't exist.
Right, the valuation challenges.
And the evolution of the standard, as seen in the shift of bear plants to IAS 16, highlights the ongoing efforts to refine these accounting rules. It's not static.
And the real-world examples we looked at, like the situations with Zonaco and Noble Group, really drive home the point of just how critical it is to apply these principles correctly and transparently, and the potential consequences when they're not.
Indeed. And considering the increasing global focus on issues like sustainability and natural capital, it leads to a really important question for the future. How might accounting standards like IAS 41 need to continue to evolve to better capture the environmental impacts and the dependencies of agricultural activities?
That's a big question. And for you, the listener, we hope this deep dive has illuminated how understanding these seemingly technical accounting principles can give you a much deeper understanding of the companies and industries that shape our food systems and the world around us.
Yeah, it's more than just numbers.
It's clear that even the fundamental act of growing food or timber is deeply intertwined with intricate financial considerations and reporting standards that have far-reaching implications for investors, regulators, and the environment itself. Thanks for joining us on the deep dive.
Welcome to the deep dive. You know, something that's always popped up when we talk about big companies is how people get paid, especially at the top. And you were curious about one particular method, share-based payments. It sounds a bit jargony, but it's actually a really fundamental way companies compensate people and sometimes even pay for things.
That's right. Your question was all about how companies use their own stock or, promises of stock to reward employees and others. So to get to the bottom of this, we've looked into the rule book, specifically the IFRS 2 standard on share-based payment. Think of this as the, definitive guide on how to account for these transactions, along with some of the official interpretations and discussions around it.
Okay, let's unpack this. So at its core, a share-based payment is when a company gives away a piece of its own ownership, either actual shares or maybe options to buy shares later in exchange for something valuable. And those common something valuable is usually the work that employees do. Right.
Usually, yeah, but it could also be goods or services from other parties. And sometimes it's even tied to a cash payout based on how the company's stock price performs.
Right.
And our mission in this deep dive is to really understand the nuts and bolts of how these transactions are accounted for. We want to give you a clear picture of how companies recognize these deals in their books, how they put a monetary value on them, and what they have to tell investors about it all.
So by the end of this, when you see news about stock options or restricted shares, you'll have a much better understanding of the underlying financial implications. Got it.
Exactly.
So we're diving into the accounting rules themselves. Where do we even begin to make sense of this? It seems complex.
Well, the logical first step is understanding when these share-based payment transactions actually get recorded in a company's financial statements. That's the recognition piece. The general idea is pretty intuitive. You recognize the goods or services when the company receives them. Now, if the company is paying with its own equity, giving away shares or options, there's a corresponding increase in the equity section of the balance sheet.
Right.
If it's a cash-settled deal, like those share appreciation rights we mentioned, then the company recognizes a liability because, they owe cash in the future.
Okay, that makes initial sense. Receive something valuable, acknowledge it. But what if that something valuable isn't used up right away? Like if they pay for a piece of equipment with stock options, does that immediately become an expense?
Not necessarily. It hinges on whether what's received meets the definition of an asset. Services, because they're usually consumed as they're performed, think of an employee working, are typically recognized as an expense right away. Goods, however, might have a longer life. For example, equipment will be used over several years, or inventory is held for sale later. In those cases, the expense is recognized when the asset is used up, like through depreciation for equipment or when the inventory is sold.
So the timing of the expense recognition follows when the company actually benefits from what they received.
Exactly. But here's a wrinkle. Sometimes an expense might have to be recognized even if the goods or services haven't been fully used or sold yet, if they don't qualify as an asset under accounting rules. Oh, like when? Well, imagine a pharmaceutical company paying for specialized research equipment with stock options. If the research project is abandoned, maybe, and that equipment has no other use, they might have to expense it immediately because it no longer provides a future economic benefit.
Interesting. Now, this is where it gets really interesting for me. What if the company can't even clearly identify what specific goods or services they're getting in return for the shares? That sounds a bit strange, right?
Sure.
How can that happen?
It might seem unusual, but it can happen. And this is where some extra guidance comes in. You mentioned a situation where the direct exchange isn't clear.
Yeah.
This is common enough that the International Financial Reporting Interpretations Committee, or IFRIC, issued guidance, IFRIC 8 specifically, to clarify how IFRS 2 applies even in these less direct situations.
Oh.
It confirms that even if you can't pinpoint exactly what tangible goods or services were received, IFRS 2 might still apply. The key indicator here is if the identifiable thing the company receives seems to be worth less than the fair value of the shares or options they gave up or the liability they took on.
Huh.
That difference often suggests the company has received or will receive other less tangible benefits, what the standard refers to as unidentifiable goods or services.
So it's like the accounting is saying, look, we gave away this much value in equity, and what we can clearly see coming back isn't equal in value, so there must be something else we're getting, even if we can't quite put our finger on it.
Precisely. Now let's turn our attention to the most common type of share-based payment, those given to employees. The recognition of those services is directly linked to the vesting period.
Right.
The standard assumes that the services an employee provides in exchange for those future shares or options are received over the time it takes for those equity instruments to become fully theirs. That's the vesting period.
Vesting period, that's the length of time an employee has to work to earn those benefits, right? Like you get stock options, but you can't actually use them or sell the shares for, say, 3 years.
Exactly. And during that vesting period, the company gradually recognizes the expense related to those services. So in your example of share options that vest after 3 years of service, the company wouldn't record the entire expense up front. No, they'd spread it out over those 3 years.
Okay, so it's a gradual recognition of the expense as the employee earns the benefit over time. Now, what about those performance conditions you sometimes hear about? Like, these stock options will only fully vest if the company's stock price hits a certain level. How does that factor into the accounting?
Performance conditions. They add another layer of complexity. The standard makes a key distinction between market conditions and non-market conditions.
Yeah.
A market condition is directly tied to the company's share price, like that target price you mentioned. These market conditions are actually taken into account right from the start when the company first estimates the fair value of the options on what's called the grant date.
The grant date, okay.
And the company doesn't later change its estimate of the vesting period based on whether that market condition is eventually met or not.
So hang on. Even if the share price never hits that target, but the employee stays with the company for the required time, the expense related to those options is still recognized.
Correct. That's because the possibility of the share price not reaching the target was already factored into the initial valuation of the options. It's part of the probability calculation, if you like.
Okay.
Non-market conditions, on the other hand, are things like the employee needing to remain employed for a specific duration, or maybe the company having to achieve certain operational targets that aren't directly linked to the share price, like hitting a sales goal. These non-market conditions affect the number of equity instruments the company expects will ultimately vest. And this is where adjustments can happen during the vesting period.
Adjustments. How so?
Well, if a company initially anticipates, say, a certain percentage of employees will leave before their options vest, they'll estimate the expense based on that expectation. If actual employee departures are higher or lower than that initial estimate, they'll revise their expense recognition in future periods.
So it's like they're constantly looking at how likely it is that these non-market conditions will be met and adjusting their accounting accordingly. They're refining the estimate.
Exactly. Let's say a company grants options with a 3-year vesting period and initially expects 10% of employees to leave each year. If, after the first year, they see that only 5% have left, they'll revise their estimate for the remaining 2 years, which will affect how much expense they recognize going forward.
Got it. Now, you've mentioned grant date a few times. What exactly is that, and why is it such a pivotal point? Seems really important.
The grant date is a really crucial concept, yes. It's the date when both the company and the other party, usually the employee, have a mutual understanding of all the essential terms and conditions of the share-based payment arrangement. It's when the deal is essentially finalized.
So it's not necessarily just the day the company announces, like a share option plan exists.
Not always, no. If some key terms, such as the specific price at which the employee can buy the shares, the exercise price, are decided later by a committee or some other mechanism, then the grant date is that later date when all the terms are agreed upon and communicated.
Oh, okay.
The standard gives an example where a company agrees in principle to issue options, but the exact exercise price is going to be set by a remuneration committee in 3 months. In that case, the date of the remuneration committee meeting is the grant date.
Okay, so it's the moment of shared understanding and final agreement on all the specifics. That makes sense. Now, our background material also mentioned employee share purchase plans.
Yeah.
How do those fit into this whole picture? Are they treated the same?
Employee share purchase plans, or ESPPs, are programs where companies offer their employees the opportunity to buy the company's shares, often at a discounted price. The specifics can vary quite a bit, but the example in our material describes a plan with a 2-week window for employees to sign up, a limit of 100 shares per employee, a 20% discount compared to the market price at the time of acceptance,
Okay.
immediate payment required, a mandatory 5-year holding period for the shares in a trust, with no withdrawals allowed during that time, and any dividends earned on those shares are also held in the trust until the 5 years are up.
Wow, that sounds like a pretty structured and long-term commitment for the employees.
Yeah.
So how is that accounted for under IFRS 2? Is it still a share-based payment?
Well, the general principle is that even with these broad-based employee share purchase plans, IFRS 2 typically applies. While some might argue, that these are more about employee ownership and less about direct remuneration in the traditional sense. The standard usually treats the discount offered to employees as a form of compensation that needs to be accounted for as a share-based payment, because fundamentally the company is giving up value.
Right, because the company is essentially giving up some value by selling those shares at a price lower than what they could get on the open market. Makes sense. Now, let's go back to those vesting conditions for a moment. You explained how they affect when the expense is recognized, but how do they factor into actually putting a monetary value on these share-based payments, the measurement part?
This is a really important distinction. Market conditions, like achieving a certain share price, are directly incorporated into the estimation of the fair value of the equity instruments right at the grant date.
Okay.
So when a company uses a financial model to value stock options, for instance, the potential impact of that share price target being met or not met is already factored into the initial fair value calculation.
But non-market conditions aren't part of that initial valuation.
Exactly. Non-market conditions, such as a requirement for continued service or meeting specific performance targets unrelated to the share price, do not influence the fair value determined at the grant date.
Okay.
Instead, as we discussed earlier, they affect the number of instruments that the company ultimately expects will vest. If those non-market conditions aren't met and the equity instruments don't vest, then no expense is ultimately recognized for those particular instruments.
So just to be clear, the initial fair value takes into account the market-related hurdles, but the actual expense recognized over time is adjusted based on whether the non-market hurdles are cleared.
That's a concise and accurate way to put it, yes.
Okay. Now, what happens if these equity instruments vest in stages over time? For example, an employee is granted 1,000 stock options that vest in installments of 200 options each year for the next 5 years. Is that treated as one single grant for accounting purposes?
Given how nuanced all of this is, I'm guessing the answer is no. It feels like it should be separate.
You're right. The standard specifies that each installment with a different vesting schedule is treated as a separate grant.
Ah, okay. Why?
The logic here is that the differing vesting periods are likely to result in different fair values for each installment. Factors like the time value of money and the potential timing of when the options can be exercised will vary depending on how long the vesting period is for each tranche you see.
That makes sense. An option that vests sooner might be considered more valuable upfront, or at least have a different risk profile. Okay. Now, I remember reading about something called the intrinsic value method. What exactly is that, and when might a company use it? It sounds simpler.
The intrinsic value method is an alternative way to measure share-based payments, but it's really intended for very specific and quite rare situations under full IFRS, specifically when the fair value of the equity instrument simply cannot be reliably estimated using other methods.
So it's a backup.
Kind of, yeah. It's generally not an option for smaller and medium-sized entities that follow the IFRS for SME standard, as they are still expected to use a valuation technique to determine fair value.
And what exactly is intrinsic value in this context? How is it calculated?
Intrinsic value is essentially the difference between the current market price of the underlying shares and the exercise price of the option. Simple as that.
Okay.
For example, if a share option allows an employee to buy a share for $30 and the current market price of that share is $40, then the intrinsic value of the option is $10. If the exercise price is equal to or greater than the current share price, the intrinsic value is 0.
Right, it's only the in-the-money amount.
Exactly. The example in our sources mentions a grant of options where the exercise price was the same as the share price at the grant date, meaning the initial intrinsic value was 0.
So it's a very basic value, and it's only to be used in those unusual circumstances where getting a reliable fair value through a model just isn't possible.
Exactly. The standard strongly favors fair value as the primary measurement approach because the intrinsic value method completely ignores the time value of an option,
Right.
which can often be a significant component of its overall value, especially for options with longer terms.
Okay, we've talked about when these payments are recognized and how they're initially measured. What happens if the terms of the deal change after the grant date? Say the company decides to extend the period an employee has to work for their options to vest. Does that mess everything up?
Modifications to the terms and conditions after the grant date definitely have accounting implications. It's not uncommon.
Okay.
If, for instance, the company extends the required service period for the options to vest, this is generally treated as a modification of the original grant. In this case, the company needs to calculate what's called the incremental fair value.
Incremental fair value.
Yeah, it's the difference between the fair value of the modified options and the fair value of the original options immediately before the modification. This incremental value is then recognized as an expense over the remaining revised vesting period.
So it's not like they just tear up the old agreement and start fresh. They add the extra value.
No, you essentially account for both the original grant and the subsequent modification. You continue to recognize expense based on the original grant's fair value over its original vesting period, and then you also recognize the additional expense arising from the modification over the new extended vesting period.
That sounds like it could become quite complex to track, especially with lots of employees and modifications.
It can be. What about if the company simply cancels the grant of options before they vest? Maybe the plan isn't working out.
If a grant of equity instruments is canceled or settled during the vesting period, and it's not because the employee failed to meet the original vesting conditions.
Right, like they just decided to cancel it.
The accounting treatment is specific. The standard views this as an acceleration of the vesting.
Acceleration.
Yes. This means the company has to immediately recognize any amount of expense that would otherwise been recognized for the services received over the remaining portion of the original vesting period.
So all the future expense gets pulled forward and recognized all at once. Bam.
Precisely. And if the company provides any form of payment to the employee when they cancel or settle the grant, that payment is generally treated as a repurchase of an equity interest, meaning it reduces the equity on the company's balance sheet.
Okay.
There's an exception if the payment exceeds the fair value of the equity instruments at the time of repurchase, in which case that excess amount is recognized as an expense.
What if they cancel one set of options and then issue a new set of options to the same employees shortly thereafter? Like a replacement?
Good question. If the company identifies those new equity instruments as being in replacement of the canceled ones, then it's treated as a modification of the original grant, just as we discussed with the extension of the vesting period. You'd look at that incremental fair value.
Okay.
However, if the new instruments aren't specifically identified as replacements for the canceled ones, then they are accounted for as a completely new, separate grant. This distinction can be important because it affects how and over what period the expense is recognized.
Right. Modification versus new grant.
Yeah.
Got it. Okay, that covers the recognition aspects in quite a bit of detail. Now, let's move on to the measurement side of things. How do companies actually determine the monetary value of these share-based payments in the first place? You mentioned fair value.
For equity-settled transactions, yes, the fundamental principle is that they are measured at the fair value of the equity instruments granted. And the point in time at which this fair value is determined is usually that critical grant date we talked about earlier.
So at the moment the deal is made, they have to try and figure out what those shares or options are actually worth.
Exactly. If there are readily available market prices for similar equity instruments, which honestly is often not the case for employee stock options with specific vesting terms and conditions,
Right.
then the company should use those. But more commonly, especially for stock options, companies have to employ valuation techniques such as option pricing models.
Option pricing models. That sounds like some pretty sophisticated financial math. Black skulls and things like that.
It can be. These models, like the Black-Scholes-Merton model or maybe more complex Monte Carlo simulations, are designed to estimate the fair value of an option by considering various factors.
Likewise.
Think of them like trying to predict the weather, almost. They use a lot of data, the current price of the underlying shares, how much that price is expected to fluctuate, which is called volatility, the time until the option can be exercised, any expected dividends the company might pay, and the prevailing risk-free interest rate. All these things go in to estimate the probability of the option being valuable in the future.
Okay.
And importantly, the fair value estimated at the grant date takes into account all the terms and conditions of the grant, except for those non-market vesting conditions we discussed.
Right, because those only affect whether the options ultimately vest, not their initial potential value.
Okay.
What about those cash-settled transactions, like share appreciation rights? SARs?
Yeah.
How are they measured? Is it the same fair value idea?
Cash-settled transactions are measured quite differently. They are measured at the fair value of the liability that the company incurs.
Liability, not equity.
Correct. And this liability isn't just measured once at the beginning, it is remeasured at the end of each reporting period, like each quarter or each year, until it is finally settled.
Wow. Like,
Any changes in the fair value of the liability during this period are recognized in the company's profit or loss.
so as the company's share price goes up or down, the estimated amount they'll have to pay out for those SARs changes, and that change directly hits their income statement each period.
Precisely. The example in our sources with the cash share appreciation rights really illustrates this well. It shows how the estimated liability and the corresponding expense are calculated each year, taking into account things like employees leaving the company and the fluctuations in the fair value of the SARs as the underlying share price changes. You can see those expense and liability numbers being adjusted from year to year based on these factors.
Okay, that makes sense. Equity settled is kind of a one-time valuation at the start for measurement purposes, whereas cash settled is a continuously moving target reflecting the current value. Now, what about those share-based payment arrangements that give either the company or the employee a choice of settling in cash or in shares? That sounds like it could be particularly tricky to account for.
Yeah, those with cash alternatives, they are accounted for based on whether the company has a present obligation to settle in cash.
How do you determine that?
Well, if the company has a past pattern or a stated policy of always settling in cash, or perhaps if the option to settle in equity doesn't have any real commercial substance, maybe the company is legally restricted from issuing more shares, then the whole arrangement is treated as a cash-settled transaction from the start.
Okay.
Otherwise, if there's a genuine choice and the equity option is viable, it's generally treated as equity settled initially, though there are some nuances if the employee has the choice.
So it boils down to the underlying reality of the situation, the substance over the form, not just the literal wording of the agreement.
Exactly. And the standard also addresses a specific scenario where the fair value of settling in cash is the same as the fair value of settling in equity. In those particular cases, the fair value of the equity component is considered to be zero. And if, at the actual settlement date, the company ends up choosing the settlement option that happens to have the higher fair value at that moment, they have to recognize an additional expense for that excess value.
Interesting complexity there. Now, we also briefly mentioned group share-based payment arrangements earlier. What happens when employees of a subsidiary company receive rights to the parent company's stock? Who is accounting for what and how?
Right, group arrangements. From the subsidiary company's perspective, the one employing the people, these arrangements are generally treated as cash-settled transactions.
Wait, cash settled. Even though the employees are ultimately receiving shares of the parent company? That seems counterintuitive.
Yeah, it does seem a bit odd at first glance, but from the subsidiary's viewpoint, those parent company shares are essentially like an asset that they need to acquire or arrange to be delivered to settle their obligation to their employees. So the subsidiary recognizes a liability for the value of the parent's equity it owes its employees, regardless of how it actually gets those shares.
Okay.
However, when you look at the consolidated financial statements of the parent company, the big picture combining the parent and all its subsidiaries, the transaction with the subsidiary's employees, is accounted for as equity settled.
Why the difference?
Because from the overall group's perspective, it ultimately involves the parent company issuing its own equity to compensate someone within the group. This highlights how the accounting can differ depending on whether you're looking at the individual company's books, the subsidiary, or the Consolidated group's books, the parent.
So the exact same employee benefit can be treated as a cash obligation for one entity and an equity transaction for another within the same corporate family. That's a really key distinction to understand.
Yeah, it definitely is.
Okay, what happens if a modification to a share-based payment changes its fundamental nature? Say you start with cash-settled share appreciation rights, and then later you modify them to become equity-settled stock options. Can that even happen?
Yes, it can. If a modification changes the classification of a share-based payment from cash-settled to equity-settled, there's a specific accounting procedure. First, the original liability for the cash-settled award is derecognized, essentially removed from the company's books.
Okay, liability gone.
Then, the new equity-settled payment is recognized based on its fair value at the date of the modification. However, this recognition only applies to the portion of the services that the employee has already rendered up to that point.
Right.
And importantly, any difference between the carrying amount of the old liability that was just derecognized and the amount of equity recognized on the modification date is recognized immediately in the company's profit or loss.
So that switch in the fundamental type of the award triggers an immediate P&L impact.
Yes, essentially to reflect the settlement of the old cash obligation and the initial recognition of the new equity component based on services already received.
We've covered a lot about when these payments are recognized and how they're measured, including all these modifications and special cases. Phew. Now, what kind of information do companies have to disclose to investors about their share-based payment arrangements? Transparency must be key here.
Disclosure is absolutely vital for transparency, you're right. Companies are required to provide information that allows people reading their financial statements, investors, analysts, etc., to understand the nature and extent of their share-based payment arrangements, and crucially, how these arrangements have impacted the company's profit or loss and its overall financial position.
Makes sense.
Yeah.
What are some of the key things they absolutely have to tell investors?
Well, they need to provide a description of each different type of share-based payment plan they have in place, including the general terms and conditions, things like eligibility, vesting requirements, maximum term.
Okay.
They also have to disclose the number and the key terms of the equity instruments, options, shares, whatever, that have been granted to employees, how many have vested, meaning the employees have earned them, and how many are still outstanding at the end of the reporting period.
So tracking the flow of these instruments.
Yeah, exactly. This would include details like the date the options were granted, the requirements for them to vest, and how long the options are valid for the contractual life.
And the monetary value of all of this, the impact on the numbers.
Absolutely. They need to disclose the fair value of the equity instruments that were granted during the period and explain in detail how that fair value was determined.
Ah, the valuation method.
Right. If they use an option pricing model, they have to say which model they used, Black-Scholes, binomial, Monte Carlo, whatever, and disclose the key assumptions that went into it.
Like the volatility and interest rates you mentioned.
Exactly. Things like the expected volatility of the company's share price, the expected life of the options, which might differ from the contractual term, any expected dividends, and the risk-free interest rate used. They also need to explain how they arrived at their estimate of expected volatility and whether they incorporated any special features, like those market conditions we talked about, into their fair value measurement.
So investors can actually see some of the underlying assumptions that go into these potentially large valuations.
Yeah.
That's useful.
Yes, it provides context and allows for some assessment of reasonableness, at least to a certain extent. Companies also have to disclose the total expense they recognized in their income statement related to share-based payments during the reporting period.
The bottom line impact.
Yeah, and they usually have to break that down to show how much came from equity-settled transactions versus cash-settled, if they have both.
Okay, what else?
If any share options were exercised by employees during the period, the company needs to report the weighted average share price at the time those options were exercised.
Ah, so you see the value employees realized.
Kind of, yeah. And for any share options that are still outstanding at the end of the reporting period, they have to disclose the range of exercise prices and the weighted average remaining contractual life of those options. If the range of exercise prices is quite wide, they might need to provide even more detail by breaking it down into more meaningful price ranges.
That's a significant amount of detail. What about those cash-settled liabilities, like the share appreciation rights we discussed? Any specific disclosures there?
Yes. For cash-settled liabilities, they need to disclose the total intrinsic value of those liabilities for which the employee's right to receive cash had vested by the end of the reporting period. So the amount they'd owe right now if all vested rights were settled.
Okay.
And there's one more specific one. If a company has classified certain share-based payments as equity settled, specifically because they plan to handle the tax withholding obligations by net settling the award.
Net settling,
Mm.
meaning they withhold shares to cover the taxes.
Exactly. In that specific situation, they also have to disclose an estimate of the amount they expect to transfer to the tax authorities related to those net settlements.
So the disclosure requirements really aim to provide a comprehensive picture of these often complex compensation arrangements, covering the what, the how much, and the impact.
Exactly. The main goal is transparency to give investors and other users of the financial statements the information they need to properly assess the impact of these share-based payment arrangements on the company's financial performance, its potential dilution, and its future cash flows.
Now, as with any accounting standard, especially one dealing with something like compensation and equity, I'm sure there have been some discussions and debates around share-based payments over the years. What are some of the key issues or controversies that have come up?
You're absolutely right. There was a huge initial debate many, many years ago about whether companies should even be required to recognize an expense at all for share-based payments, particularly stock options granted to employees.
Really, just ignore the cost.
Well, the argument was often that it was a non-cash item or that it was too hard to value reliably. But many investors and analysts argued strongly that not recognizing this expense was misleading and didn't accurately reflect the true cost of compensating employees with valuable equity. This fundamental issue was a major driver behind the development and eventual implementation of standards like IFRS 2, which now mandate the recognition of this expense. It was a really significant shift.
So that core question of whether or not to treat them as a real cost was a big hurdle to overcome. Seems obvious now, but maybe it wasn't then.
Absolutely. Another key area of discussion revolved around determining the most appropriate date for measuring the fair value, especially for employee transactions. Should it be grant date, vesting date, exercise date?
Right.
While some argued for using the vesting date or even the exercise date, the grant date was ultimately chosen, largely for a combination of practical reasons. It's the point the deal is struck. And because it was deemed to provide a reasonable and sufficiently reliable estimate of the value of the services being received in exchange for the equity commitment.
And I imagine the reliability of those fair value measurements themselves has also been questioned, especially for employee stock options in companies that aren't publicly traded. Measuring volatility for a private company must be tough.
Definitely. Trying to accurately estimate the fair value of employee stock options, particularly for private companies where there isn't a readily available market price for their shares or observable volatility, can be a complex task. It relies heavily on the assumptions and inputs used in those option pricing models, and there's always a degree of inherent uncertainty involved. However, the standard setters have consistently maintained that these estimated fair values, even with the challenges, are still sufficiently reliable to provide useful information to investors, more so than, say, just using intrinsic value or ignoring it completely.
What about the different types of vesting conditions? Have they also been a source of debate or complexity? Market versus non-market seems like a tricky line sometimes.
Yes, the distinction between service conditions, performance conditions, and then further breaking down performance conditions into market and non-market categories has certainly been a complex area. Ensuring a consistent and logical approach to how these different types of conditions are factored into both the initial valuation and the subsequent recognition of expense has been a key focus. There have definitely been discussions about the nuances and potential boundary issues between these distinctions.
And I would guess that things like what happens when options are forfeited because an employee leaves, or when companies decide to cancel or reprice existing options, especially underwater ones, have also led to discussions about the most appropriate accounting treatment.
Absolutely. How to account for options that don't vest due to employee turnover, forfeitures, and the accounting when a company takes action to cancel or modify existing option grants, like repricing them if the stock price has fallen, have been debated at length. As we discussed, the standard provides specific guidance like the acceleration for cancellations or the modification accounting.
Right.
But there have been different perspectives over time on the most theoretically sound and practically useful ways to account for these events, particularly around repricings, which some see as undermining the original incentive.
Finally, what about the interaction between the accounting treatment of share-based payments and their tax implications? Do those always line up neatly? I suspect not.
Not always at all. That's a common source of complexity in accounting generally. The rules regarding whether and when expenses related to share-based payments are tax deductible, and the timing and amount of those deductions can vary quite significantly depending on the specific tax laws in different jurisdictions. This can lead to situations where the expense recognized in the company's financial statements over the vesting period differs, often significantly, from the tax deductions they actually receive, which usually occurs much later, like at exercise for options. This difference creates complexities in accounting for deferred income taxes.
Right, temporary differences between book and tax.
Yeah.
Got it. Okay, that gives us a really good overview of some of the key considerations and areas where there's been discussion and development around share-based payment accounting. Now, as we start to wrap up this deep dive, what are the most important takeaways that you would want our listeners to remember from all this?
Okay, boiling it down. The essential things to keep in mind are: 1, share-based payments represent a company using its own equity, or cash tied to equity, to pay for valuable goods or services, most commonly employee services. 2, these transactions are recognized as an expense over the period that those services are received or the goods are obtained, typically the vesting period for employees.
Yeah.
3, the value is measured at fair value, either the fair value of the equity instrument at the grant date for equity-settled awards, or the fair value of the liability, which is remeasured over time for cash-settled awards. 4, the specific type of vesting condition, market versus non-market, has a distinct impact on how it's treated in the accounting, affecting either value or recognition. And 5, companies have to provide significant disclosures about these arrangements for transparency.
So it's much more than just handing out stock options. There's a comprehensive accounting framework designed to capture the true economic cost of the company, even if it's complex.
Exactly. Accounting for share-based payments demands careful consideration of the specific terms and conditions of each arrangement. It's definitely a complex area of accounting, no doubt about it, but having an understanding of these fundamental principles can give you a much deeper and more informed perspective on how companies are compensating their people and utilizing their equity.
That's incredibly insightful, and it definitely gives me, and hopefully our listeners, a new way to think about and analyze company financial statements, looking beyond just the salary line.
Absolutely. And for you, our listener, here's maybe a final thought to consider as you look at companies. Think about how understanding the accounting for share-based compensation can provide you with valuable insights into a company's overall strategy for attracting and retaining top talent. How much are they really spending? And how do these compensation practices potentially align or misalign the interests of employees with those of the company's shareholders?
Good point.
We encourage you to take this newfound knowledge and maybe look at the financial statements, the notes section, particularly of a few companies that you're familiar with or interested in. See if you can identify the different types of share-based payment arrangements they have in place. Look at the expense they're recognizing. Check the assumptions they used for valuation. You might be surprised by what you discover and the scale of it. Thanks for joining us for this deep dive.
Welcome back to the Deep Dive. Today we're diving into something that's, well, kind of a huge deal in the business world. How companies account for those moments when they, decide to join forces, merge, acquire, all that.
It's the backbone of how companies grow and change, really.
Exactly. And you, our amazing listeners, you've given us a treasure trove of resources to dig into. We've got the IFRS 3 standard itself, obviously, but also some really helpful guides and even responses from the IASB. Those are the folks who set the IFRS and some of the finer points of how these rules play out in real life.
So quite a bit of material to wade through.
Yeah, it's a lot. But our mission today, and I think it's a worthwhile one, is to cut through the jargon and the complexity and give you, our listener, that core understanding of how business combinations are accounted for under IFRS 3.
It's about seeing the logic behind the numbers, right? Because these deals, they make headlines, they shake up industries, and understanding the accounting can unlock a whole new level of insight into what's really going on.
Couldn't agree more. And whether you're, let's say, prepping for a big strategy meeting at work, or just trying to make sense of the latest financial news, or even if you're just someone who's genuinely curious about how all this merger and acquisition stuff gets reflected in a company's books, understanding IFRS 3, it gives you a powerful lens.
It's a bit like, having that decoder ring for a secret language. Once you have it, you can start to see the patterns and understand the messages behind the numbers.
100%. And don't worry, we're not going to get lost in the weeds here. We're going to stay focused, stay clear, avoid the jargon overload, and hopefully have some fun along the way, right?
Definitely. We'll keep it engaging.
Awesome. So to kick things off, we've got to start with the basics. What is a business combination in the eyes of IFRS 3? What are those key elements that trigger all these rules?
Okay, so at its heart, IFRS 3 defines a business combination as the bringing together of separate entities or businesses into one reporting entity. So you've got at least two distinct entities, they come together, and now you've got one entity for reporting purposes. Simple enough, right?
Sounds simple, but I'm guessing it gets a bit more nuanced.
Oh, absolutely. And here's where it gets interesting, and maybe even a little tricky. The real key, the real distinction that you need to grasp is understanding when what you're buying, what's being acquired, actually qualifies as a business, as opposed to just a bunch of assets.
Like, I'm buying a building versus buying a whole company that operates in multiple buildings.
That's a great example. IFRS 3 is really trying to make sure that we don't overcomplicate things. If it's a simple asset purchase, then we don't need to bring in the whole arsenal of business combination rules. But if it's a business that's being acquired, well, then we need a more robust framework to capture all the complexities.
Makes sense. So, to help us figure out if something is a business in the IFRS 3 sense, the standard gives us this detailed definition, right? And it talks about needing inputs, processes, and the ability to create outputs.
Right. Think of it this way. Inputs are those essential resources, the raw materials, the labor, the intellectual property, whatever it is. Processes are how you transform those inputs. It's the know-how, the systems, the actual operations. And then outputs, well, that's the goods or services you're providing to the market.
And what's interesting is that the standard says you don't necessarily need to see outputs right away. It's the ability to create them that matters.
Exactly. Think of a company that's, developing a new drug. They might not have any actual product sales yet, but they've got the scientists, the labs, the clinical trials, all pointing towards that future ability to generate revenue from that drug. That's a business, even without immediate outputs.
This all seems pretty clear-cut so far, but I have a feeling it's not always that straightforward.
Oh, you're absolutely right. There are definitely some gray areas. And the definition of a business, it's actually evolved over time as the IASB has gotten feedback and clarified things. One big change came in 2018. They really focused on making sure that those processes we talked about, the ones being acquired, that they're not just, any old process. They have to be substantive. They have to be really crucial to the ability to generate outputs.
So a company can't just claim any random internal process as being part of the business they're acquiring.
Exactly. It needs to be more than just window dressing. It needs to be genuinely integral to the operations. The 2018 amendments also narrowed down what can be considered an output. It's really about ensuring we're focusing on the core of what makes a business tick.
I bet this is a big deal for companies trying to figure out how to structure these transactions, right?
Oh, for sure. It has huge implications. The more specific, the more legally defensible you can make the definition of an asset, the more likely it is to be recognized separately from goodwill. And that can have a big impact on the balance sheet and how you depreciate or amortize things going forward.
Okay, so all these nuances, all these details, it can feel a bit overwhelming. The standard, though, it tries to give us some practical tools to work with, right?
Right. And one of the most useful tools is the concentration test. It's a way to quickly filter out some transactions that might seem like business combinations at first glance, but really aren't.
How does that work?
It's pretty straightforward. You look at the fair value of all the gross assets you're buying. If practically all of that value is concentrated in one single asset, like, say, a piece of land or a factory, or even a group of very similar assets, then it's highly likely that we're not dealing with a business combination. It's more likely just a straightforward asset acquisition.
So if I'm buying a company that owns a shopping mall, and that mall represents like 95% of the company's value, that's probably not a business combination.
You got it. It's about looking at where the value lies and whether it's spread across a diverse set of inputs and processes or really concentrated in one key thing.
That makes a lot of sense.
Yeah.
Now, to help us wrap our heads around all this, IFRS 3 also gives us some examples, right?
Yes, it does. And these can be super helpful for seeing how the principles actually play out.
Let's walk through a few. So first up, we've got the classic scenario. A company buying a controlling interest in another company that's out there operating in the market.
That's your textbook business combination. You're acquiring a stake that gives you control over the decision-making of another company, its operations, its future. No surprises there. IFRS 3 kicks in full force.
But what about this?
Yeah.
You buy a property development company. It's got a bunch of subsidiaries, but each one is focused on a single development project. Is that a business combination?
This is where it gets interesting. At first glance, you might think, well, each subsidiary is just doing one thing, one project. But you got to step back and look at the bigger picture. You've got this parent company managing all these different projects, allocating resources, overseeing the development process across multiple locations. That, taken as a whole, looks a lot like a business, doesn't it?
It does. It's like a portfolio of projects all managed under one umbrella.
Exactly. Now, compare that to something like, buying the payroll department or the central accounting function of another company. Those are important activities, sure, but they're typically seen as support functions. They're not the core essence of what makes a business in the IFRS 3 sense.
So you're not really acquiring the ability to generate outputs on their own. They're just pieces of a larger puzzle.
Exactly. And here's another one that can trip people up. Buying a shell company.
A shell company, those are always a bit mysterious. What are we talking about here?
A shell company, it's basically a company that exists legally, it's got its registration, its articles of incorporation, but it's not really doing anything. There might be no actual operations, no employees, no real business processes in place.
So if I buy a shell company, is that automatically a business combination?
Not necessarily. This is where you really have to look beyond the legal form and dig into the economic substance. If the shell company truly has minimal operations, no significant processes, and no real capability to create outputs, then it might not meet that IFRS 3 definition of a business.
It's like buying an empty box, basically.
In a sense, yeah. You're acquiring the legal structure, but not necessarily a functioning business.
Okay, here's a scenario that feels a little trickier. Let's say SME A, that's a small or medium-sized enterprise, buys the telescope division of SME B, another company. But SME B holds on to its marketing department. Would that be a business combination for SME A?
Now, that's a good one. This is where the 2018 amendments and that emphasis on substantive processes really come into play. The big question you have to ask is, did SME A acquire all the necessary inputs and processes to actually make and sell telescopes on its own?
Because if they can't market the telescopes, can they really generate those outputs?
Exactly. If SME-B's marketing department was truly essential for bringing those telescopes to the market and wasn't part of the deal, then it might suggest that what SME-A bought wasn't a complete business under IFRS 3. It's a judgment call for sure, and you'd need to look at all the specific facts and circumstances.
So lots of nuance there. Now, before we move on to the next stage, I did notice that the standard specifically calls out some things that are not business combinations.
Yeah, it's important to know the boundaries, right? So forming a joint venture that's specifically excluded from IFRS 3's definition.
Right, so if two companies decide to pool their resources and create a new entity together, sharing control, that's a whole different set of rules.
Exactly. Joint ventures have their own accounting standards, and it makes sense. It's a different type of relationship than a full acquisition. And then there's the whole area of common control combinations, which also get treated differently.
Common control, can you unpack that for us? Why are those handled separately?
Sure. So imagine you've got a group of companies, all ultimately owned or controlled by the same individual or family. Let's say they decide to restructure, maybe merge two subsidiaries. That's a common control combination. The key here is that the ultimate controlling party hasn't changed.
It's all staying within the same economic family, so to speak.
Precisely. And the IASB, they took a long look at this and decided that requiring the full fair value accounting that IFRS 3 mandates, it just didn't make as much sense in these common control situations. The users of those financial statements, they're already aware of the common control, and the information needs are a bit different.
So what happens in these cases? If IFRS 3 doesn't apply, what rules do they follow?
Well, this is where IAS 8 comes in. That's the standard on accounting policies, changes in estimates, all that good stuff. Basically, management has to develop an accounting policy that provides relevant and reliable information for these common control combinations.
So they have a bit more flexibility.
To a certain extent, yes. And often what they'll do is try to apply IFRS 3 by analogy as a starting point. That's generally considered acceptable. But what's more common is to use what are called predecessor value methods.
Predecessor value methods. That sounds intriguing. What's the basic idea there?
The idea is that instead of restating everything at fair value on the date of the combination, you essentially carry over the existing book values of the assets and liabilities from the combining entities into the consolidated financial statements.
So you're not starting fresh with a fair value revaluation.
Nope. You're looking back at the historical accounting values within the combining entities. It reflects that continuity of control.
Okay, so common control combinations, they've got their own set of considerations. But let's jump back to IFRS 3 for a second. We've established what a business combination is, but now we need to figure out who's calling the shots, right?
Absolutely. Once you've determined that it is a business combination, the next crucial step is identifying the acquirer,
Why is that so important?
because it dictates how the entire transaction is accounted for. The acquirer's perspective drives the accounting. So IFRS 3 gives us a bunch of indicators to help us figure this out.
Like a checklist?
Kinda, yeah. It's not a hard and fast rule, but it's a way to assess the situation and figure out who's really in control. One of the first things you look at is size. The entity that's significantly larger in terms of, assets, revenue, all that, that's often a strong indicator that they're the acquirer.
Makes sense. The bigger fish swallows the smaller fish kind of thing.
Yeah, in a lot of cases. Another indicator is who initiated the deal. Who approached whom? Who is the driving force behind the combination? That can provide valuable insights into who's really taking the reins.
What about those situations where a brand new company is created just to make the acquisition? How do you figure out the acquirer then?
Good question. So if the new entity, the one that's been set up, if they're issuing their own equity, their own shares to fund the acquisition, then one of the pre-existing entities that are coming together is usually deemed the acquirer.
Okay, so it's like one of the original companies is using this new entity as a vehicle to make the acquisition.
Precisely. On the other hand, if the new entity is using cash or other assets or even taking on debt to make the acquisition, then it's more likely that the new entity itself is considered the acquirer.
So it depends on how the deal is structured and funded. What about the ownership structure after the deal closes? Does that give us clues?
Absolutely. You got to look at who ends up with the majority of the voting rights in the combined entity. Whoever controls the voting power, they're usually presumed to be the acquirer. You also want to consider who has the power to appoint or remove the majority of the governing body, the board of directors.
Right, so it's about who gets to make the big decisions at the end of the day.
Right. And don't forget about the terms of the share exchange. Sometimes those terms can give one party more sway over the combined entity, even if their voting rights aren't technically a majority. And then there's the senior management team. Who are the key decision makers in the new organization? That can be a telling sign.
So it's not just one factor. It's a whole bunch of things that you have to weigh together. Now, I did see something in the materials about reverse acquisitions. That sounds a bit counterintuitive.
It does, right. It's kind of a head scratcher at first. Basically, in a reverse acquisition, the company that legally issues shares, they're the legal parent. They're actually the accounting acquiree.
Wait, so the company that's technically buying the other one is actually treated as the one being acquired?
Yep, you got it. It seems backwards, but it happens more often than you might think. A common scenario is when you've got a private company that wants to go public, but they don't want to go through the whole traditional IPO process. So what they might do is merge with a smaller, already public company, often what's called a shell company.
So the small public company legally buys the bigger private one, but for accounting purposes, it's flipped.
That's it. It's all about the economic substance, not just the legal form. And the consolidated financial statements, they'll be presented as if it was the bigger private company that acquired the smaller public one, except for the equity structure, which reflects the legal reality.
Okay, so reverse acquisitions, they can be a bit tricky, but the key is to remember that substance over form thing. Now, let's assume we've figured out what a business combination is, we've identified the acquirer. What's the next big milestone? When does the accounting for this whole thing officially start?
It all hinges on the acquisition date. That's the date when the acquirer actually obtains control of the acquiree.
And this isn't always the same as the legal closing date, right?
You got it. Sometimes they line up perfectly, but not always. You have to look at the substance of when control is truly transferred. It's about when the acquirer can actually start directing the financial and operating policies of the other company, really using it to generate benefits from its activities.
So signing a big contract, that's not necessarily the end of the story.
Nope. It's about that moment of genuine control. And IFRS 3 it gives us a handy definition for what that means. It's about the power to govern the financial and operating policies of the acquiree.
Can you give us an example of when the legal closing date and the acquisition date might be different?
Sure, imagine this. SME A signs a deal to buy SME B. But there's still some strings attached, some restrictive rights on SME B's shares that prevent SME A from having full control.
Like, they can't make major decisions without approval from someone else.
Exactly. Maybe there are some shareholder agreements or some regulatory approvals that are still pending. Even though the paperwork is done, the legal closing has happened, The acquisition date, that moment when SME truly gets control, wouldn't be until those restrictive rights expire or get lifted.
It's like having the keys to the car, but not being allowed to drive it yet.
That's a good analogy. It's about that moment of genuine freedom to steer the ship. Okay, so now we've got our definition, we know who the acquirer is, and we've pinned down the acquisition date. Now comes the nitty-gritty, the detailed stuff.
The part where the accountants really earn their keep.
You could say that. Now we have to recognize and measure all the assets that have been acquired and all the liabilities that have been assumed in this business combination. And this is where a really important principle of IFRS 3 comes into play.
Lay it on us.
The acquirer has to recognize the assets and liabilities at the acquisition date. But here's the key. The amounts that they recognize might be different from how the acquirer had them recorded in their own financial statements.
Why is that? Why the potential discrepancy?
Because the acquirer is coming in fresh with a new perspective, they're reevaluating everything based on fair value at that point in time. It's like they're taking inventory of everything they've just acquired and saying, okay, what's all this stuff really worth right now?
So it's a fresh start, a new valuation.
Exactly. And the general rule under IFRS 3 is that all those identifiable assets acquired and liabilities assumed, they get measured at their fair value on the acquisition date. There are some exceptions, but that's the starting point.
Fair value. That's a whole other deep dive we could do.
Oh, for sure. It can get pretty complex, especially for things that aren't actively traded in the market. But the basic idea is, what would a knowledgeable, willing buyer pay for this asset in an arm's length transaction?
Okay, so lots to unpack there. But let's dive into some of the specific types of assets and liabilities that we often see in these business combinations. First up, restructuring obligations. What's the rule there?
All right, so if you're analyzing one of these deals, you need to know that the acquirer, they only recognize a restructuring obligation if the company they're buying, the acquiree, already had a present obligation for restructuring costs on the acquisition date. It has to be something that was already in the works.
So if the acquiree had announced a plan to close a factory and they had already started making those provisions, that would get recognized.
Exactly. That's an obligation that existed at the acquisition date. But here's the catch. If the acquirer comes in and says, you know what, we're going to restructure this whole business, we're going to close down some divisions, lay off some people, all those costs, they're treated as post-acquisition expenses in the acquirer's own financial statements. They don't get bundled into the acquisition accounting.
So it's all about timing and who initiated those restructuring plans. Makes sense. Now, intangible assets. Those always seem to be a big deal in these acquisitions. How do they get recognized and measured?
They're often a huge part of the value, especially in today's knowledge-based economy. But for an intangible asset to be recognized separately from goodwill, it has to be identifiable. IFRS 3 gives us two main ways to figure that out.
Two tests for identifiability.
You could call it that. The first one is separability. Can you sell it, license it, or exchange it on its own, or maybe along with a related contract or asset? If you can, then it's identifiable.
So something like a well-known brand name or a valuable internet domain name, those would usually be recognized separately.
Exactly. Those are classic examples. They've got their own standalone value. And the other test is the contractual legal criterion. Does the intangible asset arise from a contract or some other legal right? If it does, then it's identifiable.
So trademarks, patents, copyrights, customer lists that are based on contracts, all those would qualify.
Precisely. And here's where it gets even more interesting. The standard says that even if selling the asset separately isn't really practical, if it meets that contractual legal criterion, it can still be recognized separately.
Can you give us an example of that?
Sure. Imagine a company that's developed a unique technology, and they've got a patent for it. They've also granted an exclusive license to another company to use that technology. Now, selling the patent without the license, or the license without the patent, it might not make much sense from a business perspective. But the fact that they both arise from legally binding contracts means they meet the contractual legal criterion and should be recognized as separate intangible assets.
So it's the legal underpinning that matters.
Precisely. Now let's talk about customer relationships. Those are obviously valuable, but are they always recognized as separate intangible assets? They can be. If the acquired company has formal contracts with its customers, then those customer relationships, as well as any backlog of purchase orders under those contracts, they typically meet that contractual legal test.
But what if there aren't formal contracts?
Even without contracts, if there's a consistent pattern of business dealings, a clear process for ordering, fulfillment, payment, and it's been going on for a while, then there might be an argument for recognizing a customer relationship intangible asset. It's about demonstrating that there's a real economic relationship there, even without a piece of paper.
So it's about more than just a one-time transaction. It's about that ongoing relationship. Now, a lot of times, companies are acquired for their talented workforce. Does that get recognized as a separate intangible asset?
This is a really important point. A skilled workforce, a team of experienced engineers or scientists, that in itself is generally not recognized as a separate intangible asset. The value of having that team in place is considered part of goodwill.
Why is that?
It comes down to control. The acquirer doesn't necessarily have a contractual right to those employees' future services. They can quit, they can go work for someone else. It's not like owning a patent. However, the knowledge and skills of those employees, they absolutely contribute to the value of other intangible assets that are recognized.
So if they've developed proprietary technologies or built strong customer relationships, those assets get recognized and the employees' contributions are reflected there.
Exactly. It's about capturing the value where it can be reliably identified and measured. Now, here's another interesting one that we sometimes see. Reacquired rights.
Reacquired rights, what are those?
Imagine this. Company A grants a license to Company B to use their technology. Later on, Company A acquires Company B. So they're essentially taking back that license they had previously granted. That's a reacquired right.
So they're getting back something they once owned.
Precisely. And under IFRS 3, those reacquired rights, they have to be recognized as separate intangible assets. They're not just lumped into goodwill, and they're typically amortized over the remaining term of the original agreement.
Makes sense. You're essentially restoring something to its original value.
Yeah.
Okay, let's shift gears and talk about liabilities. How do those get handled in a business combination? What about things like contingent liabilities, like lawsuits or potential environmental cleanup costs?
Those definitely need to be considered. So if there's a contingent liability that the acquirer is assuming as part of the deal, it gets recognized at its fair value on the acquisition date. But there's a catch. It has to meet two conditions. First, it has to represent a present obligation that arose from past events.
So something that already happened, not just a potential future problem.
Right. And second, its fair value has to be reliably measurable. If it can't be measured reliably, then you don't put it on the balance sheet, but you do have to disclose it in the notes to the financial statements.
So if there's a lawsuit going on, the acquirer has to try and figure out how much that lawsuit might cost them down the road and record that as a liability.
Exactly. They might need to bring in lawyers, experts, consultants, all sorts of people to help them estimate the probability of losing the lawsuit and how much they might have to pay out.
What if the seller agrees to cover some of those potential costs? Like they say, hey, if we lose that lawsuit, we'll reimburse you.
That's an indemnity. And in that case, the acquirer would recognize an indemnification asset also measured at fair value. It's basically their right to be reimbursed by the seller.
So it offsets the liability to some extent.
Exactly. And here's a little detail from the standard. You don't need a separate allowance for doubtful accounts for that indemnification asset. The uncertainty of actually getting that money from the seller is already factored into the fair value.
Makes sense. It's all built in. Now, we talked about operating leases before. What happens to those when a company gets acquired?
So if the company being acquired is leasing some assets, like equipment or buildings, under operating leases, the acquirer doesn't automatically recognize an asset or a liability for those leases on the acquisition date. But they do have to do something important.
What's that?
They have to look at each of those operating leases and figure out if the terms are favorable or unfavorable compared to what they could get in the market right now.
So are they getting a good deal or a bad deal on those leases?
Exactly. If the terms are favorable to the acquiree, meaning they're paying less than market rate, then the acquirer recognizes an intangible asset. It's like they've acquired a benefit, a below-market lease.
And if the terms are unfavorable, meaning they're paying more than market rate,
then they recognize a liability. They've essentially inherited an obligation, an above-market lease.
So it's all about comparing those lease terms to what's out there in the marketplace.
Right.
Now, we've touched on a lot of different types of assets and liabilities, but there are a few more we should probably mention.
For sure. We've got employee benefit obligations. Those are accounted for based on IAS 19, so there's a whole other set of rules there. And then we've got deferred taxes, which are recognized and measured according to IAS 12. And of course, those reacquired rights we talked about earlier.
So lots of moving parts. But each of these areas, it's got its own specific guidance within the context of a business combination.
Exactly. You're basically bringing together all these different accounting standards and applying them to this one big event.
Now, let's talk about contingent consideration. This is where things can get a little more, I don't know, uncertain.
Yeah, contingent consideration is when part of the purchase price depends on future events. It's like saying, hey, we'll pay you this much up front, but if you hit certain targets, if certain things happen down the road, we'll pay you even more.
So there's a bit of a gamble involved.
In a way, yes. And IFRS 3, it tries to capture that uncertainty. So the acquirer has to recognize the contingent consideration at its fair value on the acquisition date.
Even though they don't know for sure if they'll have to pay it.
That's right. It's about estimating the value of that potential future payment. And then as things unfold, as those future events happen or don't happen, the fair value of that contingent consideration might change. Those changes are generally recognized in profit or loss.
So if the acquired company hits those performance milestones and the buyer has to pay out more, that's going to impact their income statement.
Exactly. Unless it happens within a certain time frame called the measurement period. That period can last up to 1 year from the acquisition date. And if the changes in fair value during that period are because of new information about things that already existed at the acquisition date, then you can adjust the initial accounting, including goodwill.
So it's like you get a little window to fine-tune things based on new information.
Right. And you also have to consider the ongoing impact of any deferred contingent consideration. The present value of that obligation, it unwinds over time, and that also affects profit or loss. It's a bit like interest expense, but for these future payments.
Okay, so contingent consideration, it can definitely add some complexity. Now, what about those situations where the company being acquired have outstanding share-based payment awards? Things like stock options that have been granted to their employees. How does the acquirer handle those?
If the acquirer decides to replace those existing awards with their own, you have to allocate the value of those new awards. The portion that relates to services the employees provided before the acquisition, that's considered part of the consideration transferred in the deal. It's like saying, hey, part of what we're paying for is the value of those employees' past contributions.
And the portion that relates to services they'll provide after the acquisition.
That gets treated as employee compensation expense by the acquirer. They're basically taking on the cost of those future services.
Makes sense. It's all about figuring out who's getting what benefit. Now, one last scenario I wanted to touch on. What happens if the acquiring and acquired companies already had some kind of relationship before the deal?
That's not uncommon. Maybe they were suppliers to each other, or maybe they had a joint venture, or even a legal dispute. And if the business combination effectively settles that pre-existing relationship, the acquirer has to recognize a gain or loss related to that settlement.
So if they were suing each other and now they're merging, that lawsuit goes away and they have to account for that.
Exactly. And how that gain or loss is measured depends on the nature of the relationship. If it was a non-contractual relationship, like a lawsuit, then it's measured at fair value. If it was a contractual relationship, then it's based on the more favorable or unfavorable terms of the contract compared to what they could get in the market.
So lots of nuances there, depending on the specifics of the relationship. Okay, we've covered a ton of ground here. We've talked about recognizing and measuring all sorts of assets and liabilities. But now we get to the big one, the one that often grabs the headlines, goodwill.
Ah, goodwill. The mysterious intangible asset that can make or break a deal.
It's like the wild card in all these business combinations.
In a way, yes. Goodwill essentially represents the value that's left over after you've accounted for all the identifiable assets and liabilities. It's the premium that the acquirer is willing to pay above and beyond the tangible stuff.
So if I'm buying a company for $100 million and all their identifiable assets and liabilities net out to, say, $80 million, then there's $20 million of goodwill.
Exactly. And
Yeah.
that $20 million, it reflects all sorts of things that are hard to pin down precisely. It could be the value of the company's brand, its reputation, its customer relationships. We all know that things in business, well, they don't always stay the same. Companies buy and sell, strategies shift, and sometimes that means selling off a pretty significant part of the operation. So how do they actually account for those big decisions? That's what we're diving into today.
Exactly. And you've given us a great set of materials to work with on this. Everything from a look at the proposed updates to the rules on non-current assets held for sale,
Yeah.
right through to real-world examples, how these rules are applied and interpreted under standards like IFRS 5, and even some specific stuff for the public sector with IPSS.
All right, so our goal today is to kind of unpack all of this, really get a handle on the core principles behind how businesses handle assets they plan to sell, and when they decide to discontinue a whole segment of their operations. We want to make it clear, interesting, and hopefully give you those aha moments without getting totally lost in the weeds.
Sounds like a plan.
So let's kick off with the basics. When does a company officially say, okay, this asset is now held for sale? It's not just a matter of thinking about selling it, is it?
No, not at all. I mean, wanting to sell is the starting point, sure, but the accounting standards have really specific criteria that must be met before you can classify an asset as held for sale. The key principle is that the asset has to be immediately available for sale in its current condition. Think of it like it's ready to go off the shelf with only the usual standard steps needed to actually finalize the transaction.
Immediate availability. Okay, that makes perfect sense. But what about, the chances of actually finding a buyer and closing the deal? That's where this term highly probable comes in, right?
Precisely. Highly probable is a crucial hurdle. It means the sale is significantly more likely than not. And the guidance actually gives us 5 main conditions that show a sale meets this threshold.
5 conditions, okay.
Yeah. First, management has to be fully committed to a plan to sell, like properly committed. Second, the company needs to be actively out there marketing the asset at a reasonable price.
Reasonable price, okay.
Third, the price has to be realistic compared to the asset's fair value. You can't just stick a fantasy price tag on it. Fourth, the sale should be expected to wrap up within 1 year from when you classify it as held for sale.
1 year. That seems pretty standard.
And finally, it's got to be unlikely that the plan will change significantly or, be withdrawn altogether.
Okay, those all sound like pretty logical signs that a sale is actually serious. But you mentioned there's an exception to that 1-year deadline. This is where it gets interesting, I bet.
Yes, there is an important exception. Sometimes things outside the company's control can push the sale beyond a year, but it doesn't automatically disqualify it from being held for sale.
Like what kind of things?
Well, typically things like needing regulatory approvals, or maybe conditions imposed by others have to be met. But crucially, this usually only applies after a firm purchase commitment is already in place. Appendix B of IFRS 5 goes into more detail here.
Okay.
The main thing is the delay can't be the company's fault, and they still need to show they're totally committed to selling.
So if a government, say, needs to approve the sale of some land, that waiting period, even if it pushes things past a year, wouldn't necessarily kick it out of held for sale status as long as you've got a buyer lined up with a firm commitment. That example from the IPSAS discussions really highlighted that, didn't it?
Exactly. And it also brought up another good point. Even after you've classified it, if something unexpected pops up, like you discover contamination that needs sorting out, and that stops the immediate transfer before you have a binding deal, then that available for immediate sale condition might not be met anymore.
Right.
And you'd probably have to reclassify the asset back out of held for sale.
Right, that makes sense. So things need to stay on track. Now, what about an asset that a company isn't using right now? Like maybe a warehouse sitting empty because demand is down, but they're still maintaining it. Is that considered abandoned? Does it get treated differently?
No, just because you temporarily stop using an asset doesn't automatically mean it's abandoned. Example 8 from the IFRS 5 guidance covers this. Even if a storage facility isn't being used, if the company still thinks they might use it again or sell it eventually, it's not seen as abandoned.
No.
Abandonment really implies there's zero intention to ever use it or sell it, just walking away from it.
Got it. So let's circle back to that firm purchase commitment you mentioned for the 1-year exception. What exactly counts as that? It sounds like more than just a handshake deal.
Oh, definitely. A firm purchase commitment is a proper binding agreement, usually with someone unrelated to the seller.
Right.
It's normally a legally enforceable contract, spelling out all the key terms, the price, the timing, and importantly, there has to be a significant penalty or disincentive if either side backs out. Something strong enough to make completing the sale highly probable. Just saying, yeah, I'm interested, usually won't cut it.
Okay, that sounds pretty solid. Now, what if a business buys something specifically intending to flip it really quickly? Can they just call it held for sale straight away?
They can, but there's a catch, or rather a tight window. If you acquire a non-current asset, or maybe a group of them, purely to resell, you can classify it as held for sale on the day you buy it. But that 1-year expectation for the sale still applies.
Oh, okay.
unless, that exception for external delays kicks in.
Mhm.
Plus, it has to be highly probable that any other held-for-sale criteria not met right at purchase will be met very soon. The guidance usually says within about 3 months.
3 months. Wow, that is a tight deadline to get everything sorted. And you also briefly mentioned something called held for distribution to owners. Is that totally different?
Not totally. The principles are actually quite similar to held for sale. But instead of selling the asset, the plan is to distribute it to the owners, like shareholders. The asset still needs to be available for immediate distribution in its current state, and the distribution itself has to be highly probable, with active steps being taken to get it done within that 1-year time frame.
Okay, so similar logic, just a different destination for the asset. Right, so we've got a pretty good grip on what qualifies as held for sale. Now, the big question, what happens to the value of that asset on the books once it gets this label? How do we measure it on the balance sheet?
Right, this is where the main measurement rule comes in. Once an asset or a whole disposal group being sold together is classified as held for sale, it's measured at the lower of its carrying amount and its fair value, less costs to sell.
Or cost to distribute, if that's the plan.
Or cost to distribute, exactly.
Oh, but carrying amount, that's basically the book value, right?
Right.
What it's recorded at just before the decision to sell, after all the depreciation up to that point.
Precisely. The carrying amount is the value on the company's books right before the reclassification. That includes any accumulated depreciation or amortization up to that date, and maybe any adjustments from prior accounting, like if land had been revalued under IAS 16, for instance.
Could you walk us through a quick example, maybe using that Pinchback building from one of the sources, just to make it concrete?
Sure. So Pinchback had this building. Its book value was $15 million. They decided on April 1st to sell it after already depreciating it for 3 months that year. So by the time they classified it as held for sale, its carrying amount had dropped slightly to $14.75 million.
Okay.
Now, let's say they estimated the fair value, what they could sell it for minus the cost of selling it, like agent fees, legal costs, was $12.8 million.
Right.
Since $12.8 million is lower than the $14.75 million carrying amount, the building gets reclassified as held for sale at that lower value, $12.8 million. And Pinchback would immediately recognize a loss of $1.95 million in its profit and loss statement for that difference.
Ouch. So they take the hit right away.
Yes. And then, if that fair value, less cost to sell changes later, before the sale, those changes are also recognized in profit or loss.
That makes sense. It's like a reality check against the market value. And crucially, I noticed depreciation or amortization just stops dead as soon as an asset is classified as held for sale. Why is that?
That's a really key point. Depreciation stops because the whole point of depreciation is to allocate the cost of an asset over its useful life while it's generating revenue. Once it's held for sale, it's not being used in ongoing operations anymore.
Ah, right.
Its value is going to be recovered through the sale, not through continued use. So continuing to depreciate it wouldn't make sense. It wouldn't reflect how you're actually planning to recover its value.
Gotcha. What about those costs to sell? If we think the sale might take, say, 9 months, do we just use the estimated costs? Or what if it might take longer than a year, under that exception we discussed?
Good question. If the sale is expected to complete beyond 1 year, then those future costs to sell have to be measured at their present value. You essentially discount them back to today's value.
Okay, time value of money.
Exactly. And then, as time passes, the increase in that present value, the unwinding of the discount, is recognized in profit or loss as a financing cost, a bit like interest expense.
Interesting. So you even account for the time value of money on the selling costs. Now, what if the fair value, less cost to sell, actually drops below the carrying amount after you've already written it down? Do you just ignore that?
No, you don't ignore it. That further drop results in what's called an impairment loss. You recognize that loss to bring the carrying amount down to the new, lower fair value, less cost to sell.
Okay, so you keep adjusting downwards if needed.
Yes, but there's potential upside later. If the fair value less cost to sell subsequently increases, you can reverse those previously recognized impairment losses. But, and this is important, you can only reverse the loss up to the point where the carrying amount is back to what it would have been before any impairment related to the held for sale classification. You can't write the value up beyond its original carrying amount, adjusted for depreciation that would have occurred if it hadn't been held for sale.
So there's sort of a ceiling on the recovery. You can reverse impairment, but not create extra value above the original adjusted cost.
Got it. What if we're selling a whole package deal, a disposal group, as the standards call it, Does this measurement rule apply asset by asset within the group?
Not necessarily individually. For a disposal group, which is, a collection of assets, maybe even with some related liabilities, all being sold together in one transaction, that measurement principle of carrying amount and fair value less cost to sell is applied to the group as a whole.
Ah, okay.
You look at the total carrying amount of all the assets and liabilities in the group and compare that to the total fair value of the group less the costs to sell the whole package.
But I did notice a list of specific assets that are excluded from these IFRS 5 measurement rules, even if they're part of a disposal group classified as held for sale. That seemed a bit strange at first glance. That's a really important distinction. You're right to pick up on it. Certain types of assets just don't follow the IFRS 5 measurement rules. Think things like deferred tax assets, employee benefit assets, most financial assets, investment property if it's carried at fair value anyway, some agricultural assets, and rights from insurance contracts.
So why are they excluded?
Because they already have their own very specific accounting standards that dictate how they should be measured. So even if they happen to be bundled into a disposal group that's classified as held for sale, they continue to be measured under their own rules.
Okay, but how does that work with the overall group measurement?
Right, here's the crucial step. If these excluded assets are part of a disposal group, you first remeasure their carrying amounts according to their own specific standards. You do that before you then figure out the overall fair value less costs to sell for the entire disposal group.
I see.
It ensures these specialized assets are accounted for consistently using the rules most relevant to them before they get rolled into the group calculation.
Okay, that explanation really clears up why those exceptions exist. It's about keeping the accounting consistent for those unique assets. Now, let's shift gears a bit and talk about when a company decides to sell off or shut down a whole chunk of its business, this idea of discontinued operations. How's that different from just selling one asset or even a group?
Yeah, a discontinued operation is a much bigger deal. It's defined as a component of a business. Think a whole segment or division that has either been sold off or is classified as held for sale, and it meets one of three specific criteria.
Okay, what are the criteria?
It has to represent a separate major line of business
Right.
or a distinct geographical area of operations, or it's part of a single coordinated plan to get rid of such a major line or area. Or the third one is if it's a subsidiary that was bought specifically just to resell it. It's really about a fundamental shift in the company's overall strategy and operations.
So just because Pinchflex sold that factory building we talked about earlier, that wouldn't automatically make it a discontinued operation.
Not necessarily, no. It really depends. Did that factory represent a separate major business line for Pinchflex? Or a whole geographical area? Probably not, in most cases. The guide from GTIL you shared had a really helpful table on this, outlining the scenarios.
Yeah, I remember that.
Scenario A was where something is both a discontinued operation and held for sale. Scenario B was a discontinued operation that's not held for sale, like if they just shut down a division and abandon it.
Yeah.
And scenario C was where an operation is discontinued and the sale actually happens before the reporting date, so it's no longer held for sale at year end.
That table really did make the distinction much clearer. So if something is classified as a discontinued operation, how does it show up in the financial statements? Does it just get mixed in with everything else?
No, absolutely not.
Yeah.
It gets special treatment, particularly in the statement of comprehensive income, the income statement. The total profit or loss from these discontinued operations, after tax, plus any after-tax gain or loss from measuring it at fair value less costs to sell or from the actual disposal, is presented as a single separate line item.
Okay.
It's kept distinct from the results of the company's ongoing, continuing operations. This makes it much easier for anyone reading the statements to see the financial impact of shedding that part of the business.
And that single line item, it's not just one number with no explanation, is it? There must be more detail somewhere.
Or absolutely. The standards require a detailed breakdown of that single amount. This can be either in the notes to the financial statements, or sometimes companies put it right on the face of the income statement. This analysis needs to show things like the revenue, the discontinued option you traded, its expenses, its profit or loss before tax, the related income taxes, and then that gain or loss on the measurement or disposal, along with its tax effect.
So plenty of transparency there.
Yes, the goal is transparency about the performance of that segment being discontinued.
I also remember reading something about having to go back and adjust the numbers from previous years. Restatement.
Yes, that's a crucial point. For any prior periods that are presented alongside the current year's results for comparison, The company has to represent those figures. They need to pull out the results of the operations that are now discontinued and show them separately for those past years too.
Why do they have to do that?
It ensures comparability. So users can make meaningful comparisons of the company's ongoing performance over time without the results of the bit they've now gotten rid of, confusing the picture or skewing the trends.
Makes sense. What happens if there are still some loose ends after a discontinued operation has been sold? Like maybe there's a dispute over the final price that only gets settled the following year. How is that handled?
Right. Those kinds of adjustments that pop up in the current period but directly relate to the disposal of a discontinued operation from a prior period are also classified separately within discontinued operations in the current year statements. The company would need to disclose the nature and amount of these adjustments. Things like, resolving a price dispute, or maybe settling warranty claims, or environmental cleanup costs that were tied to the old business, or finalizing employee benefit payouts linked to that disposed segment.
Okay, so you keep all the financial fallout from the discontinued op bundled together, even if it trickles in later. Now, what if we remeasure an asset as held for sale, but it doesn't qualify as a discontinued operation? Maybe it's just a single asset, not a whole business line. Where does that gain or loss get reported?
Good question. In that scenario, any gain or loss from writing the asset down, or potentially up within limits, to its fair value less cost to sell is just included in the profit or loss from the company's continuing operations. That special separate presentation is reserved only for things meeting the strict definition of a discontinued operation.
Got it. And what about that situation where a company buys a subsidiary specifically to resell it quickly? It meets the held for sale criteria almost right away. How's that shown?
Right. When a subsidiary is acquired purely for resale and meets the held for sale criteria upon acquisition, it gets presented in two ways. First, as a disposal group held for sale on the balance sheet, and second, as a discontinued operation on the income statement. Example 13 in the IFRS 5 guidance actually walks through the initial measurement in that specific case.
Okay, interesting. So it gets both labels.
Yes, because it meets the criteria for both classifications.
Okay, we're getting a really clear picture now. Definitions, measurement, discontinued ops presentation. Let's talk about how these held for sale items actually appear on the main balance sheet, the statement of financial position.
Okay. The standards are pretty clear here. A company must present any non-current asset classified as held for sale and all the assets belonging to a disposal group held for sale separately from its other assets on the balance sheet.
Separately.
Okay. Same goes for the liabilities. Any liabilities that are part of a disposal group held for sale must be shown separately from other liabilities.
Oh.
And importantly, you can't just net the assets and liabilities off against each other and show one number.
No offsetting.
No offsetting.
Right.
Plus, the major categories or classes within those held for sale assets and liabilities should be disclosed separately, either right there on the balance sheet or in the notes. And one other point, if there's any cumulative income or expense related to these assets that was previously recognized in other comprehensive income, OCI, that needs to be presented separately too.
So the clear goal is visibility. Make it obvious what's heading out the door. What other specific disclosures are needed when something gets classified as held for sale or is actually sold?
In the period when the classification happens or the sale occurs, there are several key disclosures. You need a description of the asset or disposal group, an explanation of the facts and circumstances leading up to the decision, the expected method and timing of the disposal, and importantly, the amount of any gain or loss recognized.
Right.
If that gain or loss isn't shown as a separate line on the income statement, you need to say which line item it's included in. And, if relevant, you also need to disclose which reportable business segment the asset or group used to belong to.
And for discontinued operations specifically, what other information needs to be disclosed beyond just the profit-loss number?
For discontinued ops, besides the after-tax profit loss and the gain loss on measurement or disposal, the company also has to disclose the net cash flows attributable to that operation, broken down by operating, investing, and financing activities.
Cash flows too. Okay.
Yeah, this can be shown either in the notes or maybe within the main cash flow statement. There is one small exception, though. You don't have to provide this cash flow breakdown for a newly acquired subsidiary that's classified as held for sale immediately upon acquisition.
Okay. Now, what if things change? What if a company classifies an asset as held for sale, but then, for whatever reason, changes its mind and decides not to sell it? What's the accounting for that U-turn?
Right? That can happen. If the criteria for held for sale are no longer met, maybe the market tanks or strategy shifts again,
Yeah.
the company has to stop classifying it as held for sale and put it back into its original category.
Okay, reclassify back.
Exactly. And then it needs to be measured at the lower of two amounts. First, what its carrying amount would have been if it had never been classified as held for sale in the first place, so you'd need to kind of catch up on any depreciation you missed, for example.
Ah,
And second, its recoverable amount at the date you decide not to sell. Recoverable amount being the higher of its value in use, which you can get from using it, and its fair value, less costs to sell at that point.
so you measure it at the lower of those two.
Yes.
Ah.
And any adjustment needed to get the carrying amount to that lower value is recognized immediately in profit or loss from continuing operations in the period you make the decision to stop selling.
That makes perfect sense. You can't just leave it hanging in held for sale limbo if the plan's off. Now, I know the IFRS Interpretations Committee, the IRC, has looked at some really complex borderline situations around the scope of held for sale. Can you give us a quick flavor of those discussions?
Certainly. Originally, the whole held for sale idea was very much focused on, well, sales transactions.
Yeah,
Straightforward selling.
right.
Later, its scope was officially expanded to include distributions to owners, as we mentioned. But the committee has debated whether other events that lead to a loss of control over its subsidiary, even without a traditional sale of shares, should trigger the held for sale classification for that subsidiary's assets and liabilities.
Oh, interesting. Like losing control without actually selling.
Exactly. There are different views, naturally. But the staff's perspective and kind of the direction things moved in was that the scope is broadened beyond just sales. It now includes other ways an entity might recover the carrying amount of an asset, other than just continuing to use it, especially when a loss of control becomes highly probable.
That's quite a significant shift in thinking. So things like losing control because your ownership gets diluted, or maybe a non-controlling shareholder exercises an option to take control, or even just changes in shareholder agreements, these could potentially lead to classifying the subsidiary's assets and liabilities as held for sale, provided that loss of control is highly probable and the other criteria are met.
That's the way the interpretation seems to be leaning, yes. The focus shifts from, is it a sale, to, is control going to be lost? Because if control is lost, the carrying amount won't be recovered through continued use within that consolidated group anymore.
Fascinating. Another really tricky point from the IFRIC discussions was about transactions between continuing operations and discontinued operations within the same consolidated group. That sounds like it could get messy.
It definitely can. The core question is, how do you present these internal dealings in the consolidated financial statements?
Yes.
Three main views were kicked around. View one was, eliminate them completely, just like any other intergroup transaction, with no further adjustments. View two was eliminate them, but then adjust the numbers to show what the future relationship would look like on an arm's length basis after the discontinuation, sort of an as-if presentation. And view three was, don't eliminate them at all in the consolidated statements showing the discontinued of them separately.
Wow, three quite different approaches. What was the conclusion or the prevailing view?
Well, the staff view, based on the existing standards, particularly IFRS 10 on consolidation, was that full elimination view one is what's currently required. You eliminate the intergroup transactions completely.
So no as-if adjustments on the main statements.
Not required on the face of the statements, no. Even though there was some acknowledgement that the as-if presentation view 2 might actually provide more relevant information in some cases, it's not currently mandated by IFRS. However, companies aren't stopped from providing that kind of supplementary as-if information in the notes if they think it's helpful for users to understand the future impact.
Okay, so standard elimination is the rule, but extra disclosure is possible. Finally, let's just briefly touch on the public sector angle. I know IPSS has its own considerations here.
Yes, the IPSASB looked closely at IFRS 5, but recognized some public sector specifics. For instance, assets might be disposed of for policy reasons at amounts that aren't fair value, and approval processes can often take much, much longer than in the private sector.
Right, bureaucracy.
Could say that. So while they remove direct references to IFRS 5 in some places to avoid forcing potentially inappropriate application, IPSS still generally allows public sector entities to adopt policies consistent with IFRS 5 if it makes sense for them. The big emphasis is always on transparency and accountability.
And any key differences in measurement or disclosure?
One specific point highlighted was transparency. If a held-for-sale asset in the public sector ends up being measured at a carrying amount significantly lower than its fair value, IPSAS requires disclosure of that fair value, just to make it clear what the underlying value is, even if it's being transferred for less.
Okay, that's a useful public sector insight. So to wrap this all up, the real key takeaways seem to be, first, those really strict criteria for classifying something as held for sale, it's not just a casual decision. Second, that core measurement principle, lower of carrying amount and fair value, less costs to sell. Third, the absolute necessity for separate presentation and detailed disclosure, especially for discontinued operations, to give users a clear view. And finally, the fact that this area is still evolving, with interpretations needed for complex situations like loss of control or intergroup dealings, it really shows the depth of thought needed to report these major strategic shifts accurately.
Absolutely. And hopefully by understanding these rules, you, our listener, get a much richer, more informed view when you see companies announcing disposals or restructuring. You can look behind the headlines a bit more.
Definitely. And on that note, here's a final thought for you to ponder. Given how much the standards stress that a sale must be highly probable and expected within a year, what might be some of those less obvious, maybe unexpected challenges businesses face in actually meeting these criteria? Think beyond just finding a buyer in a tough market, and how could those hurdles impact their financial reporting?
That's a good one. Delays in getting information, internal disagreements, unexpected due diligence findings, perhaps.
Could be. Lots to think about there. For those who want to dig even deeper, we definitely recommend checking out the full standards, IFRS 5, IAS 1, IAS 16, IFRS 10, and the IPSAS equivalents, and especially the basis for conclusions documents. They explain the why behind the rules.
Definitely worth a read if you're really keen.
Thanks everyone for joining us for this deep dive. It's a common assumption, isn't it, that when a mining or oil and gas company sinks millions into exploration and comes up empty, those costs are just, well, an immediate write-off.
Yeah, people often think that.
But the financial reality of how these companies account for their initial ventures beneath the surface is actually far more intricate. Today, you're joining us for a deep dive into IFRS 6.
That's the International Financial Reporting Standards specifically for the exploration for and evaluation of mineral resources.
Exactly.
Think of IFRS 6 as the specialized accounting framework. It governs how companies in the extractive sector, oil giants, smaller mining firms, handle these significant spending and potential assets tied to those very first steps.
Right, the searching for and assessing potential underground resources, be it minerals, oil, natural gas.
Exactly that.
And for you, the learner, why does this matter? Well, this isn't just about some obscure accounting rule. Understanding IFRS 6 gives you a crucial window into the financial core of a massive global industry. It shows how they figure out what might become a valuable asset when facing immense uncertainty. It's high-stakes, high-reward stuff, right? Reflected directly in their financial reports.
We're basically getting a behind-the-scenes look at how value is assessed in some pretty unpredictable business environments.
So our mission in this deep dive is to pull out the key insights from IFRS 6 for you. We've looked at the standard itself, interpretations, practical guides.
Yeah, to bring you a clear, digestible understanding. We'll focus on what counts as exploration and evaluation spending, how those costs are treated financially, and critically, when these initial assets get reevaluated or potentially written down.
Okay, so let's get into the nuts and bolts. What exactly falls under the umbrella of IFRS 6?
Okay, so the standard has a very specific focus. It applies to the spending a company incurs during the exploration and evaluation phase of mineral resources.
So the initial activities to locate and assess potential deposits, basically. Minerals, oil, gas.
Right, that specific window.
Yeah, and just as crucial, what are the limits? What costs from the very beginning are not covered by IFRS 6?
That's a really important distinction. IFRS 6 doesn't apply to costs incurred before a company gets the legal right to explore a specific area.
Ah, so before you even have the permit.
Exactly. Those pre-license costs actually fall under a different standard, IAS 38, which deals with intangible assets. So before you have permission, different rules apply.
Right, so the accounting's different before you can even start digging. What about costs after they've found something promising and are moving towards extraction?
Good question. Once the technical feasibility and commercial viability of actually getting the resource out are demonstrable, IFRS 6 stops applying.
Okay.
At that point, the spending is considered part of development and production, and those phases fall under other IFRS standards like IAS 16 for property, plant, and equipment, and again, IAS 38 for development-related intangibles.
So there's a clear handoff point.
Yes, and the IFRS Interpretations Committee clarified this back in 2006. The scope of IFRS 6 is strictly limited to that initial E&E phase, exploration and evaluation.
It sounds like the extractives industry operates under slightly different financial rules during this initial phase, maybe reflecting the risks involved.
That's a sharp observation.
Yeah.
During this E&E phase, there are specific exclusions from certain other IFRSs that apply uniquely here.
Like what?
Well, for instance, IAS 2 on inventories has special rules for mineral producers valuing stock. And while IAS 16 covers the equipment used, it doesn't dictate how the E&E assets themselves are recognized.
Okay.
IFRS 16 on leases also excludes leases to explore for these resources, though it covers leases for equipment used in exploring.
Interesting distinction.
And as we mentioned, IAS 38 excludes development and extraction costs. Even IAS 40 on investment property excludes mineral rights and reserves. It all just emphasizes the unique accounting landscape for this initial uncertain period.
Okay, let's circle back to those pre-license costs. Our sources flag this as question 1, and it seems pretty clear. They're outside IFRS 6, fall under IFRS 38.
Precisely. Because they happen before the legal right to explore is obtained, they just don't meet the criteria for IFRS 6.
But what about the costs directly tied to acquiring those legal rights? Question 2 asks if those can be capitalized.
Yes, they can be capitalized under IFRS 6, but only if the company has a policy to capitalize E&E expenditure.
Ah, so it depends on their chosen policy.
Right. Since these costs are directly linked to getting the permissions that allow activities within IFRS 6's scope, they're seen as part of that initial phase.
Yeah.
You need the right to explore for IFRS 6 to kick in for those costs.
That makes sense. You need the ticket to get in the game. Now, what about the cost of an option to acquire those legal rights? That's question 3, and it sounds a bit more nuanced.
It is. The cost of buying the option itself isn't initially within IFRS 6, again, because it's before you have the full right to explore. But the critical factor is whether that option actually lets the company carry out exploration and evaluation activities.
Ah, so if the option gives you permission to start looking around.
Exactly. If it does, then the cost of that option can be capitalized as part of an E&E asset.
And if it doesn't, if it's just an option to get the rights later.
Then it's treated as a separate asset under other IFRSs. It might need impairment testing under IAS 36, or it could even be an IFRS 9 financial instrument.
Okay.
But importantly, if the company does eventually exercise that option and gets the full legal right, the carrying amount of the option at that point gets rolled into the cost of the acquired right.
Okay, that clarifies the initial boundaries of IFRS 6 pretty well. Now let's delve into how these E&E assets are actually recognized and measured. The standard says initially measured at cost. Sounds simple, but what costs are we actually talking about?
Well, at cost is the starting point, but the standard gives significant flexibility in deciding which expenditures get recognized as E&E assets.
Flexibility. How so?
The basic idea is the extent to which the spending can be directly linked to finding specific mineral resources. And crucially, once a company sets its policy on this, they have to apply it consistently.
So within some broad lines, it's up to the company to define what's directly linked to the search.
Pretty much. IFRS 6 gives a list of examples, non-exhaustive, mind you, of what might be included.
Like?
Acquiring those exploration rights we just discussed, costs of topographical, geological, geochemical, geophysical studies, basically all the initial science work.
Okay.
Also, exploratory drilling, trenching, sampling, and activities, looking at the technical feasibility and commercial viability of extracting anything found.
That covers a lot of the early groundwork. But what about the costs of actually setting up a mine or drilling, producing wells once something's found?
Right. Those development expenditures are explicitly not E&E assets. As we touched on, the conceptual framework and IAS 38 guide the recognition of assets from development activities. That happens after the E&E phase, once viability is proven.
Right, that key dividing line. Demonstrable technical feasibility and commercial viability. What about cleanup costs? The costs of restoring a site after exploration, even if nothing's found.
Good point. IFRS 6 does cover obligations for removal and restoration. If these obligations pop up because of E&E activities, they're recognized under IAS 27, which deals with provisions.
Okay.
And how you account for the other side of that entry, the debit, depends on how the related exploration spending was treated. If the exploration cost was capitalized, the restoration obligation cost is also capitalized.
And if the exploration cost was expensed?
Then the restoration cost is also expensed. Interestingly, any changes later on in the estimated cost of that restoration provision, they hit profit or loss immediately.
So even if a project yields nothing, the future cleanup costs are still accounted for. Now, you mentioned flexibility in policy. Our sources highlight a temporary exemption from parts of IAS 8. What's the significance of that?
This is a really key point. When a company develops its accounting policies for E&E assets, IFRS 6 gives a temporary break from paragraphs 11 and 12 of IAS 8.
And what do those paragraphs normally do?
Normally, IAS 8 sets out a strict hierarchy of sources an entity must look at when no specific IFRS directly covers something. This exemption essentially gives companies more leeway in deciding which E&E expenditures can be capitalized.
Even if they might not strictly meet the definition of an asset in the conceptual framework.
Exactly. It acknowledges the unique challenges and, frankly, the huge uncertainties in this early stage.
Okay, here's where it gets really interesting. So, they can basically capitalize costs that, under normal rules, might have to be expensed straight away, like research costs.
That's the practical outcome, yes. Companies can capitalize E&E spending that, if looked at strictly under IAS 38, might be seen as research costs and would normally be expensed as incurred.
Wow. And does this affect impairment too?
It can. It potentially leads to a delay in recognizing impairment losses compared to standard IFRS. This is because E&ED assets are only formally assessed for impairment when specific facts and circumstances suggest it's needed or when they're reclassified to development.
So no automatic annual impairment tests during the E&E phase.
Not necessarily a full quantitative test based on cash flows, no. The triggers are different.
That explains why our sources mentioned potentially delayed impairment recognition. Okay, let's tackle some more of these FAQs. Question 4. Dry well costs. If a company sees a whole exploration area as one asset, can they capitalize the cost of a well that turns out empty?
Yes, they can. If the company views the whole area as a single asset, the cost of that dry well is seen as adding to the overall geological understanding of the area.
Even though that well was a dud.
Right. The information gained is still valuable for making decisions about the rest of the area, so it can be capitalized as part of the cost of that bigger E&E asset.
Okay, so it's about the wider knowledge gain, not just the success or failure of one hole. Question 5 asks about similar spending, but with different chances of success, like drilling in different countries with varying geology. Do those need different accounting based on probability?
Generally, no. The fact that the same activity, say exploratory drilling, has different success probabilities in different places doesn't mean you have to split the expenditure based on those odds. It would typically be treated as one type of E&E expenditure.
That keeps things simpler, I suppose. Now, question 6 is about finance costs, interest on loans for exploration. Can those be capitalized as part of the E&E asset?
Yeah. The link between IAS 23 on borrowing costs and IFRS 6 is, well, a bit murky.
Why is that?
Because the inherent uncertainty about future economic benefits in the E&E phase. IAS 23 usually requires capitalizing borrowing costs directly linked to acquiring a qualifying asset, but only when it's probable those costs will lead to future economic benefits.
And in exploration, that probability is hard to nail down.
Exactly. Given how speculative it is, determining the probability is tough. Our sources suggest that while expensing borrowing costs is defensible.
Okay.
You could also argue that the temporary IAS 8 exemption in IFRS 6 gives the flexibility to capitalize them if the company thinks it fits their overall E&E accounting policy.
So no single right answer in the standard. It depends on their policy choice.
Pretty much. It often comes down to the company's specific, consistently applied policy.
It really sounds like IFRS 6 builds in room for judgment, acknowledging the unique uncertainties here. Now, question 9 in our sources goes into the different approaches companies can use if they do choose to capitalize E&E spending. What are some common methods?
Right. Historically, you see several main methods in the industry. The big ones are successful efforts, area of interest, full cost, and partial capitalization.
Okay, let's quickly break those down. Successful efforts. What's the idea there?
Under successful efforts, generally only costs directly tied to discovering, acquiring, or developing specific commercially viable reserves get capitalized.
And unsuccessful costs.
Typically expensed immediately when they're deemed unsuccessful. Although there can be nuances, like sometimes capitalizing unsuccessful development wells if the whole area is seen as one cost center. It's a more conservative approach overall.
Okay, linking capital costs directly to proven reserves. What about area of interest? Sounds broader.
It is. An area of interest is usually a geographical zone deemed geologically promising. Under this method, all E&E spending within that area gets capitalized.
On what basis?
On the expectation that those costs will be recovered, either through successful development within the area or by eventually selling the area itself. It's a bit more optimistic, capitalizing across a wider potential zone.
Then there's full cost. That sounds like it sweeps everything in.
It does can too. Full cost involves capitalizing almost all costs: prospecting, acquiring rights, exploration, appraisal, development, construction within large cost centers, often like entire countries.
But does that fully align with IFRS?
Our sources point out some potential conflicts, things like capitalizing pre-license costs, maybe not clearly distinguishing intangible assets at a detailed level, and potential issues with impairment testing when moving to development. So while it's a historical practice, it needs careful handling under IFRS.
Okay, so full cost needs care. What about partial capitalization?
As the name implies, this involves capitalizing only certain defined types of eligible costs while expensing others.
Like,
A common example in some places is capitalizing the initial cost of acquiring a mining asset, but expensing all the later exploration costs. It's more selective about what becomes an asset early on.
it's really striking how much variation IFRS 6 seems to permit. It really highlights that global consistency here is a challenge.
It absolutely is. That flexibility within IFRS 6 plus the different historical practices under various national standards means there's quite a bit of inconsistency globally in E&E accounting.
Do certain types of companies favor certain methods?
Larger companies, especially those with U.S. GAAP influence, often lean towards successful efforts.
Yeah.
But the choice can really impact reported profits in the early stages,
Yeah, I can see that. Okay,
Yeah.
switching gears to presentation. Once these E&E assets are on the balance sheet, how are they classified? Tangible, intangible.
IFRS 6 says they're classified as either tangible or intangible based on their specific nature, and you have to be consistent with similar assets.
For example.
Drilling rights would usually be intangible. Physical things like vehicles, drilling rigs used in exploration, those are tangible.
Seems logical, but what if a tangible asset, like a specialized rig, is used to develop an intangible asset, like gathering geological data for drilling rights? Does the rig become intangible then?
No, the standard's clear on that. While the depreciation of a tangible asset used to develop an intangible asset becomes part of the cost of that intangible asset,
That's right.
the tangible asset itself stays tangible. Its classification doesn't change.
Got it. Tangible stays tangible. Now, let's talk impairment, a critical piece. When do these E&E assets need checking to see if their value has dropped?
The general rule is assess E&E assets for impairment when facts and circumstances suggest the carrying amount might exceed the recoverable amount. This lines up with the main ideas in IAS 36 on impairment.
But I understand IFRS 6 brings in some specific indicators for this industry.
Yes, it does. Paragraph 20 of IFRS 6 gives a list, again, not exhaustive, of specific triggers for an impairment test for E&E assets.
And these are tailored for the sector.
Exactly. They're designed for the unique risks here. And for these specific assets, they effectively replace the more general impairment triggers you find in IAS 36 paragraphs 8 to 17.
Can you give us some examples of these specific triggers?
Sure. Things like the legal right to explore in an area expires with no expectation of renewal, or there's no budget or plan for significant further E&E spending in that specific area.
Okay, what else?
If exploration hasn't found commercially viable resources and the company decides to stop activities there, or if enough data emerges showing the carrying amount is unlikely to be fully recovered, even if development eventually happens.
These all sound like pretty major negative signs about future benefit. Why were these industry-specific indicators needed on top of the standard IAS 36 ones?
The main reason is that during early E&E phases, these assets often generate zero cash flow. And there usually isn't enough reliable info about the potential resources to accurately estimate their recoverable amount using standard IAS 36 methods, which rely on things like fair value less cost to sell or value and use calculations based on future cash flows.
So applying the normal triggers might be too harsh, too early.
Potentially, yes. It could lead to writing off potentially valuable exploration assets prematurely. So these specific indicators focus more on fundamental shifts in the project status and the company's plans.
Makes sense. Do other things still trigger impairment, like falling commodity prices?
Oh, yes. Other events like significant drops in commodity prices or major adverse regulatory changes can definitely still trigger an impairment test under the broader IAS 36 principles.
Right. So you look for the IFRS 6 specific triggers first, but other major events count too. Our sources have an example: failed test wells. Scenario 1 asks if the first 5 wells failing automatically triggers impairment. What's the answer there?
Well, if the company views the whole exploration area as a single asset, and crucially still plans to continue exploration in that area,
Okay.
then the failure of those initial wells doesn't automatically trigger impairment. The geological info gained, even from dry holes, still adds to the overall understanding of the entire license area's potential.
So the costs can stay capitalized.
Yes, the costs tied to those wells can continue to be carried forward as part of the E&E asset for the whole area.
So it's the assessment of the overall area's potential and the company's continued commitment that are key, not just individual results. Now, what happens when an E&E asset does successfully move out of this initial phase into development?
Good point. When an E&E asset gets reclassified as a development asset, because technical feasibility and commercial viability are now demonstrated, paragraph 17 of IFRS 6 requires an impairment test before that reclassification happens.
A checkpoint before it moves on.
Exactly. It ensures the asset's carrying value is still supportable before it enters the next stage.
And at what level is this impairment assessment done? A single well? A whole field? A region?
IFRS 6 allows some flexibility. The test can be done as a level of one or more cash-generating units, or CGUs.
But is there a limit to how broadly you can group things?
Yes, there's an upper limit. The level used for impairment testing cannot be larger than an operating segment, based on how the entity reports internally and externally.
Okay, so it has to be reasonably granular, tied to how the business is managed.
That's right. Ensures the test reflects economic reality at a sensible level.
Okay, so aggregation is possible, but capped at the segment level. Now, what if a company wants to change its accounting policy for E&E spending? Is that allowed under IFRS?
Yes, but with important conditions. A change in accounting policy for E&E is allowed only if the change makes the financial statements more relevant and no less reliable, or vice versa, more reliable and no less relevant.
Yeah.
And if the change brings the company's policies closer to meeting the criteria in IAS 8.
How does that initial temporary exemption, the one letting them deviate slightly from the conceptual framework's asset definition, play into subsequent changes?
Right. That initial exemption gives more flexibility when first setting the policy. But any later changes have to show a move towards IFRS principles.
So what kind of changes might be acceptable?
For example, changing from capitalizing all eligible costs to a more conservative, successful efforts basis, or even to expensing everything, would likely be okay. It's often hard to prove early-stage exploration costs definitively meet the strict asset definition anyway.
What about going the other way, from successful efforts to capitalizing more?
That might also be justifiable, but the company would really need to clearly show that the change results in more relevant and reliable financial statements. Any change needs solid justification under IAS 8.
So changes are possible, but need good reason and must improve the financial reporting quality. Finally, let's talk disclosures. What specific info do companies have to reveal about their E&E activities?
The main goal is transparency. They need to disclose information that clearly identifies and explains the amounts in the financial statements that come from E&D activities.
What does that mean in practice?
Specifically, they have to disclose their accounting policies for E&E's spending, including how they decide what gets recognized as an asset.
Okay. And the numbers?
Yes, they need to disclose the amounts of assets, liabilities, income, expense, and the operating and investing cash flows that are specifically from their E&E activities. This gives investors visibility into the financial impact of these risky ventures.
So clarity on their accounting choices and the resulting financial impact is key.
Absolutely. E&E assets are treated as a separate asset class, and the specific disclosures needed by IAS 16 for tangible or IAS 38 for intangible assets have to be made, consistent with how the E&E assets were classified.
Any other relevant disclosures?
Definitely. Given all the uncertainties and judgments involved, IAS 1.122, which requires disclosing significant management judgments, and IAS 1.125, covering assumptions and estimation uncertainties, are highly likely to require more disclosures related to E&E.
That makes sense.
Oh, and our sources also briefly mention Australia. While they have reduced disclosure requirements, RDR, for some entities, the specific disclosure rules under Tier 2 for AASB 6, the Aussie version of IFRS 6, are actually identical to Tier 1. So no break on E&E disclosures there.
Okay, good to know. Now, our sources also briefly mention farm-in arrangements. What are those exactly, and how does IFRS 6 fit in?
Right, a farm-in is pretty common. It's where an entity already holding an E&E interest, the farmer agrees to give up some of its rights or future reserves to another party, the farmee.
In exchange for what?
In exchange for the farmee funding certain E&E obligations. It lets the farmer share the cost and risk, while maybe keeping a piece of any future discovery.
Does IFRS 6 specifically cover farm-ins?
Not explicitly, no. But the generally accepted view is that its principles do apply, because the farmie is doing E&E activities that fall within the standard scope.
Okay.
And the farmer is essentially disposing of part of an E&E asset.
So how do farmers usually account for these deals?
Typically, the farmer doesn't record any spending that the farmie pays for on its behalf. Also, the farmer usually doesn't recognize a gain or loss on partially disposing of a capitalized E&E asset.
What happens to any cash received from the farmie then?
If the cash isn't specifically meant to fund the farmer's own future exploration spending, it's just credited against the carrying amount of the farmer's existing E&E asset.
And if the cash received is more than the carrying amount of the asset portion given up?
Then that excess amount is recognized as a gain in profit or loss. Our sources give a couple of examples illustrating this. It's basically a way companies manage the high costs and risks.
It sounds like a practical way to share the financial burden and potential upside in this capital-intensive, uncertain industry.
Exactly.
Yeah.
It facilitates exploration that might not otherwise happen.
So bringing it all together then, IFRS 6 is this specialized accounting standard really tailored for the unique world of mineral and oil and gas exploration and evaluation. It focuses on that initial higher-risk phase, gives some flexibility in capitalizing costs because of all the uncertainty.
Right, that's key.
Has its own specific triggers for impairment testing, and demands detailed disclosures for transparency.
That's a great summary. And a really interesting point to remember is that temporary exemption from parts of IAS 8. It really shows the accounting world grappling with how to recognize assets in these super early stage uncertain activities.
And for you, the learner, we hope this deep dive has shed some light on the financial foundations of an industry critical to our global economy. Understanding IFRS 6 gives you a framework for analyzing the financial risks and potential rewards tied to finding the resources that power our world. It definitely makes you think about how these accounting choices might sway investment decisions and how investors judge the health and future of these companies.
And that raises a really important question for you to think about. How might those different permitted accounting policies, say, conservative successful efforts versus broader area of interest, actually change how investors perceive a company's financial stability and growth potential, especially in such a volatile sector?
That's a crucial thing to consider when looking at these companies, absolutely. And while IFRS 6 is the current rulebook, the ongoing debates about the best way to account for these uncertain beginnings suggest this field will probably keep evolving, right, as the industry changes.
Indeed. The search for resources never stands still, and it looks like the accounting for that search won't either.
Welcome to the deep dive. Today you've tasked us with navigating a really interesting, if intricate, area, IFRS 7, financial instruments. Disclosures. You sent over quite a stack of information on this accounting standard, and our goal is to pull out the truly crucial insights for you.
Absolutely. And we've got, quite the range here, everything from official papers by EFRAG, that's the European Financial Reporting Advisory Group, and the IASB staff, right through to academic research looking at the impact of IFRS 7, plus implementation guidance and what users actually think.
So think of this as your shortcut. We're aiming to clarify what IFRS 7 is, exactly what disclosures it requires, why they actually matter, and we'll even touch on some ongoing debates and what the research is saying about its effectiveness. Okay, let's dive right in. What is IFRS 7 in simple terms?
Well, in essence, IFRS 7's main objective is to make sure companies give enough information so that people looking at their financial statements, investors, analysts, people like yourself, can really understand the significance of financial instruments to the company's financial position and its performance.
Okay.
And crucially, it also wants to highlight the nature and extent of risks that come with those instruments. The standard itself really hammers this home in its basis for conclusions.
Right. So it's about visibility, making sure the tools the company uses and the risks involved are clear. What exactly falls under this financial instrument category? What's in scope?
It was pretty broad, actually. It covers basically all financial instruments recognized on the balance sheet, your typical assets and liabilities. But it also includes some instruments that aren't on the balance sheet but still fall under the scope of IAS 39, another standard. Interestingly, some guidance notes this can even include certain contracts to buy or sell non-financial things like commodities if they meet specific criteria in IAS 39.
Wow, okay, so it's a wide net. Almost any financial agreement, it sounds like. Are there specific things it doesn't cover? Any carve-outs?
Yes, definitely. There are some important exceptions.
Things like a company's investments in its subsidiaries, associates, or joint ventures, those are usually accounted for under different standards. Also, employer obligations for employee benefits under IAS 19. Most insurance contracts, though, watch out for embedded derivatives there, and certain share-based payments under IFRS 2. Several of the documents highlight these exclusions.
Got it. Broad, but with clear lines. Now, you mentioned IFRS 7 built on older standards like IAS 30 and IAS 32.
Exactly. It essentially took the disclosure requirements that used to be scattered, partly in IAS 30, which was bank-focused, and partly in IAS 32, which dealt with presentation, and it consolidated and significantly beefed them up. In many areas, IFRS 7 demands much more detail. It was a clear move towards more comprehensive disclosure, as the background documents explain.
Okay, that sets the stage nicely. Let's get into the specifics now. What are the main disclosure areas IFRS 7 really focuses on?
Right. There are several key buckets you should be aware of. Let's start with the balance sheet disclosures. Companies need to show the carrying amount, basically the book value, and the fair value, or market value, for each category of their financial assets and liabilities.
Categories like?
Things like instruments held at fair value through profit or loss, held to maturity investments, loans and receivables, available for sale assets, and liabilities measured at amortized cost. The guidance documents lay these out pretty clearly.
Makes sense. Book value versus market value. What if a company moves an instrument between these categories, like reclassifies it?
Good point. If they do reclassify something, say from available for sale to held to maturity, they absolutely have to disclose the reasons why they made that change. Transparency is key there.
And I think I saw something specific about loans and receivables that are measured at fair value through profit or loss. Seems like extra scrutiny there.
Yes, exactly. For those specific instruments, there are additional disclosure requirements. Companies need to reveal their maximum credit risk exposure related to those assets, the impact of any credit derivatives they might use to mitigate that risk, and importantly, how much the fair value changed specifically because of credit risk changes, both in the current period and cumulatively. It gives a much deeper dive into the credit aspect for those particular assets.
Okay, really drilling down on credit risk for those. What about the income statement and equity? What needs disclosing there?
For the income statement and equity, IFRS 7 requires disclosure of the various items of income, expense, gains, and losses related to financial instruments. This includes total interest income and expense, calculated using the effective interest method for things not at fair value through P&L, and also fee income and expense. Helps you see the ongoing P&L impact.
And if a company gets rid of a financial asset, sells it or something?
Yes, derecognition. When an asset comes off the balance sheet, companies need to disclose information about that, including any gains or losses recognized on removal.
Okay. And within equity, I remember reading about movements within equity.
Right. If there are transfers of cumulative gains or losses between different components of equity, like moving something out of the available for sale reserve that needs to be disclosed, along with the reasons why, several sources mention this, ensuring clarity on those internal equity shifts.
Got it. Helps track where the value is going. Now, fair value, clearly a huge part of financial instruments. What disclosures are needed about how companies figure out those fair values?
Oh, this is critical. When fair value is used, companies must disclose the methods and the key assumptions they use to arrive at that number. This isn't just the final figure, it's about the inputs. Things like assumptions about prepayment rates on loans, expected credit losses, interest rates, discount rates used. An exposure draft we looked at really emphasizes this. You need to see the workings.
So show your math, essentially. And there are different levels of fair value, right?
Exactly, the fair value hierarchy. It's crucial for understanding how reliable or subjective a fair value measurement is. Level 1 is the best quoted prices in active markets, like a common stock. Level 2 uses observable inputs, but not direct quotes for the exact item, maybe based on similar assets. Level 3 uses significant unobservable inputs. That means more reliance on the company's own models and assumptions.
Level 3 sounds like the one to watch closely then, given the judgment involved.
Absolutely. And for those Level 3 fair values, IFRS 7 requires even more. If changing one or more of those unobservable assumptions to a reasonably possible alternative could significantly change the fair value, the company has to state that fact and disclose the effect of those potential changes, sort of a sensitivity analysis for the valuation itself. It gives you a sense of the potential volatility or uncertainty in that Level 3 number.
Okay, that's a lot on the numbers balance sheet, income, equity, fair value. Let's shift to risk. Arguably the core of IFRS 7, wouldn't you say? What are the main risk disclosure requirements?
Definitely central. The standard requires extensive disclosures about the risks arising from financial instruments. The big three are credit risk, counterparties defaulting; liquidity risk, not having cash to meet obligations; and market risk, losses from price changes like interest rates or FX. For each type, companies need to provide both qualitative and quantitative information.
Qualitative being, how they manage it, policies, procedures.
Precisely. Descriptions of how the risks arise, the company's objectives for managing risk, their policies, the processes they use, and then quantitative is the summary data numbers showing their exposure to each risk at the reporting date. Importantly, IFRS 7 says this information should align with what's provided internally to key management, what they tell the board, essentially.
That makes sense. External reporting should mirror internal risk management views. Let's break down the risks. Credit risk first. What specifics are required?
Okay, credit risk. Disclosures need to cover the exposure to loss if counterparties fail to pay. This means details on assets that are past due or impaired, information about any collateral held or other credit enhancements obtained, and disclosure of significant concentrations of credit risk, like too much exposure to one industry or region.
And what if the balance sheet amount doesn't show the full potential loss?
Good point. If the carrying amount doesn't represent the maximum credit exposure, maybe due to netting arrangements or guarantees, the company has to disclose that maximum exposure separately. The guidance is clear on making the full potential risk visible.
What about the quality of assets that aren't past due, the performing ones?
Yes, disclosure is required about the credit quality of financial assets that are neither past due nor impaired. Plus, information about assets that have been renegotiated because the borrower was struggling. It gives a fuller picture beyond just the problem assets.
Okay, moving to liquidity risk, the risk of running out of cash. What's key here?
The main requirement is a maturity analysis for financial liabilities, both derivatives and non-derivatives. This shows when obligations are contractually due. Companies might show this based on contractual dates, or, if they manage liquidity differently, based on expected cash flows. It gives you a timeline of upcoming cash outflows.
So a schedule of when debts need paying. Anything else?
Yes, they also need to provide a narrative description explaining how they manage the liquidity risk shown in that maturity analysis. And potentially, they might also disclose a maturity analysis of financial assets they hold specifically to manage liquidity risk, like readily saleable securities. It connects the numbers with the management strategy.
Right, context for the numbers. Finally, market risk losses from price movements. What's the requirement?
Sensitivity analysis. For each major type of market risk, they're exposed to currency risk, interest rate risk, other price risk like commodities or equities. They need to show how reasonably possible changes in those market variables would affect profit or loss in equity.
So showing the what-if scenarios. What if rates go up 1%? What if the euro weakens?
Exactly. And they need to disclose the methods and key assumptions used in preparing these sensitivity analyses, and any changes from the prior period. Transparency about how they did the analysis is important.
Is there any alternative to this sensitivity analysis?
Yes, if a company uses a more sophisticated approach, like value at risk, VAR, internally, which often captures interdependencies between risks, they can disclose that instead, provided they explain the model and how it's used. Some flexibility for more advanced risk managers.
Got it. And I think there was something about transfers of financial assets, too, special disclosures.
Yes, if assets are transferred but not fully derecognized, or if the company retains some continuing involvement in assets that have been derecognized, specific disclosures are needed to explain that involvement and the associated risks. It ensures you understand any lingering exposure even after a transfer seems to have happened.
Okay, that's a really thorough look at the core disclosure areas. It's obvious IFRS 7 demands a lot of transparency. Let's switch gears now to ongoing discussions and research. EFRAG has been looking at the scope and maybe adding more disclosures.
That's right. There's been discussion based on tentative IASB decisions about potentially extending IFRS 7 scope to include disclosures about a company's own issued equity. The idea is to give users like you better info on the company's financing and ownership structure. An EFRAG paper and an IASB staff paper both delve into this.
Disclosures about their own shares and equity, what specifically were they thinking about?
One proposal was requiring disclosure of significant judgments made when classifying instruments or parts of them as either liabilities or equity. That equity classification can be
tricky, you know.
Definitely.
So more transparency on the judgment calls there. Also disclosing terms and conditions that might kick in or expire over time, affecting the instrument's nature, trying to capture the dynamic aspects.
Interesting. Trying to clear up that gray area. Any other potential expansions discussed?
Well, the IASB staff looked at things like economic compulsion, where an equity instrument has features that strongly push the company to redeem it, making it act a bit like debt and indirect obligations. But for now, they decided not to propose specific new disclosures in those particular areas, according to the IFRS paper.
Okay, so some movement on equity disclosures, but other ideas parked for now. What about the academic side? I saw a study on the cost of equity capital, linking it to IFRS 7 compliance.
Yes, that study in the Gulf region was interesting. It found a negative link, basically. Banks that complied more thoroughly with IFRS 7 tended to have a lower cost of equity capital.
Lower cost, how does that work?
The theory is that better, more comprehensive disclosure reduces information asymmetry, that gap between what the company knows and what investors know. Less asymmetry means investors perceive less risk, so they demand a lower return, hence a lower cost of capital for the bank. It suggests a tangible financial benefit to good disclosure.
Fascinating. So transparency can actually pay off directly. Did the study say why financial instrument risks are so important to investors?
It highlighted that investors definitely see these risks, credit, market, liquidity, as major factors in their decisions. IFRS 7 gives them the tools to assess these risks. The authors also noted there wasn't much prior research directly linking IFRS 7 compliance to cost of capital, making their findings quite relevant.
Provide some hard evidence then. Now, what about the users themselves? The investors and analysts actually reading these disclosures, what do they think? I saw a CFA Institute report.
Right, the CFA Institute surveyed users. The takeaway was a bit mixed. Users definitely find the risk disclosures, credit, liquidity, market important, even essential, but they often struggle with understandability, consistency between companies, and comparability. The information's there, but it's not always easy to use effectively.
So the quantity is there, but maybe not always the quality or clarity. What specific gripes did they have?
They wanted more granularity in credit risk breakdowns, better info on counterparty risk, collateral information integrated more clearly. For market risk, they felt the sensitivity analyses could be more meaningful, more insightful. Basically, a call for disclosures that are easier to digest and compare apples to apples across companies.
Sounds like a common theme. The data's there, but making sense of it across different companies is the challenge. Did other research pick up on this, like that Lancaster University study?
Yes, exactly. The Lancaster research looks specifically at credit risk disclosures after IFRS 7 came in, and it confirmed that diversity. They found significant variation in how granular companies were, how much they disaggregated the information. This lack of uniformity makes comparison really difficult for users.
Echoes the CFA findings perfectly. Did the Lancaster study see differences between, say, banks and regular companies?
It did. For banks, there was lots of variation in the entity-specific details in their expected credit loss, ECL accounting policies, and how they used macroeconomic scenarios. For non-financial corporates, the focus tended to be more on overall credit exposure, the ECL estimation approach, and general asset quality. So different industries focus on different aspects, adding another layer of complexity for comparison.
Right. Different industries, different focuses, makes comparability harder. And finally, there was just a quick mention of collateral in one document.
Yeah, just a reminder that while collateral provides security for a loan and usually lowers the interest rate, it doesn't automatically mean the loan has low credit risk. You still have to look at the borrower's ability to repay. Collateral is Plan B, essentially.
Good point. Plan B, not a guarantee. Okay, let's try to wrap this up. What are the main takeaways from this deep dive into IFRS 7?
Well, I'd say the big picture is that IFRS 7 is fundamentally about driving transparency around financial instruments and their risks. It mandates a huge range of disclosures, balance sheet, P&L, fair value, and especially the big three risks: credit, liquidity, market. This information is really vital for investors and others trying to make informed decisions.
But it's also clearly a complex standard, and it's not static, is it? It's still evolving.
Absolutely. The ongoing discussions, the research we talked about, it all shows IFRS 7 is a work in progress. People are constantly evaluating its effectiveness, trying to improve it. We see pushes for more specific disclosures like around equity and that consistent user demand for better understandability and, crucially, comparability. It's definitely a living standard.
A living standard, constantly adapting. Okay, That brings us to our final thought for you, our listener. Based on all this, think about how the level of detail, the quality of these financial instrument disclosures might actually influence your assessment of a company. When you're looking at those notes, what specific piece of information, maybe about level 3 values or liquidity maturities or credit risk concentrations, would give you that aha moment, that sudden clarity about the company's financial reality? Something to ponder about the real-world impact of these rules. Thanks for joining us for this deep dive. Welcome to the deep dive. Today, we're zeroing in on something fundamental to understanding how any sizable company operates and reports its performance. IFRS 8, dealing with operating segments. Think of this as your backstage pass to see how management itself views the different moving parts of their business.
Right.
This is crucial knowledge whether you're analyzing a multinational giant or a company about to make its public debut, and, well, it applies across both individual company reports and the consolidated figures.
Exactly. To really get a handle on this, we've sifted through, well, quite a stack of information. We're looking at feedback from the European accounting experts, IFRS, on proposed improvements. A clear summary from BDO, the official definitions from the Irish Auditing Authority, ISA,
Okay.
the IASB's own detailed reasoning behind the standard, a staff paper addressing specific questions about revenue and expense reporting, a review of how well IFRS 8 has worked in practice, the latest proposed changes to the exposure draft, and, practical insights from Grant Thornton. Our goal today is really to pull out what truly matters to you, giving you a clear picture of segment reporting without getting too bogged down in accounting jargon.
Okay, sounds good. Let's unpack this from the ground up then. How does a company even figure out what its operating segments are in the first place? It might sound obvious, like just look at the different departments, but it's actually a pretty specific process, isn't it?
It is. The definition of an operating segment has basically three key elements. First, it's a part of the company that conducts business activities, and importantly, it may earn revenue and incur expenses.
Right, that may is key.
Exactly. Think of a new division, still investing heavily. It doesn't have to be profitable yet. Second, its performance is regularly reviewed by the chief operating decision maker, the KODM, to decide where to allocate resources and, how that segment is doing. And third, there must be separate, discrete financial information available for that part of the business.
Got it.
Oh, and one thing to keep in mind right off the bat, post-employment benefit schemes, like pension plans, they're specifically not considered operating segments. They're managed differently, not really part of the core operations.
The COIGM, we hear that term a lot when talking about segments. The Irish Auditing Authority, IASA, makes a point that this isn't necessarily someone with chief in their title, right? It's more about the role they play.
Absolutely. The COIGM is the person or group with the authority and responsibility for deciding how resources are distributed within the company and for evaluating the performance of different parts of the business. Often, it'll be the CEO or COO,
Sure.
but it could be a team of executive directors or even others. The key is the function, making those core operating decisions. Pinpointing the KDM requires looking at how the company is structured and how it actually operates.
Okay.
IFRS actually raised an interesting point here, suggesting that some might see major resource allocation as more of a strategic decision of the board, not just an operating decision of, say, one specific individual.
Interesting distinction.
Yeah, but under IFRS 8, the KODM role is still focused on those operational levers,
Okay, here's where it gets, well, really interesting. What if the person or group identified as the CODM looks at the business in more than one way? Maybe they get reports broken down by product line and by geographical region. Which view determines the operating segments then?
That's a critical question, yeah. And it gets to the heart of the management approach in IFRS 8. When the KODM uses more than one set of segment information, the company has to figure out which view best reflects how management actually runs the business, and therefore provides the most useful information to users, like you.
Okay, so it's about usefulness.
Right. Grant Thornton emphasizes that you should consider things like the nature of the activities within each component, who's responsible for managing them day to day, and how information is regularly presented to the board of directors. The IASB's thinking here, which they detailed in their basis for conclusions, is that the information regularly seen by the top decision makers usually signals how they truly view the business segments.
Makes sense. And what about when one part of a company primarily sells to another part? Like, a mining division that sends all its ore to the company's own smelting plant. Can that still be considered a separate operating segment? I think BDO and Grant Thornton mentioned vertically integrated examples.
Definitely. Even if a segment's main or even only customer is another internal segment, like that oil production unit feeding the refinery, it can absolutely still be an operating segment.
Okay.
The basis for conclusions specifically discusses these vertically integrated businesses. It highlights that understanding the performance of each stage of production can be really valuable for assessing the company's overall future cash flow potential because, well, different parts of the value chain will have different risk and reward profiles.
Right, it's different risk.
So as long as it's managed as a distinct unit with its performance regularly reviewed and separate financial data available, those internal transfers don't disqualify it.
Okay, so we've figured out how a company defines its internal operating segments. But you don't necessarily see all of those listed out in financial statements, do you? That's where the idea of reportable segments comes in and those specific numerical thresholds.
Exactly. IFRS 8 has specific quantitative benchmarks. An operating segment is considered significant enough to be reported separately if it meets at least one of these. Its total revenue, both from external customers and from other segments within the company, is 10% or more of the total combined revenue of all operating segments.
Okay, 10% of total revenue.
Or its profit or loss is 10% or more of the greater of either the total profit of all segments that made a profit or the total loss of all segments that incurred a loss. You look at the absolute values here.
Got it, the bigger absolute number.
And finally, if its assets are 10% or more of the total combined assets of all operating segments, BDO's summary provides a really clear breakdown of these.
No.
Importantly, these thresholds are based on the figures reported to the CODM before any accounting adjustments made at the consolidated level, like eliminating intercompany transactions.
Right, the internal view.
The IASB kept these percentages, 10%, from previous standards because they're seen as, well, objective and pretty well understood benchmarks. So when you're looking at a company's reportable segments, remember that each one hitting these 10% marks in revenue, profit, or assets is likely a major piece of their overall business.
And then there's the 75% revenue rule. That sounds like a backstop, almost, to make sure enough of the company's business is actually being reported at the segment level. Can you explain how that works?
It acts as a safety net, yes. If the total external revenue reported by all your individually reportable segments adds up to less than 75% of the entire company's total external revenue,
Okay.
then you have to identify additional operating segments as reportable, even if they don't individually meet those initial 10% thresholds, until you reach that 75% mark for external revenue.
Ah, I see. So you keep adding smaller ones until you hit 75%.
Exactly. Grant Thornton points out that while IFRS 8 doesn't specify exactly which additional segments to pick, companies should consider both their size and nature and, the overall goal of providing useful information to users.
Makes sense. What if a company has, like, a lot of really small operating segments? Can they just lump some of them together for reporting purposes? That sounds like the aggregation rules we saw mentioned.
Yes, aggregation is permitted, but it's quite strict. 2 or more operating segments can only be combined and reported as one if they share similar economic characteristics, and they are alike in all of the following ways: the nature of their products or services, their production processes, the types or classes of customers they serve, the methods they use to distribute their products or deliver their services, and, if it's applicable, the regulatory environment they operate in.
Wow, all of those.
All of them. IFRS specifically agreed with emphasizing that all these criteria must be met. The basis for conclusions highlights that this is basically to prevent companies from combining segments that are fundamentally different, which was apparently a concern under earlier accounting rules.
So no, just sweeping a bunch of dissimilar small units under the rug to make the segment reporting look cleaner.
Exactly.
Oh.
Unless they truly share those core characteristics across all those dimensions.
Okay.
However, there's also a practical aspect to consider. IFRS 8 does acknowledge that if a company ends up with, say, more than 10 reportable segments, it might become a bit overwhelming for users to digest all of that information.
Yeah, information overload.
Right. At that point, Grant Thornton suggests that any further aggregation should still prioritize segments with similar economic characteristics and that meet a majority of the aggregation criteria. It's a bit of a balancing act between giving enough detail and avoiding overload.
What if a company's management thinks a particular operating segment is really important for investors to understand, maybe a new venture or something, even if it doesn't quite hit those 10% thresholds? Can they choose to report it separately anyway?
Yes, management discretion does come into play here. even if an operating segment falls below the quantitative thresholds. If management believes that providing separate information about it would be useful for users in understanding the company's financial performance and position, they absolutely can choose to record it separately.
Okay.
Grant Thornton uses the example of, say, a promising new startup division. The basis for conclusions also kind of touches on this idea, noting that what's material isn't just about the numbers. Sometimes understanding key parts of the business, even smaller ones, is crucial for getting the full picture.
Right. Qualitative materiality. One last question on those 10% thresholds. What happens if different operating segments use different ways to measure their profit or their assets internally? How do you compare them against that 10% rule? That must happen sometimes.
Oh yeah, that's a very practical challenge companies face. Grant Thornton advises that in such situations, management needs to establish a reasonable and consistent way to compare the segments against the thresholds.
Okay, how?
Well, one approach they suggest is maybe using the lowest level of profitability or assets that is reported to the CODM for all segments as a kind of common benchmark. This provides theoretically the most consistent basis for comparison.
I see. All right, so we've identified which segments are important enough to report. Now we get to the actual information that needs to be disclosed about each of these reportable segments.
Yeah.
This is where the details of their performance and financial position become visible to us, the users.
Absolutely. IFRS 8 mandates several key disclosures for each reportable segment, and this is important only if that specific information is actually reviewed by or regularly provided to the CODM.
Ah, so it mirrors what management sees.
Exactly.
Yeah.
This includes their revenues both from external customers and from sales to other segments within the company. Their interest revenue and interest expense, depreciation and amortization expenses, and any material items of income and expense, as those are defined under IAS 1.
IAS 1, the presentation standard.
Right, the overarching standard for how to present financial statements generally.
And what about other key financial details beyond those core income and expense items? Are there others?
Yes, if the CODM also looks at these, companies have to disclose their investments in associates and joint ventures that are accounted for using the equity method, as well as any additions they've made to their non-current assets during the period. But there's some specific exclusions from non-current assets here, things like financial instruments, deferred tax assets, net defined benefit assets like pension assets, and rights arising from insurance contracts. These are usually managed and viewed a bit differently from typical operational assets.
Okay. The requirement for reconciliation seems really important. It's about tying the segment level information back to the overall company picture, right? Making sure it all adds up.
Exactly.
Yeah.
That's crucial. Companies must provide reconciliations of the total revenues, total profit or loss, total assets, and total liabilities of their reportable segments back to the corresponding total amounts for the entire company.
Right.
And crucially, any significant differences that explain why the segment numbers don't just simply add up to the total things, like maybe different accounting policies used at the segment level versus the consolidated level, the elimination of transactions between segments, or maybe corporate level items that aren't allocated to any specific segment.
Like head office costs.
Yeah, exactly. All those need to be separately identified and explained in enough detail for users to understand what's going on. IFRS specifically supported this emphasis on clear and detailed reconciliations in their feedback.
So just showing the segment numbers isn't enough. We need to understand how those pieces fit into the bigger puzzle. And it sounds like there needs to be some context around how those segment numbers are calculated in the first place, too.
Precisely. Companies have to explain how they measure the profit or loss, the assets, and the liabilities of their reportable segments. This includes explaining the basis used for any transactions between segments and highlighting any differences in how these are measured compared to the accounting policies used for the company as a whole. It helps you understand the underlying assumptions and methods.
Got it. Let's go back for a second to those material items of income and expense. The staff paper we looked at really dug into this, particularly how it connects with IAS 1. It sounds like there was maybe some debate about what exactly qualifies as material in the context of segment reporting.
There was indeed. Paragraph 23 of IFRS 8 specifically refers to material items of income and expense disclosed in accordance with paragraph 97 of IAS 1. The staff paper clarifies that while U.S. accounting standards, U.S. GAAP, use the term unusual items, IFRS 8 intends this to align with the general concept of materiality as defined throughout IFRS standards.
So not just unusual.
Right. It means considering both the nature of the item, is it unusual or infrequent, and its size or impact on the financial results. So it's not solely about things that are way out of the ordinary, although those can certainly be material.
So even if something isn't that unusual in the grand scheme of things, maybe it happens occasionally, if it has a significant impact on the performance of a specific segment, it would likely need to be disclosed at that segment level.
That's a key takeaway, yes. The assessment of whether an item is material needs to consider the overall context of the company's financial statements, naturally. But if an item is significant to understanding a particular segment's performance, it should be disclosed for that segment.
Even if it's shown elsewhere.
Even if it's also presented somewhere else in the main financial statements, yeah. The staff paper also makes it clear that items that might be individually small but become significant when you add them all up, based on the aggregation guidance in IAS 1, would also need to be disclosed at the segment level if they are important for understanding the segment's results.
Right, aggregation of immaterial items can become material.
Okay.
Okay. Now, businesses are dynamic. They reorganize. They acquire or sell off parts. How does IFRS 8 handle these kinds of changes in a company's segment structure? That's where the changes and restatements aspect comes in.
Right. When the composition of a company's reportable segments changes, say they combine two segments or split one, IFRS 8 generally requires that the company restate the previously reported segment information. That includes the figures from past interim periods as well.
Why restate?
Well, it's really important for making sure that the financial information remains comparable over time.
Yeah.
The IASB really emphasizes this in the basis for conclusions. You want to be able to compare apples to apples year over year.
Makes sense.
However, there's an exception if doing so is impractical, meaning the necessary information just isn't available, and the cost to somehow recreate it would be excessive.
Which should be rare.
Hopefully rare, yes. In those cases, the company has to disclose the current period's segment information on both the old and the new bases, so you can at least see the impact of the change in the current year.
And what about those quarterly or half-yearly reports, the interim financial statements, that also need to be adjusted right away if there's a change in segments mid-year?
Yes, absolutely. When a change in segment composition happens, the segment revenue, both external and internal, and the profit or loss information that's required in interim reports must be restated for all previously reported interim periods in both the current and the prior financial year. Again, unless it's deemed impracticable.
Okay.
Actually, the proposed amendments to IFRS 8 aim to strengthen this requirement in interim reports. They might require restatement in the very first interim report after the change, covering all comparable prior periods presented.
So even faster updates.
Exactly. It's all about giving users up-to-date and comparable information as quickly as possible. IFRS agreed that applying these amendments retrospectively makes sense for ensuring comparability.
Our outline also mentioned ongoing issues and amendments. It sounds like IFRS 8 hasn't been, a static set of rules since it was first introduced back in, 2006?
That's right. The post-implementation review that the IASB conducted a while back highlighted several areas where there have been ongoing questions and maybe some inconsistencies in practice.
Like what?
Well, for example, there have been concerns about how consistently different companies define their operating segments, even within the same industry sometimes. And some companies apparently found applying the aggregation criteria difficult in a uniform way.
Okay.
So the proposed amendments in the current exposure draft are trying to address some of these points. They aim to clarify, for instance, that the CODM is about the function someone performs, not just their specific job title.
We talked about that.
And that it can be an individual or a group, potentially including non-executive members. They also propose requiring companies to actually disclose the title or role of the CODM.
Ah, transparency.
And to explain any differences if these segments reported in the financial statements are different from how the business is discussed in other parts of their annual report, like the management commentary or MD&A.
That's interesting. So consistency across the whole report.
Yeah, that responds to concerns from regulators about ensuring consistency across all of the company's public reporting. The amendments also add more examples to the aggregation criteria to provide clearer guidance on when it's appropriate or not appropriate to combine segments.
More guidance is usually helpful.
Right. And interestingly, the proposed changes also suggest explicitly allowing companies to disclose additional segment information, even if it's not information that's regularly reviewed by the CODM.
Oh.
If they believe it would help investors get a better understanding of the business. As long as, of course, it doesn't contradict the main CODM reviewed information.
So potentially more detail if management thinks it's useful. Okay. Finally, let's just touch on the management approach itself again. It's the fundamental principle behind IFRS 8. But what are the real-world implications of this approach, both the advantages and the potential drawbacks?
The management approach, as the basis for conclusions really emphasizes, is all about mirroring how the company's top management actually views and manages the business internally. The core idea is that by aligning the external financial reporting with this internal view, you get more relevant information.
Information management actually uses.
Exactly. And it might even reduce the cost of preparing segment disclosures because companies are essentially sharing information they already use internally. Academic research cited by the IASB generally supports the idea that this approach leads to more useful information for investors compared to previous, more prescriptive standards.
But there's a downside.
A potential downside, as we noted earlier, is that it can lead to less comparability between different companies because their management structures and internal reporting practices can vary significantly.
Right. What constitutes a reportable segment for one company might be quite different for another, even if they're in the same industry. The basis for conclusions acknowledges this trade-off between relevance and comparability.
Okay.
But ultimately, the board prioritized giving users insight into how management itself sees the business.
Right, the relevance versus comparability trade-off. Okay.
Right.
So this deep dive into IFRS 8 really shows that understanding a company's operating segments is much more than just looking at its organizational chart, isn't it?
Absolutely.
It requires grasping this whole management approach, recognizing the pivotal role of the CODM, and navigating these detailed rules that determine which parts of the business are significant enough to actually be reported externally.
Absolutely. And the level of detail required by IFRS 8, particularly in those reconciliations and the explanations of how segment performance is measured, well, it provides you with a really powerful lens through which to analyze a company's operational structure and ultimately its financial health.
And the ongoing discussions and proposed updates just highlight that these accounting standards are continually evolving, hopefully, to provide even clearer and more meaningful information for users like us.
So as you next review a company's financial statements, maybe really pay attention to their reported segments. Do they make sense in the context of what you know about their business and their industry? Do the reconciliations between the segment numbers and the total company figures raise any questions for you? Digging into these details can often lead to some really valuable insights, those aha moments.
Definitely. And for those of you who want to delve even deeper, the IASB's own basis for conclusions on IFRS 8 provides a very, very comprehensive explanation of the thinking behind every aspect of the standard. It's quite readable, actually.
Good to know.
And, comparing the segment reporting of different companies within the same industry can give you a really practical understanding of how this management approach is applied in different contexts. This deep dive is really just the starting point for a much richer understanding of how companies structure and report on their core operations.
Great point. Well, thanks for joining us on the deep dive. We hope this has given you a clear perspective on IFRS 8 and operating segments. Until our next deep dive, keep exploring and stay curious. Welcome to the deep dive. Today, we're zeroing in on IFRS 9 financial instruments, a set of rules that really shook up how companies account for their financial assets and liabilities.
Yeah, definitely a big change.
Think of it as moving from an old, maybe slightly blurry snapshot to a much clearer, high-definition picture compared to its predecessor, IAS 39. We're going to extract the vital information about these changes without getting bogged down in, overly technical details.
Exactly. You, our listener, have given us some fantastic in-depth sources on IFRS 9, everything from the official pronouncements to how to actually apply it, and even some practical examples. So our mission in this deep dive is to pull out the most important insights from all that material, focusing on the 3 core areas where IFRS 9 brought about the biggest shifts.
Right. We're going to take a close look at how financial instruments are classified and measured now, then explore the new way of thinking about potential losses with expected credit losses, and finally, demystify the updates to hedge accounting.
Sounds good.
Our aim is that by the end of this, you'll have a solid grasp of what changed and, crucially, why it matters in the real world.
So let's begin by looking at the overall landscape. Our sources confirm that while the fundamental scope, what kinds of financial instruments IFRS 9 applies to, and the rules for when you initially record or remove them from the books, well, those are largely the same as they were under IAS 39.
Okay.
But the standard introduced 3 really significant changes.
Okay, let's unpack this. Those 3 pivotal areas, as we've mentioned, are classification and measurement,
Yep.
impairment, and hedge accounting. These are the three cornerstones of IFRS 9 that we need to understand to see how it represents a real departure from what came before.
Precisely. Let's dive into the classification and measurement of financial assets first. Now, under the old IAS 39, there were several different ways you could categorize these assets. Quite a few boxes.
Right. It felt a bit complex sometimes.
Could be. IFRS 9 simplified this significantly with a single, more unified approach that applies to all types of financial assets.
So instead of having to decide which of many different boxes an asset fits into, there's now a more consistent framework. And one of the key ideas here is basic lending instruments. What exactly makes a financial instrument basic in this context, and why is that important for how it's accounted for?
What's fascinating here is that if a financial asset is deemed to be a basic lending instrument, it becomes a candidate for measurement at what's called amortized cost.
Amortized cost.
Think of this as a more straightforward, cost-based way of accounting for it over time. On the other hand, the general principle under IFRS 9 is that pretty much all other financial assets are measured at fair value, which aims to reflect their current market price.
Got it. So a key determinant is whether the asset is essentially a plain vanilla loan. Now, the way a company manages these assets, their business model, also plays a really critical role. We've seen terms like hold to collect and sell. Could you explain what these models are and how they dictate the measurement approach?
Absolutely. If a company's business model is hold to collect, their main intention is simply to receive the contractual cash flows, those principal and interest payments, over the life of the financial instruments.
Okay, straightforward enough.
In this scenario, amortized cost is often the appropriate way to measure these assets. However, if the business model is hold to collect and sell, the company manages these assets with a dual purpose, both to collect those contractual cash flows and with the option to sell them if needed, maybe for liquidity or risk management.
Okay, so it's like having two potential exit strategies in mind. How does that dual objective translate into the accounting?
Here's where it gets really interesting. In the hold to collect and sell model, while the company intends to both collect and potentially sell, the financial assets are actually reported at fair value on the statement of financial position, the balance sheet.
Ah, okay, fair value on the balance sheet. But what about the income statement?
Well, the impact on profit or loss of the income statement is designed to look quite similar to what it would have been if the assets were measured at amortized cost, including recognizing any impairment losses.
Right.
The difference between the fair value and the amortized cost is then presented in other comprehensive income, or OCI.
OCI.
And think of OCI as a separate section of equity where certain gains and losses bypass the income statement, at least temporarily.
That's a really nuanced point. So you see the market value on the balance sheet, but the day-to-day impact on the profit number is more aligned with a cost-based method with those fair value adjustments going through OCI. What about financial assets that don't quite fit into these hold-to-collect models or aren't considered those basic lending instruments we talked about earlier?
Good question. If a financial asset doesn't meet the criteria to be classified as a basic lending instrument, or if it isn't held within a hold-to-collect or hold-to-collect and sell business model, then it generally falls into the category of being measured at fair value through profit or loss, or FVTPL.
FVTPL.
All right. This means that any changes in its fair value directly hit the profit or loss in each reporting period. So these are assets where market fluctuations immediately impact the bottom line.
That seems fairly direct. Now, you mentioned the basic lending criteria, and a key part of that is the contractual cash flow characteristics test, specifically the SPPI criterion. What does SPPI stand for, and how does a company determine if a financial asset passes this test?
SPPI is an acronym for solely payments of principal and interest.
Okay, SPPI, solely payments of principal and interest.
Exactly. The contractual cash flow characteristics test essentially assesses whether the contractual terms of a financial asset will result in cash flows on specific dates that are purely payments of the principal amount outstanding and interest on that principal.
Right.
The principal here is the fair value of the asset when it was first recognized, and interest is basically the compensation for the time value of money, the credit risk associated with an outstanding principal during a particular period, as well as other fundamental lending risks and costs,
So it really boils down to the fundamental nature of the cash flows. Are they just about repaying the loan and the cost of borrowing? But the sources also point out that some contractual features that might change the timing or amount of those cash flows can still satisfy the SPPI criterion. How does that work?
Yeah, this is an important point that adds a bit of flexibility to the SPPI test. Certain contractual provisions that could alter the timing or amount of cash flows can still be SBPI consistent if they're fundamentally linked to a basic lending arrangement.
For example.
For instance, if a borrower misses a payment, the contract might specify a higher interest rate as a way to compensate the lender for the increased credit risk. That makes sense in a lending context. Similarly, reasonable prepayment penalties are usually acceptable because they compensate the lender for the early termination of the loan. The key is that these kinds of changes should be directly related to the core lending relationship, not introducing some sort of equity risk or volatility unrelated to basic lending.
That makes sense. It's about making sure the essential nature of the instrument remains a lending agreement, despite these potential adjustments for things like late payments or early repayment. Now, let's switch gears and talk about equity investments. How are they treated under IFRS 9?
Generally, IFRS 9 mandates that all investments in equity instruments are measured at fair value. Full stop.
Okay, fair value for equities.
However, there's a significant exception here. When an entity initially recognizes an equity investment that isn't held for trading purposes and isn't contingent consideration in a business acquisition, it can make an irrevocable election.
Irrevocable.
Yes, irrevocable. A one-time choice at the start. It can elect to present any subsequent changes in fair value in other comprehensive income OCI. This choice is made on an investment-by-investment basis.
So for those longer-term equity stakes that aren't actively traded, companies can choose to keep the ups and downs in their market value out of their immediate profit or loss. But the sources also touch on some complexities with investments in funds that might expose investors to equity-like risks, but have features like being puttable and don't quite meet the strict definition of an equity instrument. What's the challenge there?
Right. This is a tricky area. What's particularly interesting here is that for these types of puttable instruments, that option to run fair value changes through OCI isn't available.
Ah, okay. No OCI option.
Exactly. Furthermore, because they often don't pass that contractual cash flow test we discussed, they might lack those pure principal and interest characteristics. They end up having to be measured at fair value through profit or loss, FVTPL.
I see.
And this measurement might not always align with how these assets are managed, perhaps in a long-term investment strategy, potentially making the accounting information feel less relevant for understanding the underlying business model. It's a consequence of the strict criteria.
That really highlights a situation where the principles-based approach of IFRS 9 can lead to accounting outcomes that might not perfectly reflect the economic intentions behind holding certain instruments.
What about derivatives? Where do they fit into this classification and measurement picture?
Derivatives, well, by their very nature, they don't typically have contractual cash flows that are solely payments of principal and interest in a way that would make amortized cost a suitable measurement.
Right, their value comes from something else.
Precisely. Their value is derived from an underlying variable, and their future cash flows can be quite uncertain, volatile even. Because of this, derivatives are generally measured at fair value through profit or loss.
Okay.
The same logic often applies to debt instruments that fail the SPPI test. Fair value is seen as a more relevant indicator of their future economic benefits and risks compared to amortized cost.
Okay, that gives us a good handle on how things are initially classified and measured. Now, what happens if the way a company manages its financial assets changes? Are they allowed to reclassify them under IFRS 9? Yes, reclassifications between measurement categories are permitted under IFRS 9, but, and this is a big but our sources really emphasize that these are only required when there's a genuine change in the entity's business model for managing those specific financial assets.
Okay, so it's not optional, it's required if the model changes.
Exactly. And importantly, these changes are expected to be infrequent and must be significant to the entity's overall operations and demonstrable to outside parties. You can't just decide to change it.
So this isn't something that can be done on a whim or, say, in response to short-term market movements. What kind of events would be significant enough to trigger a reclassification?
A change in business model would typically involve the entity starting or stopping a significant business activity, like acquiring, disposing of, or terminating a major business line, something really fundamental. The standard specifically says that temporary market disruptions or, just changes in intention about a particular asset due to market conditions are not enough to warrant a reclassification if there's no fundamental change in how the business manages those assets overall.
That makes sense.
And importantly, IFRS 7 requires companies to provide detailed disclosures about any such reclassifications they make. So there's transparency.
That makes sense. It prevents companies from strategically switching accounting methods just to smooth out their financial results due to temporary market ups and downs. Okay, let's move on to the second major area of change under IFRS 9 impairment. The old incurred loss model under IAS 39 has been replaced by a forward-looking expected credit loss model. This sounds like a pretty big shift in mindset.
It's a very significant change. Huge, really. Under IAS 39, you only recognized a credit loss when there was objective evidence that a loss had actually been incurred, like a default or a significant financial difficulty of the borrower.
So you waited for the bad thing to happen.
Pretty much. The IFRS 9 model, however, requires companies to think ahead and consider potential future credit losses right from the moment a financial instrument is recognized, even on day one. This naturally leads to an earlier recognition of credit losses.
So it's a much more proactive approach, trying to anticipate problems rather than just reacting to them. Could you walk us through the 3 stages of impairment under this expected credit loss or ECL model?
Certainly. The IFRS 9 impairment model is structured around 3 stages: Stage 1, Stage 2, and Stage 3.
Okay, stage 1.
In Stage 1, which applies to financial instruments where the credit risk hasn't increased significantly since they were initially recognized, companies recognize what are called 12-month expected credit losses.
12-month ECL.
Yes. These are the credit losses that are expected to result from potential default events within the next 12 months after the reporting date.
And what would cause a financial instrument to move from stage 1 to stage 2?
A financial instrument transitions to Stage 2 if, at the reporting date, the credit risk associated with it has increased significantly since it was originally recognized. It's about the change in risk.
Okay, a significant increase.
Right. In this stage, the entity recognizes full lifetime expected credit losses, which are the credit losses expected over the entire remaining life of the instrument, not just the next 12 months.
Lifetime ECL. Got it.
Now, there's a practical shortcut or expedient. Companies can assume that credit risk hasn't significantly increased if the financial instrument is still considered to have low credit risk at the reporting date, regardless of the change since origination.
Ah, okay. Bit of relief there for low-risk stuff. And finally, stage 3. What characterizes a financial asset in this stage?
A financial asset enters Stage 3 when it is considered to be credit impaired. Essentially, there's objective evidence of impairment, similar in concept to the old IAS 39 trigger, but applied within this new framework.
Okay, so it's actually impaired now.
Yes. At this point, the company continues to recognize lifetime expected credit losses. However, a key difference in Stage 3 is how interest revenue is calculated.
Oh, how does that change?
For assets in this stage, interest revenue is calculated by applying the effective interest rate to the amortized cost of the asset, which is the original gross carrying amount minus the accumulated impairment allowance.
Right, netting off the loss allowance first.
Exactly. If the asset was actually credit impaired right from the start when it was purchased or originated, a credit-adjusted effective interest rate might be used instead.
So once an asset is deemed credit impaired, not only do you recognize the full expected loss, but the way you account for its income changes too. Now, we keep hearing the term expected credit losses. How are these losses actually defined, and how do companies go about measuring them?
Good question. Expected credit losses are defined as a probability-weighted estimate of credit losses over the relevant time horizon, either 12 months or lifetime.
Probability weighted.
Yeah. And a credit loss itself is the present value of all the cash shortfalls. That's the difference between the cash flows that are contractually due to the company and the cash flows that the company actually expects to receive, discounted back.
Okay.
That probability-weighted estimate takes into account not just the likelihood of a loss occurring, but also different possible scenarios, and importantly, the time value of money. So future losses are discounted back to their present value using the original effective interest rate.
That makes sense. It's not just about the total amount of potential bad debt, but also the likelihood of it happening and when it might occur, and the time value. The sources also mention a simplified approach for certain types of receivables. Could you elaborate on that?
Yes, there's a simplified approach specifically for trade receivables, contract assets that don't have significant financing component under IFRS 15, and also lease receivables under IFRS 16.
Okay, what's simplified?
For these types of assets, a company always recognizes a loss allowance equal to the full lifetime expected credit losses. There's no need to track significant increases in credit risk or distinguish between Stage 1 and Stage 2.
Ah, so you skip the 12-month versus lifetime assessment for those.
Exactly. This simplification is mainly because these assets typically have shorter lifespans, meaning the 12-month and lifetime expected losses would often be very similar anyway.
Plus, for things like short-term trade receivables, interest isn't usually charged explicitly to compensate for credit risk. It just makes things more practical.
So for these shorter-term items, the expectation of potential losses over their entire life is factored in right from the beginning. Now, when it comes to assessing whether credit risk has significantly increased since initial recognition, which is the trigger for moving from stage 1 to stage 2, what kind of factors do companies consider?
The assessment of a significant increase in credit risk really focuses on the change in the probability of a borrower defaulting the PD over the expected life of the instrument, comparing the risk at the reporting date to the risk at initial recognition.
Change in probability of default.
Yes. This aligns with how credit risk is generally monitored and managed in risk management practices. Companies will look at all reasonable and supportable information that's available without undue cost or effort, and that could affect credit risk.
Such as?
Well, this can include things like changes in external market indicators, internal metrics like payment status or behavior scores, significant changes in the borrower's operating results or financial condition, changes in credit ratings, or even qualitative factors indicating a deterioration in the borrower's financial health or the economic environment they operate in. It's quite comprehensive.
And how is default actually defined under IFRS 9? Is there a specific universal threshold?
Interestingly, IFRS 9 doesn't provide a precise, one-size-fits-all definition of default. It recognizes that default can mean different things in different contexts.
Right.
So instead, it requires each company to establish its own definition that is consistent with how it defines default for its own internal credit risk management purposes for the specific financial instrument in question.
That allows for flexibility.
It does. However, the standard does include a sort of guideline or rebuttable presumption. It says there's a presumption that default doesn't occur later than 90 days past due, unless the company has reasonable and supportable information to demonstrate that a more delayed definition of default is more appropriate for that specific instrument.
Okay, so 90-day backstop unless proven otherwise.
Pretty much. Whatever definition is chosen needs to be applied consistently to all instruments with similar risk characteristics.
That makes sense, allowing for some flexibility based on different industries and circumstances while still providing a general benchmark. What happens with the impairment assessment if a financial asset's terms are modified, like in a restructuring?
That's a common scenario. If modifying a financial asset results in it being derecognized, essentially,
Yeah.
the old loan is extinguished and it's treated as a brand new loan, then that new asset's initial recognition triggers a fresh impairment assessment under the ECL rules. You start again.
Okay, makes sense for a new loan. What if it's not derecognized, just modified?
If the modification doesn't lead to derecognition, the modified asset isn't automatically considered to be lower risk just because its cash flows have been changed, maybe to make them easier for the borrower to meet.
Right.
You would need evidence of improved creditworthiness, like a consistent history of timely payments under the new terms, to potentially move it back from, say, stage 2 or 3 to a lower impairment stage. Just 1 or 2 on-time payments after a history of missed ones wouldn't typically be enough to indicate a sustained improvement in credit risk. You need to see a track record.
So the past payment history still carries weight even after a modification.
Right.
We've talked about the forward-looking nature of the ECL model and how it considers probabilities of default. Does this also involve taking into account broader macroeconomic conditions?
Absolutely. This is a key part of the forward-looking requirement. The ECL model explicitly requires consideration of reasonable and supportable forward-looking macroeconomic information.
Such as?
Things like forecasts of GDP growth, unemployment rates, interest rates, property prices, industry-specific forecasts, basically anything relevant that could reasonably influence the likelihood of borrowers being able to repay their debts in the future.
So it connects the accounting more directly to the economic outlook.
Exactly. This makes the ECL model much more sensitive to changes in the economic environment compared to the old incurred loss model, which was largely based on past events.
Lastly, in the impairment area, the sources mention purchased or originated credit-impaired financial assets, or POCI assets. How are these treated differently under the ECL model?
Right. POCI assets. These are financial assets that are already considered credit impaired when they are either purchased from a third party or originated by the entity itself, perhaps at a deep discount reflecting the impairment.
Okay.
For these assets, the accounting treatment is a bit different. The company only recognizes the cumulative changes in the lifetime expected credit losses since that initial recognition as a loss allowance.
Only the changes after you bought it.
Correct. Essentially, the initial purchase price or fair value at origination already reflects the market's or the entity's expectation of credit losses at that point.
So subsequently, any favorable or unfavorable changes in those lifetime expected credit losses compared to the initial expectation are recognized in profit or loss as impairment gains or losses. This prevents recognizing losses twice, once implicitly in the purchase price and then again explicitly through the ECL model.
Ah, okay, that avoids double counting. That
Yeah.
gives us a really comprehensive picture of the significant changes in how impairment is approached under IFRS 9. Let's now move on to our third key area, hedge accounting. Our sources suggest that IFRS 9 aimed to make hedge accounting more aligned with how companies actually manage their financial risks. How did it achieve this?
One of the main ways IFRS 9 accomplished this was by broadening the scope of what can be used as a hedging instrument and what can be designated as a hedged item. It also made the assessment of hedge effectiveness more principles-based rather than relying solely on strict quantitative rules.
More flexible, maybe.
You could say that. For example, under IAS 39, if a derivative was embedded in a financial asset, and you had to separate it out for accounting purposes, that separated derivative generally couldn't be used as a hedging instrument itself.
Right.
But under IFRS 9's classification rules, the combined instrument, host plus embedded derivative, is often measured at fair value through profit or loss anyway. And in that case, the entire combined instrument can potentially be designated as a hedging instrument.
That sounds like a more integrated and practical approach, reflecting the whole instrument. What other notable changes were introduced when it comes to hedging instruments?
There are specific new requirements and options for using options as hedging instruments. IFRS 9 now allows companies to separate the intrinsic value and the time value of an option, and they can elect to defer changes in the time value of an option to other comprehensive income, OCI. Then, depending on what's being hedged, whether it's related to a specific transaction or something related to a time period, this deferred time value is later reclassified from OCI to profit or loss, often matching when the hedged item affects profit or loss.
Ah, aligning the timing better.
Exactly. This change aims to better reflect the economics of hedging strategies that utilize options, where the time value is often seen as a cost of hedging.
That's interesting. So the time value, which can be a significant part of an option's price, gets a different accounting path. What are the fundamental requirements for a hedging relationship under IFRS 9? What kinds of things can be hedged and what can be used to hedge them?
Okay, the basics. For a hedging relationship to qualify for hedge accounting under IFRS 9, you need eligible hedging instruments and eligible hedged items.
Right.
Typically, hedging instruments are derivatives, measured at FVTPL. Although in certain situations like hedging foreign currency risk, non-derivative financial assets or liabilities measured at FVTPL can also be used.
And the hedged items.
Hedged items can be recognized assets or liabilities, unrecognized firm commitments, highly probable forecast transactions, or even net investments in foreign operations. You can hedge single items, groups of items, or even components of items as long as they can be reliably measured and the risk component is separately identifiable.
More flexibility there, too, it sounds like.
Yes, for a forecast transaction to be a hedged item, it still needs to be highly probable. And crucially, at the very beginning of the hedge relationship, it has to be formally designated and thoroughly documented. This documentation is key. It includes the company's risk management objective, their strategy for undertaking the hedge, how effectiveness will be assessed, etc.
We've heard about the removal of that quite specific 125% quantitative effectiveness threshold from IAS 39.
Yeah.
How has the assessment of whether a hedge is effective changed under IFRS 9?
Right, that 125% bright line test is gone. It was often criticized for being arbitrary and not always reflecting the economics.
Yeah, it could lead to discontinuing hedges that were economically sound.
Exactly. The IFRS 9 effectiveness requirements are more qualitative and focused on the economic relationship between the hedged item and the hedging instrument. There are three main criteria.
Okay, what are they?
First, there must be an economic relationship between the hedged item and the hedging instrument, meaning you expect their values to move in opposite directions because of the hedged risk. Second, the effective credit risk shouldn't dominate the value changes that result from that economic relationship. And third, the hedge ratio used for accounting purposes must be the same as the one the entity actually uses for its risk management purposes.
So it's more about the underlying economics and the entity's actual risk management.
Precisely. While there's no strict numerical range anymore, the relationship still needs to be effective in achieving offset. But the removal of that rigid test means that even if a hedge isn't perfectly 100% effective, you might not have to immediately stop using hedge accounting. Instead, any ineffectiveness, the bit that doesn't offset, is recognized directly in profit or loss.
That sounds like a more pragmatic approach, aligning the accounting more closely with the realities of risk management. Are there any other new flexibilities introduced in hedge accounting under IFRS 9?
Yes, another significant one is rebalancing. IFRS 9 allows for hedging relationships to be rebalanced if the company's risk management objective for that particular hedge remains the same, but the quantities needed to maintain the hedge ratio change.
So you can adjust the hedge.
Yes, rebalancing involves adjusting the amounts or quantities of the hedging instrument or the hedged item to keep the hedge ratio aligned with the entity's risk management strategy, without having to de-designate and redesignate the whole hedge. Hedge accounting is only discontinued when the fundamental qualifying criteria are no longer met, or if the company's risk management objective itself changes.
And what about specific details like forward points in forward contracts that are used for hedging? How are they accounted for under IFRS 9?
Right. Forward contracts often have two components, the spot element and the forward points, which reflect interest rate differentials. IFRS 9 gives companies an accounting policy choice for the forward point component when hedging.
A choice?
Yes. They can choose to treat the forward points like the time value of options, initially recognize the changes in OCI, and then amortize them or move them to profit or loss over the life of the hedge, depending on the nature of the hedged item. Alternatively, they can include the forward points in the overall assessment of hedge effectiveness and recognize changes in their value in profit or loss immediately, along with any other hedge ineffectiveness. The approach chosen should really reflect the economic substance of the company's hedging strategy.
Finally, within hedge accounting, the sources mention some temporary exceptions related to the reform of interest rate benchmarks, like the move away from LIBOR or IBORs generally. Could you briefly explain those?
Yes, the IBOR reform. Given the massive ongoing global shift away from certain key interest rate benchmarks like LIBOR, IFRS 9 includes some mandatory reliefs and temporary exceptions.
To ease the transition.
Exactly. These provisions essentially allow companies to make certain assumptions when applying hedge accounting requirements during the reform period. For example, they might assume that the interest rate benchmark underlying their hedged item or hedging instrument isn't altered by the reform for the purpose of evaluating hedge effectiveness under certain conditions.
Okay.
They also permit amendments to the formal hedge documentation to reflect the necessary changes in the benchmark rate, like switching from LIBOR to a new risk-free rate, without automatically causing a discontinuation of hedge accounting, provided the change is economically necessary due to the reform. These temporary rules are designed to prevent widespread disruption to hedge accounting solely because of this market-wide transition.
That's a really helpful overview of the key updates in hedge accounting. Now, let's talk about the actual switch to IFRS 9. When did it become effective, and were there any options for adopting it early or any specific issues that were addressed during that transition period?
Sure. The general effective date for IFRS 9 was for annual reporting periods starting on or after January 1st, 2018. And yes, early adoption was permitted before that date.
Okay, 2018 generally.
Right. The IASB also issued some amendments specifically to address concerns that arose because IFRS 9 became effective before IFRS 17, the new complex standard for insurance contracts.
Oh, the timing mismatch.
Yes, because insurance companies often hold a lot of financial instruments to back their insurance liabilities, having different effective dates could cause significant accounting mismatches and volatility. So these amendments allowed qualifying insurance companies to either defer the adoption of IFRS 9 until IFRS 17 became effective, or to apply what's called an overlay approach for a temporary period.
An overlay.
Yeah, the overlay approach basically lets them reclassify some of the profit or loss impact of designated financial assets from the income statement to OCI, kind of mimicking the effect of the older IAS 39 standard for those assets to reduce the volatility until IFRS 17 was in place.
Interesting workaround. And what were some of the main requirements or things companies had to consider during the transition to IFRS 9 itself, besides those insurance specifics?
Well, IFRS 9 generally required retrospective application for classification and measurement and impairment, with some exceptions. This means companies had to go back and restate their previous financial statements, particularly the opening balance sheet of the year they adopted it, as if they had always used IFRS 9.
Restatement can be complex.
It can be. The standard required companies to provide additional disclosures during the transition period, as outlined in IFRS 7 and IAS 8, to increase transparency about the impact, particularly around impaired assets and the changes in their accounting policies.
Any relief on that retrospective application?
Yes, there was specific relief and guidance for situations where full retrospective application, for example, retrospectively assessing whether a prepayment feature was insignificant under the SPPI test, or applying the complex effective interest method calculations retrospectively was just not practical or would require undue cost or effort. In those cases, certain practical expedients were available to simplify the process.
Lastly, the sources briefly touch on how IFRS 9 might apply to the public sector. Are there any unique aspects or interpretations for government entities?
The application guidance does explicitly consider the public sector context. One notable point is the assessment of own credit risk for liabilities. It specifies that government's exchequer funds and the Bank of England, when they hold their own liabilities, are considered to have zero own credit risk.
Okay, that makes sense.
Also, when it comes to assessing the business model for managing financial assets in the public sector, the guidance suggests that a reevaluation is really only likely after a significant, publicly announced change in government policy that clearly demonstrates an impact on how those financial assets are managed. It acknowledges that public sector business models might be driven by different factors than purely commercial ones.
Right.
But overall, the core principles of IFRS 9 classification based on cash flows and business model, the ECL impairment approach, the hedge accounting rules are generally applicable to the public sector without needing major modifications. The principles translate reasonably well.
So, while the fundamental rules apply across the board, the specific context of public sector entities and the types of financial instruments they typically hold are taken into account. Well, it brings us towards the end of our deep dive into IFRS 9. It's really clear that this standard introduced some fundamental shifts in how financial instruments are accounted for across classification and measurement, impairment, and hedge accounting, with a strong emphasis on looking forward and being more sensitive to risk.
Absolutely. By understanding these key principles, the business model and SPPI tests, the 3 stages of ECL, the closer link between hedge accounting and risk management, you, our listener, should now have a much clearer perspective on how financial reporting reflects the underlying economic realities of a company's financial instruments.
Yeah.
The move from looking backwards at incurred losses to anticipating expected credit losses, for instance. It offers a more timely and potentially more relevant view of credit risk and how it's being managed.
And on that note, here's a final thought for you to consider. Given this increased focus on expected credit losses and fair value accounting, and considering it applies across various industries, not just banks and financial institutions, how might this influence investment decisions and the overall risk management strategies of different types of companies? Think about the broader implications of these accounting rules on how we understand financial health and stability in the economy. Does it make things more transparent? Does it introduce new volatility? What are the knock-on effects?
That's a great point to ponder, indeed. The core concepts we've explored today really provide a solid foundation for understanding these important accounting changes. We encourage you to explore any specific aspects of IFRS 9 that are particularly relevant to your own interests or professional needs in more detail.
Thank you for joining us on this deep dive.
Have you ever looked at like a really big corporation? You know those ones that seem to be made up of tons of smaller companies?
Yeah, it can be kind of overwhelming, right?
Totally.
Yeah.
And it feels like you're trying to put together a puzzle without all the pieces. You get these glimpses, but the full picture just never seems to come into focus.
It's like listening to an orchestra, but only hearing one instrument at a time. You know there's more to the music, but you can't quite grasp the whole symphony.
That is a fantastic analogy. And that's where consolidated financial statements come in, right? They're like that conductor's score bringing all the instruments together. Suddenly you can see how those separate businesses, those individual notes, create a whole economic composition.
Precisely. And today we're fortunate enough to have this amazing collection of resources you've gathered focusing on IFRS 10.
Oh yeah, I dug deep for this one. We've got those dense guides that spell out all the rules and interpretations that clarify the tricky bits.
Not to mention some real-world examples of financial statements that really bring it all to life.
Exactly. So in this deep dive, we're on a mission to break down IFRS 10. We're going to extract those essential elements that you really need to understand, cut through all of the jargon, and figure out what it actually means for businesses and how they tell their financial stories.
We want to uncover those core insights that can be buried under layers of technical language. We're going beyond just summarizing. We're going to interpret and analyze.
Because at the heart of it, consolidation is really about taking all those financial results, from the parent company and all the subsidiaries and presenting them as a single unified entity, right?
Yeah, imagine being able to zoom out from those individual snapshots of each company to see the entire economic landscape. That's what consolidation aims to do.
And the golden rule for knowing when to consolidate. When do we combine those financials?
It all boils down to one fundamental principle: control. That's the linchpin. That's what dictates whether we consolidate or not.
Okay, so let's unpack this control thing. What does IFRS 10 actually mean by that? How do they define it?
So IFRS 10 lays out this three-part test for control. You ready for this?
I'm all ears.
First, you need power over the investee. Second, you have to be exposed to or have rights to variable returns from your involvement. And third, you need to be able to use your power to actually affect the amount of those returns.
Okay, so it's not just a one and done kind of thing. All three of those have to be in place, right?
Absolutely. All three conditions are essential. No shortcuts here.
Got it. So let's break down those elements, starting with power. What does that actually mean in this context? It's not just about calling the shots on a daily basis, is it?
No, it goes deeper than that. Power, in the context of IFRS 10, means having the current ability right now to direct the activities that most significantly affect the investee's returns. We call these the relevant activities.
So we're talking about big picture stuff, right?
Exactly. Decisions about the products or services they offer, those major capital expenditures, even appointing key management. Things that really move the needle.
Makes sense. And here's where it gets interesting, doesn't it? Because you don't necessarily have to own most of the voting rights to have this kind of power.
You're absolutely right. IFRS 10 recognizes that control isn't just about having the majority of the votes. There are other ways to exert influence.
Like what?
Well, think about a situation where the rest of the shares are widely dispersed among tons of small, uncoordinated investors.
Right, like a publicly traded company with loads of individual shareholders.
Exactly. In that kind of scenario, even a minority shareholder, if they own a significant chunk, might have the practical ability to sway those key decisions.
Because they're the biggest voice in the room, even if they don't have the most votes, technically.
Precisely. It's about recognizing the substance over the form. Who's really pulling the levers?
That's a key point, isn't it?
Yeah.
This shift from just counting votes to understanding the actual ability to make those big decisions.
It's a crucial distinction. IFRS 10 is all about understanding the true dynamics of control, not just ticking boxes.
Okay, so we've got power covered. What about returns? What kind of returns are we talking about here?
So for this part of the test, the returns have to be variable. They have to be able to fluctuate. It's not about a fixed payment or a guaranteed return.
Okay, so things like profits, losses, dividends, changes in the investee's asset value, basically anything that can go up or down and directly impact the investor's financial stake.
You got it. It's about sharing in both the potential upsides and the downsides.
Which makes sense, right? If your returns are locked in, you don't really have the same level of risk and reward that comes with actually controlling an entity.
Exactly. It's that exposure to variability that aligns with the concept of control.
And then there's the link between power and returns.
Yeah.
You have to be able to use your power to actually influence those variable returns.
That's the key connection. It's not enough to just have the ability to direct the company and be exposed to its financial ups and downs. You have to be able to use your power to make those returns go up or down.
So it's about having both the steering wheel and the accelerator, so to speak.
That's a great way to put it. You need the ability to steer the company in a direction that impacts your returns.
It seems like IFRS 10 really moved away from a black and white rules-based system.
Absolutely. There's no more simply checking to see who owns more than 50% of the shares and calling it a day.
They've embraced this more principles-based approach, haven't they?
Yes, and that means more judgment is required. You have to look beyond the legal structure and really understand the substance of the relationship. It's about identifying who truly has the capacity to drive those key decisions and reap the benefits or bear the risks, as the case may be.
And that brings us to potential voting rights, doesn't it? Things like options to buy more shares. Do those play into this control assessment?
They do, but only if they are substantive. And by substantive, we mean that the holder actually has the practical ability to exercise those rights.
So it's not just about having the option on paper.
Right. You have to look at whether there are any real-world barriers preventing them from exercising those rights.
Like, what if I have the option to buy a ton of shares in a company, but the price is so high that it would never make financial sense to do so?
Exactly. Or if there were some contractual restrictions in place.
In those cases, those potential voting rights wouldn't give me control right now, would they?
Probably not. And IFRS 10 even addresses the concern about constantly reassessing control just because the share price is fluctuating. They emphasize that it's about substantive rights, and those are evaluated based on more than just the market price at a given moment.
Makes sense. Now, sometimes you see these situations where control seems a bit murky. Like, what about those cases where one company is managing another on behalf of someone else? How does IFRS 10 handle that kind of delegated power?
That's a great question. It brings us to the concept of the principal-agent relationship. The principal is the one delegating authority, and the agent is the one carrying out those decisions. The key here is to determine who actually controls the investee.
Because the agent is making decisions, but they're doing it on someone else's behalf.
Right. And the agent doesn't actually have control if they are primarily acting for the benefit of the principal. The focus is on whether the decision maker is acting mainly for their own benefit or for the benefit of someone else.
So you really have to dig into the details of the relationship.
Exactly.
Yeah.
You need to understand the purpose and design of the investee itself. What was it created to do? How are its activities being directed? The answers to those questions help us pinpoint who really holds the reins.
Okay, so we've established that control is this multifaceted concept. It goes beyond simple majority ownership. But are there ever situations where a company might meet those control criteria but still not consolidate a subsidiary?
Yes, there are. IFRS 10 lays out some specific exemptions to that general rule of consolidation.
And the most prominent one is the investment entity exemption, right?
Exactly. That's the big one.
So let's talk about that. What exactly is an investment entity? What are the key characteristics?
An investment entity is essentially a company whose primary business is investing. Their purpose is to generate returns from capital appreciation or investment income.
So they're in the business of buying and selling investments to make a profit.
Precisely. And they typically have multiple unrelated investors, and they have a defined exit strategy for their investments. Think about private equity funds, venture capital firms, even sovereign wealth funds in some cases.
Okay, so their core operation is investment management. And what's unique about the accounting for these investment entities?
The key difference is that they measure their investments in subsidiaries at fair value through profit or loss. Instead of consolidating those subsidiaries, they report them on their balance sheet at their current market value.
So they're not combining those subsidiaries' financials line by line like they would with normal consolidation.
Right, it's a different approach. However, there is one exception. If a subsidiary provides investment-related services to the parent, like management services, those subsidiaries are consolidated.
That makes sense. It's about aligning the accounting with the nature of their business. But why this fair value approach for most of their investments? Why not consolidate like everyone else?
The thinking behind this is that fair value information is much more relevant for the investors in an investment entity. These investors are primarily interested in knowing the current market value of the investment portfolio.
Because they're focused on the overall performance of the fund.
Exactly. And full consolidation can sometimes muddy the waters by mixing in the operational details of all those underlying businesses. It can obscure the big picture.
So for these investors, fair value changes are like a key performance indicator. They want to see how their investments are performing in the market.
You got it. It's about tailoring the financial information to the needs of the specific users.
And I noticed that having different classes of investors or even a significant amount of debt doesn't automatically disqualify an entity from being classified as an investment entity.
You're sharp to pick up on that. As long as those debt holders are also exposed to variable returns linked to the fair value of the net assets, it doesn't rule them out.
So the debt holders are along for the ride, so to speak. They share in the gains and losses just like the equity investors.
That's right. And the same goes for different classes of investors. As long as the fundamental business purpose is investment management, those other factors don't necessarily preclude investment entity classification.
Okay, so it's really about that core purpose. But I have to ask, is this investment entity exemption a choice? Can they choose to consolidate even if they meet the definition?
Nope, it's not optional. If you meet the definition of an investment entity, you have to measure your subsidiaries at fair value. It's a mandatory exception.
So it's not a pick and choose situation. The standard sets out the rules and you have to follow them.
Exactly. It ensures consistency and comparability in financial reporting for investment entities.
Now, are there any other situations, maybe less common ones, where consolidation might not happen even if there's control?
There are a couple more, but they are less common. One applies to non-public entities like privately held companies. If they inform all the minority owners about their decision not to consolidate and those owners don't object, they might be exempt.
So if everyone involved is on board and they're not a public company, they have a little more flexibility.
Right. It's a practical consideration. For smaller, closely held groups, the benefits of full consolidation might not outweigh the costs.
Makes sense. What's the other exemption?
The other one applies when control of a subsidiary is only temporary. If a company acquires a subsidiary with the clear intention of selling it off within 12 months and they're actively seeking a buyer, they might be exempt from consolidating in the meantime.
So it's like a holding pattern. They know they're going to divest soon, so they don't go through the whole consolidation process.
Exactly. But it's important to remember that this exemption is generally not available to public companies.
Because the stakeholders of public companies generally benefit more from seeing that full consolidated picture.
Precisely. Transparency and comparability are key for public companies.
All right, so we've talked about when a company consolidates. But what about the actual process? How does consolidation work in practice?
Well, it involves several key steps. First, you bring together the financial statements of the parent and all its controlled subsidiaries.
So you're literally combining them line by line, adding up all the assets, liabilities, revenues, and expenses.
That's right. But then you have to eliminate any transactions that happen within the group.
Like if the parent company sold something to its subsidiary, you'd remove that from both sides to avoid double counting.
Precisely. You want to present the group's performance as a whole, not inflate it with internal dealings.
And what about the parent's initial investment in each subsidiary? What happens to that?
You eliminate that against the subsidiary's equity at the time the parent gained control. This is also where any goodwill or bargain purchase gain from the acquisition is recognized.
So IFRS 3 business combinations comes into play here.
Exactly. IFRS 3 guides us on how to account for those acquisitions.
Makes sense. So you've combined the statements, eliminated the internal stuff, and accounted for the initial investment. What's next?
The final step is allocating the comprehensive income and equity between the parent company's owners and any non-controlling interests.
Yes, non-controlling interest, or NCI. That's the portion of the subsidiary that the parent doesn't own, right?
Exactly. It represents the equity held by other shareholders in the subsidiary. And we present that NCI separately within the equity section of the consolidated balance sheet.
So we're recognizing that even though the parent controls the subsidiary, there are other owners with a stake in its performance.
Absolutely. It's about providing a complete and transparent picture of the group's ownership structure.
And what happens if the parent decides to buy more shares in a subsidiary they already control? How is that accounted for?
Generally, those transactions are treated as equity transactions. It's seen as a deal between the existing owners of the parent and those who held the non-controlling interest.
So it's like reslicing the ownership pie.
That's a good way to think about it.
And on the flip side, what happens if the parent loses control of the subsidiary? That seems like a pretty big deal.
It is. When that happens, the parent removes all the subsidiary's assets and liabilities from its consolidated statements.
So it's like they're cutting the cord.
Yes, and any remaining investment the parent keeps in the former subsidiary is measured at fair value on the date control is lost.
So they treat it as a fresh investment at that point.
Precisely. IFRS sees this loss of control as a fundamental change in the relationship, so it's reflected in the accounting.
Now, I know there's been some research into how the adoption of IFRS 10 has actually impacted companies' reporting. What have they found?
Well, one interesting observation is that it seems to have led to fewer companies consolidating subsidiaries where they own less than a majority.
So they're less likely to consolidate if they don't have that majority stake.
That seems to be the trend. And it's even more pronounced for companies that are losing money or carrying a lot of debt.
Oh, that's really interesting. Why might that be?
There are a couple of possible explanations. For loss-making companies, deconsolidating a subsidiary that's also losing money can make their overall profitability look better.
Because those losses aren't dragging down the consolidated figures anymore.
Exactly. And for companies with high debt levels, taking a subsidiary's debt off their consolidated balance sheet can improve their leverage ratios, making them look less risky to lenders and investors.
So it really highlights how accounting standards can have real-world implications for how companies present themselves financially.
Absolutely. It's a reminder that we always have to be aware of potential incentives when we're analyzing financial statements.
And speaking of accounting standards, I understand that the IASB, the International Accounting Standards Board, is currently reviewing IFRS 10, along with IFRS 11 and 12.
Yes, that's right. They're conducting a post-implementation review to see how those standards are working in practice.
So they're checking to see if they're achieving their objectives and if there have been any unintended consequences.
Exactly. It's an important part of the standard setting process. They want to make sure the standards are effective and relevant.
And while we're talking about related standards, how does IFRS 10 connect with IFRS 12 and IFRS 3? They seem pretty interconnected.
They are. IFRS 12, disclosure of interests in other entities, works alongside IFRS 10 by setting out the disclosure requirements for a company's interests in subsidiaries, joint ventures, associates, and other unconsolidated structured entities. It ensures that users of those financial statements have a complete picture of the company's involvements.
So it's all about transparency, providing those crucial details about those relationships and the associated risks.
Precisely.
Okay.
And then you have IFRS 3, business combinations, which gives us the rules for accounting for those acquisitions. It tells us how to recognize and measure goodwill and other aspects of those deals.
So IFRS 10 tells us when consolidation is required, and IFRS 3 tells us how to account for those combinations. They work together to ensure consistent and comprehensive reporting.
Exactly. They form a cohesive framework for dealing with group accounting.
And we also have those example financial statements to refer to.
Oh, yes, those are invaluable. They show how all these principles are applied in real-world scenarios.
They demonstrate how those consolidated statements are presented and how companies provide details about their subsidiaries, their consolidation policies, and the amounts related to non-controlling interests.
Seeing it all laid out in a practical context can really solidify your understanding.
Absolutely. It bridges the gap between those abstract concepts and those tangible financial reports we see. Well, we've covered a lot in this deep dive. Let's quickly recap the key takeaways for our listeners.
So the foundation of consolidation under IFRS 10 is control, which depends on those three elements: power, exposure to variable returns, and the ability to use your power to influence those returns. Then we have that important exception for investment entities, which generally use fair value accounting for their subsidiaries. And finally, the consolidation process itself involved combining those statements, eliminating those intragroup items, and properly accounting for those non-controlling interests.
It's about recognizing that corporate structures can be complex, but understanding these core principles gives you the tools to analyze those structures and make sense of their financial reporting.
It allows you to see the financial health and performance of the entire economic group, not just its individual parts.
So it's like having X-ray vision for businesses. You can see through those layers of complexity to the underlying economic reality.
And that brings us to a thought-provoking question for you, our listener. As global business structures continue to evolve and become even more intricate, how might those accounting standards for consolidation need to adapt? How can they keep pace with those changes and continue to provide the most relevant information to users?
It's a question worth pondering. And as we've seen, the shift toward a more principles-based approach in IFRS 10 means that professional judgment plays a more crucial role than ever before. So how do we ensure that judgment is exercised effectively and consistently when assessing control, especially in those more complex scenarios?
These are questions that will shape the future of financial reporting. And we encourage you to delve deeper into those source materials we've discussed today and consider how these principles apply to the specific companies or industries that interest you. It's in that exploration that those true insights are often revealed.
Absolutely. So keep asking questions, keep challenging assumptions, and keep learning. That's the best way to navigate the ever-changing world of finance and accounting.
We'll see you in our next deep dive.
Until then,
Yep.
happy consolidating. Welcome to the Deep Dive. Today we're tackling a really interesting accounting puzzle. Imagine a scenario where a company buys into a joint operation. Think of an oil and gas field, maybe, complete with wells, pipelines, processing facilities, the whole shebang.
Right. It's basically functioning as a business.
Exactly. It's a business, but it's owned and run collaboratively. Now, when someone buys a piece of that pie, how do they account for it? Is it like buying a slice of an existing company, triggering all the business combination rules?
Or is it just like acquiring some shared assets? That's the crux of it.
That's the core of what we're going to unpack for you today.
Exactly. And for you, our listener, who wants to get a handle on how businesses account for their activities, particularly when they team up on projects, this is a really illuminating area.
Yeah, it really shows how accounting standards try to keep pace with, well, the complexities of real-world business deals.
Definitely. We've sifted through a bunch of material for this, discussions from the IFRS Interpretations Committee, feedback from EFRAG on putting IFRS 11 into practice, and insights from firms like BDO and Deloitte.
And the standards themselves, I assume.
Oh yeah, we'll also be looking at the official IFRS 11 standard itself, the thinking behind it, the basis for conclusions, and even some angles from the IFRS for SMEs.
Okay, let's unpack this, because it sounds like before some clear guidelines were established, there's a bit of a free-for-all in how companies were handling buying into these joint operations that were essentially businesses.
That's right. Before the specific updates to IFRS 11, especially in sectors like oil and gas, where buying and selling stakes and producing assets is quite common,
Yeah, happens all the time.
there were essentially two main ways companies were approaching this.
Yeah.
The IFRS Interpretations Committee's papers really highlight this difference in practice.
So what were these two main ways of thinking?
Well, the first way was, in essence, to say, don't treat this like buying a business under IFRS 3. The logic here was that even if the joint operation ticks all the boxes of a business, it has inputs, processes, generates outputs, as defined in IFRS 3, the company buying the interest isn't getting control of the whole business.
Right, they only own a piece.
Exactly. They're only getting a share of it.
Yeah.
So they would account for it more like acquiring a collection of assets or maybe making an initial investment in a joint setup. And importantly, they wouldn't recognize any goodwill.
Okay, that kind of makes sense intuitively. You're not in charge of the whole operation, just a part of it.
Okay.
So what was the other way people were accounting for this?
The second approach is to say, no, wait, we should apply IFRS 3. The argument here was that the focus shouldn't be on control of the entire joint operations business. Instead, it should be on the interest that the buyer is acquiring. The buyer does control that specific share, right? And that share represents an interest in a business.
Oh, okay, so the share itself is the key.
Precisely.
Mm-hmm.
Therefore, it should be treated as a business combination, which means goodwill could potentially be recognized.
So, as you can imagine, this lack of consistent treatment, well, it must have made it incredibly difficult for you as an analyst or investor to compare companies.
Oh, absolutely. You'd see one company showing a large goodwill asset from buying into a field, while another wouldn't, even for, economically similar transactions. It made comparisons really challenging.
Yeah, apples and oranges.
Totally. And as the staff at the IASB pointed out, their view was actually that IFRS 11 already implied that IFRS 3 should be the go-to standard in these situations.
Okay, so what was the reasoning behind that? Why did they think the answer was already kind of embedded in the existing rules?
Their core argument was this. When a company involved in a joint operation acquires assets and liabilities as part of a business that the joint operation is running, then IFRS 3, which is specifically about how to account for acquired businesses, should naturally apply to that acquisition. They used a really helpful analogy, actually. Think about several airlines jointly owning an aircraft. Each airline accounts for their share of that aircraft as property, plant, and equipment under IAS 16, right? Even though none of them controls the entire aircraft.
Right. No single airline controls the whole plane.
Exactly. The fact that no single airline controls the whole plane doesn't change how each accounts for their piece of the asset.
I see the connection. So, by the same logic, the fact that a company doesn't control the entire business of a joint operation shouldn't stop them from applying IFRS 3.
To their acquired share of that business, exactly. If that share itself constitutes a business interest.
Got it.
Precisely. They also pointed to a specific part of IFRS 11, paragraph C7. This deals with reassessing assets and liabilities when companies transition from the older rules, IAS 31 to IFRS 11.
Right.
Specifically, if their interest in a joint operation shifts from being accounted for using the equity method to recognizing their share of assets and liabilities. This suggested a fresh look at the underlying assets and liabilities.
Which kind of lines up with IFRS 3 principles.
Exactly. It aligns with business combination accounting. And they even referenced IAS 8, the standard on accounting policies, which basically says if there's no specific rule for a situation, you should look to other similar IFRS standards for guidance.
So that pointed towards IFRS 3 again.
Yeah, it further supported the idea that IFRS 3 was relevant here. The IASB staff was essentially saying the principles were already there, just maybe not explicitly spelled out for this exact scenario.
It's interesting that even before the official amendments, the IASB staff felt the direction was clear. Were there any clues from how other major accounting systems dealt with this, like U.S. GAAP?
Yes, that's a good point. The IASB staff also looked at how things are done under U.S. GAAP. Specifically, they considered the AICPA audit and accounting guide for oil and gas producing activities.
Okay, and what did that say?
Well, this guidance generally says that acquiring a working interest in an oil and gas property that's already producing, very similar to our example of buying into an existing oil field, is considered a business combination.
So U.S. GAAP treated it as a business combination.
Generally, yes. And importantly, under U.S. GAAP, goodwill is typically recognized in these kinds of transactions.
Which aligns with that second IFRS view we discussed earlier.
Exactly, the one that said IFRS 3 should apply. So there was some international precedent for this approach. It wasn't like this idea came out of nowhere. Seeing how U.S. GAAP handled it reinforced the thinking.
So it sounds like there was a growing consensus, maybe even an existing one if you look closely, towards treating these acquisitions as business combinations. What did the IASB ultimately do to, well, remove the ambiguity and make it official in the IFRS standards?
Right. Well, to clear up this diversity in practice and make the application crystal clear, IFRS 11 was officially amended. This happened back in May 2014.
Okay.
And these amendments directly address how to account for those situations where a company acquires an interest in a joint operation, and the activity of that joint operation meets the IFRS 3 definition of a business.
And what's the core principle that came out of these amendments? What's the main takeaway?
The core principle is that the company making the acquisition should apply all of the principles of business combinations accounting found in IFRS 3.
Okay, the whole IFRS 3 playbook.
Well, yes, IFRS 3 and any other relevant IFRS standards that don't clash with IFRS 11. But, and this is key, they only do this to the extent of the share they've acquired.
Only for the piece they bought.
Exactly. And this isn't just for the initial purchase. It also applies if they increase their stake later on, provided they still maintain joint control.
Right.
One interesting point to note is about previously held interests. If they already held an interest and then acquire more while still retaining joint control, or if they gain joint control over a joint operation that's a business, they don't go back and remeasure their previously held interest at fair value.
Okay, so no remeasurement of the old stake if you keep joint control. That simplifies things a bit.
It does. So it's like a scaled-down application of IFRS 3, focused specifically on the acquired portion.
And it's crucial to remember, you mentioned this, that this only kicks in if the joint operations activities actually meet the definition of a business under IFRS 3.
Absolutely critical distinction. If you're just buying into some assets that don't constitute a business, then this specific guidance doesn't apply. You'd follow the existing IFRS rules for asset acquisitions.
Okay. And were there any new disclosure requirements tied to this?
Yes. As part of these amendments, there's also a requirement to disclose information, just like you would for a regular business combination under IFRS 3, but obviously tailored to this specific type of acquisition in a joint operation.
Right. Makes sense.
Yeah.
This all seems like a pretty significant evolution in how these collaborative ventures are accounted for. But IFRS 11 itself, the standard that was amended, brought in some wider changes beyond just this specific acquisition issue, didn't it? It replaced the older standard, IAS 31.
That's right, yeah.
And I recall hearing about some fundamental shifts in how joint arrangements were viewed altogether.
You're absolutely right. IFRS 11 represented a more fundamental change by shifting the focus. It moved away from looking primarily at the legal structure of the joint arrangement.
Like whether it was in a separate company or not.
Exactly. And it shifted the focus towards the rights and obligations of the parties involved. That became the determining factor.
Okay, so substance over form, essentially.
Very much so. And it introduced the two main categories we touched on earlier. Joint operations, where the participants have direct rights to the assets and are directly obligated for the liabilities.
Like our oil field example, potentially.
Potentially, yes. Yeah. And joint ventures, where the participants have rights only to the net assets of the arrangement, usually meaning it's housed in a separate legal entity.
And one of the major practical changes resulting from this was getting rid of something called proportionate consolidation, right? For jointly controlled entities.
Yes, that was a really key change. Under the old rules, IAS 31, companies with certain jointly controlled entities often had the option to use proportionate consolidation.
And remind us what that involved.
Yeah, sure. Under proportionate consolidation, a company would basically report its share of each individual asset, liability, income, and expense of the jointly controlled entity directly on its own financial statements, line by line.
Okay. Merging its share in.
Pretty much. IFRS 11 eliminated that option entirely. No, these arrangements have to be classified as either joint operations or joint ventures.
And the accounting follows that classification.
Precisely. For joint operations, you recognize your share of the assets, liabilities, revenues, and expenses. For joint ventures, you generally have to use the equity method of accounting.
It sounds like figuring out whether an arrangement is a joint operation or a joint venture now requires a lot more careful consideration then. You have to look beyond just the legal wrapper.
Absolutely. It requires a detailed analysis of the legal form, yes, but also the specific terms outlined in the contractual agreements and any other relevant facts and circumstances. It's not always straightforward.
And interestingly, you could have something in a separate company that's still a joint operation.
Yes, that's possible. Even arrangements structured through a separate legal entity can still be classified as joint operations if the contractual terms give the participating parties direct rights to the assets and direct obligations for the liabilities held within that entity. Again, it really emphasizes that substance over form principle.
And I vaguely remember something about venture capital firms having a different way to account for their investments in joint ventures. Is that right?
That's correct. There's a specific exemption. Venture capital organizations, as well as mutual funds, unit trusts, and similar entities, have an option under IFRS 9, that's the financial instrument standard, to measure their investments in joint ventures at fair value through profit or loss.
Instead of the equity method.
Right, instead of having to use the equity method. This was actually carried over from a similar allowance in the old IAS 31, and it recognizes the unique nature of their investment activities. For them, fair value is often seen as the most relevant measure of performance.
Okay, interesting exception. So, with all these significant changes coming in with IFRS 11, including the specific amendment for acquisitions we focused on, how did companies actually transition to these new rules? Were there specific steps they had to take?
Yes, there were quite detailed transition requirements for companies moving from IAS 31 to IFRS 11. It depended on how they previously accounted for their interests.
Okay, so for instance, if a company had used proportionate consolidation for something that was now classified as a joint venture under IFRS 11.
Right. In that scenario where they previously used proportionate consolidation and now had to switch to the equity method for a joint venture, they generally didn't restate prior periods.
Okay,
Whoa.
so no full retrospective application.
No. Instead, at the beginning of the earliest period presented in their financial statements when they adopted IFRS 11, they recognized their investment in the joint venture. The initial amount was essentially the sum, the aggregate of the carrying amounts of the assets and liabilities they had previously proportionately consolidated.
Including any goodwill.
Yes, including any goodwill that might have already been recorded as part of that proportionate consolidation.
And what about the flip side? If they were using the equity method under IAS 31 for something that was now classified as a joint operation under IFRS 11.
Good question. In that case, at the start of the earliest period presented, the company would basically de-recognize the investment they had previously accounted for under the equity method.
Get rid of the single investment line item.
Exactly. And instead, they would recognize their individual share of each of the assets and liabilities related to their interest in the now classified joint operation. This also included reallocating any goodwill that might have been part of the carrying amount of that previous equity method investment.
Okay. Any tricky bits with taxes during transition?
Well, one important point the transition guidance specifically highlighted was that the initial recognition exception in IAS 12, the income tax standard, did not apply during these transitions. Meaning companies had to consider and recognize any deferred tax implications arising from these adjustments right from the start of the transition. They couldn't just ignore the tax effects initially.
Okay, got it. And the specific amendments we discussed earlier, the ones about buying into joint operations that are businesses, did those have their own timeline for when companies had to start applying them?
Yes, they did. Those specific amendments dealing with applying IFRS 3 principles were required to be applied prospectively.
Prospectively meaning?
Meaning they applied only to transactions occurring in annual periods beginning on or after January 1st, 2016. Companies didn't have to go back and restate acquisitions that happened before that date under the new rules.
Although they could adopt early.
Yes, early application was permitted. But the default was prospective from 2016 onwards. This prospective application made sense, really. Trying to apply these rules retrospectively.
This is a nightmare.
Pretty much. It might have involved significant challenges like trying to determine fair values from years ago and performing impairment tests with the benefit of hindsight, which is always difficult.
Yeah, okay. Finally, let's briefly touch on the IFRS for SMEs, the simplified standard for smaller companies. Was there any thought given to aligning that standard with all these changes in the full IFRS 11?
There were definitely discussions about it within the SME Implementation Group, or SMANG, the group responsible for the IFRS for SMEs. They looked at whether to align the SME standard with IFRS 11.
And what was the conclusion?
Well, while there was an initial question about alignment, the SMEng raised some practical concerns. A major one was the cost-benefit balance. They felt that the added complexity of some of the IFRS 11 requirements, like the detailed analysis for classification, might impose costs on SMEs that wouldn't necessarily be outweighed by the benefits, especially for companies with simpler business structures.
Right. Keep it simple for SMEs.
That's the general idea. They also highlighted that the IFRS for SMEs already offers a choice in Section 15 for accounting for jointly controlled entities. SMEs can choose between the cost model, the equity model, or the fair value model for these investments.
Which is different from full IFRS 11.
Yes, it's different from the mandatory equity method for joint ventures under full IFRS, unless that fair value option for VCs applies. So there was already a divergence there.
So what did they recommend?
Ultimately, the staff recommendation was to primarily focus on seeking views on aligning the definitions of joint arrangements, joint operation, and joint venture in the SME standard with those in IFRS 11, but maybe not a full alignment of all the detailed accounting treatments.
Okay, focus on the basic definitions for consistency.
Pretty much, yeah.
So to bring it all together then, the key takeaway here, the main point from all this, is that when a company acquires a stake in a joint operation that is essentially functioning as a business.
Take our oil field example.
Right. They need to account for that acquisition by applying the principles of IFRS 3 business combinations, but only to their share of that business.
Exactly. And this move aims to create more consistency in financial reporting, which we saw was lacking before, especially in how goodwill is recognized. And the goal is to provide a more accurate and economically relevant picture of these collaborative business ventures.
Yeah. And for you, our listener, understanding this nuance is really important when you're analyzing the financial statements of companies involved in joint projects. You see these a lot, especially in industries like oil and gas, resources, infrastructure.
Absolutely. Where these arrangements are so prevalent, it really highlights how accounting standards are continually being refined, trying to better reflect the underlying economic reality of business transactions, even when they get pretty complex.
Definitely. So here's maybe a final thought for you to chew on. The shift we saw discussed here, from IAS 31 to IFRS 11, with its emphasis on the underlying rights and obligations rather than just the legal structure.
That substance over form idea again.
Exactly. It feels like part of a broader trend in accounting, doesn't it? Towards a more substance over form approach. It makes you wonder, in what other areas of accounting might we see, or should we see, similar fundamental shifts in perspective in the future?
That's a great question. Where else is the legal form, perhaps, masking the economic substance?
Yeah, definitely something to keep in mind as you continue to navigate the sometimes complex world of financial reporting. Thanks for diving deep with us today.
The Learner, welcome back to the Deep Dive. You've handed us quite a collection this time, all focusing on IFRS 12 disclosure of interests and other entities. We've got EFRAG advice, BDO and KPMG guides, the IASB's basis for conclusions, interpretations committee stuff. Quite a stack.
Yeah, good amount to chew on. So our mission today is to really, pull out the core insights from all this.
Yeah.
We want to give you a solid handle on what IFRS 12 is truly about and, well, why it actually matters in the grand scheme of financial reporting.
Think of IFRS 12 as like the decoder ring for how companies show their connections to other businesses and their financial statements and these other entities. It's not just subsidiaries.
No, definitely not. We're
No.
talking joint ventures, associates, and importantly, those unconsolidated structured entities, which can sometimes be a bit murky.
Right. And the main idea behind it all.
Transparency, simple as that, really.
Yeah.
It's all geared towards making sure anyone looking at those financials can actually understand these relationships.
But it goes deeper than just listing names, doesn't it? That's the key takeaway I'm getting already.
Absolutely. It's not a phone book. It's about understanding the kind of relationship, the potential risks involved, and how it all feeds into the company's overall financial health.
Okay, so let's maybe start with the absolute core objective. What's IFRS 12 fundamentally trying to achieve?
Right. The primary goal, according to the standard itself, is helping users evaluate two main things: the nature of a company's interests in other entities and the risks that come with those interests.
And how those interests affect, well, everything. Financial position, performance, cash flows.
Exactly. It's about seeing the impact. And this idea of an interest is pretty broad. It's not just owning shares.
Yeah, the materials mention contractual and non-contractual involvements that expose the company to variability of returns. What does that actually mean in practice?
Well, It could be holding debt or equity, sure.
Yeah.
But it also covers things like providing funding to another entity, liquidity support, credit enhancements, even guarantees.
Okay, so if Company A guarantees a loan for Company B, Company A's results are tied to Company B paying it back. That makes sense.
Precisely. Their returns become variable based on Company B's performance. But it's also key to know what isn't an interest.
Ah, yes, the exclusion. What's specifically carved out?
Your standard everyday customer-supplier relationship. Just buying and selling goods or services doesn't typically create an interest under IFRS 12.
Right, good distinction. So if that's what an interest is, who actually has to follow these IFRS 12 rules? Who's in scope?
Generally, it applies to any entity that holds an interest in subsidiaries, joint arrangements that covers both joint operations and joint ventures associates, or those unconsolidated structured entities. It's a wide net.
But there are always exceptions in accounting, aren't there?
Yes, always. Post-employment benefit plans, like pensions, are out. They're covered by IAS 19. And generally, IFRS 12 doesn't apply to an entity's separate financial statements.
Okay, so if a parent company issues its own standalone accounts and group consolidated accounts, IFRS 12 mainly bites at the consolidated level.
That's usually the case, because the consolidated view is meant to show the whole economic picture. But there's a but.
Knew there would be.
If an entity only prepares separate financial statements, no consolidation, and it has interest in unconsolidated structured entities, then it does have to apply the relevant IFRS 12 disclosures in those separate statements.
Okay, that makes sense. If those separate statements are the only place to see those potentially complex structures, users still need the info. Any other exclusions?
Just one main one. If you're part of joint arrangement but don't actually have joint control or significant influence, just participating without real sway, then IFRS 12 doesn't apply to that specific interest.
Got it. It's about the relationships where you actually have some clout or shared decision-making power. Okay, let's dig into the specific disclosures. Starting with subsidiaries, often the biggest piece for many groups. What's key there?
For subs, it's really about helping users understand the group makeup and the role of non-controlling interests, the NCIs. The consolidated statements need to show what stake these minority shareholders has in the group's activities and cash flows.
So showing it's not all just the parent's pie.
Exactly. And another big one is disclosing significant restrictions on the group's ability to access or use subsidiary assets or settle their liabilities.
Restrictions, like what kind of things are we talking about?
Could be legal limits on moving cash between group companies, or maybe loan covenants that restrict dividends from a subsidiary back to the parent. Things that trap value, essentially.
Okay, so investors can see if the profits reported in one place can actually be used elsewhere in the group. That seems vital.
It really is. And related to that, you also have to disclose if the protective rights of those NCIs significantly restrict what the parent company can do. Sometimes minority shareholders have veto rights that can impact strategy.
Right, understanding those potential roadblocks for management. What about when ownership levels change?
Yeah, IFRS 12 covers that too. If control is maintained, but the ownership percentage changes, you need a schedule showing the effect on the parent's equity.
And if control is actually lost, that's a big deal.
A very big deal. Then you disclose the gain or loss on disposal, including any gain or loss from remeasuring any investment you keep in the now ex-subsidiary at fair value. And you have to show where that gain or loss hits the income statement.
Clear line of sight on the financial impact. Okay, let's pivot slightly. Investment entities. They got special mention in the materials.
Yes, they're a special case. These are entities whose business model is basically investing for capital appreciation or investment income. They often measure their subsidiaries at fair value through profit or loss instead of consolidating.
Right, the fair value exception. So since they don't consolidate in the usual way, what do they need to disclose under IFRS 12?
Well, first off, they have to state clearly that they are an investment entity and are applying that fair value exception. Transparency about the different accounting is crucial.
Makes sense. But even if they aren't consolidating, do they still need to disclose things about those unconsolidated subs?
They do. They still need to disclose significant restrictions on those subsidiaries transferring funds back to them. And, interestingly, any commitments or intentions they have to provide financial support to those subs, even if not contractually required.
So even at fair value, those underlying connections and potential support obligations are still relevant. Okay, what about joint arrangements and associates, where the company has joint control or significant influence?
For JVs and associates, the goal is similar. Let users understand the nature, extent, and financial effects of these interests. This includes describing the actual contractual setup with the other partners or influential investors.
So not just we own 40%, but how the arrangement actually works.
Exactly. And again, disclosure of significant restrictions on funds being transferred back to the reporting entity is required here too.
And I remember seeing something about summarized financial information.
Yes, for material JVs and associates, you need to provide summarized financials, key numbers like assets, liabilities, profit or loss, cash flows. Gives a sense of scale and performance.
And that summary should be based on the JV or associate's own consolidated figures if they have subsidiaries, right?
That's the clarification, yes. You need the picture of the whole JV subgroup, not just at the holding company level.
What else for JVs and associates?
You need to disclose the accounting method used, equity method, or fair value. It's fair value and there's a quoted price. Disclose that price. Also, your share of any unrecognized losses from the JV or associate.
If you've stopped recognizing losses because your investment hit zero.
Precisely. And any commitments you have relating to your JVs, like future capital contributions, it's about potential future impacts.
Okay, thorough. Now for the really complex bit, perhaps, unconsolidated structured entities, UCSEs. What is a structured entity again? The definition seemed key.
It is key. A structured entity is one designed so that voting rights aren't the main factor determining control. Control might come from contracts or other arrangements. Think securitization vehicles, conduits, entities set up for narrow, specific purposes.
Often with limited equity, maybe, where the rules of the game are set in the contracts?
Exactly. Determining control requires looking beyond votes to who really directs the activities that affect the entity's returns. That complexity is why the disclosures are so vital.
Right. So given that complexity, what does IFRS 12 demand disclosure-wise for UCSEs?
The main goal is enabling users to grasp the nature and extent of the interests and critically evaluate the risks. How much exposure does the reporting company really have?
Illuminating those potentially darker corners, what specific info is needed?
You need to explain how you decided which entities you sponsor, disclose the income you get from them, and the carrying amount of any assets you transferred to them.
And there was that tabular disclosure mentioned in the guides.
Yes, typically a table showing the carrying amounts of your own assets and liabilities linked to these UCSEs where they sit on your balance sheet, and crucially, your maximum exposure to loss.
That maximum exposure seems like a really important number for risk assessment.
It is. You have to explain how you determine it too. And if you can't quantify it.
You have to say so and explain why not.
Exactly. Admitting you can't quantify it is itself important information. One other point. If you provide support, financial or otherwise, to a UCSE without being contractually obliged to.
Like a bailout for reputational reasons?
Precisely. That needs to be disclosed too. It signals potential hidden risks or dependencies.
Okay. Now, shifting gears, slightly significant judgments and assumptions. This came up too.
Yes, IFRS 12 is very clear here. You must disclose the significant judgments and assumptions made when deciding if you have control, joint control, or significant influence. These judgments can be complex and hugely impact the accounting.
Can you give an example?
Sure. A classic one is concluding you don't have control even if you own over 50% of the votes, perhaps because another party has substantive rights that block you. Or the opposite, concluding you do control with less than 50% votes, maybe due to other contractual power or widely dispersed other shareholders. You need to explain the why.
Understood. It's not just ticking boxes, it's explaining the reasoning. Okay, practical presentation, materiality and aggregation. How much detail is enough, and how should things be grouped?
The standard says provide enough detail to meet the objective, letting users evaluate the nature and risks, but avoid clutter. Aggregate similar items if it makes sense and doesn't hide key differences, but you must keep subsidiaries, JVs, joint operations, associates, and UCSEs separate.
So group within categories where appropriate, but don't mix apples and oranges across the major types of interests.
That's the idea. Clarity without excessive detail.
Okay, last piece. The why. Why did IFRS 12 even come about?
Well, partly it was consolidation. It pulled together disclosure requirements that were previously scattered across IAS 27, 28, and 31 into one place. Made things more consistent.
Streamlining. But
Yeah.
there was more to it, right? The timing seems relevant.
Oh, absolutely. The 2007-2008 financial crisis was a huge driver. There was a massive outcry about the lack of transparency around structured entities and off-balance sheet risks. People realized they just couldn't see the full picture of interconnectedness.
So IFRS 12 was a direct response to that crisis, aiming to shed light on those complex, risky relationships, especially with UCSEs.
Very much so. The IASB specifically wanted to tackle those disclosure weaknesses revealed by the crisis.
And the cost benefit, did they think the extra work for companies was worth it?
They did.
Yeah.
They acknowledged the costs, but felt the benefits of improved transparency for investors and better decision-making outweighed them. Better information leads to better capital allocation, essentially. They also aimed for convergence with U.S. GAAP, especially on structured entity disclosures.
Right, makes sense. So wrapping up, IFRS 12 is really about driving transparency into these complex webs of corporate relationships, understanding the risks, and seeing the impact on the bottom line. It's not just compliance, it's about meaningful insight for users.
It's exactly. Giving investors the tools they need to analyze modern, often complex business structures.
So the learner, as you reflect on all this, here's a thought. How might these much richer disclosures required by IFRS 12 actually change how analysts and investors look at companies, especially those with lots of JVs, associates, or structured entities? What new questions might they ask now they have this extra detail? What deeper insights could they gain about the real risks and rewards hidden within those interests in other entities? Something to ponder. And with that, we'll wrap up this deep dive. Thanks for joining us. All right, welcome back to the deep dive. Today, we're diving into something crucial in the world of finance and accounting, and that is fair value measurement.
Fair value, yeah.
So we're going to try to break down how to figure out, the price of an asset or a liability as if it were sold between like two really knowledgeable, willing parties.
Exactly. We're going to unpack the complexities of that and how we actually determine that price.
Yeah, and it gets pretty hairy. So
It does.
we have a stack of accounting standards and a bunch of related documents to help us out here. IFRS 13, that's the big one. But I mean, this whole idea didn't just come out of nowhere, right?
Right.
Our sources emphasize that there was, a real need for consistency in how we're, measuring fair value.
Yeah. So IFRS 13 is the culmination of a collaboration between the IASB, the International Accounting Standards Board, and the FASB, the U.S. Financial Accounting Standards Board.
Right.
They got together and said, listen, we have to get on the same page with this. Before we had things like, SFAS 157 in the U.S. and ISO 39 internationally, those have largely been replaced, of course, by IFRS 9 now. But there were inconsistencies. And so these boards really wanted to create a unified approach. And you can see how important and complex this topic is just by the sheer number of comment letters they received on their initial proposal, 160 comment letters.
Wow.
So that just shows you how much discussion and debate this generated in the professional community.
Yeah, absolutely. So our goal today is to kind of demystify some of this complexity and try to give everyone a better understanding of fair value, measurement, what are the basic ideas behind it, and what are some of the practical challenges when it comes to applying these principles.
Exactly.
So let's jump right in. What are some core ideas that we really need to kind of have in our minds when we're talking about fair value?
Well, the first key is that fair value is what we call an exit price.
Okay.
So it's the price that you would receive to sell an asset, or the price that you would pay to transfer a liability in an orderly transaction.
Yeah.
This is not a fire sale.
Yeah.
This is a regular, market transaction.
Right.
Not a distressed sale.
Yeah, so it's not like I'm desperate to get rid of this thing.
Exactly.
So I'll take whatever I can get.
Yeah.
It's like a normal market.
Yeah.
Okay. And then kind of tied to that is this idea of the market participant perspective.
Absolutely. And this is where it gets interesting because you're not thinking about your own specific intentions or situation as the company. You have to put yourself in the shoes of those knowledgeable, willing buyers and sellers in the market.
Right.
And what would they assume? How would they act? What's in their economic best interest? So your plans, for example, to hold an asset long-term or settle a liability early, those don't really factor into the calculation.
That makes sense. It's like a hypothetical, almost like a theoretical market.
Yeah.
Okay. And you mentioned orderly transaction. What does that mean? Like, what are the conditions?
An orderly transaction just means it's not forced.
Okay.
It's not under duress. But, and this is an important nuance, if there are distressed sellers, in the market, their actions can absolutely influence those market prices, which would then be reflected in the price you use for an orderly transaction. So you can't just ignore what's going on in the market.
Got it. So like the broader market conditions, even though this specific transaction isn't a forced sale,
Correct.
It still matters.
Matters a lot.
Okay. And when we're talking about a market,
Yeah.
I mean, there are lots of places, right, where an asset or liability could be traded. So how do we figure out which market to look at?
Great question.
Hmm.
IFRS 13 lays out some guidance on that. They talk about the principal market. So this is the market with the greatest volume and level of activity
Okay.
for that particular asset or liability.
Yeah.
Now, if a principal market doesn't exist, then you look at what's called the most advantageous market. And this is the market that would maximize your proceeds if you're selling an asset,
Okay.
or minimize your cost if you're transferring a liability. But it's after considering things like transaction costs and transportation costs,
Okay.
because those are important.
So it's almost like finding the best case scenario
Yeah.
in a realistic market.
Exactly. It's not just theoretical, it's realistic.
Yeah.
But it's important to clarify that while we consider transaction costs
Okay.
and transportation costs to identify this most advantageous market,
Right.
those transaction costs themselves are not part of the fair value measurement. They're accounted for separately.
Okay.
Transportation costs, on the other hand, can be included if the location is a key characteristic. Think about oil, right?
Yeah.
Location matters for oil because transportation costs are a factor.
So that actually changes the inherent value of the asset.
Absolutely.
Okay, so the costs of getting into the market
Right.
don't affect the fair value itself. But if it's something that's like inherently part of the asset's value,
Yeah.
then we do factor that in.
Exactly.
Okay, so we've kind of set the scene. Now let's talk about specific assets. You mentioned non-financial assets earlier.
Yeah.
Things like buildings and machinery.
Right.
How does fair value work with those?
Yeah. For non-financial assets, it's all about the highest and best use.
Okay.
The fair value is based on how a market participant would use that asset to generate the most value,
Okay.
even if that's not how the current owner is using it. And that use could be standalone, or it could be in combination with other assets and liabilities, like as part of a whole business.
Okay, so let's say I have a plot of land, right, and it's in a commercially zoned area, but I'm
Yeah.
just using it for a garden.
Right.
Like, would its fair value be based on what it could be as a commercial development?
That's the principle.
Yeah.
Now, applying it in practice
Right.
is where the challenge comes in, as our sources highlight.
Mm-hmm.
Because you have to figure out which uses are actually legally permissible, physically possible, financially feasible, and you have to think like a market participant.
Right.
And there can be a lot of debate about how much evidence you need to support a particular highest and best use.
Yeah.
Just because something is legally allowed doesn't necessarily mean it's the best use from an economic standpoint.
It sounds like there's a lot of judgment calls involved.
There is.
Now, what about liabilities?
Yeah.
What we owe to others? How do we figure out their fair value?
So the fair value of a liability reflects the risk that you're not going to fulfill that obligation.
Uh-huh.
We call that non-performance risk. And a big part of that is the entity's own credit risk, their credit standing.
Right.
A company with a lower credit rating, they might have a higher fair value for their debt because there's more risk, that they won't be able to pay it back.
So if my company's, doing better financially or worse,
Yeah,
the fair value of our debt could change even though we owe the same amount.
precisely. And there's a big assumption at play here. When we measure the fair value of a liability,
Okay.
we assume that that non-performance risk is the same before and after a hypothetical transfer of that liability.
Okay.
Now, the IASB acknowledges that, in the real world,
Yeah.
the original entity and whoever takes on that liability might have totally different credit standings.
Right, yeah.
But for the purpose of measurement, we keep that risk constant.
That sounds a little counterintuitive. Why assume that it stays the same?
Well, the idea is to isolate the fair value of the liability itself in the
Okay.
market. If we started factoring in the credit risk of every potential, transferee,
Right.
it would just get too complex.
Yeah.
And then it wouldn't be comparable.
Okay.
Think of it like valuing a coupon payment on a bond. The value of that promise doesn't change just because a, more or less creditworthy entity might end up holding that bond.
Right.
Their risk of receiving it might change.
Yeah.
But the fair value of the obligation itself, that's what we're after.
That makes sense. Okay, so we're kind of isolating the inherent risk. Okay, cool. Now, our outline mentions something called the fair value hierarchy.
Yes,
It sounds like a way to rank the inputs that we're using to determine these values.
it is. The fair value hierarchy is a 3-level system that helps you prioritize the different inputs to your valuation based on how observable they are in the market.
So Level 1 being the most reliable information, I assume.
Level 1, absolutely.
Mm-hmm.
Those are the unadjusted quoted prices
Okay.
for identical assets or liabilities that are trading in active markets.
Got it.
Think about the price of, a share of Apple stock on the NASDAQ Q.
Right.
Generally, you just use those prices directly. There's no need for adjustments. There are a few exceptions, though. Like, what if you have a massive block of shares?
Yeah.
If you try to sell all of them at once, it could flood the market.
Right.
And the price would drop.
Yeah.
Or what if something huge happened after the market closed that would clearly change the value?
Okay.
But generally, level 1, think direct, reliable market price.
That's the gold standard.
It is.
What about level 2?
Level 2 is still observable, but it's not a quoted price for an identical item in an active market.
Okay.
This could be prices for similar assets or liabilities,
Right.
interest rates, yield curves, implied volatilities, credit spreads, inputs that have been corroborated by market data.
Okay.
So, for example, maybe you have a bond that isn't traded as frequently,
Right.
but you can kind of benchmark its value
Mm.
against similar bonds that are very actively traded.
Yeah.
So you're using related market information,
Okay.
but you might have to adjust it a bit
Right.
to make it fit this specific asset or liability that you're trying to value.
And that makes sense. Okay, so we've got the gold standard, we've got kind of the related information.
Yeah.
Now we're at level 3. This is where things get a little more, I guess, estimation-based.
Level 3, this is where we get into the unobservable inputs.
Mm.
And these reflect your own assumptions as the entity about what market participants would use to price the asset or liability.
Mm.
And you use these unobservable inputs when you just don't have any observable ones.
Right.
This often happens for assets or liabilities
Mm-hmm.
that are really unique or maybe not traded very often.
Yeah.
So it's management's best guess
Okay.
when you don't have a clear market price to look at.
So we're trying to put ourselves in the shoes of a market participant, but
Right.
there just isn't a market.
Yeah. And this is where it gets really subjective,
Yeah.
which is why level 3 gets so much scrutiny.
Right, because it's based on your assumptions, your models.
It is.
And it's not as, grounded in
Well,
real market data.
Exactly. And just to be clear, the level in the hierarchy, it's determined by the lowest level input that is significant to the entire measurement.
Okay.
So even if you're using some level 1 inputs,
Yeah.
if there's a level 3 input that's really important to the overall valuation, the whole thing gets classified as level 3.
Okay, got it.
And our sources indicate that figuring out the observability and the significance of these inputs, it can be tricky.
Yeah.
And then all the extra disclosure requirements for level 3, it just adds more pressure.
Right, because investors and regulators are going to be looking at those more closely.
Absolutely.
Because they are based on more assumptions.
Much more.
Okay. So now we've got our inputs, right? We've got our hierarchy figured out. How do we actually calculate this fair value? What are the main techniques?
So IFRS 13 talks about 3 main valuation approaches.
Okay.
First, you've got the market approach.
Yeah.
And this is using prices and other relevant information from transactions that involve either identical or comparable assets and liabilities.
Okay, so like if I'm trying to value an apartment building, I might look at
Yeah.
recent sales of similar buildings in the same area.
Exactly, finding comps, like you said, in the real estate world.
Exactly.
So that's the market approach.
Okay. Number 2.
Number 2 is the cost approach. And this reflects how much it would cost to replace the service capacity of an asset.
Okay.
This is often used for, tangible assets.
Yeah.
And the idea is that a market participant wouldn't pay more for something than it would cost to just go out and build or buy a similar one.
Yeah.
So the replacement cost, it acts as a kind of ceiling on the fair value.
Okay. And then number 3.
Number 3 is the income approach.
Right.
And this involves converting future amounts like cash flows, income, expenses,
Yeah.
into a single present value.
Okay.
So techniques here include discounted cash flow analysis,
Yeah.
option pricing models, multi-period excess earnings method.
Wow. Okay.
It gets a little complex,
Yeah.
but the basic principle is what would a market participant be willing to pay today
Right.
for the expected future benefits or obligations if it's a liability
Yeah.
of that asset or liability?
Okay. So it seems like there are different tools in the toolbox,
There are.
and you use whatever's appropriate for the situation. Is there one that's preferred, or is it really just situational?
IFRS 13 doesn't really say one is better than the other.
Okay.
It's all about what's appropriate in the circumstances.
Right.
But the overall goal is always to maximize the use of observable inputs and minimize the use of those unobservable ones.
Yeah.
And sometimes using multiple approaches can give you a more robust estimate.
Okay.
So you might actually use 2 or 3 of them in combination.
Okay. And what happens when you have like a range of prices in the market?
Yeah.
You know, like a bid price, what
And-
someone's willing to pay, and an ask price, what someone's willing to sell for.
Right, that bid-ask spread. So when you have a spread like that, you use the price within that spread that makes the most sense,
Okay.
given the specific circumstances. You could use the bid for assets
Okay.
and the ask for liabilities.
Right.
It's allowed, it's a practical expedient, but it's not a hard and fast rule.
Got it.
You might also use something like a mid-market price, if that's what people in that market typically use.
Right. Okay. And when we first recognize a new asset or liability,
Yeah.
you know, we put it on the books for the first time.
Right.
How do we figure out the fair value at that initial point?
So usually the transaction price, what you paid or received,
Yeah.
that's your fair value at initial recognition,
Okay.
unless there's a good reason to think otherwise.
But not always.
Not always.
When would it not be the fair value?
So if the transaction didn't happen in the principal market,
Okay.
or if it involved related parties,
Right.
the transaction price might not be reliable.
Yeah.
In those cases, you might have to use some of those other valuation techniques
Yeah.
right from the start.
Okay.
And that could lead to what's called a day one gain or loss,
Right.
which is the difference between that transaction price and the fair value you calculate.
That sounds a little tricky. Like you just got this thing
It can be.
and you're already saying you made a profit or a loss.
Yeah. And IFRS actually puts some limits on that.
Yeah. Okay.
For financial instruments, you can generally only recognize a day one gain or loss
Okay.
if the fair value is based on level 1 inputs
Right.
or techniques that only use observable market data.
Got it.
So it has to be really solid evidence.
So it's not just based on my model or my assumptions.
Right.
It's actually tied to real market data.
Exactly. And that makes sense because, think about it. You just bought or sold this thing. So your model for valuing it,
Right.
it might need a little tweaking, a little calibration
Yeah.
to make sure it's lining up with the actual market price.
Okay. And that calibration is basically just making sure
would
that those
say.
assumptions are
Yeah.
lining up with reality.
Exactly. It gives you more confidence in your ongoing measurements.
Okay. That makes sense. Now, we've talked a lot about individual assets and liabilities, but what if
Yeah.
we're managing a whole bunch of them together?
Yeah.
Like a whole portfolio?
Right, like a portfolio of financial instruments. So there's actually a portfolio exception that lets you measure the fair value
Okay.
based on your net exposure
Okay.
to certain market or credit risks
Yeah.
instead of valuing each thing separately.
Okay.
And this is allowed when you're managing those instruments on a net basis.
So, like, if I'm using a bunch of different bonds and swaps
Yeah.
to hedge my interest rate risk,
Right.
I can look at the fair value of that whole strategy.
Exactly. It simplifies things.
Okay.
And it better reflects how you're actually managing that risk.
Makes sense. Now, we figured out how to measure fair value.
Right.
But what about telling other people,
Yeah.
investors, stakeholders,
Yeah.
what kind of disclosures are required?
So the disclosures, they depend on which level of the hierarchy your measurement falls into.
Okay.
Level 3 measurements, because they rely the most on unobservable inputs and your judgment,
Right.
they require the most disclosures. So anyone looking at a company's financials, level 3 is where you really want to pay close attention.
And what kind of extra information do companies have to give for those level 3 valuations?
So they need to give quantitative information about those significant unobservable inputs
Okay.
that they used in their models. They have to show how those level 3 balances changed
Right.
from the beginning to the end of the period.
Okay.
They need to describe their valuation process,
Mhm.
and they need to talk about how sensitive the measurement is
Right.
to changes in those unobservable inputs.
Yeah.
And for financial instruments that are, recurring level 3 measurements,
Yeah.
they also might have to disclose quantitative sensitivity information
Okay.
if there are other assumptions that could significantly change the value.
So they're really trying to be transparent
Transparency is key.
and give investors insight into those more subjective valuations.
That's the idea. Now, our sources do point out that there's
Mhm.
been a lot of discussion about whether these detailed disclosures, especially for those interim financial statements,
Yeah.
are always worth the cost and effort.
Okay.
Some people find them really useful.
Right.
Others question whether the information is really that valuable, especially if it's pretty generic across different companies.
Yeah.
So it's a tough balance
It is.
between giving enough information but not overwhelming people.
Right. Now, we've talked about specific assets in our outline.
Yeah.
Let's start with investments
Okay.
and subsidiaries, joint ventures, and associates.
Right.
How do we figure out fair value in those cases?
So this has been a big area of debate.
Okay.
The question is, should the fair value of your investment just be the quoted market price per share times the number of shares you own?
Right.
Or should you adjust that for things like control premiums, synergies, market liquidity,
Okay.
especially when there are quoted prices out there?
Yeah, so if I own a controlling interest in a public company,
Right.
the fair value of my investment might be higher than just the sum of the share prices because I have that control.
That's the argument. And the IASB, they actually put out a proposal saying that for these kinds of investments,
Okay.
fair value should just be that price times quantity, no adjustments.
Okay.
But a lot of people push back on that.
Yeah.
They said it wouldn't accurately reflect the true value from a market participant perspective
Right.
because it ignores the control, the synergies, all those things a buyer might be willing to pay extra for.
Yeah.
So this is an area where we still need clearer guidance.
Okay. What about biological assets?
Right.
Like, livestock, crops?
Biological assets, that's another area that's really tricky
Yeah.
because of the natural changes in growth.
Right.
Measuring their fair value has been, it's been tough,
Yeah.
especially when you're talking about produce.
Right.
It's constantly changing.
Yeah.
So people are really looking for more guidance on that.
And then finally, what about unquoted equity instruments? These are shares in companies that aren't publicly traded.
Right. So you can't just go look up a market price.
Right. So how do we even start figuring out their fair value?
So for unquoted instruments, you often use what are called comparable company valuation multiples.
Okay.
Basically, you look at public companies that are similar to the unquoted one.
Okay.
Same industry, business model, size, all that.
Right.
And you use their market multiples.
Yeah.
Things like price to earnings, enterprise value to EBITDA.
Yeah.
You apply those to the unquoted company's financials,
Okay.
but you also have to make adjustments.
Right.
You have to discount for the lack of liquidity
Yeah.
because it's harder to sell shares in a private company.
Right.
And you might have to discount for lack of control if you only have a minority interest.
Right. So if I don't have the ability to make big decisions,
Right.
then my stake is less valuable.
Exactly. And imagine trying to value a tech startup that isn't even profitable yet. Finding comparable companies, figuring out the right discounts for all the risks.
Yeah.
That's where it gets really judgment intensive.
So this is where those core principles of IFRS 13, the fair value hierarchy,
They all come into play.
all that really comes into play.
Absolutely.
Okay. We've covered so much ground today.
We have.
To wrap it all up, what's been the overall impact of IFRS 13 since it came out?
So the European Financial Reporting Advisory Group, EFRAG,
Okay.
they did an assessment and concluded that IFRS 13 is probably neutral in terms of costs for users,
Okay.
but it's improved consistency
Yeah.
and how people understand fair value measurements
Right.
across different companies and industries. Now, they do acknowledge that some entities probably had some upfront costs,
Right.
changing their systems,
Mhm.
getting everything in line with the new requirements.
Yeah.
But the big benefit is comparability,
Right.
transparency,
Right.
and giving people the information they need to make decisions.
Yeah.
And most people agree that that outweighs those initial costs.
So it's kind of like a trade-off, right?
It is.
We're getting a more standardized,
Yeah.
market-reflective view,
Yeah.
even if it takes some work to get there.
Fair value measurement is a complex topic, but it's a really crucial part of modern financial reporting.
Yeah.
It tries to capture what those assets and liabilities are actually worth in the market
Right.
at a specific point in time.
And it really highlights, how important it is to understand that hierarchy of inputs
Absolutely, yeah.
and all the judgment calls
Yeah.
that can go into those level 3 valuations.
Especially level 3.
So here's something to think about for all our listeners out there.
Right.
Given how much judgment is involved in this,
Yeah.
especially for those assets and liabilities that aren't traded all the time,
Right.
how confident can investors really be in these fair values that are reported?
That's the big question.
What are the questions they should be asking companies, auditors, and even themselves to make sure that those fair values are reliable and really reflect what's going on?
Because transparency, good auditing,
Yeah.
strong corporate governance, those are all essential
Yeah.
to making sure that those fair value measurements are credible.
Definitely something to keep in mind as you're looking through those financial statements.
Absolutely.
All right. Thanks for joining us on the deep dive.
Always a pleasure.
We'll see you next time.
See you then. All right. Ready to dive in. Today, we're tackling a set of documents that you, our wonderful listeners, specifically flagged for us.
Yeah, these look pretty interesting.
They all revolve around, well, a very specific corner of financial reporting, and it gets, well, kind of complex.
You're not kidding.
We're talking about IFRS 14.
Regulatory deferral accounts.
That's the one. We've got all the official IFRS foundation materials, of course.
We've also got some really useful supplementary notes from BDO. Always appreciate their insights.
Absolutely. And let's not forget the feedback from EFROG. Got to have that European perspective.
Oh, and they even threw in the Hong Kong-specific version, HKFRS 14. Makes you wonder how much variation is out there.
Right. So our mission, should we choose to accept it, is to really unpack what all this tells us about, well, a tricky accounting problem.
And it's a problem faced by any industry where a regulator steps in and sets the prices.
Think utilities. You know, your gas, electricity, that sort of thing.
Essential services, often with limited competition, and that's where the accounting fund begins, right?
Exactly. Because then you've got this tension. How do you balance, rock-solid accounting principles with the real-world economics of a sector where the prices are, well, essentially dictated?
It's a fascinating dilemma, and at the very heart of this whole puzzle, you've got these things called, the documents keep mentioning them, regulatory deferral account balances.
That's right. So in plain English, what are we even talking about?
Stripped down, they're expenses or income items, things that under normal accounting wouldn't be assets or liabilities.
Okay, so what makes them so special in these rate-regulated industries? Why do they get, a different set of rules?
It all boils down to, the rate regulation itself. You've got this governing body, right?
Yeah.
They come in and say, this is the price you can charge for your goods or services. And as we said, often it's for those essential services where you don't have a ton of competition. Now, because the regulator considers or is expected to consider certain costs or revenues when setting future rates, these items get deferred.
Deferred, meaning?
It's a timing mismatch. The cost might be incurred or the revenue earned now, but it doesn't actually impact the prices customers pay, what the regulator sets until later.
So the accounting is trying to sort of look ahead and reflect those future regulatory decisions. That's interesting. Now, if I remember correctly, this isn't exactly a brand new issue, right? The U.S. accounting standards have been dealing with this for quite a while.
You're spot on. What's really interesting here is that U.S. GAAP has recognized the economic impact of rate regulation for decades, going all the way back to the 1960s. And they formalized it with SFAS 71 back in 1982.
Wow, so a while ago.
Yeah, and in a lot of other parts of the world where there weren't specific rules, companies often looked to the U.S. approach. And these regulatory deferral accounts, they'd often end up categorized within property, plant, and equipment, sometimes as separate items on the balance sheet.
So the U.S. had a well-trodden path. What about IFRS? Do they just, follow suit?
Not quite. So fast forward to the mid-2000s, and the IFRS Interpretations Committee, they start getting questions. People asking, can we just apply that U.S. approach under IFRS?
Makes sense to ask, right?
Sure, but after a lot of thought, they concluded that the way SFAS 71 recognized things, it didn't really line up with how IFRS works, the core principles.
Interesting. So a clear difference of opinion there. So why did the IASB eventually decide to tackle this whole issue? It must have been pretty important to get their attention.
It was. So in 2008, another request came in, people still wanting clarity. And this time, the IASB added a project on rate-regulated activities to their agenda. They even released an exposure draft in 2009, putting their ideas out there.
So progress.
Well, the responses they got really highlighted some fundamental disagreements. People had very different views on what these regulatory deferral accounts actually represented from an accounting point of view. It was a real conceptual sticking point. And, the project stalled. They had to suspend it.
So a roadblock.
Yeah.
So how did we get from there to IFRS 14? It seems like a step forward.
It was. The IASB realized that this lack of clear guidance was a huge problem for some entities switching over to IFRS, especially those who were already using regulatory deferral accounts under their old accounting standards.
Right, so we had a system that worked, and then...
Exactly. So in late 2012, they decided on an interim solution, a temporary bridge. That's IFRS 14. It let these first-time adopters stick with their existing practices while the IASB worked on a more comprehensive, long-term solution.
So IFRS 14. It's like a placeholder.
Yeah.
Temporary fix. But who exactly gets to use it? It's not a free-for-all, right?
You got it. It's specifically for entities adopting IFRS for the very first time, and only if they were already recognizing these regulatory deferral accounts under their old GAAP. They essentially get a pass, an exemption from the usual rule in IAS 8, which says you got to be consistent with your accounting policies.
So it's like, okay, we know this is tricky, so if you were already doing this, keep doing it for now.
Exactly, but, and this is important, if you're already using IFRS and not recognizing these balances, IFRS 14 doesn't change that. You can't suddenly start using it.
Gotcha. So very targeted allowance. Now, something that struck me, the standard uses this very specific phrase, regulatory deferral account balances. Why not just call them assets or liabilities? Seems simpler.
That wording, it's deliberate. There's still a lot of debate about whether these things truly meet the definitions of assets or liabilities under the IASB's conceptual framework.
Oh, so it's like they don't really fit neatly into either box.
Right, so they use this neutral term. It acknowledges that uncertainty. And actually, that's one of the key issues the ongoing comprehensive project is trying to figure out. What are these things?
So the name itself reflects this unsolved puzzle. That's clever. Now, even if companies can keep using their old ways to recognize these balances, IFRS 14 does get very specific about how they present them in their financial statements. Can you walk us through that?
Absolutely. So while recognition and measurement might follow the previous GAAP, the presentation, that's where IFRS 14 gets prescriptive.
Lay down the law.
Exactly. You have to present the total of all debit balances and the total of all credit balances for these accounts separately. And they have to be distinct line items on the statement of financial position. No more hiding them within other categories.
No more blending in?
Nope. The goal is transparency. And the same goes for changes in these balances during the reporting period. They need to be presented separately in the profit or loss statement and other comprehensive income.
So users can clearly see the impact of rate regulation.
Exactly. And IFRS 14 even provides examples of how this presentation should look in practice.
Handy. Now, what about companies trying to game the system? Could a company that wasn't recognizing these balances before suddenly switch their accounting policies under IFRS 14 to start doing so?
That's a sharp question. IFRS 14 closes that loophole. You can't change accounting policies just to start recognizing these balances. Any change has to result in financial statements that are more relevant and no less reliable, or vice versa. And of course, it has to follow the rules in IAS 8.
So no sneaky moves.
Nope. It's about consistency, not creating new opportunities for recognition.
Makes sense. Now, how does IFRS 14 fit in with other IFRS standards? Does it just exist in its own little bubble?
Not at all. Even with the allowance to continue using previous GAAP, other standards still apply. For example, if a company has rate-regulated activities in a foreign country, IAS 21, which deals with foreign exchange rates, will determine how they translate those balances.
So currency fluctuations still need to be accounted for. What about things like earnings per share?
Great point. Companies using IFRS 14 have to present additional earnings per share figures. These figures exclude the net movement in regulatory deferral accounts. And, importantly, they have to be presented with the same level of prominence as the regular EPS figures.
So a more normalized view of earnings without the regulatory adjustments.
Precisely. And then you have business combinations. Under IFRS 3, if an acquirer using IFRS 14 buys a company, they continue using their own previous GAAP for any regulatory deferral accounts they acquire.
Consistency within the group.
Right.
Yeah.
And the basis for conclusions clarifies that if the acquirer doesn't recognize these accounts under IFRS 14 and they buy a company that does, they can't start recognizing those acquired balances. The acquirer's policy wins.
Interesting. So consistent policies are key across the board. Consolidated statements, IFRS 10, investments in associates, IAS at 28, even when you lose control of a subsidiary, IFRS 12. IFRS 14 really touches a lot of areas. Now, beyond just the numbers, what about disclosure? What kind of information do companies have to provide about these balances?
Disclosure is huge in IFRS 14. The idea is to give users enough information to understand the company's rate-regulated activities, the risks involved, and how it all affects their financial performance.
So painting a complete picture.
Exactly. They have to describe the rate-regulated activities, explain the rate-setting process, and identify the rate regulator. And they need to disclose any related party relationships with the regulator.
Transparency is key.
Absolutely. They also have to explain how future recovery or reversal of these balances might be affected by risks and uncertainties, like changes in demand, future regulatory changes, market risks, that kind of thing.
So not just a snapshot, but a look ahead too.
Right. And they usually have to provide a table reconciling the movements in these accounts. It shows how they've changed over time.
Very comprehensive.
Now, let's talk about why the IASB issued IFRS 14 in the first place. The basis for conclusions document, it sheds some light on their thinking.
Right.
Especially since it's just an interim standard.
Yes, it does. One of the main reasons was to make the transition to IFRS smoother for first-time adopters. They didn't want companies to have to suddenly de-recognize balances they'd been accounting for legitimately under their old standards.
So a practical consideration.
Right. It was also seen as a way to encourage wider adoption of IFRS, which, in theory, improves comparability globally.
Even if it meant some temporary inconsistencies.
Exactly. But, and this is important, there were dissenting opinions within the IASB. Not everyone agreed with issuing IFRS 14.
That's interesting. What were their concerns?
Well, some were worried about comparability. They argued that allowing continued use of previous GAAP would create inconsistencies within IFRS. They were also worried about setting a precedent for using these sorts of interim solutions whenever a big project ran into trouble.
So a slippery slope argument.
Yeah. And some fundamentally disagreed with the recognition of these balances. They argued that not all of them meet the definitions of assets or liabilities under the conceptual framework.
A clash of principles.
Right. They felt that IFRS 14 was giving too much weight to the goals of regulators, potentially at the expense of fair financial reporting.
So a very fundamental debate about the nature of these accounts and their place in the financial statements. Now, we've mentioned that IFRS 14 is temporary. What's the latest on the IASB's comprehensive project on rate-regulated activities? Any idea when we might see a more permanent solution?
The IASB is still actively working on that. They're gathering feedback from all over, including from national standard setters and companies. They're looking at different accounting models and wrestling with that core question, do these balances really fit the definitions of assets and liabilities?
Tough question.
It is. And the feedback from EFRAG, for instance, they stress the importance of having a rate-setting framework that establishes enforceable rights and obligations, and they lean towards a revenue-based approach, though they do see a potential role for cost deferral in certain situations.
So lots of different viewpoints to consider.
Absolutely. It's a work in progress.
So what does all this mean for our listeners? We've gone through a lot of detail.
It's been a deep dive, but I think IFRS 14 really highlights the complexity of financial reporting in regulated industries. It shows how standard setters try to balance principles with practical realities. And these regulatory deferral accounts, they really highlight the unique challenges that rate regulation can create for accounting.
And the fact that IFRS 14 is an interim standard shows that this is an area that's still evolving.
Exactly. And those dissenting opinions. They're a reminder that there are still fundamental disagreements about these accounts and how they should be treated. It's a nuanced area, lots of debate, even among the experts.
Definitely food for thought. What might the future hold for utility companies and other regulated entities?
That's the million-dollar question. Will we get clearer definitions of regulatory assets and liabilities under IFRS? And how will that impact comparability?
Big questions.
Huge. It's a development worth watching.
Absolutely. For now, IFRS 14 provides a framework. Temporary though it may be, it lets certain companies keep doing what they were doing, but with more transparency.
And that's a good reminder that accounting standards, they're not set in stone. They change, they adapt, they respond to new challenges.
It's a dynamic field. So we've just scratched the surface here. But hopefully this deep dive has given you a better understanding of IFRS 14 and this fascinating corner of accounting.
And what really got you thinking? What other questions do you have about accounting for rate-regulated activities? We'd love to hear your thoughts. Keep exploring those source materials. And remember, accounting, it's not just about numbers. It's about telling a story. And sometimes that story is pretty complicated.
And on that note, we'll wrap things up. Thanks for joining us on this deep dive.
Until next time.
Bye for now.
All right, welcome to the deep dive. Today, we're going deep on, well, it might seem kind of dry on the surface, but it's actually super important. IFRS 15, revenue from contracts with customers.
Yeah, IFRS 15.
Basically, the rules around when companies can actually say, we've earned this revenue.
Yeah, absolutely. This is the framework, right? Like so many businesses, different industries, different countries, everyone's going to be on the same page for how they report revenue.
Consistency, comparability.
Yeah, exactly. Brings clarity to the top line of a company's financials.
Okay, so for this deep dive, we've pulled together a bunch of stuff. We've got, the actual IFRS 15 standard itself. We've got implementation guides, expert analyses, and even some post-implementation reviews to see how this is all played out in practice.
Right.
So the mission here is to really, distill the core principles and the practical implications, right? Like, how does this actually affect businesses? What does it mean for them?
Yeah, how do they apply it day to day?
Right, exactly. And we're going to try to do it without getting bogged down in, all the technical jargon.
Right. Yeah, let's make this practical.
So IFRS 15, it follows this 5-step model. We're going to walk through all the steps, right? Like, first, how do we even identify a contract under IFRS 15? Then how do we figure out what the companies actually promised to deliver? That's the performance obligations.
Right.
Then determining the transaction price, like how much money's involved, allocating that price to the different performance obligations, and then finally the big one, recognizing that revenue.
Yeah, when can they actually say they earned it?
Exactly. We'll also touch on some of the more specific areas like contract costs, variable consideration, and licenses, which can get a bit tricky.
Yeah, licenses are always fun.
Okay, so let's start at the very beginning. What makes a contract under IFRS 15? Is it more than just, a signed piece of paper?
Yeah, so at the core, it's an agreement.
Right.
It creates enforceable rights and obligations between parties.
Legally enforceable.
Yeah, exactly.
Yeah.
So it doesn't have to be just that formal written document. It could be oral. It could even be implied by customary business practices. You go to the coffee shop every morning.
Oh, interesting. So like a regular pattern can create a contract.
Yeah, that routine can be enough.
Okay, so no signature required in some cases. But for IFRS 15 to actually kick in, are there specific criteria?
Yeah, for sure. So it has to be approved by all the parties involved. Everyone's got to be on board. Those rights and payment terms, they got to be clearly spelled out.
Yeah, know who gets what and when.
Exactly right. And there has to be this commercial substance, as they call it.
Commercial substance. What does that actually mean?
Basically, it means the contract will actually change the company's future cash flows. Like the amount, the timing, the risk. It can't just be theoretical.
Makes sense. Has to have some real-world impact.
Right. And the company also has to believe that they'll actually collect the money they're owed.
Oh, right. Probable collection. And I remember reading that even like potential discounts and stuff need to be considered here.
Yeah, exactly. So when they're assessing that probable collection, they have to consider things like their past practices. If they always give discounts or price concessions,
They got to factor that in.
yeah, they have to bake that into their initial assessment of how much they'll actually collect.
Okay, so no inflating that initial price tag. Now, what about situations where, let's say, either party can just back out of the deal? Does that even count as a contract under IFRS 15?
Generally, no. IFRS 15 says if either party can just terminate it unilaterally, walk away without any penalty.
Without any consequences?
Yeah, then it's not really a contract in the IFRS 15 sense.
So those rights and obligations have to be enforceable. Okay, that makes sense. Now, what about when a company makes multiple deals with the same customer, let's say around the same time? Are those always treated separately?
Not necessarily. IFRS 15 has rules for when multiple contracts, especially those made close together, should actually be viewed as one combined contract.
Oh, interesting. So, like, when would that happen?
Well, if they were all part of one big negotiation, right? Like a package deal. Or if the price in one depends on the other, or if those goods and services promised across all the contracts, they all kind of blend together into one performance obligation from the customer's perspective.
Yeah, like buying a new car, you might also buy the extended warranty, the service package, all at the same time.
Exactly. It's all part of that one big decision.
Feels like one transaction. Okay, so we've established what the contract is. Now we need to figure out what's actually being promised, right? And that's where the performance obligations come in.
Exactly. A performance obligation is a promise within the contract to transfer something distinct to the customer.
A distinct good or service.
Yeah, or it could be a series of goods or services,
Yeah.
but they have to be substantially the same and have that same pattern of transfer.
Okay. Distinct seems like a key word here. How do we know if something is distinct?
So it has to meet two criteria.
Well,
First, the customer can benefit from it on its own, or with other resources that are readily available to them,
readily available meaning.
meaning things they could buy separately, or things they already have, or could easily get. And second, that promise to transfer that good or service, it has to be separately identifiable from other promises in the contract.
So not so intertwined that they're basically one thing.
Exactly. Like if a company sells a piece of equipment and also offers training on how to use it,
Those are probably separate.
Probably, yeah.
Yeah.
The customer could benefit from the equipment even without the training. They could find training elsewhere.
Right. But are there cases where it's less clear-cut?
Oh, absolutely. Imagine some highly specialized piece of medical equipment, right? And it needs specific software, a unique installation process that only the seller can do. In that case, it's also interdependent that it might be considered a single performance obligation.
Because the customer can't really use the equipment without those other pieces.
Right, it's one package deal.
Okay, what about longer-term contracts, like in construction or ongoing IT support? Could those be single performance obligations too?
For sure. Like if a company's building an entire bridge, that's usually a single performance obligation. Even though there are lots of components and services involved, the customer wants that completed bridge.
The end result is what matters.
Exactly. Same with a multi-year IT support contract. It might be a bunch of similar services over time, but it's ultimately fulfilling that one need for ongoing support.
So it's about understanding the big picture, the customer's ultimate goal. And I remember reading that it's not just about what's explicitly written in the contract, right? There's this idea of implied promises.
Oh yeah, that's important. Companies have to consider not just the written stuff, but also any implicit promises.
Yeah.
Things that create a reasonable expectation with the customer. Like if a software company always provides free updates,
Even if it's not in the contract.
even if it's not explicitly stated, that could be seen as an implied performance obligation.
Okay, so really understanding the entire arrangement, what the customer is reasonably expecting. All right, so we've got the contract, we've broken it down into performance obligations. Now we get to the part everyone cares about, the money. How do we determine the transaction price under IFRS 15? It seems like it can be more than just the listed price, right?
Yeah, it's not always straightforward. The transaction price is the consideration a company expects to receive in exchange for transferring those goods or services. And that includes not just fixed amounts in the contract.
But also something called variable consideration.
Right, variable consideration.
Variable consideration. What falls under that?
Think discounts, rebates, refunds, bonuses, penalties, anything that can change the final amount. Even non-cash consideration.
Non-cash. Like, what does that mean?
Like if the customer pays with goods or services instead of money. Bartering, basically.
Oh, interesting. Okay, so if a company offers a volume discount, they can't just assume everyone will qualify and recognize the full price.
No, they have to estimate how much of a discount they'll realistically give.
And IFRS 15, does it give any guidance on how to do that?
It does. There are a couple of methods. One is the expected value method.
Which is?
Basically, you weigh the probabilities of different outcomes. Like, how likely is it that a customer will buy enough to get a 10% discount versus a 20% discount?
Okay. And the other method?
The other one's the most likely amount. That's just the single outcome you think is most probable.
So they pick the method they think is most accurate, and they have to stick with it for similar contracts? Consistency?
Exactly. But what happens if there's a lot of uncertainty around that estimate? Can they just book the whole amount right away?
Good question.
That's where this idea of a constraint comes in.
A constraint.
Yeah, on variable consideration. Basically, they can only recognize revenue to the extent it's highly probable a significant reversal won't happen later.
Highly probable. That's pretty cautious.
It is. It's to prevent companies from jumping the gun, recognizing revenue they might have to adjust later.
So, like, if they don't meet performance targets or customers return a bunch of goods?
Exactly. The recognized revenue has to be reliable. Now, what about when a company pays consideration to the customer?
Okay, yeah, like when a retailer charges a supplier a fee to stock their products.
Right, those slotting fees. That usually reduces the transaction price unless the company's getting a distinct good or service in return.
So in the slotting fee example, the supplier's revenue would be reduced by that fee.
Right, because they're essentially paying for shelf space.
Makes sense. And I remember reading about the time value of money, too. When does that come into play?
So if there's a significant delay between when goods or services are transferred and when payment is received, and that delay provides a benefit of financing to either the customer or the company.
Like if a customer gets years to pay for a big piece of machinery.
Exactly. Then that promised amount of consideration needs to be adjusted to reflect the time value of money.
To reflect what the cash selling price would have been. So the revenue recognized up front would be lower.
Right, to account for that interest element.
Yeah.
However, there's a simplification for contracts with a duration of 1 year or less.
Oh, okay.
They don't have to make this adjustment.
Yeah.
For the longer ones where it's needed, they use the discount rate that would apply in a separate financing transaction. and it's set at the beginning of the contract.
No updating as time goes on.
Nope, it's locked in. All right, so we've identified the contract, the
Yeah.
performance obligations, figured out the transaction price. Next up, allocating that price to each of those obligations.
How do we do that?
We use the standalone selling price.
Which is the price the company would charge if they sold that good or service separately.
Right, exactly. Sometimes they can directly observe this, but often they need to estimate it.
And how do they do that?
Well, there are a few methods. One is adjusted market assessment. Look at what similar things are selling for and adjust accordingly.
Makes sense. What else?
There's the expected cost plus a margin approach. Figure out your costs, add a reasonable profit margin.
Okay, so those are kind of based on market data or internal cost data.
Right. And then there's the residual approach, but that's only used in specific situations.
When?
When the standalone selling price is really uncertain, it's basically taking the total transaction price, subtracting the standalone prices of the other things in the contract, and whatever's left is allocated to the uncertain item.
Okay, so they're trying to assign a fair value to each promise. What about discounts? If there's an overall discount on a bundle, does that just get applied to one item?
Usually it's allocated proportionally to all the performance obligations based on their standalone selling prices.
So it's spread out.
Yeah, unless there's clear evidence the discount relates specifically to certain obligations.
Like a promotion on a specific product.
Exactly. And the same logic applies to variable consideration. If it relates to a specific part of the contract, it can be allocated just to that part.
As long as it meets certain conditions.
Right. It has to be directly tied to the satisfaction of those obligations. And it has to reflect what the company expects to be entitled to, like a performance bonus for hitting a certain milestone.
Makes sense. Okay, we've reached the final stage. We've identified the contract, the performance obligations, determined the transaction price, allocated it. Now, recognizing the revenue.
The moment of truth.
Exactly. So this happens when or as the company satisfies each performance obligation.
And that means transferring control of the good or service to the customer.
Okay, control seems like a big deal here. What does it actually mean?
Control means the customer has the ability to direct the use of the asset and get substantially all the remaining benefits from it.
And benefits means?
The potential cash flows, basically.
Yeah.
Whether from using, consuming, selling, or exchanging the asset.
So who gets to how it's used and who reaps the rewards? What are some signs that control has transferred?
Well, there are a few indicators. Does the customer have present right to payment? Has legal title transferred? Do they have physical possession? Have the risks and rewards of ownership transferred? And have they accepted the asset?
So for a simple sale of a product, control usually transfers when the customer takes possession.
Generally, yeah. But it always depends on the contract. Control could transfer upon shipment, upon delivery, to a warehouse. It varies.
Now, not all revenue is recognized at one time, right?
Yeah.
Sometimes it's recognized over time. When does that happen?
Yeah, that happens when one of three criteria are met. First, if the customer simultaneously receives and consumes the benefits as the company performs.
Like a monthly subscription service.
Exactly. Second, if the performance creates or enhances an asset that the customer controls as it's being created.
Like constructing a building on the customer's land?
Right. And third, if the performance doesn't create an asset with an alternative use for the company, and the company has a right to payment for work completed to date.
Okay, that's pretty specific.
It is.
Yeah.
So for revenue recognized over time, how do they measure progress?
Yeah, how do they know how much to recognize at each point?
There are output methods and input methods.
Output versus input.
Yeah. Output methods look at direct measurements of the value transferred, like milestones achieved, units produced, things like that. Input methods look at the company's efforts, costs incurred, labor hours.
So it depends on what best reflects the transfer of control.
Exactly. For a service contract, labor hours might be good. For construction, milestones might be better.
Makes sense. Okay, let's talk about some of the trickier areas. Licensing of intellectual property seems complex. How does that work?
Yeah, it's a bit more nuanced. The key is whether the license is a right to access the IP over time or a right to use the IP as it exists at a point in time.
Okay, so access versus use.
Right. Access usually means the company's ongoing activities will impact the IP, like software updates, brand support.
So revenue's recognized over time.
Usually, yeah. Use means the customer uses the IP as is, like a patent for an invention. So revenue is usually recognized at a point in time.
And what about royalties?
Royalties based on the customer's sales or usage are recognized when those sales or usage happen.
Makes sense. What about sales with a right of return? That's pretty common.
Right. So they recognize revenue for a product they expect won't be returned. They also set up a refund liability for expected returns.
And an asset for the right to recover those returned products.
Exactly. And what about bill and hold arrangements?
That's when the customer buys goods, but the seller keeps holding them.
Right. For revenue recognition there, the customer has to specifically request it. There has to be a valid business reason. The goods have to be identified as belonging to the customer, and the seller can't use them for anything else.
So it's pretty strict. Okay, now let's talk about the costs involved in all this. How does IFRS 15 handle contract costs?
So there are costs to get a contract and costs to fulfill a contract. Incremental costs of obtaining a contract, like sales commissions.
Those are treated differently.
They are. Those costs are recognized as an asset if the company expects to recover them. Costs to fulfill a contract are capitalized as an asset if they relate directly to the contract, generate resources for future performance obligations, and are expected to be recovered.
So they're spread out over the contract's life.
Generally, yeah. Amortized and expensed as the related revenue is recognized. Now, IFRS 15 has been around for a bit. How did companies transition to this new standard?
Yeah, what was that process like?
They had a couple options. They could apply it retrospectively, restate their prior financials as if they'd always used IFRS 15.
That sounds like a lot of work.
It could be. Or they could use a modified retrospective approach, recognize the cumulative effect as an adjustment to their opening retained earnings.
Okay, so a bit simpler.
Yeah. And there were some optional simplifications for certain types of contracts.
And what about the ongoing reporting? What do companies have to disclose about their revenue under IFRS 15?
They had to disclose quite a bit. It's all about helping users understand the nature, amount, timing, and uncertainty of their revenue.
So a lot of transparency.
Exactly. They break down revenue into categories, talk about performance obligations, judgments made, and assets recognized for contract costs.
Enough detail to be helpful, but not overwhelming.
Right, that's the goal. Now, how does IFRS 15 fit with other accounting standards? Does it cover everything?
Good question.
It has a broad scope, but it excludes some things that are covered by other IFRS standards. Leases, insurance contracts, financial instruments.
Those are separate.
Yeah. And if a contract has elements under both IFRS 15 and another standard, there's guidance on how to handle that.
Okay, so it's all interconnected.
It is.
We've really covered a lot of ground today. IFRS 15, it's clearly a fundamental standard for understanding a company's financial performance.
It really is.
And it sounds like the reviews have been pretty positive, bringing more clarity and comparability to revenue reporting.
That's the goal. A consistent approach globally.
So, to recap, the 5-step model. Identify the contract, identify the performance obligations, determine the transaction price, allocate that price, and recognize the revenue.
Right.
Each step requires careful analysis of the specific contract.
Absolutely.
And when you think about it, IFRS 15 really highlights how much a company's industry and their specific deals with customers shape their revenue recognition. It's not one size fits all.
Definitely not.
So here's something to ponder. Think about a software company with cloud subscriptions versus a retailer selling physical goods, or a construction company versus a consulting firm. How would their revenue recognition patterns differ under IFRS 15? This deep dive should give you a good starting point for thinking through those kinds of scenarios. Thanks for joining us as we navigated the world of IFRS 15.
Thanks for having me. Ever stop to think how many companies out there rely on stuff they don't even own?
You know, like all those delivery trucks we see on the roads every day.
Yeah, exactly.
Yeah.
Or the machines keeping a factory running. Heck, even the very buildings businesses operate from. Leasing, it's kind of a big deal, right?
Absolutely. It's woven into the fabric of so many industries. But what's interesting is, for a long time, how those leases were accounted for, well, let's just say it didn't always give the clearest picture of a company's financial commitments.
So we're talking about potentially significant financial obligations that weren't exactly front and center in their financial reports. That seems kind of problematic, doesn't it?
It can be. If key financial obligations are tucked away, it makes it tougher to assess a company's true financial position. And that's where our deep dive comes in today. We're tackling IFRS 16 leases. Now, I know, accounting standards might not sound like the most thrilling topic.
Not usually the stuff at dinner party conversations, right?
But bear with me. This isn't just about bean counting, not at all. IFRS 16 represents a pretty major shift in how companies report their assets and liabilities connected to those leases. It actually has tangible effects on how businesses are perceived financially, in the real world.
So this is way more significant than just rearranging numbers behind the scenes. We're talking about changing how we understand a company's financial health.
Exactly. And to really wrap our heads around this, we've got a whole spread of materials in front of us. We've got the official IFRS 16 documents, of course, and analyses of its impact on those all-important financial statements. We've even got insights from some big-name accounting firms on how it's actually being applied out there in the wild.
So our mission, if you will, is to cut through the technical jargon and really get to the heart of what matters. We want to equip you with a solid understanding of IFRS 16's core principles and, most importantly, why it should matter to anyone who's, looking into companies' financials. No need to drown in accounting speak here. We'll keep it nice and accessible. So let's jump right in. What would you say is the single biggest change IFRS 16 brought about for companies that lease assets?
Well, the most significant impact is definitely on the lessees, the companies doing the leasing. The previous standard, IAS 17, you see, it drew a distinction between operating leases and finance leases. Now, finance leases, they were viewed as essentially transferring the risks and rewards of ownership, right?
Because they were so similar to actually owning the asset.
Exactly. So they were recorded on the balance sheet, both as assets and liabilities. Operating leases, on the other hand, those were largely kept off the balance sheet, and the payments were just expensed as they happened.
Oh, yeah. I remember hearing about off-balance sheet financing. It always sounded a bit like, well, a way to make those debt figures look a little smaller than they really were.
You're not wrong. And IFRS 16 has essentially done away with this distinction for lessees, though there are a few specific exceptions, which we'll get to later. Now, for most leases, companies are required to recognize a right-of-use asset. Think of it as their right to actually use the leased item, and a corresponding lease liability, which is their obligation to make those lease payments. And both of these go directly on their balance sheet.
So instead of just kind of tucking away those lease obligations, companies now have to acknowledge them right there on their balance sheet. That's got to make a difference in how their financial position looks. Got an example to help illustrate this change, make it a bit more concrete?
Sure, let's imagine a nonprofit, maybe a community transport organization. They enter into a 5-year agreement for, say, 10 vehicles.
Okay, they need those vehicles to actually provide their transport services.
Right. And the contract specifies these particular 10 vehicles. It's very clear. The transport company, they get to decide all the routes, they set the fares, even who qualifies for discounts. And when those vehicles aren't out there on the roads, they're parked at the transport company's depot. The leasing company can't just, swoop in and take them back unless there's a problem with payments. Even if a vehicle needs maintenance, the leasing company has to provide a temporary replacement, same type of vehicle, the whole works.
So even though they don't own the vehicles in the traditional sense, the transport company has real control over how they're used and gets pretty much all the benefit from them.
Exactly. Under IFRS 16, because those specific assets, those 10 vehicles, are clearly identified and the transport company has that control over how they're used, they would recognize an asset representing their right to use those vehicles and a liability for the payments, both on their balance sheet. IFRS 16, it's basically saying, hey, you might be renting these assets, but you got to acknowledge them like you would if you owned them.
Okay, so it's about reflecting the economic reality of the situation. Now, just to highlight the contrast, how would this exact scenario have been treated under the old IAS 17 rules?
Under IAS 17, this would likely have been an operating lease. So the transport company would simply record those lease payments as an expense in their income statement over those 5 years, probably spread out evenly. The 10 vehicles themselves and the big financial commitment they represent wouldn't be clearly visible on the balance sheet. Like a 5-year lease for an office space. Under IAS 17, it was just a monthly rent expense. Now with IFRS 16, that same lease results in a pretty substantial asset and liability right there on the balance sheet.
Oh, okay, that really clarifies how things have changed. So how does IFRS 16 actually define a lease? What are the key things that make a contract fall under these new rules?
The core definition is pretty straightforward. It's a contract that gives someone the right to use an identified asset for a certain period of time in exchange for payment, which they call consideration in the standard.
That identified asset part seems pretty crucial. What makes an asset identified under IFRS 16?
Well, it can be explicitly named in the contract, like our 10 vehicles, but it can also be implicitly defined, not directly spelled out. For example, a company might have the exclusive right to use a specific, physically distinct part of a large warehouse.
So it's like their own dedicated section within the bigger space.
Exactly. That would be an identified asset. Or if a company has the right to, let's say, almost all the capacity of an asset, like a significant portion of a pipeline's throughput, that could qualify too. It's not always about having a specific serial number. It's about having control over a particular resource, you
Oh,
know?
okay, so it's about more than just pointing to a piece of equipment and saying, that's the one. And speaking of control, you mentioned that earlier. What does having control mean in the context of IFRS 16?
Control means the lessee, the one leasing, has two key rights. First, they have the right to obtain substantially all the economic benefits from using the asset. And second, they have the right to direct how and for what purpose the asset is used, you see.
Substantially all economic benefits, that still feels a bit, I don't know, open to interpretation. What does that actually look like in real-world situations?
Yeah, it can be a bit tricky, which is why there's extra guidance in the standard. Think about, let's say, a power purchase agreement. A utility company agrees to buy all the electricity generated by a brand new solar farm for the next 20 years.
Okay,
Uh-huh.
so they're not building or owning the solar farm, but they're buying all the power it generates.
Right. Now, the company that actually owns the solar farm, they might get tax benefits and all that. But the utility company, they receive all the electricity, which is the main economic output, right? And they might even get renewable energy credits for using that green energy. So even though they don't hold the legal title, their right to all that electricity and those potential credits, well, it could suggest that they're the ones getting substantially all the economic benefits from the solar farm.
It's interesting. So even if you don't own it, the benefits you reap can point towards a lease situation. What about that other part of control, the right to direct the use?
That means the lessee has the power to decide how and for what purpose the asset is used throughout the entire lease. Or, even if those decisions were mostly made when the lease started, if the lessee had a big say in those initial decisions, or if they actually operate the asset themselves, or if they design it specifically for their needs, these things can indicate they have that right to direct its use.
Okay, it all comes back to who's really calling the shots on how the asset is used. Now, are there any situations where an asset might seem identified at first glance, but the whole arrangement wouldn't actually be a lease under IFRS 16?
Yes, absolutely. One important exception is if there are what they call substantive supplier substitution rights.
Okay, that sounds a bit complicated.
Essentially, it means that the supplier, the one providing the asset, has the practical ability to replace the asset with a different one, and they would actually benefit financially from doing so. In that case, the customer, the one using the asset, doesn't really have control over a truly identified asset.
It's like they can't be sure they'll have that exact piece of equipment for the whole lease.
Exactly. Imagine a logistics company, right? They contract to use a specific model of truck from a big rental fleet. Now, if that rental company has tons of identical trucks ready to go and could swap out the original truck at any time, maybe to optimize their fleet or whatever, well, the logistics company might not have a lease of that specific truck under IFRS 16. It's all about whether the customer can depend on using that particular asset.
Makes sense. So you figured out that a contract is a lease according to IFRS 16. How do you actually record that in the financial statements at the start of the lease?
That's where we get to what they call initial recognition and measurement. So on the day the lease begins, the lessee recognizes the right of use asset at its cost. And this isn't just about the first lease payment you make, it's a much more comprehensive calculation.
So what all goes into this cost figure?
Well, it includes the initial amount of the lease liability, which they also have to recognize, of course. Plus, any upfront costs the lessee incurs to set up the lease, things like legal fees specifically tied to that lease. And if they made any lease payments before the lease actually started, those get added in too. And even an initial estimate of any costs to dismantle or restore the asset at the end of the lease, if that's part of the deal.
Wow, so it's a really thorough calculation of the initial investment, both upfront cash and those future obligations. Okay, what about the other side of the equation, the lease liability? How do they figure that out at the beginning?
The lease liability is initially measured at the present value of all those future lease payments the lessee will have to make over the entire lease term. This means you have to take each of those future payments and discount it back to its present day value using a specific discount rate. Think of it like, how much money would I need to invest today at a certain interest rate to have enough to cover all those lease payments down the road?
Okay, bringing the future costs back to today's dollars. And what interest rate do you use for that present value calculation?
Ideally, you'd use the interest rate that's built into the lease, what they call the implicit interest rate. This is the rate that balances everything out. It makes the present value of those lease payments and any unguaranteed residual value match up with the fair value of the asset itself, plus any initial direct costs, the lessor, the one leasing out the asset, had. But honestly, a lot of times that implicit rate is hard for the lessee to figure out.
So what do they do then?
They use what's called their incremental borrowing rate. It's
Yeah.
basically the interest rate they would have to pay if they went out and borrowed money to buy a similar asset. They're using their own cost of borrowing as the best estimate, which makes sense from a practical standpoint.
Yeah, it reflects their own creditworthiness.
Yeah.
So when you're calculating the present value of those future lease payments, what exactly counts as a lease payment?
Lease payments include those regular fixed payments, and that also covers what they call in-substance fixed payments. Those are payments that might technically vary a little, but they're pretty much unavoidable. Like if a lease has a minimum payment amount that's almost always exceeded, you see.
So it's not just about the label, it's about the economic reality.
Exactly. You also include variable payments that are linked to an index or a rate, like payments tied to inflation or a market interest rate. And if there's an option for the lessee to buy the asset at the end of the lease, and it's pretty certain they'll do that, then the purchase price is included as a lease payment too. Same thing, if the lease term considers them exercising an option to terminate the lease early, any penalties they'd have to pay for that are also part of the lease payments.
What about things like maintenance or insurance costs that might be bundled into the lease agreement? Do those count as lease payments?
Payments that are specifically for non-lease components, like maintenance or insurance services, those are usually excluded from the lease payments unless the lessee chooses to use a practical expedient to simplify things. So like if you have an office lease and part of the rent covers utilities, ideally you'd try to separate that out if it's priced separately.
Okay, so you're breaking it down into the pure lease cost and any additional services.
Right. But they do have the option to just treat the whole payment as relating to the lease of the office space. And any lease incentives, like a period of free rent, that reduces the overall cost of the right-of-use asset.
Got it. So you've got your initial right-of-use asset and lease liability on balance sheet. How do you account for these in the periods after the lease starts?
That's where subsequent measurement comes in. The right-of-use asset, you typically depreciate that over the shorter of the lease term or the asset's useful life, how long it's economically viable.
So it's like recognizing the gradual decline in the value of that right to use the asset.
Yes, exactly. The depreciation method should reflect how the lessee consumes the asset's benefits. Many times, it ends up being straight-line depreciation, meaning they recognize the same amount of depreciation expense each period.
And what about the lease liability? Does that just stay at its initial present value?
Nope, the lease liability changes over time. You increase its carrying amount to reflect the interest that accrues on the outstanding balance, just like a loan, and you decrease it as the lessee makes those lease payments. So every period you recognize interest expense, it's basically unwinding that discount you applied at the beginning.
So it's like gradually paying down a loan over time. What happens if there are changes to the lease agreement while it's still in effect? Like if the lease term gets extended or the rent goes up because of some index-linked clause?
Those kinds of changes trigger what's called a remeasurement of the lease liability. So if the lease term changes, maybe the lessee decides to use that extension option they weren't sure about before, or if there's a change in the amount they're expected to pay under a residual value guarantee, or if those future payments change because of some index or rate fluctuation, they've got to recalculate that lease liability.
So it's not just about updating the payment schedule in your accounting system. It's about reflecting those changes in the overall liability.
Absolutely. And when they remeasure the lease liability, they make a corresponding adjustment to the carrying amount of the right-of-use asset. The asset and liability are tied together. They have to be adjusted together to reflect any changes in the lease agreement or the underlying economics.
Okay, it's like keeping those two sides of the equation in sync. Now, earlier you mentioned some exceptions to this full-blown balance sheet recognition. Can you remind us what those key exemptions are?
Yes, of course. One is all about how you determine the lease term. This isn't always just the initial non-cancelable period written in the contract. It also includes any periods covered by options to extend or terminate the lease if the lessee is reasonably certain they'll either exercise or not exercise those options.
So you're looking beyond the legal contract to the likely economic reality.
Exactly. Let's say you have a retail company. They lease a store location for 5 years with the option to extend for another 5. Right at the start, they have to figure out if they're reasonably certain they'll take that extension. Things like significant improvements they made to the store, the importance of that location to their business, how well that store has performed in the past, all those things might suggest they're probably going to extend, even if they haven't formally told the lessor.
So it's about making a judgment call based on the available information.
Right. But then let's say their business in that area starts declining. That might change their whole thinking about extending, and they might have to reassess that lease term.
It shows how important that initial assessment and any later reassessments can be. What are those other exemptions you mentioned?
There are exemptions for short-term leases and leases of low-value assets. Short-term leases, those are leases with a term of 12 months or less from the start date. Lessees have the choice to not recognize a right-of-use asset and a lease liability for these. They can simply expense those lease payments over the lease term, kind of like how operating leases were treated under the old rules.
So it's like a simplified approach for those shorter leases?
Yeah, it's a practical option. And the other exemption is for leases of low-value assets. IFRS 16 doesn't give a hard dollar figure for what's considered low value, but they give examples like small IT equipment, things like tablets and PCs, or inexpensive office furniture. They suggest an asset worth around $5,000 or less when new might be considered low value. And this exemption, you can apply it on a lease-by-lease basis.
So if a company leases 10 laptops, each costing $800 new, they could choose to use that exemption for each individual laptop.
That's the idea. It's meant to make things easier for lease agreements that involve assets that aren't really a big deal to the company's overall finances. Remember that practical expedient we talked about earlier? It's not an exemption, but it's another way to simplify things. It lets lessees lump together lease and non-lease parts of a contract and account for them as one big lease component. Like, if an office lease includes stuff like common area maintenance or utilities, they might find it easier to treat the whole payment as a lease payment instead of trying to separate out the cost of those extra services.
So it's all about making life a bit easier for the accountants, right?
To a degree, yeah. But it also aims to provide a faithful representation of the lease arrangement in the financial statements. Now, we've talked a lot about how IFRS 16 impacts lessees. What about the lessors, the companies leasing out those assets? Does IFRS 16 shake things up for them too?
Good question. I'm curious about that as well.
Well, the accounting treatment for lessors is pretty much the same as under the old IAS 17. They still categorize leases as either operating leases or finance leases, based on whether those risks and rewards of ownership are mostly transferred to the lessee.
So no major changes on the lesser side.
Not really. For operating leases, the lessor keeps the asset on their balance sheet and recognizes lease income over the lease term, usually in a straight-line fashion. For finance leases, they take the asset off their balance sheet, recognize a net investment in the lease, which is basically a lease receivable, and recognize interest income over the lease term.
Makes sense. So the big changes and challenges are really on the lessee's side.
That's right. Now, when companies first adopted IFRS 16, did they have to completely rewrite their accounting history, or were there some, transition options?
I'd imagine that applying these new rules retrospectively could be quite a headache.
Yeah, it could. Companies had a choice. They could apply IFRS 16 retrospectively, meaning they'd have to restate their past financial statements as if the new rules had always been there. Or they could use what's called a modified retrospective approach.
So that sounds a bit gentler.
Yeah, it was meant to be a bit easier to manage. They didn't have to restate those comparative periods. Instead, they recognized the overall effect of adopting IFRS 16 as an adjustment to their opening retained earnings at the date they first applied it.
So they basically adjusted their starting point to reflect the new rules.
Right, and with that modified retrospective approach, they had some practical expedients to simplify things even further. They didn't have to reassess every single old contract to see if it contained a lease under the new definition. They could use one discount rate for a bunch of similar leases. They could even rely on their previous assessments of whether a lease would have been considered burdensome under IAS 37.
Sounds like they tried to make the transition as smooth as possible.
Yeah.
So to sum it all up, what's the one key takeaway about IFRS 16 that everyone should remember?
The big picture is this. IFRS 16 has brought most lease obligations out into the open, onto the balance sheet for lessees. This gives us a much clearer and more complete view of a company's financial obligations and the assets they control through leasing.
It's about transparency, isn't it?
Yes, it is. The specific rules can be detailed, but the main idea is to show the economic reality of those leases. It's about the right to use an asset and the obligation to pay for that right.
Well said. So here's something to ponder. Think about a company you're familiar with, maybe one you invest in or one in an industry you follow closely. And imagine they lease a lot of their assets.
How might adopting IFRS 16 have changed their balance sheet? How might investors see their financial health differently now? What new questions would you want to ask when you're looking at their financials?
And if you're really keen to dig deeper, take a look at the financial statements of some publicly traded companies. See how they're presenting their leases under IFRS 16. Those notes to the financial statements, those are often a gold mine of information about their leasing activities, the types of assets they lease, the terms of their agreements, all that good stuff. You could also look at industries that rely heavily on leasing, like airlines, retail, or logistics, and see how IFRS 16 has impacted their financial reporting.
That's great advice. It's all about understanding the nuances, isn't it?
Exactly. IFRS 16, it might seem like an accounting technicality, but it's actually changed the landscape of financial reporting. And understanding its impact can give you a real edge in analyzing a company's financial position.
Thanks so much for taking this deep dive with me. Until next time. Ever get that feeling like you need one of those secret decoder rings, to crack the code of the finance world?
Yeah.
Especially when it comes to insurance, right?
Yeah,
It
totally.
can feel like a whole different language.
Absolutely.
Well, you're not alone. Today, we're diving deep, and I mean deep, into something called IFRS 17. It's this whole new way of looking at how insurance companies handle their finances, their books, the whole shebang. Think of it like, I don't know, like an X-ray, giving you this super clear view of what's really going on with their money behind the scenes.
That's a great analogy. Yeah, IFRS 17, insurance contracts, that's our focus today. Really a complete overhaul of how insurance companies, we're talking globally, have to report how financially sound they are, how well they're doing, the whole 9 yards.
And you might think, okay, sounds like something only accountants would care about. But honestly, getting to the core of what IFRS 17 is all about, why this change was even needed, and what kind of ripple effects it's having, well, that's actually super valuable for anyone who's trying to make sense of the insurance industry, really. We've got a mountain of material here, the official standards, practical guides, industry reports, even some real-world case studies. We've been digging deep, so you don't have to.
Exactly. We want to cut through all the technical mumbo-jumbo and get to the heart of it. Whether you're prepping for, I don't know, a big meeting, trying to understand some article you saw, or you're just curious about the inner workings of international finance, we're breaking this down in a way that respects your time, and hopefully you'll have those aha moments along the way.
So let's jump right in. What is IFRS 17, really? And what were the issues with the old system that made this change so necessary?
Well, IFRS 17 basically replaces this older standard called IFRS 4. And IFRS 4, it had its limitations. It did define, what an insurance contract actually was, but the rules for accounting for those contracts were, well, they were pretty loose.
Because the companies could kind of do their own thing.
Pretty much. So you'd have different companies using totally different approaches, which made it really hard to compare them directly.
Ah, I see. Like trying to compare apples and oranges.
Exactly. And that's where IFRS 17 comes in. The main goal here is to provide information that's more relevant, but also, and this is key, more comparable across the board, different companies, different countries, the whole bit. The idea is to give anyone looking at their financial reports a much clearer, more consistent understanding of where they stand. How much cash they're expecting to get from their insurance contracts in the future and how profitable those contracts are actually going to be.
Okay, that makes sense. Because let's be honest, the financial side of insurance companies, it can feel a bit like a black box sometimes, right?
Yeah. They can be pretty complex beasts. An insurance contract, it's not just one thing. You've got elements that are like a financial product, almost like an investment, right?
Right.
And then you've got elements of a service agreement, where they're promising to cover you if certain events happen. This means they have different ways of making money. There's the profit from the core insurance business itself, we call underwriting profit. Then there might be fees for managing assets in some of their products. And then there's the returns they make on their own investments. IFRS 17 tries to untangle all of that, give us a clearer picture of each of those income streams.
So how does it do that? What are the big fundamental concepts it introduces?
There are two really key ideas at the heart of the IFRS 17 model. One is what we call fulfillment cash flows. This is essentially the current value of all the future obligations the insurance company has under a specific contract, taking into account risk.
Yeah.
So they have to estimate all the cash that's expected to flow in and out, claims payouts, premiums coming in, operational costs, even taxes. And then they have to discount all those future amounts back to today's value, which, money today is worth more than money tomorrow, right?
Right.
And a really crucial part of this is adding an adjustment specifically for the uncertainty in those non-financial risks they're taking on.
Risk adjustment for non-financial risk. Can we unpack that a bit? What kind of uncertainties are we talking about here?
Sure. So we're talking about things like, how many policyholders will actually make a claim, how severe those claims might be, or in the case of life insurance, how long people are going to live.
Right. Those are big unknowns.
Huge unknowns.
Yeah.
So the risk adjustment is basically that extra amount the insurance company needs to hold, kind of like a cushion,
Right.
to compensate for the fact that they're dealing with all this unpredictability.
I see. So it's like putting a price tag on the uncertainty.
Exactly. And then the other key concept is the contractual service margin, or CSM for short. Think of the CSM as the future profit that's baked into a profitable insurance contract, but it hasn't been earned yet.
Okay.
So when an insurer sells a new contract and they expect to make money on it, they don't get to just recognize all that profit up front.
Right.
It's held in the CSM account and is gradually released as the insurance company provides coverage over the life of the policy. It's like recognizing revenue over time as they deliver the service. So for someone like you, observing the industry, this move to recognizing profit over the life of the contract, it suggests that you'll likely see a smoother pattern of earnings reported by insurers,
Yeah.
rather than these potentially big swings from one year to the next that you might have seen under the old rules.
So profitable contracts, they start with a positive CSM, and then that balance gradually goes down as time passes and coverage is provided.
That's it.
What happens with contracts that aren't expected to be profitable right off the bat?
Those are classified as what we call onerous contracts. And with those, there's no CSM at the beginning. Actually, if it looks like a contract is going to cost the insurer more in payouts and expenses than they'll receive in premiums right from the start, they have to recognize that expected loss immediately in their profit and loss statement. It's like, imagine they sell a specific type of policy and then new data comes out and they realize, oh, wow, we're almost guaranteed to lose money on this.
Yeah.
That would likely be considered an onerous contract.
That's a pretty big change in how they handle those potential losses, isn't it?
Yeah, it is.
You mentioned significant insurance risk earlier. Is that the deciding factor, the litmus test for whether a contract even falls under IFRS 17 at all?
It is, yeah. Under IFRS 17, a contract only qualifies as an insurance contract if it involves the transfer of significant insurance risk.
Okay.
So there has to be a real possibility that the insurer will have to pay out a lot more than they've received in premiums because of some future event, something uncertain, that negatively impacts the policyholder.
Could you give us a clear-cut example of what would be considered significant insurance risk?
Of course. A classic example is a life insurance policy with a big death benefit. If the insured person dies unexpectedly, the insurance company has to pay out a substantial sum, way more than the premiums they might have collected up to that point. That's a clear transfer of significant insurance risk. On the flip side, if you have a contract that's mostly an investment, with only a tiny insurance element tacked on, let's say, a death benefit that's barely more than the investment's value, that wouldn't be considered significant insurance risk.
Okay, so what wouldn't be considered an insurance contract under IFRS 17?
Investment contracts that don't have that significant insurance risk element, that's a big one.
Right.
Also, a lot of service contracts where the main thing is to provide a service for a fixed fee, even if there's, some small insurance-like aspect to it. Those would probably fall under a different accounting rule, IFRS 15, which deals specifically with revenue from contracts with customers. So think of an extended warranty on, a washing machine.
Okay.
That might be accounted for under IFRS 15. There's also a specific case. If a contract caps the compensation for insured events at the amount needed to settle the policyholder's underlying obligation. So like a loan with a death waiver that only covers the outstanding loan amount, the company can choose to account for that under IFRS 17 or IFRS 9, which covers financial instruments.
So there's some wiggle room in certain situations, some judgment calls to be made.
Right.
Now, you talked about groups of insurance contracts.
Yeah.
Why is that grouping so important in IFRS 17? And does this grouping rule have any implications, for someone like me who's trying to compare different insurers' financials?
Grouping is super important because under IFRS 17, the rules aren't applied to each individual contract on its own. Instead, they're applied to a group of contracts that has similar risks and are managed together. These groups are formed when the contracts are first recognized, and you can't just change them later on a whim. The idea is that insurers manage their business in portfolios of similar risks, right? There is a minimum requirement for how fine-grained these portfolios have to be. They have to be divided into what we call annual cohorts, which means all contracts issued in the same calendar year have to be in the same group.
Right.
But there is an exception that some EU-based insurers can use where they might not have to follow the strict annual cohort rule for certain contracts.
Oh.
This came up during the EU's review of the standard. Often, for a higher level of grouping to be okay for CSM measurement under this exemption, all the contracts in the group have to share 100% of their returns.
Okay.
Meaning the insurer isn't really impacted by how each individual contract within that pool performs.
Interesting. Now, how do those onerous contracts we talked about earlier fit into these groups?
Well, onerous contracts, they're treated a bit differently. If a group of contracts is immediately flagged as onerous, a loss is recorded right away in the profit and loss statement, and no CSM is calculated for that group. Then any changes later on in the expected cash flows for those contracts, they're allocated specifically to that initial loss.
Okay, that makes sense. Another term you used was contract boundary. What determines the scope of a contract under IFRS 17? Like if my car insurance automatically renews unless I cancel it, would the potential future premiums and claims for that renewal period be included in the boundary we're talking about?
Yeah, good question. The contract boundary basically decides which future cash flows are included when we're measuring an insurance contract.
Okay.
And this is especially important when a contract has options for future coverage. The key question is, do those options create real substantive rights and obligations for both the policyholder and the insurer? If they do, then those future cash flows related to those options need to be considered part of the current contract boundary. So with your car insurance, if it renews automatically and you have to actively cancel it, that suggests there's a real obligation for the insurer to provide that future coverage, and you have a right to receive it.
Right.
So those future cash flows might be brought into the current boundary. It gets a bit tricky because insurers might need to estimate how likely those renewals are.
Makes sense. It's not just about the initial period of the policy then.
Right.
Now, insurance contracts can sometimes have parts that aren't strictly insurance, like investment components.
Yes.
How does IFRS 17 handle those?
So IFRS 17 has very specific rules for untangling those different pieces of a contract. If there's an investment component that's clearly separate from the insurance part, meaning they're not closely linked and could basically be sold on their own, then that investment component has to be split out and accounted for under IFRS 9, which is the standard for financial instruments. Similarly, if there are promises of distinct goods or services besides insurance, maybe some administrative services that are priced separately, those would be separated and accounted for under IFRS 15, which deals with revenue from contracts with customers. It's important to note that separating insurance components themselves, it's based on the fundamental nature of the contract, not just how the policy is written or choices the policyholder makes. They're really trying to get at the core of that insurance promise.
Right. So they're really trying to get to the heart of the matter,
Exactly.
focusing on the pure insurance element.
Right.
We talked about fulfillment cash flows, and you said the estimates need to be unbiased, reflect current conditions, and be explicit with that risk adjustment separate. What does that mean in practice for insurers?
It means they have to use their best judgment when estimating those future cash flows.
Okay.
They have to look at all the information they have at the time, their reasonable expectations about the future, consider different scenarios, and assign realistic probabilities to each.
Right.
They're not supposed to try and predict future changes in laws or regulations. That only comes into play when those changes are actually enacted. And as we talked about, that risk adjustment for the non-financial risks, that has to be a separate, clearly identifiable part of the calculation.
Got it. What specific cash flows have to be included in these estimates?
It's pretty comprehensive. You've got all the expected claim payouts, including ones that have already been reported and ones that have happened but haven't been reported to the insurer yet.
Okay.
Then you've got all future claims they're obligated to cover under the contracts, the premiums they expect to receive from policyholders, all the costs associated with administering policies and handling claims, any taxes and levies that are directly tied to the insurance contracts, even costs related to providing benefits in kind, not just cash payments.
Wow, that's a lot. And are there any specific cash flows that are not included?
Yes, there are. Investment returns, they're specifically excluded because those are accounted for separately based on the assets the insurer holds. Then there are cash flows related to reinsurance contracts that the insurer has purchased. Those are accounted for under a separate reinsurance asset.
Right.
And lastly, Any cash flows that might come from future insurance contracts, meaning contracts that are outside the boundary of the current policies, those aren't included in the calculations for the existing contracts.
Okay, so it's really about keeping things separate and focused on the specific contracts being measured.
Exactly.
You mentioned discounting those future cash flows,
Yeah.
figuring out the right interest rate to use. The bottom-up and top-down approaches our sources went into, those got pretty technical.
Yeah.
Could you give us the kind of the high-level view of what insurers are trying to achieve there?
Absolutely. Basically, they're trying to find the right interest rate, considering both the time value of money. Money today is worth more than money tomorrow.
Right. Yeah.
And the fact that insurance payouts are less predictable than some other investments. They have to look at how easy it is to turn those insurance liabilities into cash, how the value of money changes over time.
Mhm.
It has to be in line with what we see in market prices for similar financial instruments. There are different ways to do it. Some start with a risk-free rate and add a bit to account for the less liquid nature of insurance liabilities.
Right.
Others look at returns on certain asset portfolios and adjust those.
Okay.
But the main idea is to get a rate that accurately reflects the time value of money and the financial risks involved.
And what about the risk adjustment for those non-financial risks we talked about? You said it's for the uncertainty.
Right.
But IFRS 17 doesn't give one specific way to calculate it, right? So what are some of the approaches companies might use, and does this lack of a single method lead to big differences in how they report?
It's true. IFRS 17 doesn't say you have to calculate it this way, but it does outline some key things it should have. It needs to represent how much the insurer would want to be compensated for taking on that non-financial risk, and it should factor in any diversification benefits they get from having a diverse portfolio of insurance policies. Some common approaches, there's the confidence level approach, where the insurer wants enough capital to meet their obligations with a certain probability.
Okay.
Then there's the cost of capital approach, which considers the return investors expect for taking on the risk. There are also various margin-based approaches, and they can even combine these.
Right.
Because there isn't one set method, different companies can use different approaches, and that can lead to some variation in the reported risk adjustments and potentially impact their financial results.
Okay, so it adds a layer of complexity when comparing different companies.
Yeah, it does.
Now let's delve deeper into the contractual service margin, the
Yeah.
CSM. You called it unearned profit. How is that initial CSM amount determined when a new insurance contract is recognized as profitable?
When a group of contracts is expected to be profitable, the CSM is set to ensure there's no immediate profit recorded in the income statement.
Right.
It's basically the present value of the future net cash inflows expected from the contract minus the risk adjustment. So it's like all the expected profit from those contracts is deferred and recognized as the insurer delivers the coverage. The thinking is that the value created by those profitable contracts is tied to services they'll deliver in the future.
And how does the CSM change over time? What makes it go up or down?
It's adjusted based on changes in those expected future cash flows that relate to future services.
Okay.
So if they revise their estimates of future claims downward, and this change relates to future coverage, that would usually increase the CSM. If expected future costs go up, that would likely decrease the CSM.
Right.
But changes in expected cash flows tied to past events, like claims that have already happened, those don't impact the CSM. Those are recognized directly in the profit and loss statement in the period they relate to.
So the CSM is always looking ahead.
That's right.
When and how is the CSM recognized as profit in the insurer's income statement?
It's released from the balance sheet and recognized as revenue over the period they're providing coverage. This is often done using something called coverage units. A coverage unit is a way of measuring the insurance protection provided by the contract in a given period. The CSM is then released in proportion to how much coverage was provided. If there are differences between what they expected and what actually happened, what we call experience adjustments, those will also impact the insurance revenue they recognize.
Okay.
So, if fewer claims happen than they thought, that would usually lead to a positive experience adjustment, which increases the insurance revenue.
Okay, that makes sense. Let's go back to those onerous contracts.
Yeah.
So they start with no CSM and a loss right away. How are they dealt with after that?
So, if a group is deemed onerous at the beginning, they record a loss, right?
All right.
In the following periods, any changes in the expected future cash flows for those contracts are split between this initial loss component and the remaining liability for the contract. That loss component acts like a buffer.
Okay.
If things improve and the losses are expected to be less, those improvements are used to reduce the loss component until it's gone. Only then would any further improvements potentially lead to a CSM being recognized.
Okay, so it's like a safety net.
Exactly.
Let's switch gears and talk about reinsurance, where one insurance company buys coverage from another. How does IFRS 17 handle those reinsurance contracts?
Reinsurance contracts, where one insurer, called the cedant, offloads some of its risk to another insurer, the reinsurer, those are accounted for separately from the original insurance contracts.
Okay.
That's because the original insurer still has their obligation to the policyholder, even if they have reinsurance.
Right.
The accounting for reinsurance contracts the company buys mirrors the accounting for regular insurance contracts, but with some tweaks. Any cash flows tied to the reinsurance that depend on claims from the original policies are factored into the expected reimbursements. Non-contingent amounts, like upfront commissions, are treated as a reduction in the premiums paid for the reinsurance. There's also a loss recovery component for reinsurance covering onerous contracts.
Okay.
That can lead to a recovery of some of the initial loss on those onerous contracts. One important thing, a reinsurance contract can't be a direct participation contract.
Got it. What about those investment contracts with discretionary participation features, the DPFs? Those sounded kind of like a hybrid.
They are, yeah. Those are investment contracts where the policyholder gets to share in the returns of a certain pool of assets, but the insurer has some say over the amount and timing of those payouts. These don't usually involve significant insurance risks, so typically they wouldn't be insurance contracts under IFRS 17. But if a company issues both regular insurance contracts and these DPF investment contracts, then those DPF contracts do fall under IFRS 17. The general model we've been talking about applies, but with adjustments for their investment-like features. Often, a simplified approach called the variable fee approach is used.
Interesting. How does IFRS 17 mesh with those other accounting standards we've mentioned? IFRS 9 for financial instruments, IFRS 15 for revenue.
There are definite links. We talked about IFRS 15 for separating non-insurance components.
Right.
The big one with IFRS 9 financial instruments is related to the financial assets insurers hold to back their insurance liabilities. IFRS 17 wants to measure those liabilities reflecting current market info. So when you have financial assets measured at fair value through profit or loss under IFRS 9, changes in interest rates, for example, could make the reported profit or loss fluctuate. The way insurance finance income and expenses are recognized under IFRS 17 can sometimes help offset that potential volatility. Companies also get to choose how they present insurance finance income and expenses. They can break it down between profit or loss and OCI, and this is often tied to how they account for those related assets.
So it's all very interconnected.
It is.
IFRS 17 has been in effect for a little while now.
Right.
What kind of impact has it had, and how did the transition go?
Initially, when IFRS 17 came into play, there were some big changes to many companies' balance sheets, especially in life insurance. It was tough to predict exactly how big the impact would be beforehand because insurers had all sorts of different ways of doing things under the old IFRS 4.
Right. They had a lot of freedom.
They did. So the actual impact for each company depended on how different their old way was from the IFRS 17 requirements and the specific transition method they chose.
Okay.
There were some worries about short-term risks to financial stability, especially if huge insurers were significantly affected, but those were generally expected to be manageable with clear communication.
You mentioned different transition methods. What were the main options?
Companies had three main ways to transition. Full retrospective application, meaning they had to restate their financials as if IFRS 17 had always been the rule.
Okay.
A modified retrospective approach, which allowed for some shortcuts because historical data might not be perfect.
Right.
And a fair value approach, which involved figuring out the fair value of insurance contract liabilities at the transition date.
Yeah.
Interestingly, we've seen companies using all three pretty equally.
Implementing something this big must have cost a pretty penny. What did our research say about the costs of transitioning to IFRS 17?
Studies did find that there were significant upfront costs. Things like adapting their systems, handling the separation of risk sharing and investment components, and the sheer amount of work to gather and analyze the necessary data, it all added up.
Yeah.
There was also a sense that those delays in the initial effective date actually drove up costs because companies had to revisit and maybe redo work they'd already done. But a lot of people in the industry felt that beyond just ticking the compliance box, IFRS 17 would bring benefits in the long run. More robust financial reporting, potentially a better understanding of the insurance sector, and more stability overall.
The EU had some specific considerations for IFRS 17, right?
They did, yeah. The EU has its own process for endorsing IFRS 17, and there was quite a bit of discussion, especially about the annual cohort requirement for grouping contracts.
Right.
Some said it was technically sound, others were worried about the practical side of it. In the end, the European Commission did endorse IFRS 17, but they included an optional exemption from that annual cohort rule for certain types of contracts. If a company uses this exemption, they have to disclose that as a significant accounting policy. They don't have to use annual cohorts for those specific contracts, but they still have to apply IFRS 17 when measuring those cash flows, and the CSM is released at a more aggregated level.
So we've seen some early reports under IFRS 17. What are some of the key things we've observed so far?
It's a mixed bag. Some companies reported a higher net profit under IFRS 17 than they would have under the old rules. Many life insurers saw a drop in their opening equity. There was also a lot of variety in how companies chose to apply the standard and the judgments they made.
Right.
And, as we talked about, there were all sorts of different methods used for things like the discount rate and risk adjustment. These early reports are giving us the first real-world glimpses into how this new standard is being used across the industry.
All right, let's sum up this deep dive for our listeners. What are the big takeaways from all this?
Well, IFRS 17 is a major shift in how insurers account for their business. It focuses on using current estimates for future cash flows, recognizing profit gradually through the contractual service margin, and drawing a clear line between insurance and non-insurance elements in their contracts.
Right.
The big goal here is greater transparency and a more accurate picture of how insurance companies are performing financially.
So the aha moment here, the key thing to remember, is that IFRS 17 isn't just some arcane accounting rule. It gives us a much clearer, more consistent way to look at the financial health of insurance companies. By understanding these core principles, you, whether you're following the industry or just have an insurance policy, can better understand their financial reports and what's really happening in the insurance world.
Absolutely. And it's still early days. The full impact of IFRS 17 will continue to unfold.
Given all the choices companies have in implementing IFRS 17 and the initial concerns about its potential impact on financial stability, it really makes you think. How will IFRS 17 shape the insurance industry going forward, and how will it influence our understanding of risk and profitability?
That's the million-dollar question. Making sure this standard is applied consistently and interpreted the same way around the world will be crucial to achieving that greater transparency and comparability in the insurance world.
This has been a deep dive, and I mean deep, into the world of IFRS 17. We hope it's given you a solid understanding of this important new accounting standard. What other parts of financial reporting, or the insurance industry for that matter, are you curious about? Let us know, because that might just be the focus of our next deep dive.